Good morning, Jose. It is 8 o'clock. I haven't seen you this early ever.
Yeah, good morning, Matt, and good morning to all the fools watching. It is definitely early for me, but now with the little one, Matt, I think it, earliness is a must.
That's what changed it for me. I was not a morning person, then I had kids, and now I'm a morning person. I've been up for 4 hours at this point. And I'm on the East Coast. It's not like I live in a weird time zone and this is like noon to me. Um, but good morning. This is, I guess, the pre-morning show. Our theme is today's market news, which I like doing that theme pretty much every day because let's be honest, lately there's a lot of news to cover. Um, so the biggest news story of the day, it has to be the Fed meeting. I know there are some other things. Um, I have a quick kind of recap to put on the screen, but while I'm doing that, so I invest in primarily banks and real estate and rate sensitive stocks. So following the Fed's moves and interest rates are definitely a big part of what I do. But as a technology investor primarily, how much do interest rates play into this?
Mm, I think for me, Matt, as a tech investor, mm, things like this obviously could impact like consumer spending. So at least to understand that there might be some headwinds due to macroeconomic news. But it's more to just understand maybe what are some of the headwinds or tailwinds, depending, that could imply for like the consumer tech. Because some of the stocks that I follow are very kind of consumer tech dependent.
Yeah, that's a really good point. It's more with the tech sector, it's definitely more about consumer demand and consumers' willingness to spend money and the health of the economy, which so if you're not familiar with how Fed meetings work, there are 8 Fed meetings a year. They come. It's too early for me to really do the math, but that's roughly every 9 weeks. Yeah, between 8 and 9 weeks, we get a Fed meeting. Um, I probably no 7 to 8 weeks. I'm totally wrong on that, but it's too early to think. But so there are 8 of them per year, and the reason I bring that up is because there are 4 that go one way and 4 that go the other way. So every other Fed meeting, all you have is the rate decision. You get a statement, you get whether or not the Fed's raising or lowering rates, and then every other meeting you get the Fed's economic projections. It's more of a big deal Fed meeting when you get the economic projections. The Federal Reserve, the voting members, the ones who set the policy, give you their projections of where things like unemployment and interest rates and um, GDP growth are going over the next year, 2 years, 3 years, and over the longer term. So we just got that. So we got a little bit of kind of more insight into what I would say what matters for the broader market more so than just the interest rate decision, because things like the unemployment rate, GDP growth, definitely have a lot more to do with consumer demand and the health of the consumer and the things that affect like who's going to buy the next iPhone from Apple and who's going to, things like that. How much, how many gaming chips NVIDIA is going to sell. I don't know. You probably have better examples than I do for that. But before we dive in, so here is just kind of the general overview. So the headline is that the Fed held interest rates steady. That was widely expected. But like I said, we got a projection. We got economic projections from the Fed members. Um, and here's just kind of a rundown. So I want to just kind of briefly read through these and get kind of Jose's reaction from the like a consumer demand, the health of the economy point of view, because this what's on the screen right now was the real story, not necessarily the fact that the interest rates were held steady. So now the Fed sees GDP, which is just economic growth, significantly slower than they saw last time they gave these projections in December. They see unemployment 0.1% higher. This is all by the end of the year. They see PCE inflation, which is the Fed's preferred inflation gauge, up 0.2% higher than they previously saw it. Core inflation, which excludes volatile prices like energy and housing, they're seeing that 0.3% higher. And they still see, and this kind of came as a surprise, and the last bullet is why the market rallied yesterday. They see the federal funds rate at 3.9% at the end of the year, which implies 2 rate cuts, which there was a question of whether they were going to kind of indicate they were slowing and kind of being on pause. So before we move on, Jose, what's your initial take on this from your investing perspective?
Yeah, so to me, the ones that really kind of stood out to me, Matt, out of the two was the first one, obviously, right? The kind of huge change in GDP versus just a few months ago. And again, I kind of saw some of the top line numbers already, Matt, but I didn't really kind of dig in too much into what was some of the reasoning for the massive changes. Maybe some of the fools might also be in the similar boat, Matt, but did they explain what kind of cause is causing this kind of major change? And to me, the two major ones were bullet point number one, which we saw the huge change in GDP, and also the even though federal fund rates are expected to remain unchanged, we do see kind of core PCE inflation to be much higher for the end of the year than previously expected. So did they kind of give any talking points on why those two kind of saw a massive shift compared to previous?
Yeah, and I'm glad you brought that up because the Fed, along with its economic projections and its interest rate decision, every meeting they issue a statement. There is no document on earth that is more scrutinized word for word than their Federal Reserve statement. Literally, a one word change in wording can move the stock market. If they go from economic activity is soft to softening, that could be a big deal. So generally, the language was toward more uncertainty and more economic softening. We're seeing consumers under pressure for sure. Just this morning, another thing that I noticed when I was looking at the news, Darden restaurants reported lighter than expected sales. So, and they're not the only one. We've seen from like Target and Walmart both saying that, consumers are under pressure. So the statement, I don't want to read the Fed statement word for word because it'll put our audience to sleep, but it generally changed in the direction of more uncertainty and, consumers, the strength of the economy weakening. So the general takeaway from the Fed meeting is, as I said, the Fed's projection implies 2 rate cuts by the end of the year. And one interesting thing is that the markets almost never believe the Fed. There's a handy tool, you can Google this. It's called the CME Fed Watch tool that tells you how many rate cuts traders are pricing into the financial markets. And the latest expectation is a 59% chance for 3 rate cuts or more by the end of the year. There's a 26% chance, I'm looking at it right now, of 4 or more priced into the market. So the market thinks that the Fed is going to be forced to cut rates. Now, a lot of times the Fed can't give its true projections because it doesn't want to scare the market necessarily. The Fed is, they want to maintain an orderly market. But the CME rate cut tool, and actually, let me put that, I have it on the same tab. So Natasha, don't worry, you don't have to change anything. Here it is. The CME Fed Watch tool, on the top, you have a bunch of different dates. These are all the different Fed meetings. So if I look at December, that tells me what is expected by the end of the year. And these are all the different interest rate outcomes that that could happen and are priced into the market. So right now, the federal funds rate's at a target range of 4.25 to 4.5%. And there's only a 1.7% chance priced into the market that the Fed isn't going to do anything. And then you see, as we go down the list, the percentages increase, and the highest percentage chance is 3 rate cuts this year. But there's also a significant chance for 4 rate cuts, 5 rate cuts from the current level. So this really helps you see what 1 rate cut, 2 rate cuts, and all that would look like. And it goes all the way out to 2026, which, I mean, I think any interest rate projections longer than a year are kind of, noise. But so that's the CME Fed Watch tool. Let me go ahead and stop my share real quick. It's a handy tool to kind of let you know whether or not the market believes the Fed, is the best way I can describe why that's useful. And historically, the investors have been more accurate than the Fed. They can kind of sense consumer behavior and things like that. Maybe they're just more honest with, they don't care about spooking the market and things like that. Jerome Powell's really got to, be careful with what he said. Like I said, the Fed statement is the most scrutinized document that I know of in the world.
And Matt, I mean, like you mentioned, this is something that you follow a lot, also mainly because of your investments in banking and financial entities and institutions, when you and you kind of show that CME tool, like we saw right now, it's around 50 something percentage that they believe it's going to do about 3 rate cuts. Around what percentage do you start to say, hey, look, this is what most likely is going to be the outcome?
Uh, the short answer is that I get more confident as we get closer. So if I look at the May projection, there are essentially almost no chance of a rate cut priced in May. I think it's a 17% chance of any rate cut in May. So when we get closer, I tend to put more stock into this. It really is just kind of the market's day-to-day movements are not based on necessarily what's happened. Like, it's not based on what the Fed did yesterday. They left rates the same. It's based on expectations, and not necessarily the expectations that the Fed is feeding us, the expectations of analysts, economists, experts in the market. And this kind of gives you an insight into the expectations, how they're shifting over time. Because another thing, I already stopped my share, but on the bottom you can see what the percentages were now, what they were 1 day ago, what they were 1 week ago, and what they were a month ago. So you could really see how experts' expectations are shifting over time. A month ago, just for example, there was a total of a 19% chance of 3 or more rate cuts. Now, as I mentioned, that's up to 56%. So it's really the shift in expectations over time when you're looking that far out that is most important in my investment thesis. Because banks are very rate sensitive stocks. Real estate is a very rate sensitive sector in 2 different ways. And based on what future interest rate expectations are, I can get a really good sense of what might be happening with them over the next year or so. It's a lot more technical with interest rates than when it comes to things like technology. But so there's my little Fed recap.
If I may, just one more, and then I
Sure.
do see we have a lot of a nice amount of questions coming for this, Matt, that we mostly you could probably tackle. But when I heard you when I asked that question of kind of some of the changes that we saw kind of like with GDP and core PCE inflation, a lot of it was morely just based on uncertainty, right? Uncertainty of what things may play out. So it seems like what I don't know why the first thing it kind of put me into is right now in this past earnings season, especially in the late earnings season, we started to see maybe more companies start to give a little bit more conservative earnings projections for the upcoming quarter. They didn't really say it was because of any weakness. It's just more because of uncertainty that they can't really see what could happen within the next few months in forms of the overall macroeconomics. Is this kind of like maybe what the Fed is doing as well? Is kind of adding a little bit more conservativeness to maybe some of these numbers because of some of the uncertainties happening. So it's not really based on too much data that they have at the moment that's showing this. It's more just the unknown data that they just want to plan forward for the future.
Yeah, I mean, the Fed does what any good manager would do. Any good manager of a company would do. They want to manage their investors' expectations. That's definitely a big part of being a good Federal Reserve chair. Hold on, I'm bringing something up right now, and I like this because this will. Oh, hold on. So I'm trying to find the Fed's projections from the end of 2021 because we all know what happened in 2022, right? Interest rates, more than doubled. The Fed had to, hike interest rates by 5 percentage points or so. So I'm trying to find the projection materials from the end of 2020. I think I got them from the end of 2021. And it's kind of remarkable to show like just how much you really need to take this with a grain of salt. So here's the Fed's expectations. And sorry, Natasha, I am going to share my screen one more time. Let's see. I've gotten really good at sharing my screen without accidentally kicking myself out of the meeting. So this is the federal funds, and I know this is small, so I'm going to talk through the important parts. But this was at the end of 2021. This was the December 2021 Fed meeting. These, and the bottom part right here, the federal funds rate projections. The Fed expected the federal funds rate at the end of 2022 to be 0.9% at that point. Remember, at the end of 2021, interest rates were at 0. Money was essentially free. By the end of 2023, 1.6%. They were about 5.5%. So that's why I say when you see these projections kind of extrapolated out, especially beyond the end of the year, take it with a big grain of salt, because the Fed doesn't know what's going to happen in 2026 or 2027. They don't know what's going to happen next month. There are a lot of things that could happen that could dramatically change interest rates, and force the Fed's hand in cutting rates or raising rates. It's entirely possible as well. Um, you know, we're not out of the woods on inflation just yet, especially with all the tariffs and uncertainty around that going on. We're not out of the woods with inflation. If inflation spikes, the Fed could be forced to raise rates. That's not out of the question. And if the economy really falls into a deep recession, 3 rate cuts could be just a starting point. It's really important to take things with a grain of salt. And if you ever, pull up their end of 2021 projections, if you ever want to see just how accurate they sometimes are not. So hopefully that was, a nice trip down memory lane to zero interest rate times.
Yeah, Matt. So we have a few questions here coming in. I don't know which one. A lot of these obviously have to do right now with the topic we just discussed. So I'm not sure if you want to take any first.
Yeah. So I'll take one real quick, and there's one that's directed toward me from Ed about the trade desk and NVDA. So maybe you could take that one, because I'm not the one you want to ask about NVIDIA. I can tell you that much. All right, so let me start from the beginning. Matt got the first question in of the day. Says, what metrics will you be watching when Boston Omaha reports next week? Boston Omaha is the worst performing stock in my portfolio, as in terms of how much it's worth now versus how much I put into it. It's been a disappointment. The company's execution was kind of terrible over the past couple of years. If you're not familiar with it, one of their co-CEOs abruptly left the business earlier in 2024, and their asset management business, which they had been kind of hyping as the future of the company, really just imploded, didn't gain any traction, and ended up being shut down. The co-CEO who left ended up getting a kind of ridiculous control premium to give up his shares, and it's just really been a big disappointment. The remaining CEO, his name's Adam Peterson, and from what I can tell so far, he's doing a solid job. It's too soon to say whether or not he's going to be successful in turning the company around and really getting back to the heart of the business and focusing on the 3 core businesses that they originally were focusing on: insurance, billboards, and broadband infrastructure. But he's taking all the right steps. He's doing a little bit of a better job communicating with shareholders. I wish he would do an even better job. You don't get any interim updates. You have to wait right now. What is it? It's almost April, and we haven't heard their fourth quarter earnings yet. That's what the question's talking about. So there's definitely room for improvement, but he is putting out slide decks, actually talking about the business on a quarter-to-quarter basis, which wasn't the case. So the biggest thing I want to look at is probably the broadband business and their cash flow. To answer the question more specifically, the broadband business was it's a capital-intensive business to build out, to either acquire assets or to add new fiber infrastructure. And we were told that by 2025 was the year we were told we were going to start seeing real cash flow from those assets. So that's one thing I will be looking at. I totally understand that the earnings coming out are fourth quarter 2024, but anything they have to say about cash flow, if that's still on track, if it's improving, things like that. The buyback will be another thing. They've been slowly selling portions of their Sky Harbor investment, which is an enormous investment. They needed to kind of right size that a little bit, but they also did a buyback authorization, and Sky Harbor seems to be kind of fairly valued, while Boston Omaha definitely seems to be trading for less than the sum of its parts. So if they're selling some Sky Harbor shares and using it to more aggressively buy back their own stock at these levels, that would definitely be encouraging. And the cash, Boston Omaha at one point was a pretty cash-rich company. That's not the case anymore. So I'll be keeping an eye on how their financial flexibility is doing, because that's going to be a big part of being able to not only turn around but eventually start growing the business again. Jose?
Thanks, Matt. So yeah, I'll take the next question, the one that you mentioned. Who was it? We were talking about Trade Desk and NVIDIA. So at 9 minutes ago, Matt, do you have an opinion on Trade Desk? Who performs better at the end of the year, Trade Desk or NVIDIA? But I mean, the end of the year is such a short amount of time. If Ed, I would say both have the opportunity to perform really well. I mean, obviously, the Trade Desk did see a massive stock plummet over the past few weeks, especially after reporting earnings, right? They reported earnings of around $741 million for Q4. And this was below their own expectations. And this was the first time in 33 quarters, I believe, that Trade Desk has missed its own guidance. So that kind of created some form of maybe we shouldn't be giving Trade Desk the valuation that it has. And it also came during a time when Trade Desk was doing a lot of changes. They did kind of a lot of restructuring changes in the business and in their organization. And they were doing a little bit more rollouts into more of a different technology. Kokai, I believe, or Kokai, I forget the actual pronunciation, but it was kind of their AI-driven platform that they're shifting into. The rollout was a little bit slower than expected. So I think one of the biggest things for Trade Desk during the earnings is, and the weaker guidance, right? It's just a combination of everything. It's like, hey, you did organization changes, but with this organization changes, you ended up missing your own guidance. Does that kind of indicate that maybe these restructuring that you did within the business might have not been the right thing to do? Also, you're changing into this kind of AI-driven platform. Is this really the route that you should be going? As we're seeing, it's taking a little bit longer to implement, and everything is kind of giving us even more uncertainty because guidance for Q1 kind of maybe wasn't what the analysts or the market was expecting. So there's just a lot of uncertainty about Trade Desk, and if in the upcoming quarters it can kind of turn around and say, hey, look, yes, we maybe we started off to a slow start, but the movement to this new AI tech-driven platform was the right move. The restructuring changes that we did were the right move. I believe the market might seem a little bit excited about it by the end of the year. So there is growth opportunity for Trade Desk, and for NVIDIA, there's growth opportunities as well as we continue to see AI investments continue to increase as where we're at right now. Obviously, both these players, the ad spending and maybe even big tech spending for infrastructure could maybe see some uncertainties due to whatever macroeconomics events happen within the next few months before the end of the year. So, Ed, I don't know if I could pick one, but I do believe that both have great probability and great growth opportunities. There are markets that are already there. Their business that is already up and running. It's not like it's a pipe dream, but it's actual core products that they can grow into, and there's a road for both of them performing pretty well by the end of the year. But unfortunately, there's also a road for uncertainties to come in and maybe kind of have the stock. And this is why I think for the Fool, it's important to have kind of like that long-term mindset where maybe in a year, a lot of this thing seems like noise, but in multiple years, the probability of being successful in these investments will still be very high.
Yeah, I feel like my biggest obstacle to being a good tech investor is wrapping my head, and this has been a problem for the 15 years or so I've been actively investing, has been wrapping my head around being able to invest in stocks that have such high valuations. And coming from a value investor, real estate, banking, I'm the guy who there's an infamous article I wrote, over 10 years ago where I call an Amazon expensive back then. Boy, was I wrong on that one. So when I look at NVIDIA's valuation, it's like where I get lost is how do you reconcile the opportunity, the massive opportunity that these companies have with, let's be honest, a nosebleed level valuation in a lot of cases. That's always been my biggest problem when it comes to getting in on these tech stocks.
And that's the great thing about the market, or right, Matt, is you can have different styles of investing and still win, right? I mean, like
Right.
the real estate, I don't know why it's just not a market that excites me or look at it, but I definitely see various investors do extremely successful in kind of REITs in the financial institutions. So yeah, I mean, I think with NVIDIA and the tech space, the reason I enjoy it, Matt, so much is it keeps you on your toes. I don't know if I like that rush. I don't know if I'm just looking for a small rush there, but it's like you have to continue to see tech innovates at such rapid levels. So you can't really kind of sit still and see it. Hey, look, NVIDIA is going to be the dominant player forever. You have to enjoy watching these keynotes, enjoy understanding, or at least reading maybe from the advisors there on Fool who are doing that research of why NVIDIA and why these tech players will continue to be leaders and why it's the market is willing to kind of give it those valuations.
Yeah, I didn't mean to just call out NVIDIA. There are a lot of companies that trade at very high valuations that have a big opportunity, but it's just really tough to wrap my value investing brain around. And yeah, you're right. Real estate is not that exciting. That's really probably why I like it. I figure I have enough to worry about in my life. My portfolio doesn't need to be another thing to watch it go up and down and crazy. And I will in bear markets. I tend to sleep a lot more soundly than my tech investing peers. In bull markets, I tend to feel like I missed the boat. But generally, it's very even keel. So let me get into some of these other questions. I see Ed has a bunch of questions about banks and real estate. So I'll grab one of those if you want to find one for after. I see the Bitcoin implosion of MicroStrategy. That could be an interesting one. So Ed says, if and when the Fed reduces rates, when would it be a good time to lighten up on financial stocks? My short answer would be, wait a while. So basically, when I ask the question, are lower interest rates good or bad for banks? There's no right answer to that. They're good for parts of the business, but they're bad for other parts of the business. In the more immediate sense, lower interest rates are good for banking businesses because they lower the cost of deposits. Even with the big banks, which, Bank of America, Wells Fargo, they're well known for paying like 0.01% on savings accounts. That's a very well-known thing. But they also pay much higher rates on corporate deposits and government deposits and things like that, which make up a big part of their deposit base. So right now, banks have pretty high deposit costs. In like Bank of America's case, it's in the 2.5% range. This is what they're paying on their average deposit. With like an online bank like Ally Bank or SoFi, it's closer to the 4% range. So, and those are not directly tied to the Fed's rate moves, but they tend to move in the same direction. So the short version is that as rates come down, you're going to see that deposit costs come down. Now, the other side of that is that when rates come down, the rates that banks charge on loans also gets lower, which is a negative, but more in the long term. In the more immediate sense, you'll see rates come down, deposit costs come down, but the banks, they have mortgages, auto loans, multi-year loan products on their balance sheet. Those are still the same for the time being. And you'll see that kind of asset mix kind of slowly shift. If you look at like Allied and SoFi both do a great job of breaking this out quarter by quarter. The yield they're getting on their interest-bearing loans, and you can see it's kind of a delayed reaction to the Fed's rate hikes. Like we're just seeing the average yield of the portfolio continue to climb right now, even though the Fed hasn't raised rates in quite some time. So that's more of a delayed reaction. So bank profits should initially rise as rates come down, but over time, lower rates are generally a negative thing for banks as they can't charge as much on loans. So I would say maybe a year or so after the Fed is done lowering rates is when I would start to take a closer look at my bank stocks. And yeah, so that's my kind of quick take on it.
Matt, I have a question here, but I really do enjoy a question that came in about 10 minutes ago.
Okay.
And hoping you can take it. We were just talking about the Fed rate meeting, and It seems like sometimes when we think of things like the Fed rate meeting, it's more of like, what was the wrong things that we hear about it? What was the negative thing about it? So James wanted to know, is there any happy takes to grab from yesterday's Fed meeting?
Sure. Well, I like that question. I like being. Sometimes I forget to be optimistic. There are some good takes. For one, the Fed is still expecting the rate cuts to continue, which a lot of people were not expecting going into the meeting. That's why the market rallied. When the market goes up like that in response to a Fed meeting, there are some happy takes. So that's good for consumers because things like auto loans and credit card debt, things like that, the interest rates will go down. It's generally good for spending. The higher than expected inflation projections could be good for retirees. It means your Social Security cost of living adjustment could be higher than we thought, although it means things are more expensive, so that kind of offsets. But there are some happy takes there. We're seeing a path to lower rates. And give me just 1 second. I want to look. Okay, so the Fed is projecting 2 rate cuts this year, 2 more next year, another one in 2027, and longer run, they see the federal funds rate settling at about 3%. So that's about 1.5% below where it is right now. So they're showing a path to things like mortgage rates. The real estate market could start to thaw. That's definitely a big takeaway, and why we've seen certain real estate stocks kind of not REITs, but companies like Rocket was one of the best performers a couple of days ago with interest rate projections. So there are some good aspects of this. There are some bad aspects of this. And I guess the best thing to say is that the negativity you saw in those slides was to lead to the good. Like the Fed's expecting higher than expected inflation, higher than expected unemployment. So now we have a clearer path to lower interest rates. It's a good and bad. I like that question. Thanks for bringing that one up.
So Matt, I'll take one here. Let's see. It was from our good friend Pro Shop Guy. My biggest takeaway from NVIDIA GTC was the Dynamo announcement. In 5 years, we will look back and realize this was a huge moment for NVIDIA like CUDA. So for those that are not familiar, NVIDIA is currently having their tech conference on Tuesday. I forget what day we are right now because sometimes they all blur. Okay, it's Thursday. So 2 days ago, they had their main keynote. And this during GTC events, that's kind of like the events to go to. If you go to pictures nowadays, you see like massive lines wrapped around the streets for everybody trying to get into a Jensen keynote nowadays. So this is where NVIDIA CEO explains a lot of the different new, the various new solutions and innovations that the company is making. Some are short, some are ones that are going to come out within the next 12 months, and some are previews of what the company is going to release multiple years from now. So they give almost about a 3-year roadmap, which is pretty insane to kind of think about it, because it's like saying the Apple goes into a tech show and tells you not only the iPhone that they're going to release this year, they're also going to tell you the next 2 years of iPhone's release. So it kind of showcases how one, NVIDIA wants to show the competition that you're nowhere near close, but also to kind of show its customers that they're going to continue to innovate at rapid levels. One of the announcements there was a software solution called Dynamo, and this helps kind of improve more and more the hardware solutions dramatically. The best thing to explain it, it's more of like a manager of GPUs, which makes sure your GPUs are always working or always doing some form of task like that. It has the highest efficiency rate and the highest ROI for your big players that are purchasing it. And it seems something so simple, but something that simple of having like a GPU manager is extremely difficult to do with all the different types of tasks. And no other real player can do that right now. So NVIDIA, again, is just kind of strengthening its software side. If I was to Pro Shop Guy into any other NVIDIAns watching, one of the things that really got me excited was the photonics networking solutions. I think this is probably my favorite thing from GTC. And NVIDIA is just kind of reinventing the way we can, big data centers connect computers and connect kind of all these massive 100,000, 200,000 GPU clusters by reducing the amount of components needed. And then by that, they reduce the amount of energy needed, reduce the amount of power of energy, reduce the cost, and then their customers can use that extra energy and that extra savings to even buy more and more solutions. So to me, I think the biggest announcement there was the networking innovations that NVIDIA brought up.
Right. So I wanted to hit two questions. One of them's really quick. Matt says, to clarify, is Boston Omaha really a worse performing stock in your portfolio than Upstart and Lemonade? I'm only down by 33% with Boston Omaha versus over 50 with the other two. No, but on a percentage basis, it is not the worst performing stock in my portfolio. It is one that I invested heavily in. So on a dollar basis, it is by far the worst performing stock in my portfolio. I limited my positions in the more, what I considered the more speculative names, but maybe they weren't. So that's just to clarify that. And then Greg, Greg Hunter asks, Matt, what are your thoughts on the spinoff from O, which is Realty Income, ONL, it was Orion Net Lease. Now it's called Orion Properties. So let me address this because it has not been a great performer since it was a spinoff of Realty Income, which is my favorite real estate investment trust. Ticker symbol is O. This was in late 2021. They decided to spin off their office properties. From Realty Income's point of view, that timing was perfect. There was no better time to remove office space from your portfolio than right before the end of the COVID pandemic. The work from home trend has really just killed the office industry, things like that, especially in suburban markets, which is what they focus on. So Orion is down since the spinoff 91%. They've lost 91% of the value since the spinoff. And there are two things that make me, I sold my shares just after the spinoff. I didn't want to own suburban offices. I think people will still be working in offices, but I greatly favor urban office properties to suburban office spaces. One of my biggest investments, if you followed me, is Empire State Realty Trust, the owner of the Empire State Building and a bunch of what I would call mid-tier Manhattan office properties. I like those so much better than the suburban market. In suburban office space, I live in a suburban market. Work from home is a lot more prevalent. It's a lot more, more of the culture, I guess I would say. And the offices that you see in suburban markets aren't necessarily mission critical for a lot of businesses. Like I'm looking at some of their top tenants. Bank of America is one of its Orion's top tenants. Do they really need as much suburban office space? And they're trying to, close branches and limit their physical footprint. Do they really need as much of a suburban footprint as they have right now? Maybe not. The other thing that really scares me about Orion is that the top industry in its portfolio is government, specifically federal government. The GSA, the General Services Administration, is their number one tenant, makes up over 16% of their rental income. And with all the efforts to the government efficiency efforts and things like that going on right now, that just kind of frightens me. Now, having said that, there could be some value in this portfolio. 73% occupancy is not great. I mentioned the Empire State Realty Trust. Theirs is over 90%. So I'm not a big fan. It's very speculative at these levels. Like I said, down more than 90% since it spun off from Realty Income. I just don't really want suburban offices, and I really don't want suburban offices that are occupied by the federal government right now. So hopefully that was another pessimistic answer I had to give.
Ned, thanks for that. I want to take this question that came in 12 minutes ago from Ed. Marvell is not profitable. And Marvell is ticker MRVL. This is a semiconductor company, but yet it still pays a small dividend. Why is that? Right, Matt? Because normally you see companies that are not profitable not pay, usually don't pay a dividend. A few things, Ed. So Marvell, it is a semiconductor player. If most people think the semiconductor market right now is doing really well, and that is completely false. The only industry, the semiconductor market has various industries. The only segment within the semiconductor market that is really doing well is the one that deals with kind of the data center and AI spending. Consumer tech is still a little bit weak, not mainly because a lot of the purchasing of consumer tech happened about 3-4 years ago when everybody was buying a new laptop, when everybody was buying a new phone, new tablets, and the list goes on. And then there was like a massive over inventory correction, and that over inventory correction has taken a little bit longer to normalize. So every other industry outside of AI has been completely weak, while some are picking up, some are bottoming, and some are still going down. Now, Marvell is focused in a market that provides networking solutions. So within that networking solution, you have a lot of data center solutions, which they are doing really well in. But they also have other core markets like telecommunication, and like the telecommunication market is huge for them, but it's doing pretty weak. So historically, when Marvell is in a good cycle, it is profitable. And I'm guessing that's when kind of these this dividend started. But also on the bright end is this company's free cash flow, even though they are not profitable at the moment, they still in the trailing 12 months had about $1.4 billion in free cash flow. And they in total dividends was paid about $200 million. So we can see based on the free cash flow that it's not like they're burning money at the moment. They're still able to kind of generate cash from their operations, and they're willing to pay some of that towards the dividend. It's very small percentage, and I do believe the other markets that Marvell is growing at rapid levels or are turning around. And market expectations now expect for this upcoming fiscal year for Marvell to actually be GAAP profitable again, as we are kind of seeing the growth story in AI, but also we're seeing that turnaround story in their core markets as well. So it all depends on where the cycle is. Normally, semiconductors tend to have cycles of very high earnings and then cycles of negative earnings, and they still kind of continue to pay dividends throughout the time. It's not like they pause it during this negative downturn unless it's really bad. But as long as they're able to retain positive free cash flow, you should expect maybe those dividends to stay as well. And that's what we're seeing here with Marvell.
I like that. So Ed had two questions I'm going to combine because they're both about real estate. The first one says, are you concerned about real estate REITs? Would you stay away expecting things to get worse in the real estate market? And also said, if interest rates remain the same for the rest of the year, REITs or a 4.5% CD, which is the better buy? So there's a lot to unpack there. The short answer is I'm not very concerned about REITs right now. And I actually wrote an article about my bold predictions article I write every year on January 1st. And one of my predictions this year, and I'm still holding to it, is that real estate is going to be the best performing S&P sector in 2025. So far, I'm doing pretty good, so don't laugh at me for that. So far, real estate is 6 percentage points above the S&P year to date, even though interest rates haven't changed or anything like that. REITs should have a very nice tailwind if interest rates fall. But even if they don't, like the second part of the question suggested, I would still buy if we're talking about a long-term investment. I would still buy a basket of REITs or a real estate index fund like the Vanguard REIT ETF VNQ over a CD, just because they're similar yields right now, and REITs have a lot of upside potential from here, especially as rates fall. The short version is that REITs have a lot of other ways to create value other than their rental income. I mean, the most obvious is property values tend to go up over long periods of time, but REITs also have other ways of value creation, and some of them have been very successful, like development. A lot of REITs develop their own properties from the ground up. Just the very simplified example of this would be If you could build a office building and it cost $8 million to build, and it was worth $10 million when you finished it, then you've just created $2 million worth of value. A lot of real estate investment trusts are really good at doing that. There's capital recycling, which is selling, mature and appreciated assets to fund development and things like that. So that's a way to create value. As rates come down, it becomes easier to borrow money and grow. So that's a way to create value. There's a lot of different pathways to create value, especially in a falling rate environment. The general the speed and magnitude of interest rate cuts is anyone's guess at this point. But pretty much every projection right now, based on all the information we have, is that the general direction of interest rates over the next 3 or 4 years will be lower. Real estate investment trusts, regardless of what the economy is doing, tend to outperform in falling rate periods, unless you have a recession caused by real estate, like in 2008. But the short answer is, most of the stocks I'm buying recently are real estate investment trusts or other high dividend companies, especially if I'm talking about a long-term investment. Now, if you need the money within the next few years, the CD does sound like the better option. But for now, I'm still a big fan of real estate investment trusts. It's like the REIT market is like a loaded spring with interest rates at high levels.
Thanks for that, Matt. Let's see. There were, I think the only, I'm going to take this question 17 hours ago, Matt. It does seem like most of the recent ones are mainly meant for you. So 17 hours ago, Kent, what are some of the AI benefits that the building industry can expect? Right, when we think of AI, we think of right now mainly the cloud space. We think about just large language models, but I think this is a great question, Ken, of how can it benefit kind of the building industry. And I think there are a few ways to do about it. The first thing is it can massively help the supply chain. With AI, right, you can kind of be better off on directing, acquiring, just moving around the type of materials needed for whatever type of project that you're about to do. So AI, in a low level, it can help very quickly with supply chain. There are other things that AI is kind of really progressing, and now we're going to get a little bit more sci-fi. With AI, we're really starting to see this kind of digital twin world where it's kind of AI generated, not just AI generated, but with data. You can kind of have this real world digital twin inside your computer. So when building something, let's say you're building a manufacturing plant and you want to see how productivity would be if you put the supply chain lines in this place, or if you put the manufacturing lines in this place, if you even put like the bathroom in this location and whatever in this location and the lunchroom in this location, how can AI kind of project what is the optimized routes, what is the optimized locations of a lot of these things? So AI can help a lot with the efficiencies of the supply coming in, but also the efficiencies of how to build kind of a proper building. It can also a lot of clerical work, right? There's when building something, I'm pretty sure there has to be a lot of paper to do things like POs, things like licenses, make sure all that is intact. AI can definitely help with that clerical work as well. So that's something that it can do to help speed up the process. Eventually, right, in some sci-fi maybe not far future, but if we do kind of have robotics really start to take place, and robotics is something that I believe can still take at least 5 years before we start to see it any real growth for it. But things like AI can help robotics kind of and more like humanoid robotics. Humanoid robotics kind of do more tasks. But in the short term, we already do have kind of a lot of different types of robotics that can help in AI. For example, the moving robots that are usually kind of like a car on wheels. Then you also have kind of like the one-handed robots, and the AI can help create where these robots usually only have one task because they're usually hard programmed software. With AI, you can help them be more versatile and have various tasks just depending on the type of model. So there are, I think, a lot of benefits from just the paperwork, the supply chain, and the actual labor itself, to also the design process of building. So there's, I think AI can help out all those to improve the efficiencies, and either reducing the cost, speeding up a little bit the time of production and time to start building. So there's different ways, Kent, that AI can help the building industry.
So I do see a few more questions that I want to quickly get to, but I was wondering if Jose, if I could ask you about a tech stock that is actually on the top of my radar right now. And I think, are you familiar? You're pretty familiar with AMD, right? Okay, cool. So I see a headline. So AMD is a tech stock that's kind of starting to look like a value stock in a lot of ways. If I'm looking at it right now, it's down over 50% from the highs. It trades for like 23 times forward earnings, which even a value guy like me can wrap his brain around. So I see a headline right now. This is on CNBC. It says AMD's Lisa Su has already vanquished Intel. Now she's going after NVIDIA. So what the first part of that means is AMD has definitely captured a lot of share of the PC market from Intel over the years. If you look at a long-term like market share chart, pretty much every PC and laptop in the US has a chip from either Intel or AMD. And AMD has captured a lot of share over the past couple of decades. Lisa Su's been one of the best CEOs, in the industry. Even a value guy like me appreciates that. But when it comes to like the data center, the GPUs and things like that, they are a distant second to NVIDIA. I want to say NVIDIA has something like 95%, and AMD is the number two, which 5% of that market is not bad. But do you see AMD as an actual threat to NVIDIA, or do you think that as this headline implies, or do you think that's not what the investing thesis is here?
So I do enjoy. I own AMD, Matt, and very similar to Nvidia. Luckily, I got lucky and very early on into both companies. For AMD at the moment, the market is just seeing the AI GPU space. I don't think that's the right thesis to look at for AMD. AMD has various markets, and I think that's what I enjoy about AMD. It doesn't just depend on AI. Where Nvidia really, that it's pretty much that's the only thing that if AI fails, unfortunately, NVIDIA will see some pain. AMD, the market is believing it's the next NVIDIA. I think that's the wrong thing to think about it. I think for AMD, like you mentioned, even 5% market share in a growing market could be strong. And that's how the market should see it. Because for Intel, one of the things Intel was seeing a lot of lag in a lot of their technologies. There wasn't huge innovations. I think usually back in CPUs, when you would kind of get the next generation CPU, you would see a marginal 7-8% improvements. With GPU architecture, you're seeing massive from Hopper to Blackwell, you saw about 15 to 30x. You don't see that kind of innovation other places right now. So NVIDIA, I think, is too paranoid for AMD to catch up or even be a threat, in my opinion. But the market is so big that even if you're a long distance second, just getting a small portion of that, having some viable solution can help you grow. But I think the market might be looking at AMD as the next NVIDIA, and I think that's the wrong bull thesis. I think there's plenty of other bull theses that make AMD pretty attractive, and AI is part of the equation, not the whole equation.
I appreciate that. They're also just to your point, they're one of the leaders in autonomous vehicle chips. That's one of their big growth opportunities that I like. I like the opportunities that I can see that like of things that are, a car could be in my driveway, but the PC I'm using right now is an AMD chip. Things like that. Gaming, they're a big, the big gaming, and that's been kind of a lull lately, but historically has been a big part of their business. So I appreciate that. I apologize for putting you on the spot, but that's I figured you could talk more intelligently about AMD than I can. So we have just a few minutes left. I want to hit this one from Ken that just came in a little while ago. Matt, what are your thoughts on NLY? That's Annaly Capital Management. And I'll be quick so we can get to a couple more questions. Annaly Capital Management is a mortgage REIT. It's a real estate investment trust that does not invest in properties. It invests in mortgages, mortgage-backed securities, and related assets. Specifically, Annaly invests in government-backed mortgages, like the ones owned by Fannie Mae, Freddie Mac. So very high-quality loans, very low risk of default, things like that. The government steps in if those default. So my problem, and it's not hard to see why this would be an attractive stock. It's got about a 13% dividend yield. That these types of companies tend to do really well in environments when interest rates are steady, or or predictable at least. And you see the stock's been roughly flat over the past 2 years, and the reason for that is the interest rate environment jumped in 2022. In 2022, Annaly Capital Management lost about 1/3 of its value, about half of its value at the peak, but 1/3 of its value, during the year, as rates were rising rapidly. And then when rates stabilized, the stock stabilized. So the problem is that the mortgages that Annaly Capital Management owns pay 5, 6, 7%, like the mortgages you might have on your house. The stock pays a 13% dividend yield. You don't get a 13% dividend yield from a mortgage that pays 6%. You get it from borrowing money at short-term interest rates and buying more mortgages and profiting from the spread and passing that money on to investors. So mortgage REITs have two different types of risk that they could have. There's default risk and there is interest rate risk. Annaly, because it specializes in federally backed loans, doesn't have the default risk. But because federally backed loans have relatively low interest rates compared to like jumbo mortgages, things like that, they have to borrow more money than their peers in order to produce acceptable returns. So they have a lot more interest rate risk. In periods where interest rates are falling, or are rising rapidly, or are just, the spreads, the short-term interest rates rise. So the spreads between what they're getting from their mortgages and what they're paying for short-term debt tends to narrow. In periods where rates are falling very rapidly, a lot of people are refinancing their mortgage. I don't know one person who owns a home that didn't refinance during 2020 and 2021. I just don't know anyone who didn't do it. So what happens is you buy these mortgages, you get your short-term debt, you have this acceptable spread, then the borrower refinances their mortgage and you no longer own it. So that's a big challenge of these businesses as well during falling rate periods. So if you think interest rates are going to be stable for the next couple of years, it could be a good one to take a look at. Beware that these can be very volatile stocks. They are income plays. Do not expect the stock price to rise over time. If you look at a long-term chart, historically that has not been the case. It is down roughly 70% since 2010. And most of the big declines have come in periods when interest rates are either rapidly rising or falling. We had the rate hike cycle in 2017 to 2019. That was a big period of decline for them. The rate hike cycle in 2022. And when rates were falling, it hasn't done that well either. So I'm not a fan of mortgage REITs. I don't own any. I know a lot of investors do. I would say if you do buy, do it for as not a short-term investment, not like a day trade or anything like that, but with like a 1 to 2 year time frame in mind, and reassess when interest rates look like they're going to be less stable. So that would be my best suggestion, but I stay away from those. That was too
Thanks
long.
for that.
I answered that too long.
I think I can do a quick rapid fire of a question that just came in from Happy Fool. Hi Fools, any thoughts on ASML buying opportunities? Apologies if the question has been asked. So Happy Fool, I focus a lot on the semiconductor space, and normally I don't really like entering into ASML, as I do believe it trades at a hefty valuation. The past year, in my opinion, has changed my mind a bit. I still don't own it, but it does look a lot more it is very high on my watch list in the semiconductor space. The main reason is while semiconductor equipment is kind of slowing down in purchasing in the past few quarters, in the past few years, we are seeing tailwinds of massive kind of fabs being opened up all over the world, and also the change of manufacturing node from to kind of gate all around and 2 nanometer and below. You're going to have massive tailwinds to fabs either buying, opening up and being to buy new ASML machines, or just advancing and improving their current supply chain lines to kind of more advanced nodes. So obviously not personal advice, but I do like ASML at these valuations.
Awesome. And we are right at 9 o'clock. It should be time for the actual morning show. We're the morning pre-show. I see Sandmeat. I see Thomas coming on. Good morning. And David. Good morning, everybody.
Good morning. Hey, good morning.
Good morning.
Good morning. Good morning. We talked about the Fed and stuff like that for a while, so we are happy to kick it over to you now for some more exciting things.
All right. Thank you. Well, good morning, fools, and welcome to the morning show. It's Thursday, March 20th, 9:01. I'm joined here by Thomas King and Dave Meier. Welcome, gentlemen. How are you?
Good, thanks. How are you guys?
Doing good here.
Doing pretty good. So I guess we'll just kick it off. I mean, I know they had a little Fed talk already, but we can kick it off right away with a little bit more that I know Dave had some stuff he was thinking about with the Fed and interest rates and all that fun stuff, right?
Yes. So it's probably been said, but we'll just I'll reiterate my takeaway, and that is we're probably not going to expect the Fed to do anything for the first half of the year, be either cut or raise. Basically the signal is we're looking for more data. What is the actual impact of any of the tariffs, and the tariff situation is fluid. So the data could change over time. So they're not basically willing to get out ahead of their skis, which is what the Fed does. The Fed is reactionary. It doesn't take, make predictive moves. So that's not a surprise. I think the thing that is my biggest takeaway is they're actually a little bit worried about stagflation, which is a combination of, hey, inflation may increase a little bit, so they're keeping their eye on that, and the economy might slow down a little bit. So they're not saying recession, just saying slow down a bit. So they're a little worried about that, which is a little new.
And is that, can I just ask Dave, is that real? So that real growth will slow down, but inflation goes up. Is that what stagflation is?
Stagflation typically is no growth, like zero growth,
real
right?
growth,
stagnant
right.
growth,
Yeah.
and then while inflation is increasing. So that would be like the worst of both worlds, right? Because as consumers, you're feeling the effects of not growing, which could be the labor market could be weakening, right? My wages could be weakening, but things are getting more expensive, which puts more pressure on me. Fortunately, coming out of the employment news or the labor market news today, the labor market does not appear to be weakening, at least significantly. So I think I think the Fed did the right thing, if you will. We see some risks. We're not doing anything because we don't need to do anything. That's kind of the message.
Sandmeat, go ahead. You were muted.
Oh, whoops. So if we were to have slower job growth, and then obviously if inflation starts kicking up, that could definitely put us at much more risk of stagflation, because one, people have less income to pay for things that are already priced higher.
Correct.
Slowing down the economy. Right now, I think the economy is predicted to, I forgot what didn't they say, like around 2.6, 2.8, something like that for the year?
I don't know. I haven't seen.
I saw some numbers thrown around somewhere.
So there's been a wide variety, which is very interesting, because you have the GDP now from the Atlanta Fed, which at least as of last week, let me take a little peek. It was actually negative. So right now, GDP now is predicting a little less than 2% decline. So that's a little less than negative 2%. But I've seen estimates in the 1.5 to 2%. So there's a huge variation. There's some questions about what the way GDP now calculates its estimate, right? So we just don't know. I think the economy is growing. I don't think that there is imminent recession, but we've seen some economists and Wall Street strategists basically say, hey, their estimate of a recession happening has gone up from, let's say, 10% to maybe 25%, something like that. So there's worries, right? There's things that are happening over here based on some data, and so pay attention. I think that's the message. Just pay attention if you're a stock analyst.
Predictions are hard, especially about the future.
Yogi Berra.
Can I ask a question? How do you guys? We know from, maybe just to cover some ground for anybody who perhaps doesn't know this, that the reason people spend a lot of time, or one of the reasons that people spend a lot of time thinking about what the Federal Reserve is doing with that key interest rate it controls, which is the federal funds rate, which is basically what the rate of what banks earn when they deposit money with the Federal Reserve. I think I'm right about that.
Yep.
So that kind of has because interest rates kind of build on each other through the economy. So you go from that very basic, safer than safe rate, you put depositing money with the Federal Reserve, to the end where you lend in money to a consumer to buy an Apple iPhone, for example, which is the most risky transaction. So these things build on each other. We focus on that rate because we build that into what we call the discount rate when we value cash flows that are going to occur in the future. We need to come up with what's called a discount rate. The higher that rate is, the lower the value of projects. The lower that rate is, the higher the value of projects. So if today the federal funds rate, or the Fed lowered interest rates by half, for example, this is just obviously a very extreme example, then the value of assets today would go up significantly. So everybody who's playing the short-term game in the stock market is kind of trying to predict what they're going to do. We obviously trend more long-term in how we think about investments and that. So I'd like to ask you guys how you think about it. I mean, does it change your discount rate? Are you guys Fed watchers? How does it factor into your investment process, if at all?
For me, I mean, usually when I do like DCFs and valuations, I tend to use a standard kind of 10% discount rate and keep it pretty, honest, I guess you could say. If I don't try to lower the rate way too much, maybe go down to 8 or something, but
Depends on how much you want to make the investment, how low you make your discount rate.
Yeah, it depends on whether I want to make the valuation look attractive or not, right? And how good I want my pitch to be. But I mean, I monitor the Fed, and like right now, so really, I think yesterday the markets were up because the market was happy that it looks like the Fed's 2 interest rate cuts for the year are still kind of intact, which would go along with the lines of what you're saying, Tom, is like 2 interest rate cuts, value of assets will go up over the year. So we're in a more favorable environment for asset prices to kind of rise. So in that environment, it's maybe a more favorable time to invest, and I should at least consider the fact that I have the wind at my back. Versus when interest rates are being cut, or excuse me, risen or hiked,
increased,
increased, whatever word it is for that, then it's a less favorable environment, and I have to note that I have a headwind that I'm facing, and so I need to be a little more careful about the investments that I make, my valuations, and kind of where how I allocate. So that's kind of, I use it as a broad kind of paintbrush into my investment thinking, but I don't really spend more than a few minutes maybe thinking about it.
So real quick, I will say I second what Sanmeet said. As far as a discount rate for pure valuation purposes, it's an opportunity cost. So what you need to figure out is what am I willing to give up in order to allocate my capital to something that's more risky. So Fed funds rate is one thing that you can look at. The macroeconomic situation is another thing you can look at. Investor sentiment is another thing you can look at. What's the competitive situation at the company? How, there's all sorts of things that can go into that. But the other thing is 10% is a little bit above the long-term rate of increase of the S&P 500. Right. So if I want a little bit more than the S&P 500, 10% is actually a very good rule of thumb. I'm not a Fed watcher, but given my experience in markets over the last 20 years, especially when I was down in asset management running or managing other people's money, I pay attention a lot more to the macro situation. I don't disagree with the famous Peter Lynch quote. If you spend 13 minutes, I think it's if you spend 13 minutes looking at the macro situation, you've wasted 10 minutes. I disagree with that. Now,
Okay.
he's a much better investor than me, but there's also circumstances by which he could do that, and I can't necessarily do that. I think it's important to pay attention to the situation that you're in, to make adjustments based on what you see, and then go from there.
Yeah, I think I may be wrong about this, but I think during the late 70s, early 80s, I mean, I think you could lend money to the US government for 12, 13% or something. Am I right about that? I mean, I know that interest rates
It might have been even higher than that.
Really? I mean, so that helps you think like about where interest rates can go, just
Correct. They were very high. They were very high then.
yeah.
All right, so let's go to an earnings report. I think that Dave, you follow Accenture because I think that's trading a little bit down in the pre-market now, right?
Yeah. So, excuse me. So what basically the Accenture, the giant consulting firm, came out and said, "Hey, we did good in the fourth quarter. We did good for the year." And they actually came out and said, we think we're going to grow just incrementally faster in 2025 than we thought we were at the end of than our first estimate at the end of last year. And if I recall correctly, the stock was actually up, and now it's trading a little bit down. So it's a little volatile right now. If I had to make a guess, I would say that because they're so big into AI, meaning they are helping companies manage the artificial intelligence landscape, right? What do I do? How do I do it? What does my business need? What does my business not need? If I had to guess, and this is strictly a guess, they booked, according to their earnings report, $1.4 billion in contracts for that consulting. My guess is that's probably a little lower than some people expected, which, given a time when AI is the hottest thing, and this is the biggest consulting firm and out there, if you will, and a very good one at that. Maybe that's what's worrying the market a little bit. That being said, that's just a conjecture. I don't think the competitive situation at Accenture has changed at all. It's still going to grow at a reasonable rate for being how big it is. And so, this could be a little bit of an opportunity, especially considering that the company seems pretty positive going into 2025.
Is there do they talk a little bit about their AI business? Their AI business is doing, or the AI consulting? It's because these consulting companies are really benefiting from this. Right?
Yes, and there from what I understand, it's doing well. But I think if you're playing this short-term expectations game, is the market is like, hey, why aren't you doing better? But again, that's just conjecture on my part. Stock could be down for any number of reasons.
Yeah. Awesome. Let's see. Tom, let's go to what you were going to talk about. I think you were going to talk about Airbnb. That's like a pretty popular, common name that a lot of our fools would know. I know I've followed it myself, so I'm interested to hear what you have to say about them.
Can you guys hear me okay?
Yep.
Good. Okay, because
good.
my screen has just gone dark, so I can't see you guys. Don't know. It's weird. It's happened before. I don't know why this happens, but anyways, we'll make it work. I'll be like blind man here. All right. So Airbnb. This is an article in the Wall Street Journal. We recently recommended Airbnb in Rule Breakers. The fundamental sort of thesis was that it was very cheap. Well, not very cheap, but pretty cheap compared to relative to what we thought it was worth. And there were a few things about it that really kind of stuck out to us about Airbnb. One of them was the resiliency of the business. Now I know that resiliency is a bit of a cliche. It's a word that tends to get used a lot, but in Airbnb's case, we think it really does apply. If you think about the pandemic, for example, 2020, it was pretty much, I think if you could have imagined a worst case scenario, I don't think you could have imagined a worst case scenario within reason for the travel industry. And Airbnb, it was fine. It lowered its expenses. Its revenue went down significantly, obviously. It lowered, I think it had a fairly small loss in 2020, but it got through fine. It didn't have any debt or very little debt. It had a good cash reserve, and it bounced back really, really strongly in 2021 once people were, let out the house. The other way that Airbnb survived that whole period was, people stopped getting on planes and traveling overseas, but they did start moving locally. They would go out to the countryside or to the beach or whatever. There was some travel that they could do, and a hotel chain or someone with an establishment in a city center or somewhere fixed couldn't really benefit from that dynamic. Whereas with Airbnb, suddenly you had people, launching Airbnbs in little mountain towns and little seaside villages and whatever, where people could go to, where there was demand to, get out of their homes, out of apartments, and just, get somewhere. So it's really quite an incredible business. Got about 8 million listings all over the world. I think there's one or two countries that it doesn't have a presence, but it's pretty much everywhere in the world. I think there's even one in Antarctica, if I'm not mistaken. So, anyways, there was that's the accommodation business. They have had another segment of their business called experiences. They don't list out the two separately, and experiences, it's hard to know whether it's been a failure or whether it has simply been dwarfed by the success of the accommodation business, because it's never really discussed. There's not a lot of emphasis on it, but it makes a lot of sense. because people have got the Airbnb app, they've booked their accommodation, they're going to a place that potentially they don't know so well, and they're looking for things to do. And the same way they found their sort of unique homely accommodation on Airbnb, it makes sense that they should look for some sort of unique experience at the place they're going to. So that is the whole idea of the experiences business, where local entrepreneurs or tour guides can list their activity for guests coming to that place. And there's a lot of reasons that could work quite well. First of all, you have people's attention on the app. Second of all, you know where they're going and what time they're going there. And you probably know most people use Airbnb for holidays, vacations. You know, so there's that people are willing to spend money, and they're in the mood for doing something different and out of the ordinary. So it seems it should work, right? So anyways, Airbnb they're expecting to increase their expenses. They don't have a lot of fixed expenses that they capitalize. They generally Airbnb just has to lower. It spends its money on things that pass through the income statement every period. So not a lot of the expenses are capitalized, and they're expecting to increase their expenses by about 200 to 250 million, which is actually not a lot of money. It's 3 to 4% or so for them.
It's always fun. It's always fun to think about that from a business standpoint, right?
Yes.
But anyway,
Yeah.
sorry, I didn't mean to chuckle.
No. Well, and their hope is that they're going to revitalize this experiences business. So they're hiring people to, get those products, to put more effort and thought into what they show up on the app. Obviously, they're going to need customer service people. They're going to need managers to get that project going along. So it's their plan. I think this summer they're hoping to launch. They call it a revamped experiences business. They did mention revenue projections for that line. I mean, I don't want to talk about that, because I feel like it just kind of propagates something that is speculative. So I'm just going to leave that out. But yeah, I mean, they certainly have the money. They can afford it. It's worth going for. The accommodation business is really well set up. They've got, it makes sense for them to go into this, I think, and we'll see how it goes. And yeah, I'm pretty interested in Airbnb. I think it's a good business.
Yeah, I think this is actually reminds me a long time ago when I was following TripAdvisor, and I believe it was 2014 when TripAdvisor bought a business called Viator. So TripAdvisor basically was a community or is a community-led, hey, this has been my experience going, to this place, Paris, Washington, D.C., whatever it is. This is where I stayed. This is, so they got all this content, and they used to sell ads against it, right? Which was a good thing. And then they did the same thing. So not only can we talk about places to go to stay, right? But experiences. That's what Viator does. Right. Not only that, actually, as TripAdvisor's business model changed, Viator actually became an extremely important part of their business, a part of their growth. So, just based on my experience there, it does. This does seem like a very logical, strategic extension of for Airbnb to be in this business and to be able to create these relationships, right? Because you said something that's just so important. They know exactly where customers are going to be, and they know exactly how many are going to be in the area, right? That's the thing. If you're an experience in an area, right? You're absolutely going to be willing to
I think they
work with
also know
Airbnb.
they know your age as well, because you
Sure.
verify
They
with
know they have incredible data, so they can basically say, yes, let's target these people, right? Let's get our product in front of them, right, to try to spur business. It's absolutely logical, and I think if done correctly, based on what I saw at TripAdvisor and Viator, this seems like something that they should be good at. So I'm glad to see them making this investment.
I was gonna mention, I've been following Airbnb a little less as of late, but they've been talking about experiences for a long time now. I remember when I was listening to their calls a little more frequently, they'd be talking about experiences, and I don't know, like I haven't used Airbnb very much, so I don't know how their experiences interface and the quantity and quality of what they have is. I've actually used Viator, and it's kind of an extension from TripAdvisor. TripAdvisor is so commonly used when you're looking for, good restaurants, good resorts, good hotels.
Right.
Whenever you're traveling, I just literally will go up on TripAdvisor and be like, all right, how is this place? And then get good deals. You can even link from there to book it. I think it goes to Expedia or Travelocity or one of those. And so, you get good ratings, you get customer reviews, their picks. Great resource for that. And they've kind of stepped it up where not only is it a resource to look up information, it's a resource that you can use to book stuff. And I've often actually used Viator to book experiences, like,
Yep.
when we went to Hawaii or we went to Puerto Rico or something, you just book like some tours, or you book, some travel stuff.
Absolutely.
So it's pretty seamless. I don't know how Airbnb, I mean, obviously if I were to use Airbnb more and I was going there first and foremost to say, hey, I want to book a trip to Costa Rica. Where's an Airbnb I can stay at? And you start looking, I would imagine they have something that links or helps you kind of say, all right, I'm going to book this. Now what's in the area, or what can I book in addition to that? So I don't know how much their experience is business. Like you said, Tom, they don't really break it out. I don't know how much impact it's having. Is it maybe non-monetary impact where, since it's there, it helps kind of push along the booking process? Are people going to it outside of the booking process? Like I've actually gone to Viator just to say, hey, what's some good activities in this like area before I even book like the trip, because I want to see, hey, what are some good experiences?
Okay, yeah. Just out of curiosity, Sammy, when you travel, like on vacation, how do you book accommodation? Do you typically stay in hotels, or how does it work for you and your family?
We like to stay in hotels, so
Okay.
I'm probably more biased towards staying in hotels. So I don't actually look at Airbnbs, because for us, we're like, all right, if we're going on vacation, we don't want to be responsible for cooking and cleaning and like taking care of the house that we're living in, because we do that anyway. And I have teenage kids now; they're messy, so it's not going to be much of a vacation. So we'd rather just be in like a hotel room that's maybe a little bigger, maybe has like a kitchenette, so we can at least save on food.
Yeah.
But we like to book hotels primarily.
Okay.
So
You know what? I am going to, if you guys don't mind, I'm going to try come out and come back, because I can't see you guys. So
sure.
I'll see you guys
Okay.
shortly.
Well, Dave, there was another company, Sport Radar, which is another
Yes.
a little more popular of a Motley Fool pick. I know one you
Yes.
follow quite closely.
That is true. So Sport Radar is the sports betting company. As if you're a returning listener, you have heard me say it is the brains behind the bets, because it takes data
Yeah.
from sports leagues around the globe and transforms that data into content in the form of betting opportunities that it sells to businesses like FanDuel, booking houses in Europe, Bet365, and as well as content producers like CBS Sports and Facebook. So they actually had a very good earnings report, and the report was Growth was ended up being 26% for fiscal year 2024, which was outstanding. They're predicting growth of 15% revenue in 2025. I think the thing that the market really liked to hear, and something that I was glad that they talked about, is they're expecting margins to expand, as well as free cash flow to expand. Basically, if the way it works is they sign these big deals with sports leagues, and until they get things going, there's actually a lot of expenses early on. So the idea is to get scale over time as you move through these contracts. And the signal for margin expansion and free cash flow expansion along the way is a sign that the business model is still working. Like, what they predicted could happen. Basically, it's a reassuring signal that we didn't overpay for access to the data from the sports leagues, right? And that's the investment that they have to make. There's also something very interesting. They're getting paid to take the sports betting rights from IMG Arena. I did not stutter because I had to read this a number of times.
I saw a headline about that.
But they are getting paid to acquire part of the IMG Arena's sports betting rights. So which is fascinating. I haven't seen any details yet, so we'll see what happens when the filings come out, if there's any more in there. But basically, it's incremental growth for their business. They get some data from the tennis league, from Major League Soccer, and a couple of other things. So it's incrementally additive, as well as we get a little money along the way.
Was it kind of a lemon or what?
I don't know. I need to go find that out because I'm absolutely intrigued. There might be a turnaround situation, Tom. That's definitely a possibility that ran through my mind. Meaning, you may get a little money, but you're probably, do you have to spend a little money? So I haven't listened to the conference call yet. Because I was doing some other things, and when you get a good report, you might push back on. You might delay listening to the conference call, so there might be some more details in there. But nonetheless, the momentum, the business momentum, is still there with Sport Radar from a demand standpoint. They're doing a good job on the operating, from an operating standpoint, again, with the margin expansion and free cash flow growth. There's the shifting their business to make AI front and center in terms of their technology stack does also seem to be working. They said that that's actually helping to increase margins along the way. So, the company is firing on all cylinders. And yesterday was a good day in the market for the stock price. So I think it's, from a long-term standpoint, like we talked about, started the show with, this is a business in a good long-term trend, that's a leader in the segment, that operates well, has a strong management team. It's a lot of foolish qualities there for a good business.
Does it serve companies like DraftKings and those sort of consumer-facing betting companies?
Pretty much any. I'll hesitate to make a big blanket statement like this, but because there's a couple of other providers, but it is a leading provider of betting opportunities to global booking houses, global betting houses around the world. So there's a good chance that if you're making a bet on, let's say, the NBA, that the origin of that bet has come from Sport Radar.
So is it actually is it selling data to these companies, or is it actually taking the bet? Like I'm receiving your.
No, they do not take the bet. They take the data from, let's use the NBA as the example. They get the data from the NBA. And this is all kinds of data, player data, interactive data, real-time data as a game is going on from all the games that are being played, and they transform that into a betting opportunity. So it's not just, hey, I'm going to bet on the game.
Okay.
It could be anything that's happening, a prop bet, anything that's happening during the game. In fact, one little fun fact is the sport that's most bet on is tennis. And the reason that it's most bet on is because there's the most opportunities during the game, right? You can literally bet on, on a point by point basis of what's going to happen. Yeah. So it's a matter of the number of betting opportunities in the game that makes tennis so attractive from that standpoint.
So I just want to clarify: they don't have any risk. They don't take any betting risk. They don't
They have risk in terms of they have to make the bet attractive enough for somebody the bettor on the other side, right? To actually say, okay, I'm going to take you up on this bet, and in some of their contracts, the revenue gets shared, right? So there is a risk there, but they are not the booking house,
right? Okay.
They are a service provider.
The data arms dealer, I guess, right?
The sports data arms dealer.
The sports data arms dealer. That
provides... I give the company a glowing recommendation, and you.
Well, I didn't mean it as a negative thing. It's more of like, here's how you can make money. Here's how you can make money.
I mean, it's not entirely incorrect because again, that's one of the very interesting things, right? Like you could price this where the customer could never win, right? You could create a bet that's where the customer would never win, but no one would ever over time, no one would ever take your bet. Yeah. Right. So there's a very interesting trust aspect, right? A psychological aspect of not only is this a technologically savvy business, but it's an economically savvy business and a psychologically savvy business. And that has come from the 20 plus years of experience that sport data has in the field.
Yeah.
I've often watched sports and you see something like this player has kicked 4 penalties with their left foot in their 20-year career. And you're like, who collects that information?
Exactly. And you're going to bet, and you could bet on, is he going to take this one with his right foot? Right. I mean, like that's the way it works. What are the odds that he does that, that he makes a free kick? Like, if we're talking soccer or, the correct term, which is football.
Well,
as a soccer player.
I think I was reading that, or hearing here and there, that with the big college tournament going on right now, or about to start, there's been a lot of betting going on with that. So
you think?
Yeah.
It gets more and more massive every year.
Is this the college football or
college basketball tournament?
College basketball.
So is that March Madness?
The NCAA basketball tournament.
We're not allowed to say that. So I just called it the big dance.
I just said it.
It's fine. Yeah. The big dance or the tourney or something, I guess we could say. But
and today is the day where the tournament actually kicks the official bracket actually kicks off. They had the play-in games. So pro shop guy actually in our little feed, this is the day where business productivity goes down tremendously because there's literally games from the early afternoon.
Starts at like 12:15, like 12, correct. Like noon, and it's all the way to the evening. So
it's all the way to the evening. So
did the Fed reference that in their comments yesterday?
I don't think they mentioned it as a risk. No, they knew it was coming, so they already accounted for it in their model.
I feel like it could be a nice little opportunity for Sport Radar and some other companies that it'll be non-productive for some companies, but something like a Wingstop or something like that might benefit a little bit from people enjoying in the festivities.
Turning lemons into lemonade. There you go.
Yeah. I'm trying to make up for the arms dealer comment. I didn't want to come off negative there. I actually meant more like they're powerful, right? They have data.
And obviously, I was just giving you a hard time.
Yeah,
you rallied there. That was awesome.
So here's a question from Sedoff. I always never know if I say it right. Sedoff. Thoughts on ASO earnings? ASO is Academy Sports and Outdoors. I thought I'd take that because I've briefly followed it. It's a company that I actually like, and ironically enough, it's based out of my hometown where I grew up in Katy, Texas. So I recall going to Academy Sports as a child to go pick up sporting equipment or soccer stuff, basketball stuff, whatever. So it's a smaller chain that you may not fully nationally. It's not everywhere in the country. It's more local. It's more localized towards kind of the southern region since it kind of grew out of Texas. But they reported earnings today or this morning, I believe, and the earnings beat the consensus. The revenues were kind of in line with consensus. If you look at it straight from the quarter and the numbers, revenues are down, comp store sales were down. So 2024 it sounds like was kind of a rougher year for them. And I was just looking briefly at the press release because the earnings call is probably either going on now or about to happen. And it sounds like, when you kind of look at the management comments on the earnings release, and again, I haven't followed this too closely as of late, but it sounds like 2024 was almost like a reset year of sorts. They talked about, they made significant strides towards achieving their long-term goals while navigating a challenging macroeconomic environment. They're probably facing some, it's a discretionary purchases, so I'm sure they're facing some headwinds. Although I think, if I recall, Dick's has been doing very well. They're the largest sporting goods retailer, one of the largest sporting goods retailer. But it sounds like, they have a lot. Academy has a lot of stuff going on for the next year. New slate of brands. Jordan brand with they're launching the Jordan brand with a focus like shop and shops. Targeting and marketing in technology investments. They said that the first quarter is still going to be challenging, and they expect that the back half of the year is going to be better, and it's going to start picking up from some of the initiatives and the investments that they're taking. The one interesting thing about this company too is that, and this is probably why someone else asked, we need a scoreboard episode with Jim Gillies and Emily for this one, Aaron with no Bush. Because he said, looks like a decent report. One of the reasons Jim Gillies like this is they are very good at capital allocation. They're putting the money into their business like they believe they need to, but they also pay out like about a small 1% or so dividend yield. They actually, in this release, they said that they hiked their dividend by 18% per share, and they also repurchase shares very consistently. So they have a very good allocation of capital. And so while their top line numbers may not be crushing it, as you see from this earnings report, their top line sales, were down, yet their earnings still performed well. So they do a good job of that. And I like this business. I think it's very regional. The store experience is a little different from if you go to like Dick's. It's more. The cool thing that I used to remember about Academy Sports is, it's primarily in Texas, but it's also in a lot of other southern regions. Let's say, because I'm a big college football fan and basketball, but if you're like a local sports team fan, when you go in there, they have a huge selection of like local sports apparel. Like if you're looking to get Houston Astros or Houston Texans attire or gear or stuff, they have a huge selection. So instead of going to like a Dick's or Foot Locker or somewhere else to get your team specific stuff, you can go there and you'll have a broader selection. Now, if you're like in Alabama, I don't know if they have stores in Alabama, but if you're in Alabama, I'm sure they would have a huge selection of Alabama merchandise. So they keep it very local, and so it's a good company.
So I was going to ask, what makes Academy Sports and Outdoor different from the others, and so I'm guessing it's more that local flavor they bring to their stores that gets people to go to them and buy from them rather than online or from a national chain like Dick's or Target or Walmart or something.
Yeah, and it's reasonable too. I remember from what I recall, the prices are pretty reasonable. And sporting goods, while you can get them online, just like you can get everything else, if you're taking, they also have like deals, or like if you have kids and they're playing, local leagues,
Right.
you can get all the stuff you need for their local league. Like let's say they're playing baseball, you need certain bats or helmets or gear. You can go there and it's like, they'll know the local teams, they know the local leagues and what they need and require. They might have stuff for you there. So it's very, very localized and personalized. So that's another way to, and you want to go into the store and shop for these things. You don't want to, because you want to try on some of the gear. You want to try on some of the bats and equipment and shirts and stuff. So it's a little less prone to getting disrupted completely by online. I'm sure some of the like apparel could be bought online, but then again, if you keep it more localized, you're not going to get the selection you would online. So, and plus, I don't know about you guys, but maybe I'm old school, but it's just fun to go into a sporting goods store and check out stuff. Like I've gone with my son and we just kind of stroll around. This is going to age me a bit, but I was just talking recently with my son about it used to be an event to go into a Blockbuster and pick out a movie and then like walk around, see what movies are out, new releases, old ones, and then pick something out and then get maybe a snack and then walk out and you go home and you watch it. And like, it was fun. It was like an experience in and of itself. Now it's like you just sit on the couch and just, hey, search for, whatever, Ted Lasso, and just throw it on.
Yeah.
It's not as fun. You get it instantly, but it's not as fun.
The very last Blockbuster store in the country is not far from Eastern Meat. So if you
oh, that's right, it's
a
in
trip down
Oregon,
memory
right?
lane. Yeah, Bend, Oregon. Yeah.
How far is it? You should go there and take a picture. And
I should. Yeah, I've driven past it. I've never actually gone inside though. Yeah.
Wow, that's
Do
amazing.
it quick.
It's like
You
a
never know
relic.
when it might close.
Yeah, yeah.
I think they keep it. I think they probably do fairly well. I mean, I think they keep it open for nostalgia purposes, like a museum. So I think it's more of a. I don't even know if you can rent a movie from them. Even if you did, nobody's got VHS players anymore. So
Or DVD players, even VHS. You're
DVD.
taking it even further back.
Yeah.
yeah.
So I got a couple of, I'll give a, going back to the macro situation, Hold Long and Prosper says, today's stagflation worries are nothing compared to what we experienced in the 70s. Inflation near double digits and no growth for several years. Remember? I don't honestly remember because I was born in 1970. but that being said, there's another one a little further up from, sorry, where is it?
Was it Ted Haas Options?
No, that's the one I wanted to get to next. But basically, oh, there it is. Spiffy says, hold long and prosper. I remember getting a 16.5% CD interest rate in the 80s. Crazy times. I actually remember my parents buying a house during that time because we moved. And so could you imagine 16, 18% on a mortgage. But yeah, I mean, the 70s had high inflation, 2 recessions. The 80s I believe had also 2 small recessions and then even higher inflation. So yeah, the combination of those 2 things can be bad, which is why we pay attention to it. And then Ted Has Options said, when you're wasting only 10% of your 13 minutes looking at macro, what else do you check? That's actually I appreciate the other comments, but that's a good question. It starts with me for what's happening with the consumer. The consumer is so important to our economy. So I look at confidence levels. I look at retail sales. I look, just keep an eye on what things you're buying, what the trends are. But there's also you can look and see from that standpoint, how is e-commerce doing, since technology companies are another one that I focus on. So you can see not only what's happening in the macro situation, but perhaps what's happening in an industry or a sector that you follow. I pay attention to interest rates. You mentioned the PGI, which is an indicator that says, hey, how much money is on the sidelines? It's one of Tom Gardner's favorites. That definitely want to be paying attention to that, because if basically the theory goes, if there's lots of money on the sidelines, there's quote unquote lots of fear. And as we know from Warren Buffett, when there's times of fear, that can be a good buying opportunity. VIX is another quote unquote fear index, meaning is the market expecting short-term volatility to increase? So the higher the number, the more it's expecting volatility to increase. There can be times when you can, use those things in combination to see if they're, along with like what's the price of your stock doing relative to your valuation, right? That's what we're searching for. We're searching for those mismatches within, fundamental data versus sentiment that's in the marketplace that can create, the longer term investing opportunities. So those are a few places where I look.
Yeah. Excuse me. Oh, excuse me. I don't tend to look at macro that much, like I was saying earlier, but I do look at the VIX. I do like to kind of take a look at if it's spiking and what's happening, only to kind of gauge, what kind of environment we're in. If it's very volatile, then I know that, all right, if I do buy some stuff, well, it could mean like it's a decent time to buy because a lot of stuff has gotten beaten down, but I have to be wary that it's volatile, right? So I may buy something and it may continue to go down. So, and then once the VIX kind of starts to settle down a little bit, then I know, all right, I could buy something and not worry as much about it going kind of haywire, or the market's just kind of being haywire. Although I do delve into small, medium, growth stocks, so that's always the case where they're going to be could go haywire as well. So yeah, and the historical average for the VIX is about 19. Just for reference, it's at about 20 now. And about just a few weeks ago, when we had that big downdraft, or actually last week, I should say, or the week before, it was at 27. And then when I like to look at it historically too, and in August of 2024, not too long ago, it had spiked all the way to 38. And then, just for even more reference, you look at it way back in the good old pandemic days, it had spiked to about 75.
And if you go back further, I actually remember it touching almost 80 in the Great Financial Crisis.
In 1929, David.
What's
in 1929.
And what's interesting about that, and this is why I look at the VIX, is when you track it historically, 75 in the pandemic, and would you say it was like 80 something?
I know it closed just below 80, but I'm pretty sure in the intraday spike it got above 80.
Yeah, so now looking back on that, hindsight's 2020, looking back on that, those were high VIX numbers. They call it the fear index too, right? So yes. Rightfully so. If you think about, if I had put some money to work in those periods, yes, how well off, and held for long term, because that's what we do, we hold long term, how well off would I have been right now? Pretty well off.
Yeah, let me do a quick check.
And that's why I kind of use it as like, all right, things are very volatile right now. Things are kind of hectic. The markets are crashing. Everyone's panicking. It's gonna revert. It's gonna normalize.
That was October. The high of just over 79 was in October of 2008. So that was when the money market fund they broke get away from their peg of $1, right? There was a lot of volatility going on in terms of that's the start of the financial sector dropping. And so, yeah, that was the actual, in terms of the VIX, the height of the fear. But the markets actually went down considerably between that and the low of March 2009. So you probably still would have done pretty good from at that standpoint, but there would have been a lot of pain along the way.
Yeah, I mean, you can, again, it's not a market timing tool, but it is, if you're a long-term investor, at least you can use it as a gauge of, hey, the
Correct.
markets are crazy right now. Things are getting wild. If I have some cash to work, maybe now's a good time to start putting some of it to work, knowing that full well in the short term it could still decline, but in the long term, if I'm buying something like, I don't know, like an Alphabet or Apple or something that I know I'm going to hold for 5 plus 10 plus years, I think I'll do okay. Like if you're to go back and look at those prior VIX periods, and let's just take Apple or Alphabet or something, what the prices were there, and you had put money to work, what it's doing now, you might have been pretty well off. And again, not a market timing tool per se, but like just a general gauge of when I can start putting some money to work. The real fun is picking which companies you want to invest in, or it could just be the SPY.
Yep. Yes, and this is why I don't look at just one thing.
Yeah.
There is no magic indicator.
Absolutely not. No.
You combine a lot of things together and you can paint an interesting picture, right? This is why my process has changed over time to just basically say, hey, let me put my thumb in the wind of the current environment and let me see, like, okay, what's happening. How might that inform the decision that I make? And it very well could be, maybe I start dipping my toe, right? Maybe I start making some investments, but something else might say, hey, now is a time the risk reward profile has changed such that even though it's volatile, the reward is there and I'm not really taking that much risk. The idea is to get a picture in your mind of the broad market situation. It's not a timing thing. That's not what I do, at least. I don't think that's what a lot of fools do. So yeah. which is a good thing over the long term.
I know we have about 4 minutes, and I want to just briefly at least touch on this because it's just I'd be curious to hear your thoughts too. I haven't gotten to dig into this as much as I would have liked, but there was some report yesterday that Amazon's, and this has come out before too, but Amazon's potentially eyeing used car sales, trying to refine their shopping platform online. And I remember when Amazon was first out, it's like they had books, right? And then they started coming up with all these other things, and used to be like, why would you buy all this stuff on Amazon? And then over time, I was like, all right, well, the last thing to go is probably gonna be cars, or maybe not cars, maybe houses, right? Like maybe houses will be the last thing to go before, like in real life, so to speak. But yeah, I mean, they're looking at potentially entering the used car market.
So would they just act as a broker, or they're actually going to buy inventory of used cars and then resell? Are they going to be a dealer, or are they going to be a broker? Was that covered?
I didn't see that.
So in a news article, it says JP Morgan views Amazon's platform listings and transaction capabilities as essentially providing an alternative lead generation channel for new and used cars, and sees minimal risk of disintermediation of the dealer channel, given the complexities involved in franchise regulations. So the answer to that looks like no, just basically lead gen, advertise. Right. This is available, and you can come to our site and see that it's available.
Which makes sense for them, because then that just
there's no way they want to take that risk.
Drives traffic to them, drives more of their advertising business, which is huge.
I mean, there are so many online used car options out there that you can look, like CarMax and now I'm blanking. I know there are at least a few. I mean, I don't know what is Amazon going to bring to this space. It'll be different, special, and differentiated from the multitude of others that are out there, giving you the option to search for cars.
I imagine that's the sheer number of eyeballs they bring.
Mm-hmm. Okay.
Yeah, because
No, you're restocking on toilet paper. Just take a little look at these used cars.
You got toilet paper, car.
well, if we quickly go back to the idea of Airbnb and entertainment options in local demographics, right? You could get the same thing from Amazon if they have the data and
they know
you're
where you
willing to
live.
buy it to access like
Yeah.
targeted ads, right?
Yeah.
That's one way to think about it. Whether or not it'll be any more successful than all the other businesses that are doing that, I don't know, but it's probably a relatively easy thing for Amazon to stand up,
Yeah.
right? And sort of, you never know. Like maybe they hit an absolute home run, right? Because they can do it incrementally better, or maybe incrementally cheaper. I don't know. I am a little skeptical like you, Tom, but I don't think they would go. I think given the data that they have, it sort of makes sense to try, and they're always willing to try.
Well, I was looking up just because I was seeing a report here too. They already have, they're already in new vehicle sales and an existing partnership with some. So like Amazon Autos, actually it says beta on it, but I just went to Amazon Autos. You can shop for available cars, and there's like a listing of. And obviously, I'm sure these are just. It basically becomes a platform, probably, right? To say, hey, here are the cars available, and. Would you guys ever shop for a car online? Maybe, look is another thing, but actually buy.
I've shopped online. Do you know what you want? Absolutely.
But would you buy it? Obviously, looking that makes sense, but would you just feel comfortable just say, you know what?
I was told I went through the process and had to go to the dealer to make the execution.
Okay. But you did all the legwork and research and stuff online
because I knew what I wanted.
Yeah.
I mean, that was the thing, right? If I don't know what I want and I had never test driven it, or, if I had not quote unquote kicked the tires, so to speak, like at that point, I'm just a price shopper. So,
yeah.
All right.
Well, we're at the top of the hour, and I see the Bryans here. So wanted to say thank you, fools, for joining us on the morning show. We hope we're roughly good. We hope we're good. We'll be better next time. We're facing on the glass for Shorter and Tasha Hall. I am Samiteo. I'm joined by David Meier and Thomas King, and we'll kick it over to Feroldi and Stoffel.
All right. Thanks, guys. Brian, I haven't learned to put your title underneath your name here. So you're a financial educator today, and I'm nothing.
You're just blank.
Yeah. It's really too bad.
Seems about right.
Yeah,
that's
fair.
The Stoffel I know. No labels.
No, yeah, that's true. No labels whatsoever. Here's another thing that's a little bit scary. I'm going to try and share my screen, and we'll see how I do with this.
Yep.
So you tell me if you can see this on the screen. I see that.
Not yet.
It's pulled up at the bottom. I'm just waiting to see if it gets pulled up all together. Maybe Natasha needs to bring it onto the screen. I'm not really sure, but do you want to let people know what we are talking about today?
Today, we're talking about position sizing, a really important concept to understand with investing. It's broadly asset allocation, but if you're a stock picker like we are, it's important to know how to size positions appropriately in your portfolio. The goal with smart positioning sizing is to maximize your upside potential while minimizing your downside risk. Easy to say, hard to do.
Yes, that's true. And Brian, I think that this might be, and I see it's pulled up
there
now.
We go.
I think that this might be one of the most important things that we can say about this, which is that what we're going to present here is just one way out of probably hundreds of different ways to think about position sizing. So this is not the right way. It is not the Motley Fool party line way of thinking about position sizing. It is just, I've been investing for about 15 years. And so I made this slide deck to talk about how I think about position sizing. And Brian, you know what's in this presentation. Is the way that you think about position sizing going to mimic what I am about to present, or are there some important differences?
No, I do it my own way. I would say that from a high level, we're aligned with thinking about position sizes differently. I just go about it differently than you do, and your returns are higher than mine, so I say that your way is better.
Yeah, it could also change within the next couple of weeks. So who knows?
I would say that I'm pretty good at analyzing companies. I'm not as good as allocating them appropriately in my portfolio.
Okay. Well, as we go along, I want to make sure, because if you can man Slido and just make sure that we've got any questions, but I want to stop and talk about the differences between your approach and my approach so people understand that there are more than one right way. But our goal for this presentation is that at the end of it, you'll be able to at least understand how Brian, it's Brian Stoffel, chooses position size based on the risk reward profile of a stock. Now, we're going to talk a little bit about this guy, Joel Greenblatt. Brian, are you familiar with Joel Greenblatt?
Read his book a long time ago. Yes.
And I'm guessing it's this book right here, The Little Book That Beats the Market?
Yes. I think he has another one too.
He
What's another one called? I'll think about it. I read his other one.
Okay. This chart right here, which I know is a little bit tiny, but I think it's absolutely fascinating, has some of the greatest investors in the world. Here's how you read it. This x-axis that goes from left to right is the number of years that an investor has a track record. And then the y-axis that goes from 0% up to 30%, that's actually not, Brian, returns per year. That is how much the investor is beating the S&P 500, including dividends, per year. So like, even if you are in this lower left-hand corner, you're still a winning investor. Even if for just 10 years you beat the S&P 500 by 2%, that's pretty good, right?
If you're on this chart, you're outstanding.
Yes. And Warren Buffett, for what it's worth, is all the way over to the right. So when this chart was made, between 55 and 60 years, and beating the S&P 500 by over 10% per year. Now, this guy right here, Joe Greenblatt, he shows up here. So what that means is his record was about 20 years, and he outperformed the market by over 25 percentage points per year.
What a run.
Yeah. When he was a managing partner at Gotham Capital, he had annualized returns of 40% or more for 2 decades. And one 10-year period, it was 50%.
Pretty
Just
good.
amazing. Are you familiar with Shane Parrish, Brian?
Yeah. I was listening to his podcast yesterday.
You want to tell people the name of it, just in case they're interested?
The Knowledge Project. Shane Parrish, The Knowledge Project. He's from Farnham Street, for those that are more familiar with Farnham Street. I actually have his book series, the Clear Thinking book series.
Yes. All right.
Right over
So
there.
he had Joel Greenblatt on his podcast, where Greenblatt talked about basically everything in investing, at least when you're running a fund, comes down to risk and reward. And here's what he said, and I thought this was great. Now, the context, the only context you need to know is he gave this talk a year after Tesla had gone up like 6 or 7x. So he said,
2019.
yeah,
2020.
he said, if you have this great investment, Tesla last year, that's going to go 10x, and you put 2% in it, well, you could have blown it. That could have been your worst investment of all time. Now, Brian, I don't know about you, but if I have any stock that goes up 5 or 6x in a year, I don't care if it's up 1% or if it's 1% of my portfolio or 10, I'm going to be bragging about it. Would that be fair?
Yeah, so you can continue the quote, but I think it's important to distinguish between being a money manager and managing your own money.
Yes, and he is a money manager. Because what he says is, sure, you own Tesla, but if it was just a 2% position, that could have been the worst decision you ever made. Because if it was a 10% position, it could have been a move the needle position. So he says that being too timid on the few good ideas that come your way, he thinks is the biggest mistake that people make. So I just kind of summarized what Joel Greenblatt said, that when you're thinking about the reward side of the balance, He's saying, don't be timid with your best ideas. But what makes Greenblatt such a good investor is that he didn't stop there, because then he said, on the other side, on the other hand, to take a large position, you have to be willing to be wrong. He says, the biggest positions I've had are not my best ones. I think it's so important to just say that again. The biggest positions I've had are not my best ones. The ones that I think are going to 5 or 10x. I'm really looking down, not up, when I take a big position. So he says, I'll size the position larger if I don't think I can lose that much money. It's looking at how much you can lose from that position if your cost basis is going to be huge. So the reward side is don't be timid with your best ideas. But on the risk side, he says your biggest position should have the least downside. So I've just kind of laid out from 30,000 feet the philosophical way of approaching this. Would you say, are there huge differences between you and I when it comes to how you think about risk and reward?
No, I feel the same way. If I'm going to take a substantial position, if I'm going to put a substantial chunk of my net worth in something, I don't want the downside to be minus 100%.
Yeah.
I want the downside to be a market losing.
Sure.
Market losing, right?
Mhm.
Or some. So that's how I think about allocation. On the flip side, if I find something that I think can 100x, right?
Mhm.
If I'm swinging for the fences, I'm a big fan of Tom Engel's quote, right? If this is the next Amazon, a little is all I need. If it's not, a little is all I want.
And I would say the difference between Tom Engel and Joel Greenblatt is he would say you'd want a little bit more than a little, but not, a huge percentage of your portfolio. Before we move on, just want to see if there's any questions in Slido.
Yeah, so lots of people saying good to see us. So thank you all. It's good to be back. We are here one time a month, so it's a rare time that we're invited on Fool Live. And Jimmy G was asking for the Knowledge Project guy's name. His name is Shane Parrish, Parrish. But if you go to the podcast and just type in the Knowledge Project with Shane Parrish, his blog is called Farnham Street.
And I'm not certain, was he like an intelligence officer for the Canadian government or something?
Something like that.
Okay, all right.
He's smart.
Yeah, he's a very smart guy. I know
I view him as the Morgan Housel of Canada.
Yes, exactly. We both basically just said the same thing. All right, so I want to talk about how I took Joel Greenblatt's, what he had to say, and kind of created a framework for myself. Again, I don't encourage you to copy this. I encourage you to look at this as one of a plethora of ways that you can use this idea. So I started out by building what I called anchor positions. So what's an anchor position? Well, that's a company that has a wide and established moat. It has an attractive valuation. That's going to be an important differentiator in a little bit, but an attractive valuation. It usually has less upside potential. And personally, I'm willing to put, this is a big chunk, 7 to 15% of my portfolio. And that's not 7 to 15% in anchor positions in total. That's 7 to 15% per stock into things like an anchor position. So for me, that's how I handle the risk side of it. And I'll just throw in one thing before I get your comments on this, Brian. I also consider cash to be an anchor position. So currently, I actually have about a 15% cash position.
Woo, that's high for you.
It is very high for me. It is.
I'm 20%, which is an all-time high for me.
All right. All right. So I'm curious, would you ever, on a cost basis, devote 7 to 15% of your portfolio to any stock?
No.
Okay. But you have stocks that get to be that big, right?
Yes.
How do they do that then?
Appreciation.
Okay. And they just, why would you not? And it's not that it's wrong, but I think it's good to hear. Why wouldn't you do that?
Experience.
What do you mean by that?
I've learned the hard way that as much as I might like a company, the market, I might be wrong. And I'm a fan of essentially my portfolio. My personal plan with this is to put lots of seeds into my portfolio, and then let the ones that sprout dominate my portfolio, which is the exact same way that the indexes work.
Yep.
Right. So be reluctant to sell, especially winners, and let them earn their spot in my their position in my portfolio. Like 6 months ago, Tesla was my biggest position, not because I wanted it to be, but because it grew to be that. Over the last 6 months, it's no longer my biggest position, but
for 6 weeks.
Yes, there you go. Mercado Libre is my biggest position right now, not because I set out to make it my biggest position, but because it grew so much that it became my biggest position.
Yep, that makes
and I feel
sense.
way more confident having a lot of money or a lot of my net worth in a single company in an anchor position if it earned its way in there than if I forced its way in there.
Well, and one of the nice things about that approach, it's not the one that I take right now, but one of the nice things about that approach is a lot of the times, I mean, when I'm talking about an anchor position, I'm usually talking about, it doesn't have to be a blue chip stock, quote unquote. But if you think about it, what do you max out a position as in terms of if you're just what you're buying, not what it appreciates?
3%. Okay,
3%. So if you put a company in at 3% and it grows to 15% of your portfolio, this isn't true all the time, as in a la Tesla, but usually by the time they reach 15%, those, would you agree, tend to be more stable businesses because they're older, they've grown more, they tend to be, not always, but a little bit more stable. Because if I'm not mistaken, like MasterCard and Visa, I know that you are big fans of companies like that.
Yep.
Those can be a much lower beta stock at the very least.
Yeah. So if I think about my top holdings, they were all companies that I bought a long time ago that I didn't sell, and they just grew and grew and grew. And so like Mercado Libre, Netflix, MasterCard, Meta, and Tesla are 1, 2, 3, 4, 5 for me.
Yeah.
So would you consider those all? I mean, they're all almost exclusively in the capital return phase, or
maybe not Tesla yet, I would say.
Well, it depends on your.
They go back and forth.
Yeah. Yes. My top holdings are all now large, dominant companies that earn their way in there.
Yeah. They're not, at the very least, they're not micro cap stocks.
Correct.
All right. So I want to talk. So my number one cash, but another one is Amazon. And I do know that Amazon can be quite volatile, but it's my largest anchor position because it's got network effects with their, merchants go and list on there. It brings in customers. There's switching costs involved with AWS. It's got low cost production in terms of its fulfillment. It's got brand value. So it's got a wide moat, and I actually think a pretty attractive valuation. So that's an example from my portfolio. I have this other, this is kind of like an extra one. I have this thing called starter positions, where if I'm not familiar with a company, but I'm intrigued by it, I'll put between 0 and 3% of my portfolio into that. So my starter position is kind of like your positions in terms of the cost basis. All of yours would fit within the bucket in terms of allocation of what I do for a starter position.
Yep.
Yeah. Do you ever do that? Like, you have a company that you've heard a lot about. Maybe you haven't taken a dive into all their annual reports or their investor presentations or interviews with management or testing out the product. Do you do that sometimes?
So I like what Tom Angle says again about companies. When he buys a company, that's the least. That's his minimum knowledge level about the company. It's passed through a filter. He's ran through the earnings reports. He's ran through the 10Ks and stuff like that. But your knowledge about the company grows over time.
Yep.
You get new information. You get new earnings reports. You learn the management style and everything like that. So yeah, when I make my initial purchase, I want to make sure I'm over a minimum threshold of knowledge about the investment, but then my knowledge will increase with there. Plus, I'll learn about the company's execution.
Now, let me ask you this. Would you ever allocate the full 3% to a stock that you've done all that research on, right? But you've never owned it before. And it's not, let's say you'd never earned Meta before. Like, you know what Meta is.
Yeah, exactly.
Everybody knows what Meta is. So like a non-consumer facing stock, would you ever do that?
It depends on the riskiness of the business.
Okay.
So Microsoft, I would have if I was interested in buying Microsoft, I would have no problem putting 3% of my capital into Microsoft.
Makes total sense.
Instantly. If it was a new IPO that I was interested in, that even if I'd heard of it and knew a little bit about it, completely different story.
Yeah. So you wouldn't run out and make, I'm just pulling it, the most popular recent IPO out of a hat, Reddit. Yep. Even if you read all about it. In fact, I think you did a video for us on YouTube about it, but that's not one where you'd be running out to fill your full 3% right off the bat.
Yeah, and that's because mostly where Reddit is in the business growth cycle stage. So I think if memory serves, Reddit was in stage 2,
which means they're not profitable yet.
Correct. They're not profitable. They were losing money, but their loss was shrinking. So if Reddit was in the stage 5, when they were already buying back stock, paying a dividend, they were optimized for profit, they'd already achieved scale, I would feel much more comfortable in doing it. So I rely heavily on the business growth cycle, and the closer it is to stage 5, the more comfortable I am investing more in the outset.
Well, I'll say this. My approach to starter positions is maybe a little bit blasphemous for what we both came up with in the Motley Fool's ethos of how to invest, in so much as I'm okay taking a starter position if I've done about 50% of the work that you have, because these are usually like 1% positions, and I know that it's not going to move. Like, even if it loses 50% of its value, then my portfolio goes down by 0.5%. Like, it's not the end of the world. And I'm willing to buy something I'm interested in. The fact that I own it is my motivation. I put my skin in the game, so I'm going to do the research now. And I might 3 months later be like, yep, done. Like, not interested anymore.
You're better at changing your mind than I am. So,
Fair.
So that's given your ability to make put companies on a shorter leash. That makes sense to me. And then we should mention Stanley Druckenmiller, one of the greatest investors ever. His motto is invest and then investigate. So if he gets excited about an idea, he puts money into it right away, and then he starts to, and then he researches it. However, he can change his mind at the snap of a finger.
Yeah,
like, he is incredibly good at changing his mind about an investment, and that's just the style that works for him.
Cool. All right. Example, most recent one that I made was AST Space Mobile. I'm not sure. This is not a recommendation. It's just an example. This is not only a stage 2 company, Brian, but it's pre-revenue. So this is not a suggestion to go out and, buy a whole bunch.
Stage 1 then.
What's that? So, yeah, it's in stage 1. So I might spend a little bit of time researching and be like, yep, done. And I'm okay with that. That is not a problem for me. This next part, this is the important part of the reward side of Joel Greenblatt's equation. And I call it the booster position. And I think this is where, the anchor position is about controlling that downside. The booster position is like giving you that upside potential. So companies where the moat is not only developing, but in my opinion, it's getting wider. It doesn't have to be an attractive valuation. It just needs to be not crazy. It just needs to be reasonable. It needs to have enormous upside potential. And I'm willing to devote 3 to 7% of my portfolio to a company like that. And an example, Brian, I've probably drilled this into your head over the last 10 years. Axon has always been my number one example in the company behind police stun guns, body cameras, things like that. Just any comments there about would it be fair to say, I feel like in your portfolio, most of your positions kind of mostly fit the description of what a booster position is for me. You just max out at 3%.
Yeah, well, if I look at my portfolio today, I would say most of my positions are anchor positions, or at least that's where the majority of my capital is.
Sure.
But they weren't
Right.
when I first made an investment. They would have
These are the
classified.
seeds.
They would have classified as booster positions for you.
Right.
Yeah. And it seems like the difference between an anchor position and a booster position for you is the moat and the growth.
But valuation too, because I'm actually willing to cut an anchor position if it gets really, really expensive. So I used Amazon as an example. I doubt I would like cut it entirely, but it's a huge position for me. I think it's maybe like 12 or 13%. And I'm not sure. I think it trades for about $200 per share. If something happened and tomorrow it was trading for $400 per share, I would trim that because the valuation is not it. I'm not controlling for my downside as much anymore, which is what that anchor position is really for me, if that makes sense.
It does.
So anyway, that kind of tells you the way that I think about it. Anchor position, a booster position, a starter position. Another way of thinking about it is that anchor position, I want to be a market beater. And that, Brian, that would be why, like if Amazon doubled tomorrow, I would probably, depending on why it doubled tomorrow, I would start to be a little bit concerned about that being able to be a market beater moving forward. The booster position, higher risk, but it could 10x, it could 100x. And the starter can, it depends on where it would be. So let's just pause there for a second and again, see if we've got any questions.
Kent asks, what type of accounts do you consider a cash position?
What type of accounts?
Yeah, I would assume you're talking about cash that is held in your brokerage account that is uninvested.
Correct.
And I'm also guessing you just keep it in cash. You don't put it in money market funds or anything like that.
Correct. A part of that is because, as you said, Brian, a 15% cash position for me is huge. But I could understand why some people might want to. What do? You've been sitting on a huge cash pile for a while.
Yeah. So for example, do you consider an emergency fund cash?
No.
Yeah.
No, because I'm not going to put that in the market ever.
Yeah. Yeah. Personally, I have my personal finances and I have my investing finances. And when I say a cash position, I'm only talking about the money that's in my investing finances. Does not include my regular savings cash emergency fund.
Out of curiosity, Brian, when your cash is sitting there in your brokerage fund, is it earning interest?
Yep. Yeah. So I use Interactive Brokers, and they're paying like 4% or something like that, 3.8%.
That's not bad.
No, it's really good. Yeah, I've thought about putting it into bonds to get a higher to earn a higher return, but then you're taking on interest rate risk.
Yeah.
Because if interest rates increase, which is possible, then I don't want to take principal risk with that. So I'm happy to earn just whatever the going interest rate was. I think at one point Interactive Brokers was paying like 4.5% or 5% or something like that. But that's what I do. What do you do?
I just let it sit in cash, and I don't in what I have, which is an E-Trade primarily. It doesn't pay much, but again, I'm usually not as high as a cash position as I am right now. Any other questions in Slido to get to?
Yeah. So there was a question about at what point would you rebalance your portfolio?
Oh, that's a great question.
Percent that its stock gets to, or do you just let it ride?
You know what? We're going to cover that next. But I'm going to be curious to hear what your take is.
15% for me is when I get uncomfortable.
Okay, that makes sense.
So it depends. So it depends on the company. It depends on the riskiness of the company, and depends on the valuation.
Yeah.
So I will say if it's a high risk company trading at a high valuation, I start to trim at 10% of my net worth.
What is the highest a position has ever gotten in your portfolio?
100% when I bought my first stock.
Yeah, not including when you got started. Obviously, it'll be about
probably 12 or 13%.
Okay, mine was 21%. It was Shopify in late 2021, which which was the impetus for starting to incorporate more valuation into my investing framework. Because for those who aren't familiar, it then fell 80%.
Nathan asks, would you shift your percentage thresholds downward if you're more comfortable with greater diversification?
Yes.
Or would you consider allocating a portion to index funds?
No, yes, I would. I like, I still aim for the Motley Fool of 15 to 25 recommendation of 15 to 25 positions. I just am closer to that 15 than the 25. But yeah, absolutely. All right, let's move on. And I just want to talk about, this gets to what Brian was talking about, where he plants a lot of seeds and there's some trees that grow and then some that just wither out and die. A position in my portfolio can go from 0 to 3% all the way up to 15% in two ways. You can buy more shares, or as happens in Mr. Feroldi's portfolio, the stock just goes up. And those are the positions that end there. Same thing on the way down. Positions can go down because you sell some shares or because the stock goes down. So there's two different ways of looking at it. Great example in my own portfolio, and this was a lesson for me. I bought this company called Transmedics back in November of 2023. Not a stock advisor recommendation, just stock I was curious about. I think he's TMF Genghis on, kind of brought it to my attention. It's a company that helps keep heart, lung, and liver alive for longer in the transportation from a donor to a donee. So I had a starter position. It went up by March of 2023. It was at 3%. I bought some more, brought it, and I said, hey, I'm comfortable graduating this. I'm going to graduate it from a starter to a booster, and then it went up even more. And so the question then becomes, boy, if you have a position that, like, for me, crosses this line, well, what do you do? Well, just to review, the anchor position is about wide moat and attractive valuation. The booster for me is about growth and a reasonable valuation. The starter is just a starter. The question is, well, what do you do if it crosses over that threshold? And for me, it's carefully watch the direction of the moat and the valuation. So I'm going to give you an example from real life. And again, these are not stock recommendations, but they're real life examples for me. So last year, Brian, let's say the middle of the year, I had Axon, I had Tesla, Shopify, and Duolingo all as 7% positions. So like maximum booster positions in my portfolio. By late December, here's where they were. Axon was up to 12%. I don't know if you follow, but it went from like $200 a share to like $700 a share. It was crazy. And then these other three, Tesla, Shopify, Duolingo, they all jumped up to 9%. So I'm sitting there and I'm like, holy moly. These look like anchor positions, but they don't have the characteristics of anchor positions. So for me, what do? I want to look at the direction of the moat. I want to look at the valuation. So I just made this little chart right here. I listened to the conference call. This is what I said. Axon, moat's expanding. Tesla, I'm all about what exists in the real world, not the promise of tomorrow, right? So I'll give Tesla, seems like in December, their moat was stable. Their brand is suffering a little bit right now, but it remains to be seen if people are just waiting for that new model to come out or not. Shopify and Duolingo, definitely expanding. And so I did some analysis. And what I did for my analysis, Brian, was I did a reverse discounted cash flow analysis. And we're not going to get into how to do that today. But basically, I did some valuation work. And I said, okay, if Axon had a 30% free cash flow margin, which, by the way, it doesn't, but if it did, then in December, it would need to grow its revenue by 29% per year for 10 years. Now, you're shaking your head. Why are you shaking your head?
Those are some awfully high expectations for a company to achieve. Growing at 29% for 10 years is incredibly rare. And you're talking about a company at scale doing that.
Yes. So when I looked at that, to your point, I said, yeah, that's really optimistic. And at the same time, I don't want to sell it because I think Axon, the company, is unbelievable, super anti-fragile. But am I comfortable with its valuation? No. All right, Brian, I did the same thing with Tesla. Let me ask you this. Right now, Tesla's free cash flow margin is in the low single digits. If full self-driving, Optimus, Cybercab, if all those things hit, what do you think is the most like aggressive free cash flow margin that they could hit in the future?
Everything hits?
Everything.
So I guess it depends on at a blended company level. I would say it would be close to Apple. I think Apple's like 25.
Okay.
Apple 25%, something like that. But they have they're always going to be a mix of
Auto,
predominantly low margin businesses.
Yeah.
With perhaps their software is their only real chance at high margin.
Yeah. And I will say their energy storage is medium margin. Like it's decent.
What's their gross margin there? Like 30%, something like that?
But that's double what their auto business is. So
right. I mean, they make it to a point where their auto business is like a 0% gross margin business, and it's purely monetized through software.
So would it be fair to say that in December of 2024, my giving them an optimal free cash flow margin 25% is uber aggressive?
It's generous.
Very generous. 6x where it was at the time. Even if it did that, Brian, Tesla would have to grow its revenue by 21% per year to do that. And for what it's worth, expectations, and I take Tesla expectations with a grain of salt because they're all over the place. But, to me, that was really aggressive. I'm not sure. But to the point, though, you could have done this and seen it, and you might have said it's overvalued, but would that have caused you to make any moves in your portfolio?
No. For most companies in my portfolio, like you, I place far more emphasis on the now than the potential.
Mhm.
Tesla is an outlier in a bazillion ways.
Yeah.
And I'm willing to bet that full self-driving pays off.
Okay.
Yeah. But
Fair enough.
that is the bet you're making.
Yes, that's absolutely the bet you're making. Maybe less and less so as the stock goes down. But yes, that is the bet.
Yeah.
For what it's worth,
I don't want. Yeah. I wouldn't.
No, go ahead.
I wouldn't bet against Elon Musk. Period.
Yeah,
That has not been a winning
It's never
strategy.
been a good bet. I did the same thing with Shopify. Now, this wasn't a stretch too much. I gave them a 25% free cash flow margin. Shopify stock that you own?
Yes.
I think they could get there, especially since they got rid of their fulfillment business, which means lower revenue but higher margins.
What's Shopify's gross margin? Do you know off the top of your head?
I don't. It's tough.
I now know, but what do you think it is?
60.
50.
Okay. But their subscription gross margin is super high, like 80%. And their merchant solutions is super low. It's like, I don't know, 20.
Yeah. But you have to blend all that together when doing this.
Yeah. I thought Shopify was optimistically valued, so I gave it that. And then Duolingo, I don't think this is a stock that you own. Is that fair?
No, I don't. It's been a great performer, though.
Yeah. I mean, they already have free cash flow
Awesome
margin.
founder, too. Love Louis Van Aan.
Yes, their founder is great. By doing this, I said they need 22% per year for 10 years. And again, that is a high. Like keeping that up for 3 or 4 years, okay, fine. Keeping that up for 10 years, that's a different story. But their expectations were above it. So I said, you know what? This seems reasonably valued. So then this is what I did. I trimmed the first 3 and I left the last one where it was. So like, this is what I did in my portfolio in December. I trimmed these 3. I left this one where it is. So we just threw a whole bunch of people. Let me pause again and just see if we've got any questions.
Jimmy G says, would you invest differently if you were in retirement?
I think I would. I think I would focus. I think I would have. So right now I bet about 40% of my portfolio is in anchor positions. I bet I would do like 75% in anchor positions. Or more. Let me just say that, more.
Yeah. I think it depends on. So again, talking in percentages makes a ton of sense.
Yeah.
When talking about all this kind of stuff, what's often lost is the dollars.
Right.
So if I had $100 million portfolio,
Yeah.
right, I would want everything to be a 1% position.
Mm. Or 50% cash.
Right. No, a 1% position would mean I had $1 million in 100 stocks.
Yeah.
Right. If I had a $10,000 portfolio, I would be extremely comfortable having 100% of that in one stock.
Right.
Right. So that the dollar amount really matters for me personally. As the total dollar value of my portfolio grows, I'm okay with it being with the percentages decreasing over time.
Because, and I think this is worth stating, it's something I've actually talked about. Tom Gardner. Tom Gardner's done some research on this, and he has found that when they survey Motley Fool members, making money is more important than beating the market. Now, there's a ton of people that want to beat the market, but it makes sense that as you have more and more dollars, then getting 10% per year is less and less important, right? Because you can live off of your portfolio without being forced to choose how you live your day. And in the end, isn't that what this is all about?
Yep. Yeah, exactly. What's the point of this? What's the point of what we're doing here? We're trying to, money is a tool for leading a better life.
Yep.
Right. You can't spend relative outperformance.
Exactly.
If you beat the market by 3% per year, you can't if your real return is negative, but you're outperforming the market, that's a bad outcome.
Right.
So
from a how it affects your life point of view.
Moreover, once you've gotten enough money that you've won the game, does compounding it at a higher rate than the market really matter?
Yeah.
So,
I will
all
say
these
this.
things, that's why we're talking position sizing and percentages. It makes total sense. And when you're listening to money managers making quotes about them, it makes total sense to listen to what they're saying, but then think, am I managing somebody? Am I a professional money manager? I don't need to. Their goals and what you're doing as an individual are not the same.
Let me ask you this, Brian. If people are watching this right now, they love investing, right? Because who's going to take time out of the day to listen to the two of us talk if they don't at least love investing a little bit? Let's say you hit your number, right? Are you going to still approach the stock market in a way that you can see how you do versus the market?
Oh, I'm definitely going to look.
Mm-hmm.
Yeah, I'm always gonna check, but I'll be much more focused on absolute performance versus relative performance.
I think I'm going to carve out, like maybe I'll take one account that I have and I'm going to want to still run it. Maybe it'll just be 10% of my overall nest egg. And I'm still going to run it in a fashion that I want to beat the market just because that's fun for me.
So when you're an individual investor and you're going through the trouble of picking your own investments, as I'm guessing everybody here is, the thing that everybody assumes that you're going after is outperformance.
Right.
That's the assumption that everybody is making. And if you're not going after outperformance, why bother? Just index is what most people think. That's not the entire story. You could, when you're picking your own stocks, what you're saying is, I want something different than the market provides on its own. For most people, the different thing they want is higher return. But you could also want higher income. You could also want lower volatility.
Yep.
Right? You could also want absolute returns.
Yep.
So even if you're picking your own investments and you're underperforming the market, you still could be getting what you want if what you want is income or lower volatility. So that's an important thing to just keep in the back of your head. Even if you're going through the hassle of picking your own stocks and underperforming, that might be more than okay.
Yep. I love that. I love that. So I just want to show people like how I think about this moving forward. So let's say in December, I'm just using Shopify as an example, to 7%. And let's say that by this month, it had grown up to 10%. Spoiler alert, hasn't done that. I would do the same thing. I would look at the moat, I would look at the valuation, and then I would say, maybe I'll hold it or maybe I'll trim it. Certainly not going to add to it. Or let's say that it went down to 5%. Spoiler alert, that's pretty much what it did. Then I'm going to look at the moat. I'm going to look at the valuation, and I might hold it. I might trim it even more because something is on the horizon or something came up in the earnings report, or I might add to it and bring it up to 7%. Any other questions before we just kind of wrap up the end of this, and we can just have a discussion before we sign off?
Yeah, Vihan asks me, for building your cash position, do you trim some winners or try to add capital from your monthly
Good
paycheck?
question.
So the answer is all the above, except for I would also add trim some losers too. When I try and raise cash, the first thing I look at is my losers, not my winners, my losers. David Gardner's statement: winners tend to keep on winning, losers tend to keep on losing. When I'm looking to increase my cash position, I used to sort by biggest winners and trim the top. Now I do the exact opposite. I look for biggest losers and trim those. One, because you get the tax benefit of doing so, or at least offsets some of your immediate tax benefit. But I don't want to water my weeds. I want to water my flowers, or at least I don't want to trim my flowers. I want to trim my weeds.
Yep. That makes total sense. And just as a fun little follow-up, how did that decision work out from December until 2 days ago? Axon was down. Tesla was down a lot. Shopify was down. So this is very short term, right? We shouldn't be throwing any parties about this, but this is how I built up that cash position. Duolingo was also down. So maybe holding it there didn't really work out for me. But again, this is short term. To just kind of review, and then I'll take off of shared screen. Risk and reward, two things to consider. I've developed 3 different types of positions to address that, and they have different characteristics and different things that I look at based on how the positions are doing. So that's how I think about it. So Brian, what other questions might we have? And we can have a little discussion here as we've got 15 minutes left. And as Brian said, we are only on once a month, so we love having an opportunity to answer whatever questions you guys might have.
Well, the most upvoted thing is from Miss Melanie, who says the Investing 101 show, the Investing 101 show consistently makes me smarter, happy, and richer. Would love it if Fool made this a weekly show.
Woo!
Like
I don't know if we could do a weekly show, but I love that sentiment.
Yeah. I assume the Investing 101 is what you're talking about that we do.
I hope so, because that would
pretty
be
much
really mean if it wasn't.
exclusively what we do. So thank you for that wonderful comment. So yes, Fools, if you have questions, please head them over to Slido about capital allocation. We're happy to answer them. Brian, one thing I do want to point out is when it comes to capital allocation, my strategy, which has been the strategy for a long time, is I buy in micro positions and I like slowly build them over time. And when I'm exiting, I do the reverse, just with like larger chunks. If I'm exiting a company, it's almost because I've lost faith, or I'm like, I need cash, so I'm willing to sell a bigger position. But I don't mind taking small little chunks and kind of adding them along the way. And again, I'm a big fan of having my biggest positions earn their spot in my portfolio, not forcing their spot in my portfolio. In fact, I have a pretty good history of when I force something into my portfolio, I'm forcing the wrong thing.
Yep.
And I've heard this from a lot of other money managers that are like, we always have our money in our 20 best ideas. The problem is it's always number 7 that's the best performer.
Yep. Well, in that light, I have learned the same lesson as you. So anyone who's been with Motley Fool for 15 years might know this. My stock that I was most excited about when I wrote my first article for Fool.com, and this is in 2010, was Rosetta Stone. And I was just so excited about it. I put like some stupid amount, like 20% of my portfolio into it, and it absolutely tanked. It did not work out well for me. And so I learned that lesson. I've learned it a number of times. What I will say is that if there's a stock that's kind of boring,
you might be back to break even on Rosetta Stone by now if you still held, by the way.
Yeah, well, I think it got bought out.
It got bought out for $30 a share.
I'll say I left well before then,
Yeah.
so it did not work out well for
Hey,
me.
you've done pretty well with a language learning software.
Yeah, Duolingo has done what what Rosetta Stone should have aimed to do way back when. They didn't have Luis von Ahn back then though. The thing that I'm okay with is like, if it seems like the stock market's getting really, really expensive and things are like, let's say late 2021 type situation. If there's a stock that like puts me to sleep, that would be the one that I'd be willing to put more into. The example that I use is like Berkshire Hathaway. I would be okay not doing little bits. To me, what's the point of just adding little bits of Berkshire Hathaway, for instance? Like, if you want Berkshire Hathaway, just make it whatever position you want to make it. That's my approach to that. So I don't always bite off little pieces.
But I did look this up when you mentioned it. E-Trade currently pays 0.01% on uninvested cash.
So you're saying I'm not getting very much for my position sitting there.
Interactive Brokers pays 3.8%. Looks like Fidelity pays 2.5%. Robinhood pays 4.5%. Public pays 3 point something. Anyway, would that be a reason for you to switch brokers?
Switching brokers is such a pain in the butt. I mean, have you ever done it?
Yeah, I've done it. I've done it twice.
It's a pain.
It is.
I don't know. I don't know.
My first broker was Scott Trade.
Mm-hmm.
Scott Trade, I went with them because it was $7 to buy and sell, which was by far the lowest thing at the time. Then I switched to Scott Trade's options when I got into options trading, and I wanted to be able to use options. That required believe it or not, that was a change of brokers to go from Scott Trade to Scott Trade's options. Yeah, I had to go through that. And then I switched to Interactive Brokers in 2012 because they allowed you to trade for $1 per trade. And I was like, okay, $1 versus 7 is worth it times the number of trades I make in a year, which was all buying, by the way. I was like, that's a few $100 per year savings. And then they also paid interest on top of them. And then, since all of that, since the last couple of years, all of them are free. It's free to buy or sell, right? So that's not a thing anymore. But I've changed. And whenever I share my returns publicly, it's always from 2012, which is when I changed brokers.
Yeah, because brokers does do a nice job of conglomerating all that information for you. I do get a little bit jealous of that. One of the ongoing jokes between Brian and I is just how cheap I am. I mean, we're both cheap, but I'm really cheap. And so all of mine was with this outfit called Zecco Trading. Have you ever heard of that?
No.
Exactly. It does not exist anymore because it got bought out and eventually became part of E-Trade. But Zecco was zero cost. That was what Zecco was. Zero
that's
cost.
how you're an E-Trade customer. Yeah.
And they got bought out by someone else, and then that was bought out by E-Trade. And so that was my winding path to E-Trade.
Yeah. So it's like my bank. I'm with Capital One because I used to be with ING Direct.
Same here because they paid great
by Capital One.
And I think ING Direct was it Orange or maybe
yes,
known as Orange?
Yes. Yeah, exactly. Nathan here has a question. How often do you assess your positions that have moved yearly, quarterly, or when news leads to a big move?
So before what I had done was I did this once per quarter. And I always timed it at the end of earnings season. So relatively recently, at least earnings season for my portfolio. Once I have 15 stocks in my portfolio, once all 15 had reported, then I kind of take 2 days and I'm like, all right, I've looked at all these earnings reports. What do I think about these companies now? What have I learned? What does the valuation look like? And then I'll use the framework I have of the anchor, the booster, the starter to make adjustments based on that. So at least, once per quarter, I'm now thinking about doing it before earnings season starts as well. And Brian, the only reason for that is that a whole bunch of stocks that I owned from when I did this in kind of like December to when I did it in March, just went up and up and up and up. And I wish I would have looked before earnings season because they were all very, very, very optimistically priced, and I would have been okay trimming them, but I didn't do that with all of them. So what about you? How often do you kind of take a 360?
Depends on the company. If it's MasterCard, once a year.
Mhm.
If it's Tesla, every quarter.
Sure. Makes sense.
Yeah. If it's a starter position for me, it's whenever I get around to it.
Sure. Also makes sense.
Yeah. But most of my capital is in companies that I would like to Buffett's. I would feel very comfortable if I didn't get any information from those companies for a long period of time, stock price, earnings, anything like that. And I would be completely comfortable with that for, years even.
Out of curiosity, I just said I own about 15 stocks. From those, I would say the top 7 are maybe 2/3 of my portfolio. How many stocks do you own, but how many make up the top, I don't know, 50%?
I think I'm down to like 30 something.
Okay. How high did it get at one point in time?
50s.
Okay.
And I mean, this was what's nice about FinChat. Let me pull it up. And my top like 20 are like 90%.
Okay. So again, you might have 30, but they've naturally concentrated.
And my top 10 are 60%.
Yeah. Okay. That makes total sense.
Yeah. Again, I'm like an index.
Yep.
So like it's I'm overweighted in my largest holdings.
Yep.
Rose says, what do you like best about Interactive Brokers? It offered $1 per trade 10 years ago, which is when I bought it. Interactive Brokers is not beginner friendly. It's really not. It's got kind of a clunky interface, but it's free and they pay a really high rate on cash, and you can invest in almost anything.
And it's worth saying, it's also where your money is now. So you'd need a pretty good reason to change.
Yeah. If I was picking a broker from scratch, I don't know which one I would go with.
I would probably go with Robinhood just because it's so easy and it pays so much on cash.
Yeah.
But
I'm not a fan of having, I don't like apps on my phone.
Ah, that's fair.
Personally. Or at least I don't want to be tempted to check and trade easily.
Yeah, in a way,
I want there to be friction with
your friction is a good thing. You think
absolutely
it being clunky is a good thing.
Yeah, we've called out that having Motley Fool trading restrictions has made us money.
Yep, it made us tons of money. It's super. We're like little babies in the moment where we're like, dang it, I can't buy this or sell this, and we look back and we're more mature.
To be clear, let's be clear what we're talking about. When we want to buy or sell, we have to make sure it's not a quarantine thing, and there's rules before we can transact. Yep. So it's not like we have inside information. It's just that there's more friction to us selling in particular than there would be otherwise, and that increase of friction has resulted in us holding stocks longer, which is what we're saying has resulted in a positive return.
From a Daniel Kahneman point of view, Nobel Prize winner and author of Thinking Fast and Slow, the Motley Fool's trading rules force us to go from thinking fast to thinking slow, and that tends to be a good thing.
Yeah. What systems do you use to track your investments quarter to quarter? Spreadsheets and stuff like that, or another program? To track my investments, I use Interactive Brokers for the returns, and then I use FinChat. I loaded my portfolio into FinChat. What's cool about FinChat is it like gives you like portfolio level metrics. Like you can see like what's your weighted average market cap, what's your weighted average operating margin, what's your weighted average forward price to earnings ratio. You can actually do like analysis of your portfolio from as if it was a single company.
Yeah, and I think
really cool.
It's free to put a portfolio in there too, so it's not.
Yeah, you can do that on the free. You can on the free version. You only get one dashboard, one portfolio, but if you want to add more, then you have to upgrade to the premium stuff.
Yeah, makes sense.
Mm-hmm.
One last thing I just want to say is if people have topics that they want us to cover, because we do this once a month, to put those in Slido as well. Brian, if I remember correctly, next month you are going to be gone. You're taking a nice little trip, I believe.
Puerto Rico.
There you go. And Mr. Withers is joining because, of course, you can only be on Investing 101 if your first name is Brian. And we're going to be talking about why growth is so important, which sounds a little bit boring and a little bit, wait, I don't understand. But this is a topic that Mr. Withers made the slides for. And I remember after watching it, I was like, I looked at the necessity to accomplish a minimum threshold for growth for a publicly traded company in a totally new way after watching it. So I think it should be really helpful, especially for those that are closer to retirement, because those folks tend to, at least in my mind, invest in larger blue chipier stocks, and those stocks tend to have lower growth rates. So it's about why it's important to still meet a minimum threshold for growth. That's what we're going to be talking about in April.
Happy Fool asks, is there a good place to get a DCF worksheet or model? Do we give ours away for free? I can't remember if we have a resource.
Honestly, I have no idea.
Yeah, I know we give a reverse discounted cash flow analysis away for free. But I don't know if we could do a DCF once. Neither of us are big fans of DCFs, discounted cash flow models. I don't use it to invest personally, but I do use reverse discounted cash flow analysis. The difference is one is looking forward and making assumptions about growth rates. The other is looking at what are the assumptions that the market is making. That's the reverse DCF. But I'm sure if you Google around,
you should be able to find them.
Yeah, that's probably easily Googleable.
But I see that brings us to the top of the hour. And I also see a number of people in the offing. There's Anthony and Matty A, and we're going to be turning it over to them. So fool on, guys.
All right. Thanks, Brian's. Fool on. All right. Well, it is 11 o'clock Eastern, and it is time for the Dividend Show. I am Matt Argersinger. Joining me, as always, is Ant Schiavone. And Ant, before we get started, because I think it's super relevant to maybe a lot of viewers this month, any strong feelings about the NCAA men's basketball tournament that's going on? I know we can't use the popular moniker for it, but
yeah, I mean, I'll be honest, I haven't watched too much college basketball this year and really the past few years, but I do like the way the Houston Cougars play. And Kellen Sampson, those guys play so hard. So the one bracket that I did make, I have them winning it. So
all right,
it'll be fun to watch.
Cool. I don't watch any college basketball. I have no idea. I mean, I know Duke's supposed to be good, and I don't know. I guess Houston. So that's awesome. All right. Well, we're going to do our own version, kind of the NCAA basketball tournament with stocks. This show, I think that's pretty exciting. We're going to look at 16 dividend-paying companies that I think we've talked about each of them on this show at various points over the last couple of years. So let me go ahead and share my screen, and we'll get going on that. Right. Yep. Here we go. All right, Ant, let me know when you can see that. But we're going to pit 16 teams, 8 teams on each side, and we're going to kind of go through, and we've kind of picked our favorites and where we lean. We're going to discuss each one. And do you see the screen?
Yeah. Yep.
All right. And by the way, if you're joining us live and want to chime in, there might be a poll coming that's really relevant later in the show. So please join us on Slido. Fool24 is the hashtag. You can ask questions, upvote, and there might be a poll coming, which you might want to participate in. So we're going to do this March. We're calling the March Dividend Tournament. I thought about coming up with some name like Dividend Delirium, or something like that, kind of echoing the actual NCAA tournament. But March Dividend Tournament, our generic name for it, 16 companies compete. Which one will be crowned dividend champion? I think that'll be pretty fun. And then, as always, Ant's got another great list of companies that have raised their dividend recently. And then, of course, we'll get to Q&A after all that. All right, so let's take a look at this bracket. We've got on this side, on the left side, what we're calling the yield division, which are all companies that have a dividend yield of at least 4%. In some cases, a lot higher than 4%. You can see companies like Altria on there, Whirlpool, which have very high dividend yields. EPR is another one. And so these are companies that, if you're looking for income, if you're a dividend hunter and income yield is your game, these are your teams on the left side. On the right side, we're calling that the growth division. And these are companies that have lower yields, sometimes 2-3% or less dividend yields. But they have demonstrated, at least over the last several years, the ability to grow their dividend at high rates, high single digit, low double digit rates. And so these are the companies where if you're betting on growth, earnings up, outsized earnings growth, outsized dividend growth, these are your teams on the right. And like I said, we've talked about each of these companies at one point or another over the last couple of years. So we know a little bit about these companies, and hopefully you do as well. All right, Ant, let's go ahead and get into it. We're going to start here. I guess we'll call this the Northwest group. We'll start with our first matchup. Altria Group, Whirlpool. And if you follow either of these companies, let's start with Altria, which of course we know is in the business of cigarettes, smoking, in a lot of cases, smokeless tobacco as well. It's the former Philip Morris company, obviously famous for Marlboro and a few other brands. They actually spun off their international company. You may be familiar with Philip Morris International, which is another stock out there that has Altria's old international brands. But this is a stock, it yields around 7%. Obviously, we know that the trajectory for cigarettes smoking is not great, which is a good thing for the health of the world and the country. But it's also a company that has delivered pretty exceptional shareholder returns, because even though revenue has been flat to even slightly down, they've been able to deliver pretty good earnings per share growth, and mainly because they've been buying back stock, and then paying a dividend. So not a bad shareholder yielding company, even though the business itself, I think we know, is not going to really grow. Whirlpool, on the other hand, which also as of right now has roughly a 7% dividend yield, even higher than that, I think. This is the country's leading bathroom and kitchen appliance maker. Yet its stock has been beaten down. And recently, the stock is trading at a 10-year low. Really has a lot to do with the housing market. Recently, some stuff to do with tariffs and the threat of higher steel prices in the business. But that dividend, which looks very healthy, is well covered by Whirlpool's cash flows and earnings. They're looking at generating about $10 in earnings per share this year. So the stock trades for less than 10 times earnings. Ant, how do you feel between these two? Altria, Whirlpool, and then we'll reveal kind of which one came out ahead. Any thoughts?
Well, I think heading into this matchup, Altria Group is definitely the favorite, I would say, because if you go back and look at its history, I'm not sure how many viewers know this, but it is the best performing, or is the stock that has created the most wealth of all time. That's according to a study by Hedrick Bessenbinder. And so it's done 16% annualized for 98 years. It's turned $1 into $2.65 million. So it's been an amazing. That's like almost difficult to comprehend.
It is $1 into $2.65 million.
Yep.
I cannot believe that. Okay, yeah. Whirlpool does not have that history. Whirlpool is far more cyclical, as you can imagine, and kind of rides the ups and downs of the housing market. So we went back and forth here, and guess what? Whirlpool actually pulled the upset here. Stock's beaten down. We think there's hope if the housing market rebounds. We know what to expect with Altria. Whirlpool, though, if the housing market turns around, could be a really big winner. So that kind of pulls a little bit of an upset there in that first Northwest group matchup. All right, let's go down to the next matchup in the Northwest, and that's Realty Income versus EPR Properties. I'm sure more viewers are aware of Realty Income. I mean, look at that ticker symbol, O. How many companies have just one letter as a ticker? And of course, this is famously known as the monthly dividend stock. It pays a monthly dividend. But weirdly, EPR Properties does as well. So this is a matchup of two companies, two REITs, real estate investment trusts, that each pay a monthly dividend. Realty Income is the net lease REIT. So it invests in mainly single tenant net lease properties. Think you're like your freestanding Dick's Sporting Goods, freestanding Home Depot. That's kind of their bag. EPR Properties is much more in the experiential real estate space. Things like movie theaters, ski resorts, water parks, Top Golf is one of their tenants. You get the idea, kind of entertainment destination. And Realty Income right now has a yield of about 5.5%. It's actually in Realty Income's history, that's a pretty high yield. Yeah, 5.7% I'm seeing this morning. EPR, however, is close to 7%. And the real drag there, the reason EPR is trading at kind of a very beaten down valuation is really because it still derives most of its, I'd say a plurality of its revenue, rental revenue from movie theaters, which it is rapidly diversifying. But you almost get a 7% yield, and they just raised that dividend, by the way. All right, Ant, any leanings one way or the other, Realty Income, EPR?
Yeah, I'm going to lean towards EPR Properties on this one. One, because of the higher yield. And then two, I just think it's easier for EPR to grow compared to Realty Income. I mean, Realty Income is so big. And the way for these net lease REITs to grow primarily is through acquisitions. So Realty Income is just so massive that it takes billions and billions of dollars in acquisitions, just to get a little bit of earnings growth. Whereas EPR Properties is a lot smaller. They don't really need to issue equity, take on too much debt in order to grow. And so I think I kind of like the growth trajectory actually better for EPR Properties and with the higher yield. So that's the one I would go with.
All right, let's see what happens in the matchup. Fierce game, close game, but EPR comes out ahead. So EPR takes the win there over Realty Income. All right, let's head down to the Southwest division now. We're still in the yield division. We're in the Southwest group now. Chevron, Target. Now these are two, brand names, very different companies. Obviously, you've got Chevron, massive oil and gas integrated company, and one that's become much more shareholder friendly, I'd say, over the past decade, and has a lot of companies in the energy sector. Chevron's shareholder yield last year was 10%. That's the combination of share repurchases and dividends, I should say. And right now with Chevron, you've got a yield I think is right around 4.5%, 4.2%, actually, a little lower than I thought. And then on Target, now this one, Ant, has been really beaten down. Been a rough year or two for Target. Also about a 4.2, 4.3% dividend yield. And I see a P ratio of about 11 for Target. It seems fairly beaten down. What are your thoughts on Chevron or Target?
Yeah, this one was really tough because, both have similar dividend yields. They've both grown their dividend for the last 30 plus years consecutively. I think Target's at like 50 plus years. Chevron, I think, is 30 plus. Both are kind of out of favor right now, for sure. Discretionary retail is kind of taking a hit the last couple of weeks. And then, energy is only like roughly 3% of the S&P's 500's market cap.
Right.
So both are out of favor, but I'm going to lean Chevron, though, because of the total shareholder yield of 10% that you mentioned between dividend and share repurchases. So I think that's why I would go with Chevron.
Yeah, I'm leaning that way too.
Close.
And there is a little bit of a wild card with the whole Hess. If you don't know, Chevron's trying to acquire Hess, another big oil and gas producer. They've run into some hiccups there. Exxon's making a claim on some of Hess's assets. We'll see. We'll learn, I think, in May whether or not that deal is going to go through. But even still, Chevron takes it over Target right now in that Southwest matchup there. All right, our last matchup in the yield division in the round of 16 is Battle of the V's. Vail Resorts, ticker Mountain, love that. Everyone knows Vail Resorts, of course. And then Vici Properties, another REIT, high-yielding REIT, by the way, that owns mostly gaming properties, a lot of exposure to Las Vegas. What is the yield on Vici right now? Yeah, Vici is about 5.3%. Mountain might be around, Vail might be
5.5.
5.5. So roughly the same yield. Where are you going here, Ant? Vail Resorts or Vici Properties?
This is another tough one. I'm going to go with the Vail Resorts. I've had some questions around management's capital allocation the past few years, but at the end of the day, they're not making any new mountains, and Vail Resorts owns some of the highest quality ski resorts in the country. Their Epic Pass is a lot cheaper compared to its closest competitor, and so I just think this business has a lot of pricing power, and I think that will overcome any challenges with the management team. So, got to go with Vail Resorts on this one.
All right. And how's the game turn out? Vail Resorts takes it over Vici Properties. All right. We've got kind of our 4 teams left in the yield division. Let's jump over to the growth division now. And we'll head to the Northeast. And we've got 2 restaurants. And we've got Domino's Pizza and Texas Roadhouse. I think everyone knows Domino's Pizza and it's probably ordered from Domino's at some point in their life. Probably when they were younger as well. And then Texas Roadhouse, a concept that's been around for a while, but maybe not one that's, as that a lot of viewers are familiar with, but probably never been to one. I've been to one once. I know you've been to one at least once. And what are your feelings? Both these companies have great dividend track records. Their yields are low. I want to say their yields are each below 2%, if I'm not mistaken. But a lot of dividend growth that's happened for these companies in recent years. What are you feeling between Domino's and Texas Roadhouse?
Yeah, I mean, their yields are so low is because they perform so well.
That's right. Stock's gone.
Prices have gone up. Yeah.
Yeah. Domino's is 1.5 on the yield. And what is Texas Roadhouse?
Guess around 2.
Yeah, 1.6 actually.
Oh, wow.
Is what I'm seeing right now.
Yeah.
So roughly the same yields, around 1.5%.
Yeah, well, I mean, Texas Roadhouse is my favorite casual dining restaurant, probably of all time. I absolutely love going there. They have a differentiated dining experience with country music blasting, and it's just there's always a line out the door. It's always packed. The food is super affordable compared to the quality that you get. So I've always been a huge Texas Roadhouse fan, but I'm actually going to go with Domino's on this, Matt. Largely because of the valuation. And I mean, Domino's is, I don't get Domino's as often. I mean, that's just a phenomenal business, awesome dividend growth. And I think Warren Buffett and Berkshire just bought shares too, so it's hard to argue against that.
All right, let's see what turns out. Domino's versus Texas Roadhouse. Domino's Pizza takes it. All right. Now we're going down. Still the Northeast here. We're in Academy Sports and Outdoors and the Home Depot. This is like David versus Goliath because you've got Home Depot, which of course is the country's leading home improvement retailer, massive company. I want to say at least a $200 billion market cap, if I'm not mistaken. Let's see. No, I was way low. $350 billion market cap for Home Depot. Wow, I did not think it was that big. And you got a roughly 2.6% dividend yield for Home Depot. Great track record of raising that dividend, although it's slowed down. That growth has slowed down a little bit recently. But then you compare Home Depot's $350 billion market cap with Academy Sports at $3.4 billion. So about 1% of Home Depot's market cap is Academy Sports and Outdoors. So tiny, 1/100th the size of Home Depot. And kind of more of a regional sports concept, like very similar to Dick's Sporting Goods, right? But more regional and maybe catering a little more to outdoors, hunting, fishing kind of stuff.
Yeah, I feel like this is kind of like a SEC matchup here. You have Academy Sports and Outdoors located in Katy, Texas, and then the Home Depot out of Atlanta. I mean, I think the Home Depot is it's definitely the better business. I think we both agree. But Academy Sports, though, it also comes down to valuation. And I think that plays a big role in why I'm going to go with Academy Sports and Outdoors on this one.
All right.
And their dividend growth, too. They just raised it 18%. So they're growing at a pretty high clip. I think Home Depot just recently raised their dividend at 2 or 3%. It's a pretty low dividend increase for them.
Yeah, and you've got Academy Sports trading for less than 10 times earnings. And Home Depot, despite it being a pretty rocky environment, we know the situation in the home market, Home Depot is still trading for about 24 times earnings. So yeah, ASO definitely takes it on the value and the dividend growth. So where does this come out? Wow, we got an upset. Academy Sports and Outdoors upset. I mean, this is like, I don't know, what would be the equivalent? Is this like, I don't know, Boston College upsetting Duke or something like that? I don't know what it is, what the equivalent would be. But Academy Sports and Outdoors takes it over the Home Depot. All right, let's head to the Southeast group here. We've got Quest Diagnostics and Packaging Corp of America, two very, very different companies. Quest is one of the leading companies when it comes to blood diagnostics. So many hospitals, so many healthcare facilities use them to do testing. It's a very steady business, very non-cyclical business. And it's got a great track record of dividend growth. It's an expensive stock, as you might imagine, because of the stability of the business. And then you've got Packaging Corp of America, which sounds like the most boring company on the planet. And it kind of is, because of course, all they make is packaging, mainly paper products, corrugated packaging. So the kind of packaging you find from, if you get Amazon deliveries to your house or other deliveries, oftentimes they're making the boxes for those deliveries. It's one of the leading companies to do that. Great dividend history. I don't know, Ann, where are you coming out between Quest and Packaging Corp of America?
Yeah, this is another tough one too, because again, like two very well managed companies, and I'm leaning towards Quest Diagnostics, just because like when I think about healthcare, like, and you think about like the future of healthcare and what that's going to look like I think it kind of comes down to like detecting diseases and illnesses kind of before they become diseases and illnesses, and I feel like Quest Diagnostics with their lab testing kind of fits into that. So I kind of like what the future looks like for them. Obviously, they have massive market share in that industry, consistent dividend increases. They just had their analyst day, I believe, yesterday. So still have to dive into that a little bit more. But I would lean Quest here, but it's definitely close.
All right, let's see how this matchup turns out. Quest versus Packaging Corp of America. Quest, by the way, about a 2% dividend yield. Packaging Corp of America, 2.5%. And it's Quest. Quest takes that game right there in that matchup. All right, our final matchup in the round of 16. Two pretty well-known companies, very different companies. We've got eBay and Starbucks. And eBay, everyone knows eBay, but the question is, when's the last time you shopped or bought anything on eBay? Might have been a while. Used to be a lot more kind of popular in terms of an online marketplace, but still very large, still very relevant for millions of buyers and sellers around the world. And this is a company, if you don't know, earns a ton of cash, plows it back big time in form of a growing dividend and buying back massive amounts of stock. In the last 5 years, they have bought back around 40% of their stock. It's amazing. And sometimes you look at eBay and you wonder, like, will there ever be any stock left if the management keeps buying back so much stock? And it's actually quietly been a pretty good performer in recent years. Starbucks, on the other hand, has not been a great performer in recent years. It's been really tough going since, I don't know, maybe the pandemic, but a couple years after the pandemic. Store traffic's kind of flattened out. The appeal of the stores is not the same. The occasional customer has not been as active with Starbucks. I don't know. This is a tough one, Ant, because Brian Nichols come in from Chipotle, and he's got a great plan, great strategy, we think, to turn Starbucks around, focusing on kind of order throughput, also focusing on the in-store experience, making Starbucks a welcoming, nice place to hang out again. It's way too early. He's only really been on the job for about 6 months, so we don't know. Definitely probably the right guy for the job, though. Where are you landing between eBay and Starbucks?
Well, Matt, we went back and forth on this one a couple times.
We did.
Between eBay and Starbucks. I mean, I love eBay's their capital allocation in recent years. I love their CEO who's come on board in recent years. But I guess like this is the growth division, right? And who's growing their dividend at a higher rate most recently? I think that's Starbucks. I think they've grown their dividend at a 20% rate since they initiated it in like 2011-ish.
Yes.
2012. So
that's right.
I think you go either way on this, but
yeah, I think you and I were both surprised that Starbucks, after Brian Nichols became the CEO, about a month later, they raised the dividend 7%.
Yeah, that was surprising.
Which, given what had happened to earnings last year, we thought, man, if they just don't cut the dividend, that'd kind of be a win. But Starbucks raised it, and that kept that streak alive. And as you mentioned, it's been growing that dividend pretty well. So who wins this matchup? Final round of 16? Starbucks takes it. All right. So we've got sort of the Elite Eight here. Oh, I don't know if I'm allowed to use that. That might be trademark. But we've got our final 8. Whirlpool, EPR, Chevron Vale, Domino's Pizza, Academy Sports and Outdoors, Quest, and Starbucks. Let's head back to that Northwest division. Let's go Whirlpool, EPR. We can go a lot faster now with these because we kind of giving you guys the introduction. Whirlpool, obviously beaten down, waiting for a housing recovery. EPR also beaten down. These companies also, roughly have 7% dividend yields. I'm going to say the stronger company right now is EPR. What do you think, Ant?
I think that's fair, especially if you're looking out on a risk-adjusted basis too. there's more certainty, I think, in EPR's future cash flow and cash flow growth than there is in Whirlpool. So I think that probably gives it the nod in this matchup.
All right. And that's where we land. We pushed EPR through this round into the final four. All right. Chevron, Vail Resorts, very different companies. Oil and gas giant, great dividend track record, shareholder yield. Vail Resorts really beaten down, probably needs a new management team, but obviously has tremendous assets, tremendous competitive advantages that aren't going away anytime soon. Great pricing power with that Epic Pass. What do you think of this matchup, Ant? Chevron, Vail?
Yeah, I know we're going back and forth on this one too, and I forget which one we actually ended up with.
Well,
I want to say it was Vail Resorts.
Let's see what happens. Chevron, Vail. Chevron.
Chevron. Okay.
Yeah, Chevron actually took that win in that game. All right, so EPR Chevron into our final four. Let's head back now to the Northeast. We got Domino's Pizza, Academy Sports and Outdoors. Academy, pulled quite the upset against Home Depot. I think we say Domino's kind of dominated Texas Roadhouse. So where do we land between Domino's and Academy Sports? Who do you think's coming out of there?
Academy's got the momentum coming off a big win. I think the momentum continues.
All right. Underdog magic. Let's check. Let's see. Yep. Academy Sports pulled the upset again. They're like the Cinderella team of this tournament into the final four. All right. Quest, Starbucks. This is another tough one because, you get Quest business, which is just on a kind of pretty nice, steady upward trajectory. That's not going to light the world on fire, but you can probably depend on mid to high single digit earnings per share growth, steady rising dividend. Or do you go with Starbucks and you bet on the Brian Nickel magic to turn Starbucks around? It's also kind of beaten down. It's been raising that dividend a lot faster than Quest. Where are you landing with these two? And
well, you need a little magic in March, a little bit of luck. I think Brian Nichols got that. They have a higher dividend growth rate, so go with Starbucks.
All right. Starbucks takes that one as well. All right, we've got the final four now. EPR against Chevron. Academy Sports against Starbucks. Let's do EPR, Chevron. All right. A relatively small REIT with a high dividend yield against the oil and gas giant. This is a little bit of again, another David Goliath matchup here, potentially. I don't know. What do you think happens here, Ant?
Yeah, movie theaters versus big oil.
Exciting. We keep it exciting here in Dividend Land, don't we?
I'm gonna go with EPR Properties for the same reasons that I picked it over Whirlpool. Just more certainty in those cash flows, higher starting yield. Great management team at EPR Properties, although
Yes.
Chevron has a good management team too. But I give EPR Properties the edge here.
All right. EPR certainly takes it over Chevron. That brings us to Academy Sports, our Cinderella story, against Starbucks, a revitalizing Starbucks. I don't know. Tiny sports retail shop against, and more regional, against Starbucks, the ubiquitous coffee chain. You can find one pretty much in every corner of every city, major city around the world, most countries. Starbucks or Academy Sports, Ant? Can Academy keep their Cinderella story alive?
They can't. Pedigree and experience wins out, and Starbucks takes it.
Yep, I think you're right there. Starbucks takes it. It's like Duke or North Carolina. Inevitably, one of them is going to probably make it in the Final Four. All right, here we go. We've got EPR Properties against Starbucks. REIT, small cap, REIT, great yield against Starbucks. And guess what? We're leaving this up to you, everyone. If you're following us on Slido, we're gonna put up a poll. The poll is there. So if you're in Slido, who deserves to be the dividend champion? Is it EPR, Starbucks, or a different company? Maybe one of the companies here, or a different company entirely. Let us know. We'd love to hear it. Obviously, there's so many companies we could have featured in this 16-payer tournament. We chose what we chose, and we ended up with EPR and Starbucks in the final. I'm going to go ahead and make my vote, and we'll see where we land. All right, we've got 9 votes in so far. Ooh, looks like so far EPR is taking a little over 2/3 of the votes, although we only have 10 votes, so nothing scientific here. All right, yep, still holding strong on EPR. More votes coming in. 18 votes. EPR's with a pretty hefty lead over Starbucks, and so almost 80% of the votes. Well, I think that tells the story, everyone. Yeah, we've gotten more than 20 votes now, and EPR has more than 3/4 of the votes. I think EPR is our inaugural March dividend champion. I think that's a great choice, everyone. Great company, great valuation. A stock that I think is going to be re-rated at some point. It trades for about, all right, 30 votes in, 80%. All right, we're going to crown EPR the champion. I think that's an awesome choice. I don't know what you think, Ant, but I mean, this is a REIT that trades for, I think, less than 11 times FFO per share. Its guidance for FFO per share this year. I mentioned that 7% dividend yield, which we know is well covered. They're slowly diversifying their away from movie theaters. They're planning on putting at least, I think, 200 million or so in new investments this year into properties that are diversifying away from movie theaters, but also properties that they think fit well within the strategy, the ongoing strategy of the business. And let's not beat up on movie theaters too much, right? This could be a bounce back year. We've seen a steady rise in blockbuster movies. I mean, a couple of years ago, we had the Barbieheimer showcase, which was really, Barbie movie, and Oppenheimer did really well. It kind of brought people back to the movie theaters after the pandemic. We've got the Superman movie coming this year, which I think there's a lot of excitement around that. So maybe there's that business could probably do well as well. So EPR takes it. Thanks everyone for participating in this March dividend tournament. Just looking at the slide to see if we. Oh, Rose asks, is the winning stock chosen for both qualitative and quantitative reasons? I think so, Rose. I mean, I think it's all of the above. I think everything we know about the business is whether, what do we think, how the financials look, dividend growth, management, all the above can factor into our decision here. And Richard O says, Matt and Ant, please use your dynamic dividend determination to convince the MF software team to incorporate 5 or 10-year dividend CAGR rights. Oh, not. We'll get back to Richard O's comment there. I thought that was something to do with the tournament. All right, Ant, awesome job. Thank you. That was a lot of fun. I hope.
I think so.
Let's go to the recent dividend raisers, which we do all the time. Which companies raised their dividend recently?
Yeah, so we have JP Morgan, which I believe is the world's largest bank, at least the largest one in the United States. 12% dividend increase for them, 2.3% yield. This is a company that pretty much every year raises their dividend, but they're not, if we go into a recession or something, they're probably not going to raise it. They might even, shrink it, which they've done in the past. And I just thought it was funny. Jamie Dimon was interviewed a couple of weeks ago. And on the interview, he said something along the lines of the dividend is our number one priority. We view it as sacrosanct. And then he continued, although we've cut it a few times in the past. So that was kind of funny. But just a well-managed company. Another big dividend increase for them. So
yeah, 12% is good, like a healthy raise.
Yeah. Now we have Williams-Sonoma with a 16% increase. They own Williams-Sonoma, and I believe they own Pottery Barn too. So furniture, house furnishing company. This is their 16th consecutive year of increased dividends. And I thought this was interesting. Their chief financial officer said, over the last 5 years, we've returned over $4.1 billion to shareholders through dividends and share repurchases. Wow. And I don't know what exactly its market cap is at today. Looks about 20 billion. So I mean, it's a pretty big return.
Yes.
And the stock has performed very well. I don't know the company all that well, but definitely been a strong performer in the past.
All right.
Then we have Realty Income, raises their dividend every single quarter. Pretty well, yeah. They literally raise their dividend every single quarter. Obviously, they pay a monthly dividend, like we mentioned. Big yield there, 5.7%. This is their 110th consecutive quarterly dividend increase and their 656th consecutive monthly dividend payment. So just consistent there.
Yeah. Quick question follow-up there, Ant, because I know you've looked into it recently as well. Do you think they can keep raising that dividend every quarter like they have for so long without taking maybe, I don't know, a little more uncomfortable risk, I would say, with their leverage? Because it does seem like the opportunity set for them is shrinking. And you wonder how can they keep that streak alive without, either making some big acquisitions or taking on more debt to do it.
Yeah, that's a good question. I mean, like year over year, their yearly dividend growth has been around 4.5% roughly throughout its history. But they're just so big right now that I feel like they've almost become kind of like a victim of their own success, in that, the way for these companies to grow is primarily through acquisitions. And when you're, a 50 or $60 billion market cap like them, they have to go out and make these massive acquisitions. And that just becomes a lot harder to move the needle on earnings growth. And you've seen them in recent years, like they've expanded to Europe. They've expanded into data centers, casinos, gaming properties. They've expanded into that. So it's not just that traditional net lease retail anymore. So I think that maybe adds a little bit of extra risk, maybe. So I think it is going to be a little bit harder for them to get to that 4 to 5% annual dividend growth moving forward. But I mean, time will tell. So
time will tell.
Here's an interesting one. Build-A-Bear Workshop. They just increased their dividend 10%, yields 2.4%. They initiated dividend last year, but they paid out a few special dividends in the years before that. And this is pretty interesting. So over the last 4 years, they've returned over $130 million to shareholders. And that is more than their market cap from 4 years ago.
Say, how big is this?
So so they've returned more than their market cap over that time frame, which is very impressive.
Yes,
and I don't think they have any long-term debt on their balance sheet. If I remember correctly, they have leases, but I don't think they have any long-term debt. So definitely a business that, if you would have looked at it in like 2020,
oh my gosh,
outlook probably didn't look too great. But I mean,
well, I'm looking at this. I mean, if this is right, the stock is up 1,800% over the last 5 years.
Yeah.
I mean, and I feel like they're in malls, right? It's mostly a mall-based retailer. You go to the mall and they have like a small store. That's incredible. Wow.
Yep.
Wouldn't have thought that.
No, definitely not. And then rounding out here with 2 sporting goods stores. So we have Dick's Sporting Goods with a 10% increase, 2.5% yield. This is their 11th consecutive year that they've raised their dividend. So pretty consistent there. And then Academy Sports and Outdoors with an 18% increase. We mentioned that earlier. They initiated dividend in 2022. They increased their dividend 20% in 2023, 22% last year, and then another 18% increase this year. So they've been growing their dividend at a pretty good rate, Matt, and also repurchasing a lot of shares too. So really a capital return story here.
Yeah, definitely big time. And we could have featured them in our bracket.
Yeah.
Oh, can you hear me? Sorry,
Yeah, I don't know if I'm like freezing up or if it's you, but
I think I might be freezing up a little bit. But if you can still hear me, keep going. Sorry.
Yeah, you're good. No, I was finished. We just have some other dividend raisers here. Oracle, which I believe raised their dividend 25%. Toll Brothers, Home Builder, WP Carey, which is another net lease REIT, and then Applied Materials with a dividend increase.
All right. Good stuff, Ann, as always. All right. If you have any questions, if you're not on Slido, please join us if you can. Fool24 is the hashtag. Let me stop sharing my screen right now. And actually, Ann, if it's okay, I wanted to lead off with a question that you and I got in an email from Max, who asked, so here's Max. I've been trying to map out the tariffs car wreck. And one of the things that I hit on is how to quantify its impact on warehouses. When companies order stuff from overseas, it comes to America and it sits in warehouses somewhere waiting to be distributed. Is it safe to assume that tariffs will make things expensive and the sales volume will drop, resulting in reduced need, resulting in empty warehouse space, resulting in et cetera, et cetera. And he goes on to say, he's theorizing that maybe rental rates will go down as companies, do fewer leases on warehouses. He says, I'm specifically looking at REITs like Prologis, Duke, Stag Industrial, and many others. What does a tariff war place them long term? You and I had a few answers to this. I'll share my answer, and I think your answer was, I think, smarter, which is even if there is demand loss on the international side, in other words, goods coming into the country, imports not needing as much warehouse space to house those now. I expect if these tariffs are lasting and impactful, a lot of companies, as they have already done, will start bringing a lot more production back home domestically. They will do that. They will also probably store more inventory. So as a way of kind of controlling, better controlling for price and, supply. So in a way, the tariffs could actually also increase demand for warehouses domestically, where, the companies you mentioned, like Prologis, Duke is now part of Prologis, but Stag Industrial, others, where they have most of their footprint, could benefit from that. So that's one. So I don't expect that it'll be total demand loss, that suddenly imports stop. There's no need for those warehouse space. It'll be made up probably for more domestic production sources.
Yeah.
What about you, Ann? You got a good thought too.
Yeah, it's hard to know like how tariffs will impact things and what are the second and third order effects that can take place with that. So I read something smart from Morgan Housel a while back, and kind of I think it was a blog post where he talked about expiring versus long-term knowledge. And I feel like when we talk about tariffs, I feel like this is kind of an example of that, expiring versus long-term knowledge. Like, if tariffs really do result in a meaningful sales volume drop, and cause, maybe inflation or recession, when a new administration comes in 4 years, there likely won't be tariffs anymore. So, and plus tariffs can be called off at any time. So I don't think it's really something to worry about, especially with Prologis. And, talk about the second and third order effects. Like, if tariffs raise the price of building materials, it's going to make it harder for new developments to take place. And so that's going to be good for Prologis because there's no new supply coming online.
Right.
And then you talk about like one of the biggest things I like about Prologis is that warehouses are so simple, and you can convert those warehouses into higher and better use opportunities. Like you're doing that with data centers right now. So if there is a huge demand drop, which I don't think is going to happen, they can always convert that highly valued land into something, that's more valuable. So yeah, who knows how tariffs are going to play out, but I really don't think it's something worth focusing too much time on.
Yeah. And again, Max, to Ann's point, how much of these tariffs are actually sustainable new policy going forward, rather than sort of flash in the pan meant to trigger some kind of behavior? We just don't know. There's so much uncertainty. So hard to gauge at all. But yeah, long term, don't think there's going to be that much of an impact on warehouse demand. All right, Ant. I want to just point out Richard O's had a couple ideas, I think, probably for our tournament, which was AbbVie versus Eli Lilly would have been a good matchup, or Chevron versus CNQ, which is the Canadian oil and gas giant that I think you've been looking at. T-Stock. Oh, sorry. And then T-Stock, Big Brown, UPS. Yeah, we could have. I think we had UPS as one of our ideas. We just didn't put them in a tournament. That's a great, potential idea as well. And then Dave J said EPR is one of 5 companies I am interested in on that list, and Realty Income is the only one I've bought. All right. Well, yeah, Dave, check out EPR. We've discussed that REIT quite a bit on the show in recent months, so definitely check it out.
Should we take this question from Richard O? Which of the big tech companies that have recently begun dividend programs would you buy now?
Oh, okay, yeah.
Booking, Meta, Alphabet, Salesforce. I don't follow any of these companies, so I can't give you a good answer on that.
Mm-hmm.
But what I will say is I was kind of surprised that Meta only increased their dividend by, I believe, 5% earlier this year. And they increased what was their CapEx? Like 60 billion, 70 billion, 80, somewhere around there. I don't know. I mean, if they can earn a good return on that, like, yeah, for sure. That's a good investment. But I was kind of surprised to see their dividend growth only at 5%, considering all the tailwinds that are behind their business right now. But
yeah, I own one of these companies, and that's Alphabet. And I was pleased when they initiated their dividend. Have they raised it yet once for the first time? I'm not sure they have. I have to say though, I was very impressed with Dylan Lewis's interview with Mark Benioff, which he did on our Motley Fool Money podcast. I think it was about a week and a half ago. And I know that, they initiated Dividend as well. I'm just kind of intrigued by what they're doing in terms of on the AI tools front and things like that. No, I can't say anything about their Dividend because I don't know what their plan is going to be. But that's one just of the four that you mentioned, Richard, that's the one I want to get a closer look at.
All right, and I think Google just made a big acquisition, or at least announced a large acquisition of
Wiz.
Called
That's
Wiz Cybersecurity for $30-some billion.
Yeah, wasn't that rumored? I thought that already happened, but or at least it was rumored to happen like several months ago. That was in the news, and then it kind of died away. And maybe it was because of, they were waiting for the new administration to have a little bit of a lighter touch on the FTC to maybe get that deal through. I don't know. But I for some reason thought that already happened.
Here's an interesting one from Dave J. Have you noticed any RECs that have also had big buybacks on top of their dividend recently? I'd probably Chevron might be one.
Chevron's definitely one. I think Academy Sports has been doing some buybacks, right?
Yes,
Lately.
they announced I'm going to get the numbers wrong, but I think it was a $2 billion buyback program. Maybe that sounds a little high. Might be a little bit, but they announced that I think in December, and then raised their dividend this past quarter or so. That's
A.O.
one.
Smith, ticker AOS, is another one that seems to be getting more aggressive with buybacks. They pay a dividend that's grown, but I think if I have the numbers right, they want to return 600. It's not a big company, but they're going to return 600 million to shareholders this year, 400 million in buybacks and 200 million in dividends. So that's one I think that's also that could be a list of buybacks. Any other ones that come to mind? Starbucks was doing buybacks for a long time. I don't think they're going to be doing buybacks anytime soon. Yeah, off the top of my head, those are the ones that have announced kind of bigger buybacks lately.
Probably all the big tech companies too. I'd imagine they're announcing.
Apple's always buying back tens of billions worth of stock all the time.
Let's see.
I'll respond to Richard O's comment. A question: can you spend 20, 30 minutes of a show on pipeline companies? He lists a bunch there. Enbridge is probably the only one I know on that list, which is pretty sad. But talking about tax advantages, distributions, moat, natural gas, liquefied natural gas exports. Yeah, that's an interesting topic, Richard. It's an area that I would like to have a little more knowledge about, because they're within that midstream space. There's been a lot of shareholder-friendly capital allocation, including dividends. And it's one area I'd like to spend some more time, for sure.
There's definitely been some interest there too. I know. I think I was reading an article yesterday. Brookfield is purchasing a pipeline,
right?
Colonial Pipeline from KKR, and I think a couple of other affiliates as well. I think that was a pretty big deal. I want to say 10 billion off the top of my head, but yeah, there's interest there. I know Phillips 66, they also have their midstream business, and they have an activist investor involved with that, trying to get them to spin that business off.
Mm-hmm.
So there's definitely a lot of interest in that area of the market right now, for sure.
Let's see. Besties, what is your view of A.O. Smith, competition in China? Where will the growth come from? So yeah, that's a good question, Besties. Growth has been tough to come by lately for A.O. Smith, and China has been the biggest reason. I think their results have been disappointing. I don't know necessarily think it's for them. It's competition as much as it is just a general slowdown in home transactions here in the U.S. and then real estate activity in China, construction activity. They have pretty meaningful competitive positions, certainly here in North America. And remember, 80+% of their business is replacement. So it's, they do well simply because people's water heaters and boilers reach the end of their life and they need to be replaced, and people don't usually wait to replace those, no matter what's happening in the economy. So that's a great support for their cash flows. But getting growth you're going to need a revitalization of, I'd say, the U.S. housing market, U.S. construction market, and same story in China. China is doing some stimulus measures designed to boost their real estate market and to encourage consumers to replace outdated appliances with more efficient ones. Kind of something like similar measures that we've done here in the U.S. in the past. And A.O. Smith commented briefly on that in their most recent conference call, that they're seeing some demand come through because of those activities, but it hasn't really flowed to their business yet. So it's kind of a wait and see for them. But yeah, we just kind of keep our fingers crossed. The great news about A.O. Smith, though, net cash on the balance sheet's in great shape. They're going to generate at least $500 million or so in free cash flow this year, despite, and that's without any kind of pickup in housing activity. So it's still a great cash flow generating business, and obviously buying back stock, which I think is a good move at today's price.
I think their business in India that's growing pretty strong too. I know it's a really small part of the business right now, the overall business right now, but yeah, that's an area to watch too.
That'll be as that economy modernizes and there's more housing formation. That could be big for them in the future. Maybe bigger than China at some point. It'll take time, but
yeah. Question from Rose. I think Kroger was one of the stocks the Dividend show picked at the end of last year. What is your assessment now? Yeah, I think Matt, end of last. What do we think?
I think it was end of 2023. Yeah, that we looked at. We thought Kroger was one of our favorite dividend ideas, and it's worked out pretty darn well from that point. If I remember, let's see.
Yeah, it's performed well really ever since the Albertsons deal fell through, or when the market started to price in that it wasn't going to go through.
Right.
Because they really deleveraged their balance sheet in anticipation of that merger closing, and then once it didn't close, they had so much excess capacity to go out and repurchase shares. And I believe the most recent quarter they shrunk their share count by, probably gonna get this wrong again, but roughly 8%.
Yeah, it was a big move.
It was a big repurchase.
So there's another answer to Mike J's question about companies, dividend payers doing big buybacks. Kroger's.
Yeah. Yep.
Yeah, I see Kroger up about 25% since the end of 2023. So that was, I don't know if that beats the market necessarily, because 2024 was such a good year for the market. But that's it's a good move for Kroger.
Yeah, Y chart is showing me that their share count is down 9% over the last 6 months.
That's huge. 6 months. I mean, it's a pretty stark buyback.
Looking forward, do have some questions about Kroger, especially with the management team. Their longtime CEO. He's been with the company, not necessarily in the CEO role, but he's been with the company since the 1970s. So he knows that business in and out, and he just recently resigned from the company after a board investigation. But they also have a new CFO as well, who came over from Pepsi. I think he's not at the company yet. I think he's coming in April. But so there has been some management changes there. So we'd like to see the dust settle there before gaining some more confidence in that one. But
all right.
But yeah, definitely been a great performer so far.
Richard O, what are your current thoughts on self-storage REITs? They have not received much love recently. That is true, Richard.
No.
I think overall assessment, very good business most times. And they've been, in fact, I want to say it was a year ago or so, Ant, that we looked at it was like the best performing REITs of the last 10 years. And Extra Space might have been the best performing REIT over the last 10 years. And all the self-storage REITs were like up there in terms of the best performing REITs. I think the situation with self-storage is there was just a lot of pre and post-COVID development. A lot of supply came in. The returns were I think a lot of developers looked at self-storage compared to other types of developments. And they said, wait a second, it's so much cheaper to build self-storage. The returns are great. Where I can build is land for where these things tend to be built is cheap. So why am I going to be in the apartment business or the office business or the retail business? Man, I should just build self-storage. And that was a big trend, I think, especially when interest rates were low. So there's just been a lot of real estate markets. There's been a lot of supply that's come into self-storage. So their ability to push price increases, get their occupancy up without offering deals, it's been a little tough. And so that might persist. I don't know if you have any thoughts there, Ant, but that seems like the situation.
Yeah, I mean, supply is always the biggest risk, I think, for self-storage, because it really is a great real estate class. If you think about, we remove supply from the equation, which is, admittedly a very important part to real estate. But if you think about a self-storage, like one, it's pretty cheap to build, like you mentioned. And then two, the ongoing maintenance capital that has to be spent to maintain these properties is so low.
Yes.
It's very low. So a lot of that cash flow just flows to the bottom line. And that's why these companies are able to raise their dividends, or at least historically have raised their dividends at such high rates. It's because that maintenance capital doesn't eat into their cash flows. But again, since it's such a great business model, it's easy to build. That's why you see so much supply always coming online.
Yeah.
So great asset
By
class.
the way,
recession resistant too. Like
well, yeah, and you have tenants who I hate to say this because I've been a victim of this, or like I've been one of those tenants where you're like, oh yeah, I think I'll use the self-storage. I'll use this unit for like a year. I'm moving to a new house or something like that, and you end up keeping that unit for like 5 years. You keep renewing it because you're like, I just don't want to go with that stuff, or I don't want to move it, and so that happens. You get these tenants that end up being pretty sticky as well, which is sad to say. Americans have too much stuff generally,
and those rent increases can be hefty at times too.
Yeah. And you just like, all right, well, they're going to charge me $50 more a month, but like, I'm so lazy, I still am not going to go take my stuff out. Oh.
Yep.
Besties, what percent of your portfolio is in dividend stocks? What is your income goals? I guess for younger ones, it might only be a supplement to a salary. What do you think? Well, how do you, I guess to you, Ant, what are your income goals? And maybe what percentage dividend stocks, or what percentage of your portfolio is in dividend stocks?
Well, percentage of my portfolio in dividend stocks, probably, in my stock portfolio is probably like 80%, I would say, mostly because those are the companies that I'm looking at every day. And those are the companies I know the best. But as far as my income goals, I think like long term, if you can get your dividend income to surpass like your monthly expenses, you can kind of reach that crossover point. I think that's kind of the goal that I'm reaching. It's going to take years and years of compounding to reach that, but I think that's kind of the ultimate goal with that for me. But
yeah, I mean, me as well. I'm a lot older than Ann. And I came from a little bit different world before I got into dividend stocks. So I'm not sure dividends are 80% of my stocks, but they're probably just over the majority. I would say the majority of stocks I own pay dividends. And same with that, just compounding that income, letting that income grow, reinvesting those dividends in the companies I believe in to, kind of keep growing your yield on cost and then eventually hopefully having income that surpassing your expenses. How awesome would that be? That'd be such a great achievement, I think. Yeah.
Yep. We have another one from Besties. What do you think of AVGO Broadcom as a growing dividend play, plus top line growth in store? I don't follow Broadcom. I mean, he's been an awesome dividend grower in the past, and a company that I think used to yield above 6%, which is shocking considering where it's at today. But
yeah, maybe if Eric, maybe we can keep that question in the queue, because I know we've got Jason Hall, Danny Vena coming up, and it looks like they're talking Taiwan Semiconductor and NVIDIA. So maybe they can also hit on Broadcom a little bit as well, because we don't. Yeah, I don't have a great answer to that question about Broadcom. Although to say that it has been a wonderful dividend stock for a long time, and yeah, it had a higher yield at once, but that stock has gotten so much love, obviously, in recent years. So I'm sure the yield is not near where it was in the past. I don't know what the yield is today. Probably pretty low.
I think it's around 1% today.
Yeah, it's a lot higher.
Yep.
Just pointing out Jose Mag's comment, would love to see this show every week instead of monthly, possibly. Both Brian's together, amazing. Learned a lot with these two guys during COVID. Thanks, Jose. Well, we do this show every 2 weeks, so it's not monthly. So every other Thursday at 11 a.m. Eastern. So catch us there. So we'll, our next show will be in 2 weeks. Would love to do weekly. It's just hard to fit in with everything else that Ant and I have going on a weekly basis, daily basis, actually. So, but we love doing the show. He also asked, can you publish your template? So Jose, my template, literally I Googled 16 team bracket, and it was one of the first or second images that came up. And I just generic images from some generic site, and I just copied it. So I could have paid more to make it fancier and add things into it, but I just literally just took the blank template and then filled it in using Google Slides. So give that a shot. That was my low maintenance way of doing it.
We have one from Dave J from the beginning of the show. Any European REITs you follow? Not any European REITs that I follow that are headquartered in Europe, but I mean, there are some REITs like we mentioned, Realty Income and WP Carey, which own assets in Europe. So that might be a way to get exposure if that's what you're looking for. But yeah, I don't really follow any purely European REITs.
Pure European REITs, no. WP Carey, WPC still, I think they still have a lot of European assets, right?
A lot of retail assets in Europe.
Right.
Yep.
Then maybe we can end on this quickly. And I Need Input, roughly an hour ago, said, hey, Matt and Ant, what are your top 3 REITs to buy or hold for the next decade at current levels? Thank you. Got top three on your head right now before we pass it on?
I don't know off the top of my head. I would say EPR Properties is one I would look at personally.
Yeah, won our inaugural dividend tournament, so that's got to be one of them.
Yeah. But that's all I got.
Yeah. EPR for sure is one I like as well. I mean, we've talked a lot about Simon Property Group. There's so much value right now in that retail space, in the REIT, and the valuations are very low, and yet we could do a whole show on this, but there's just a real zeal right now for brick and mortar real estate, because a lot of retailers of all sizes are figuring out that the storefront is actually the most efficient retail model, believe it or not, most profitable model versus the pure e-commerce model. And so a lot of retail REITs are benefiting from that. And then I'd say, one that we talk about a lot and is Prologis as well, PLD, the dominant warehouse distribution REIT. That's another one that's probably in my top 3 right now, if I had to choose. Great. Well, thank you so much for the questions. Thanks for participating in our poll and our tournament. That was a lot of fun. I hope everyone learned something and had a little fun. We're handing it over now to Jason Hall and Danny Vena to talk news versus noise and maybe some semiconductor stocks.
Matt, Ant, we will see you in 2 weeks.
All right.
Sounds good.
See you guys.
Peace, guys.
Hey, Danny.
Jason, how are you, buddy?
I'm good, and I'm better now that I am in your presence. It's good to be here together. All right.
We have not shared the stage together for as much as we did once upon a time, so it is a pleasure for me to be here.
But just as when we're analyzing companies and looking for opportunities, we want to think directional going forward, and directionally the trend is very favorable for you and I doing this, and hopefully the people watching get something out of that. Like Matt said, he's Danny Vena, I'm Jason Hall. We're longtime Motley Fool contributors. This is the news versus noise hour. So here's the short version of what we look to do during this hour. We try to do it once a week, and the goal is to take things that are going on with the companies that we follow, things in the news, economic stories, macro stuff, and try to rate it on a continuum of, is this news? And what we mean by that is this something, think about it maybe a signal. Like, is this a thing that I can use? Is the information that I'm gleaning here, is it something that I can apply to my investing process, apply to my understanding of a company, some way that I can use that is going to help me make better investing outcomes? Or is it noise? meaning it's not. And again, it's not binary, right, Danny? So like, let's think about if something is pure signal news useful, that's like a 10. If it's pure noise, maybe it's interesting, but it's not actionable, it's a 0. So thinking about somewhere on that continuum in between is where most of these things are going to fall. So we're going to try to use that framework to when we're answering questions where it applies. We have a couple of companies that we wanted to put through that framework to get things started. And of course, we want to take your questions, whether it's within that news versus noise concept or otherwise. Danny and I are happy to answer as many questions as we can. So whether you're watching us on YouTube or you're a Motley Fool member behind the paywall, go to slido.com. The event code is Fool24. Get us your questions in there. And just a reminder, this is not a forum where we can or will provide personalized or individual financial advice. We do not do that. We don't know anything about you besides a question you asked. And it's
Right.
ethical and legal reasons. This is not the thing that we do here. So we'll give our answers. We'll share our experience and our opinions. But remember, they're just that. So you need to take them with a grain of salt as you inform yourself in the decisions that you're going to make. All right, Danny. So we had a couple stocks that we thought would be good to start with. Where do you want to start?
You know, there's actually one that I want to start with that I didn't originally put on the list, but it's news that's come up in the past 48 hours that I think is pretty interesting.
I think we call that relevant.
Relevant.
Yeah. Yeah. Let's do this. I like it, Danny. That's good.
So I think the relevant news here is that Google, aka Alphabet, ticker GOOGL or ticker GOOG, its intention to spend $32 billion to buy cloud security platform startup Wiz. $32 billion. That would make this Alphabet's largest acquisition ever. And you know, there's been a lot of press about this because not only is this a huge amount to pay for a startup, but you know, when you look at the big three cloud providers, and by that I'm talking about Amazon Web Services, Amazon ticker AMZN, Microsoft Azure, Microsoft ticker MSFT, and of course, you know, Google Cloud. Amazon Web Services has 33% of the cloud infrastructure market. Microsoft has about 20%, and Google is the laggard with about 11%. And one of the areas that they have historically lagged is in cloud security. And so some of the commentators that I have watched have said that this is a huge move by Google that's going to basically plug that hole or fill that gap where Alphabet has been lacking, and will make them more competitive in the cloud infrastructure market. It's also a record-breaking deal for the size of a buyout for a cybersecurity startup. So I think this is, it seems like big news, got a lot of attention. So Jason, since this is my first time on news versus noise, is this one where I just want to throw my number out there now, or do we talk about it first? What's your process?
Yeah, so let's start with that. I think it'd be good just to, again, thinking about a 0 is it's immaterial, and not only is it immaterial, but it's not actionable, right? Both of those things, like it probably doesn't matter, and even if it did, I couldn't use this information in any way. And 10 meaning it's very material, and I can use this information to inform an investing outcome. Where do you think about something? Where do you think about this?
So for me, I think this is a pretty big deal.
Yeah.
If you look in terms of cloud infrastructure being Alphabet's biggest growth area, and the fact that its cloud has been growing faster than its search for a while now,
Mm-hmm.
and the fact that this will as I said earlier, plug that hole, basically make Alphabet a more attractive place for enterprise to bring their cloud needs, because they now have this cloud security. In fact, one of the commentators that I saw said, expect that Alphabet is now going to boast for having the most secure cloud, because Wiz is, the top cybersecurity cloud platform startup. So I would say, in terms of news, I would rate this probably an 8. And the reason that I'd say it's an 8 is that if you look right now in terms of Alphabet's valuation, Alphabet is right now pretty historically cheap. It's got a trailing 12-month price to earnings ratio of 20. 20. Which is, pretty darn cheap, and close to as cheap as, you could have gotten Alphabet stock over the past decade. I think there was one period, during the economic downturn where, you could have gotten it closer to, say, 16. But still, I mean, 20 is pretty darn cheap, particularly when you look at it in terms of the market, which runs in the low 20s. And on a forward basis, it's got a multiple of 18. So you've got a company that is historically cheap right now. It's one of the, big Mag 7 tech stocks. And the fact that they're going to be able to maybe increase their desirability for their cloud platform, which is their biggest growing area, I would say, yeah, I'd say that's an 8 for me. Your thoughts?
So I'm gonna say, number one, that I agree that, again, on this continuum of whether it's mostly news or mostly noise, I do think it's mostly news, and it is material. What I'm less certain about is how much value it's going to create for Alphabet and for its shareholders. So to put some context, kind of around the numbers, Alphabet can write a check out of their savings account for this and still have 2/3 of their cash left over. So it is a massive deal within the context of the round numbers, but within the context of Alphabet's got 90 some odd billion dollars in cash. So I think in terms of like causing harm to the business, it's a pretty low probability outcome that it's going to cause harm. What's less clear is whether bundled security is being offered by the cloud provider is really going to create a lot of value, because we know Microsoft with Azure, they have their Defender products for the cloud, and also for endpoint. So, they have those offerings there as well. So I'm not sure that this necessarily creates a lot of upside value for Google. I mean, that's yet to be determined. In other words, it's clearly material. I'm just not sure, to me, that it informs more than like a 4 or a 5 that I can make an investing decision based on it with any more precision or directional outcome, right? I'm going to get closer to the right answer if this makes Alphabet more investable today than it did before the decision came out. So I'm gonna spin this a little bit, though.
Jason,
because
in something? Come on.
The most important law of investing is the law of unintentional consequences. And when I think of security in the cloud, now it's a different business, but I think of CrowdStrike. And CrowdStrike's primary business, right, is endpoint protection. That's where they focus. But Wiz and CrowdStrike absolutely compete. And the question is, will Google, assumingly, Alphabet, they're going to bolt this into Google Cloud. I'm assuming that's where they're going to park it.
Right.
What are the resources they're going to give it to continue to grow and expand? And who are the real losers going to be potentially its two largest competitors in the cloud, or maybe Oracle in the cloud, or some of the smaller cloud service providers? Or is it going to affect the cybersecurity companies more? Is this deal maybe create more headwinds for CrowdStrike for their net new growth or even customer retention that we've already seen over the past few quarters that they've reported? Their margins are getting squeezed. They're having to pay a lot more for search and for sales and marketing. Those expenses have gone up coming out of the outage last summer. And I can't help but wonder if maybe this isn't a little bit of signally newsy for those of us out there that maybe think that CrowdStrike's just going to continue to dominate. Maybe the headwinds are going to start standing up a little bit more. So I would say, thinking about this for Alphabet, I would say this is probably 5-ish for me. It's definitely material. I'm just not sure how useful it is in informing a better decision about the business going forward. I would also say maybe it's a 5 for CrowdStrike in helping clarify some of the risks to the business, particularly in terms of competitive threats. What do you think about that? Pushback or agree?
It's an interesting point. I think that there's a lot we don't know yet. And I think this is, to me, it's an 8 because of the potential. Now, there's also a risk involved here. Anytime that you acquire a company, there is a risk of culture clash. There's a risk that the integration takes longer or costs more, or is more problematic than what management views it, at the time of the acquisition. But Wiz has been making a killing in the, ever since AI reared its head, because it offers something called agentless security.
Yeah.
And essentially what it is you don't have to spend a lot of time deploying individual security programs. Basically, Wiz's platform connects remotely to the cloud, and it lets their experts oversee the setup. They use a digital twin or a copy of the cloud setup, and they use it to simulate the impact of potential threats. So I think this gives Alphabet a boost because they have not had the cloud security, platform security that its two main competitors, Amazon Web Services and Microsoft Azure, have had. So I still think it's closer to an 8. Now, if they don't execute on the plan to integrate this and use it as a draw for new customers, or to increase the take rate that they get from their existing customers, then they're spending $32 billion. That's a lot for if they don't execute on it.
Yeah, no, I think that makes sense. And to Nathan's point, I kind of hinted at it. I want to say it directly. You're absolutely right that in CrowdStrike, the endpoint protection is their core business, and Wiz is cloud data security. So they are two different things, but we've seen both expand, and there is some overlap. And we don't know what's the full plan that Alphabet has in place. Obviously, they want it to be around their core cloud business, but you just you never know what companies decide to do with this sort of thing. So it'll be interesting. It'll be interesting to see. So, yeah, I'm not convinced that it's going to be. We'll see. We'll see.
I'm not convinced it will move the needle.
Yeah, I think maybe that's it.
And I think it's more towards moving the needle than not.
Newbie mentions Fortinet, ticker FTNT, and the impact on Fortinet for Alphabet's acquisition. So Fortinet's core business is largely firewall and a lot of firewall appliances, and they've begun to it's been a while ago, but they're transitioning that business to more service based and less hardware based. Probably some impact there, but I think again, Fortinet has been transitioning to kind of get ahead of some of the threat to their hardware based business for a while. But yeah, honestly, I think the point here is that maybe Fortinet probably is more exposed to this than CrowdStrike would be, because it is more of a direct threat to the business. All right, we got another couple questions that have come in, Danny, so we can answer those.
Let me just take a quick look here. Besties asked about 10 minutes ago, how would you play Intel, ticker INTC, as a value play now? Anything?
It's not a value play.
Yeah,
the second half of that question, I cut you off there. Anything that looks up to them, but this is not a value play, right? This is.
I think, to me, Intel's more of a turnaround play than a value play. And I think the danger here is that Intel is more of a falling knife. There are a lot of moving parts with Intel. There's a lot going on. The company has not been able to pivot so that it can capture the opportunity that is artificial intelligence. They've fumbled on the foundry business. I think they are too stuck in a world that no longer values what they do.
Yeah.
I just don't see it as a value play. I see it as a value trap.
Right. Right. No, but I think that's the key. The reason it's not a value play is you don't have a steady cash generating business that props up the value of the assets that are currently deeply discounted. And eventually the market's going to turn around and see, wow, there's something here and it's just way too cheap. And you get a multiple expansion that rewards investors. The foundry business lost a ton of money last year, and they're not expecting the foundry business to be cash flow break even until 2027. And there's some optimism around getting there, because what they have to do is, kind of to Danny's point, is they still have to convince companies that need semiconductors to build on x86, right? To build on their form factor, their platform, and trust that there's not going to be competing interests using their proprietary x86, being a customer of the foundry business, which is a subsidiary now. It's a separate, complete standalone subsidiary of Intel, and be willing to make a long-term commitment. Because if you're a company using semiconductors, you can't just jump over to Intel and then next year jump over to TSMC without some substantial startup costs along the way, because you can't just pull one chip out and stick another one in your products. You have to completely design just about from the ground up to be able to do that. So it's substantial what they're trying to do, and they're learning it's a lot harder to gain that trust, and before you can gain the revenue, right? So those are the challenges that the business faces right now. And guys, we just got a replacement CEO, and this is somebody that's deeply steeped in the semiconductor industry, but more on the software side than the hardware side. Led was he at Synopsys or Cadence? Synopsys,
yes.
For really basically through its best, took over the company when it was not doing great, and led it through its best period of growth to become this established company that's got roughly a third of the automated design software that's used for semiconductor design and other things too. It's become a wonderful business as a result of what he did. So it remains to be seen if having somebody with his that's as highly respected in the semiconductor industry as he is with his connections can help start bridging some of those relationships and opening doors for Intel Foundry, we're going to find out, right? So that we don't know. And at the same time, like all of that's happening, AMD basically has kind of taken a big bite out of their PC marketplace, their market share. AMD's also taken a share out of the data center for CPUs,
Right.
and AMD and NVIDIA both have taken a big share out of GPUs, whether it's NVIDIA for accelerated computing tied to AI, but AMD's taken a good bit of share in the data center for just a lot of other accelerated computing applications over the past decade, right? Not just, this isn't a brand new thing that Intel's been losing market share to. So I view it as, like Danny said, and two things. There's a turnaround, and it's too early to know on the turnaround, but also a little bit of like a special situation opportunity. I actually made the decision a couple weeks ago, Danny, to buy some calls that don't expire for like January 2027. So the better part of 2 years out, when the stock was kind of at some of the lowest points we saw a few weeks ago.
Mhm.
And I am 100% accepting the possibility that things don't work out. Nobody buys the foundry business. They don't stand up the foundry business. And those call options expire worthless because the stock price never gets above the strike price that I bought the calls for. So I'm taking on the risk of 100% losses, but I'm risking a lot less capital than if I had bought shares, right? So there's the risk reward makes sense, because if there's a buyer or they do manage to turn it around, the payoff would be really, really good, because that's with options you can get that. But it is a riskier kind of option strategy that I'm using. I will not buy a single share until I see some clear evidence that there's something going on with a foundry business that's meaningful with a customer that's not Intel products. So that's kind of where I am right now. So,
and that segues really nicely into one of the other topics that we had put out there, and that was the rumors that came up last week that Taiwan Semiconductor Manufacturing, ticker TSM, had pitched an Intel foundry joint venture, had been in talks with NVIDIA and AMD and Broadcom.
right.
And essentially saying, hey, here's what we'll do. We will be the foundational company in this joint venture, foundational since they're a foundry, and that they would take a stake.
Foundational. I apologize, everybody, but I'm not sorry.
Okay. Well, you're the master of dad jokes. So
that's true. It's true.
So yeah, Taiwan Semiconductor said that they would take a stake of no more than 50% in the joint venture, and they were pitching the idea to NVIDIA, AMD, and Broadcom for them to take stakes in it as well to fill out the remaining 50 plus percent, and that group would operate Intel's foundries. And essentially, Taiwan Semiconductor made this pitch at the urging of the Trump administration, who had asked them to help turn around Intel's foundry business. Now, when it comes to rumors, this one was pretty interesting. I was talking with Seth Jason about this one, and he knows a little bit more about some of the specifics than I do. And Seth was saying, they use very different processes in the chip manufacturing business, and therefore he did not see how there would be an easy transition, say, to TSM and the other members of this proposed joint venture operating Intel's foundries because it would be too complicated, too complex, wouldn't be cost effective. And since then, one of who was it? One of Taiwan Semiconductor's board members has come out and denied the joint venture. And that's the thing about rumors. It was reported by Reuters initially. It was picked up and carried by, all the major tech publications and many of the major news organizations. But frankly, it's a rumor. And so for me, that falls a lot further down the noise versus news spectrum. And so for me, I don't know, I put this maybe out of 1. Just because, 1 or 2, I just don't see unless it was verified.
Go ahead, Danny.
Yeah,
I think that's the key, right? I think that's the key, is because it's at this point it's just rumors, and maybe we can say that we can substantiate that conversations happened, right? That's almost certainly there were conversations that happened, but at this point, that's it, right? So we know, here's the reality: Intel forced Pat Gelsinger out months ago. This is the person that led the decision when he came back to the business and became CEO. This was part of the strategy, was to stand up a foundry business and have the products, like all of the integrated chip design, as a separate business unit, right? And separate those businesses. So we know that's been the plan for forever. And then when they ran him out late last year, it became readily apparent that they were going to consider just about every viable option that they could, because one look at the balance sheet and the deterioration there, and the continued loss of market share and weak operating results makes it obvious that something has to happen, right? So from that perspective, I would say maybe it's more like a 2 or a 3, because it does puts the business in a position where there could be, it's more information about something happening with Intel's decision going forward and what it looks for. But 2 or 3 is about as actionable to me as 1, right? It's barely more actionable, to the point that it's really not. I think until you get to like 6 or 7, for me, thinking about it again on that 0 to 10 spectrum, you almost can't really do anything for it, but it's starting to get a little bit closer to being useful, I guess, is the way that I think about it. There's an exception, Danny. For those of us that may or may not own long-dated call options that are deep in the money, sometimes noise becomes signal, because it can turn those investments into profitable investments. And sometimes you might make the decision to close out a trade on an option early when it's profitable, so that it's profitable on a rumor. Sometimes that's what you do. But I don't think that for Intel, the business at this point, I agree, I don't think it's particularly useful. That's for sure. So
yeah, I certainly don't find Intel an attractive business or an attractive investment opportunity. To your point, if you are a user of options strategies, and like you said, if you are prepared to see your investment either double or go to 0, this might provide an opportunity, and rumors could be useful to you personally then.
Right. Well, that's it. That's very unfoolish, though. It's not. Well, we do have an option service. Motley Fool has an option service, but it typically doesn't take these sorts of use of options. They're usually really safe ways, and the trades are profitable 90% of the time, because they find high probability outcomes. Just get a single every time you come up. Just hit those singles, and versus going 1 for 5 with a home run. That's the difference in most option strategies. So we got a lot of questions that have come in here. I want to talk to about home builders. So Besties and a few other people who put comments in here. They know this is a part of the market, an industry that I'm very favorable on for the long term, despite some serious headwinds right now that home builders are facing with high costs, high interest rates, access to labor is getting challenged. Lumber costs could go up substantially this year with tariffs. Besties asked right at the beginning of our show, what is your view of home building in the next few years and potential for dividends? So this is a little bit of an overlap with the prior show too. Mentions Dreamfinder Homes and Invitation Homes. So a couple things. Invitation Homes is not a home builder. It is a REIT. It's a real estate investment trust that owns and leases single family homes to residential tenants. So they do buy from home builders, some. That's part of their go-to-market strategy. But I will say, because of the lack of inventory of existing homes and all of the challenges that home builders are facing just to meet demand, Invitation Homes is a really interesting business right now, because a lot of people want to live in a house. They don't want to live in an apartment, but for various reasons, they either don't want to or can't afford to buy a house. So renting is the choice that they go with. And Invitation Homes is built to provide that demand to the market. And it does a really, really good job. So I think that's an interesting business, and it is likely to be a dividend grower over the long term. It has been so far, and I think that probably continues. There is a path for smaller home builders like Dreamfinders Homes to become dividend payers. We saw Meritage Homes, ticker MTH. We saw it become a dividend payer in the past few years. And this was a small home builder that really grew a lot over the past 15 years coming out of the financial crisis, and got to a scale where paying a dividend made sense. For a lot of home builders, paying a dividend can get really risky, and generally it's going to be relatively small and maybe not a high yield. And you may go multiple years before you see an increase, because again, it's a very cyclical business. It's heavily leveraged to the economy and interest rates. A lot of home builders use a lot of debt, so they have a good bit of leverage to buy land, and because it can take multiple years to develop that land from the time you acquire it before you're actually selling a home on it, it's an unproductive asset. It's not generating cash on your books, but you're having to service the debt. Dreamfinders doesn't use debt to buy land, but it has a lot of corporate debt. Looking at the leverage ratios, it's actually one of the more leveraged home builders. So they need to grow into their balance sheet a little bit more to have a more manageable debt load across the cycle before I think a dividend would even make sense for them. Right now, they shouldn't be paying dividends to investors. They should be focused with the vast majority of their earnings growing the business from their small starting point right now. Danny, if I can,
Sure.
I want to build on that with Rose's question, and then Sadaf
Build on that.
Yeah, Sadaf asked about Lennar. I'll circle back to Lennar later. People don't want to hear me talk for 20 minutes straight, so I'll circle back to Lennar. But this is the follow-up from Rose, building on home building questions earlier. How does Builders First Source, that's ticker BLDR, stack up against Home Builders and Home Depot / Lowe's? I want to compare it to Home Depot and Lowe's. First of all, so Builder First Source is one of the largest distributors of building materials. And I think they have 500 or so locations that is specifically targeted at builders. They don't, Home Depot and Lowe's, they sell a ton of stuff to us, to DIYers. They have a plant department. They sell appliances. They even have some electronics and, all of the little kind of things, lawnmowers and, all of that kind of stuff. You go into Builders First Source and you're going to see a lot of lumber. You're going to see some rebar. You're going to see sheetrock. You're going to be able to buy like full roof trusses from them. They actually manufacture some goods like that for home builders to buy. So they're laser focused on that market. That is their core business, and they're one of the largest distributors, particularly one that's focused just on a specific area like home builders. So my main point is that all of the trends and risks that affect home builders affect Builders First Source as well, right? So I think that's the key. The good thing is that home builders right now are in growth mode because there's very little inventory for of existing homes for sale. It's about half of the usual amount that we would see in a healthy market. It's been that way for years. But also there's a big mismatch about where the supply is versus where the need for more housing is. So think about the Sun Belt and some areas like that where a lot of people are relocating and where there's a lot of population growth and economic growth. Builders First Source has a lot of exposure to that. So that's positive, right? So they're there over the long term. I think it's probably going to do really well because we get into like distributors. The distributors, often we don't think of them as being great businesses. A lot of times they're kind of maybe a middleman or a little in between. Maybe their margins aren't great, but really well-run distributors can be extremely profitable because they do smart things like managing their inventory really well and turning their inventory over. So even though the margins are small, if you turn your inventory over more quickly than your competitor, you're more profitable because you're getting more dollars of profit for all your operating costs. So that operating leverage is something that they're really good at. So I think Builders First Source is really, really interesting. Now, Home Depot and Lowe's are large, mature. They don't have a lot of room to continue expanding. There's some room. They can both continue to open a few new stores every year. But most of their growth is just going to come from growth in GDP and people spending more money on their homes. They can get more profit than that. Let's say they can grow the revenue 5-6% a year across the cycle. Some years are going to be good, some are not going to be good, but across the cycle, say they grow like that mid-single digit revenue rate, they should be able to grow their profits 8 to 10%. They buy back a lot of shares, so that boosts earnings per share. All of a sudden, instead of 8 to 10%, maybe it's 10 to 12% across the cycle, right? And then you get the dividend yield on top of that. That's how they can be market-beating investments, because the total return that you get really starts to add up and compound, even at those modest revenue growth rates. The tailwinds for Home Depot, it's not new homes being built. It's all these old houses that nobody's leaving. I can't remember the exact number that I saw from a study that came out of Harvard probably close to a decade ago, Danny, that said as we see the baby boomers move into retirement and continue to age, and we get the largest population of seniors the country's ever seen, the impact of falls on the economy and on the healthcare system is an enormous expense. And because of that, just a lot of improvements that need to be happening. A lot of those accidents happen in the home. I think the average home that a senior lives in needs something like $10,000 to $20,000 of improvements for accessibility and safety. That's just accessibility and safety. We're not even talking about getting rid of those avocado appliances from the 80s or the 70s, right? There's a lot of money that's going to be spent to modernize and improve, but also necessary improvements for safety and accessibility too. So those are the big trends for Home Depot. A healthier housing market, existing housing market, Danny, will juice that, because when somebody buys a house, they're going to improve it. So,
Right.
So that's how I think about the puts and takes on those businesses. All right. So it wasn't 20 minutes. It was a lot, but people want to hear from you.
I did want to throw one more thing out there. I hesitate to think that there will be any drastic change in the housing market anytime soon, primarily because you have so many folks out there who locked in lower mortgage rates over the past 3 years. So you've got
100%.
some folks out there like me who has, like, I've got a mortgage rate below 3%. There is no way on God's green earth I'm ever going to sell this house unless, something drastic were to happen. And I think there's a lot of people in that situation.
It's the golden handcuffs. No, that's exactly right. And again, we're not even talking about just 2020, 2021, the refinances and the homes purchased there, but it's easy to forget that really from 2010 through 2018, interest rates were well below historical norms. So even people that for some reason chose not to refinance during the pandemic, zero money rates still have very attractive rates that are still lower than the rates that people are able to get today. So no, I think that is definitely that, and just a lot of people aging in place and not downsizing and relocating and that sort of thing.
Right.
Those two trends are definitely headwinds for turning over existing inventory. You're 100% right.
So having said that, Sadaf asked, well, it was 4 minutes ago. I think it's a little longer now. How any tech dividend payer that you have your highest conviction? I think it depends on what you're looking for in a dividend. My favorite dividend payer, tech dividend payer, is Apple. And that the dividend that they pay is very low. The last time I checked,
Well, the yield is
Apple's
low, but it's billions of dollars.
right. Yeah, it's like 0.5% is what Apple's dividend yield is. However, if you go and look at, in fact, let me just pull up that chart here because it shows it better than I could say it. So I'm going to share my screen here for just a second. I'm going to show you what this Y charts looks like. And this is since Apple began paying its dividend. Again, let me make that a little bit bigger so it's more evident. So we've got the new larger chart here. And if you look at it, since Apple resumed paying a dividend back in early 2012, the dividend itself has increased by 164%. That's pretty good dividend. For a company that only started paying it a little more than a decade ago. The other thing that I really like about Apple's dividend is Apple's ability to pay that dividend. I don't see that going anywhere. The company generated $124 billion in revenue in the last quarter alone. They've got more than $50 billion in net cash on their balance sheet. And I think there have been some headwinds with Apple over the past couple of years, with inflation being what it was. There are a lot of Apple iPhones out there that have not been upgraded in the past 4 years. Now, the numbers that I'm going to give you right now are courtesy of Wedbush analyst Dan Ives. And he said that he believes there's roughly 300 million iPhones that haven't been upgraded over the past 4 years, and that Apple could sell north of 240 million iPhones this fiscal year. Even if those numbers are wrong, even if they are just directionally close, that's a lot of iPhones, and that's a lot of potential revenue for Apple, even though sentiment is kind of weighing on Apple right now. There's this common narrative that Apple has fallen behind in its deployment of AI onto the iPhones. That's kind of par for the course with Apple. Apple's never been first with anything. They're very measured. You were going to say?
Yeah, no, I was just going to, when you're finished, I was just going to build on that point.
Yeah, Apple was not the first smartphone out there. They were not the first music device out there when the iPod came out. And yet what they have done, they weren't the first notebook. And yet each of their subsequent devices has a significant amount of market share. And I don't see that changing with its deployment of AI. I think Apple is taking a very measured approach. They don't want to have the embarrassing episodes like Google had with Bard. And so when they do roll something out, I think it's going to be something that is useful to the 1.2 or 1.3 billion iPhone users out there in the wild.
Yeah, no, I think that's exactly right, Danny. And kind of to build on your point, it's not just that Apple is measured about bringing a product out there. When they do bring a product out there, they try to make sure that it has things that make it sticky and useful and better than the prior things out there. So like the iPod, the innovation with the iPod was being able to buy music, right? It wasn't the device itself. And there's plenty of businesses. I'm looking at you, Microsoft. I'm looking at you, Intel, that did not pursue the smartphone market because they didn't want to upend their existing businesses. And in the case of Microsoft and Intel both, they were prioritizing their desktop PCs business, and they didn't want to launch lower margin, lower profitable things that could potentially disrupt their cash cows. Apple had some serious discussions internally about before they launched the iPhone because you're disrupting your core business. That's a pretty good profitable business with the iPod. I think most people have forgotten that the iPod was the big success that turned Apple into a massive winner in the 2000s from a business that was in trouble, right? Coming at through the 90s. So it's easy to forget that. So that willingness to kind of, cannibalize your own cash cows is we underestimate how willing Apple is to do that. I think that's we shouldn't because that's how they continue to grow profits over the long term. So that's a key there. All right.
Indeed.
We got a good news or noise one that I want to take here. And this one definitely ranges into the topic of politics. So that can be dangerous and alienating when you're watching a live stream that's about stocks and investing. So I think it's one of those things where it's important to be able to have these conversations and try to look at it through the lens and framework of how can I use this as an investor? And that's besties. You've kind of put it in that framework. So the Department of Education cut news or noise for Stride, ticker LRN. Education going to states might be good for them as they seek more efficient tools for their students. So I think as a starting point, this definitely moves more towards like the noise side, because the whole thing with the Trump administration trying to eliminate a department that was created by an act of Congress, this is going to take a long time to play out, through the courts. So what that actually looks like remains to be seen. Trying to think about down the road, like obviously that's a very noisy thing. So it's like a 1 or 2 for me. But if it does become material, whatever the outlook is 6 months or a year from now, and let's say if the Department of Education didn't exist, but there's still those funds allocated that would go to the state, because that's part of the idea here, is removing a layer of administration. So more of the dollars go to the states, and then the states choose how to allocate those dollars. Yeah, you would think that it would be a positive for private businesses like Stride. So it's so early though right now. You have to put it kind of in that that noise, more in the noise side of the plate than the news side of the plate. And the interesting thing is going to be to hear from these businesses where this is their market, where education is their market. What are their competitive advantages? And if a larger pool of money becomes available, how do they get a portion of that? So at this point, it's so early. It's almost entirely noise. Danny, did I do okay there? You're muted.
I think you did fine.
Okay. All right. Anything to add?
No, just going to leave it at that.
Okay. Good job, Charlie.
So Besties asked about 4 minutes ago, or stated, baby boomers not wanting to sell due to locking lower rates may be played out. Millennials and Gen Z eventually will want to own, and they will buy, and we need more. I don't necessarily agree with that. What I did is I went and looked to see if that was played out, and a survey that was done late last year by Clever Real Estate basically found that 54% of baby boomers have no intentions of ever selling their homes. They said there's a wide variety of reasons for that. But half of them say that the house fits their lifestyle. Others say that they prefer to age in place. But also, if you're looking at the current market right now, rates are between 6 and 7%. If you have locked in a rate of about 3%, then you're probably going to want to keep that rate. And if you own your home, if some baby boomers bought their homes decades ago and own them outright now. And if you have a choice between owning your home outright and then, getting back into a market where, you have to spend money, I don't think that's going to happen. Now, there is the potential for baby boomers to downsize and sell their houses and move into, something that they would consider more of a retirement home. And I think that potential is there for those houses to come on the market. But the housing market is akin to turning the Titanic. It's something that does not happen quickly. I think the biggest catalyst will be if you see interest rates, mortgage rates fall. Then I think that could be the catalyst that unlocks the market.
So I'll agree with Besties to some degree on the specific part about interest rate aspect of it, because here's a surprising statistic, and this is from last summer. So it honestly probably hasn't changed that much, but this is from Census Bureau data. Almost 39% of U.S. homes that are owned by a family do not have a mortgage. It's a pretty high percentage.
Sounds about right.
So the number of older homeowners with the golden handcuffs, in other words, they're staying in place because of a mortgage. I agree with Besties on that. But Danny, to your point, what we're not seeing is what we're seeing more of, as you were describing it, is retiring in place. It's a higher ratio of retirees are remaining in place, staying closer to where their friends are, where they have activities, where they built their life. Definitely a lot less downsizing that was expected to happen for this generation. So again, I think the bigger thing with housing, though, is the mismatch of geographical supply and demand. A lot of supply that could come onto the market is not necessarily where buyers want to live. So I think that's where I see the biggest opportunity remaining as investors, thinking again on this within that range of news versus noise. Makes it far more actionable to invest in home builders. All right, what's next here? Oh, I got one. Besties also said that we're right that Intel is a hope, not a value play. And the question is, the U.S. going to get TSMC, Taiwan Semi, to invest and build fabs in the U.S.? Is that realistic in the longer term? So we're already seeing TSMC's doing that, right? That's already started. And I believe they just announced one of the things that they announced with President Trump was an expansion of their existing plans into the U.S. There is no doubt, and this has been the case under every administration for decades, that having a healthy domestic supply of advanced semiconductor manufacturing is a national security priority. So that is something that is helping Intel. Is the fact that there is a national security interest in having domestic manufacturing. And honestly, that was one of the things that I took into consideration, Danny, when I decided to buy those long dated call options, those leaps on Intel, is that, is a little bit of a government project at work as well. So whether or not it's realistic in the long term, we're going to find out, I guess, is the best answer I can give.
Because the truth is, we just don't know. Now, I do think that your calls have a better opportunity of being profitable with the Trump administration sort of agitating for Intel to be successful. And, by trying to bring Taiwan Semiconductor into the mix, be that through a joint venture, or maybe have them act as advisors, might tip the scales one way or the other.
Yeah, it could. Okay, what's next?
So Ed asked about 16 minutes ago, isn't C Limited, ticker SE, a better buy, cheaper than Mercado Libre, ticker MELI, based on our discounted cash flow at today's prices. It may well be, but for me, the thing is, C Limited for a number of years has been a company that's needed to prove itself. Mercado Libre is a company that has proven itself over and over and over again over the past 2 decades. So sometimes you get what you pay for, and sometimes an equity is cheaper for a reason. And so for me, you know, I'm looking more at I don't mind paying up for quality. And Mercado Libre has, you know, they have a long track record. They have succeeded in becoming the largest e-commerce provider in the region. They are one of the largest providers of fintech services in Latin America. They're expanding their fintech offerings into a number of adjacent and or ancillary services. They are providing merchant loans. And they have all this data on their merchants, so they know whether or not the merchant is going to be able to pay them back or not. You know, they are offering expanding into consumer credit cards. And again, this is consumers that have been using their platform for years and years, so they know they have much better information about whether or not this consumer is going to be able to pay that back. So for me, there's a lot of reasons why. Now, just to be clear, I own C Limited stock. I also own Mercado Libre stock, but C Limited is a small percentage. I would say less than 0.5% of my portfolio, whereas Mercado Libre has grown to about 10% of my portfolio. It might be a better buy, but just because it is a better buy doesn't mean I should buy it.
Yeah, I want to point out too that it's a little bit of an apples and orange with C Limited and Mercado Libre. They both have e-commerce businesses, but
they both have fintech businesses.
Yeah, to some degree, but the difference is that Guerra, that's the software business,
Right.
or the video games business, is a really big part of C Limited, and it's had great periods and it's had not so great periods. It's a mature industry. I don't necessarily know that it has like the growth driving potential of some of the things Mercado Libre is doing. So that's a big part of the reason that it's cheaper, is because the potential growth rates are a little bit different. The biggest thing with Mercado Libre, Danny, you talked about it, and I wanted to, because Emily Flippin and I talked about this yesterday, and I wanted to share this context as well because I agree with Emily on it. The fintech business. I don't know what's going on with my camera here. Can you hear me still okay, Danny?
Yeah, I can hear you.
Okay. All right, there we go. Yeah, my camera does this thing sometimes where it's switched over to the other camera. So I'm going to leave it off for just a second and finish what I'm breaking down here. The fintech business, the payments business, one of the big advantages Mercado Libre has with it, Danny, is they get so much off Mercado Libre data from consumers. Mercado Pago users use Mercado Pago. They spend more money on things that are not Mercado Libre than they do for things on Mercado Libre. Right. Paying mobile bills, paying other bills, other types of spend. So you do get this really powerful cohort of data about the users that you don't necessarily get if you're just offering a payments platform that's just on your e-commerce platform. So that data is very useful for Mercado Libre, and it's in markets that are still largely unbanked, right? So as those the users in those markets, the consumers in those markets look for more digital payments and banking solutions, Mercado Libre is there to benefit. But this also creates more risk. And I've said this before, that because this business continues to grow and now it's becoming a lender, consumers and businesses, without a lot of recourse necessarily for those loans, it does make the business more and more risky the more credit that it extends to borrowers. So I do want to point out that I do think that risk profile has changed. Emily went so far as to say yesterday that she thinks Mercado Libre is far more risky today than it was 5 years ago. And I can't counter that. I think there's some truth to it. I really do. I think that there's some truth to it.
Well, you know what? Since Jeremy is here, I will let you guys hash that out.
Fair
Jeremy.
enough.
It's an interesting point there about Mercado Libre. All
All
right.
right. Hey, my
Jason,
camera's
looks
up
like
again.
you're back. Yeah.
I'm back, and I'm me.
Good,
So
good to see you.
all right, well, let's kick off this hour. It's great to see you too, Jeremy Bowman. We're going to invert this hour. Invert, Mungerizing your questions, taking Charlie Munger's inversion principle and applying it to your questions to maybe get to the core of maybe the question that's more important to answer. I'm still Jason Hall. The new guy, that's Jeremy Bowman. Both of us are longtime Motley Fool contributors. Get your questions into us at slido.com. The event code is Fool24. If you're just joining, just watching us on YouTube for the first time, you're watching us, you're a Motley Fool member behind the paywall. You haven't seen this before, just remember, we're not here to give anybody individual or personalized financial advice for a litany of reasons. This is just for educational purposes only. Hopefully our answers are useful to inform, helping you make the right decision for yourself, but we're not giving anybody advice here, Jeremy.
That's very true. Good
For, like we
reminders
said,
always.
a lot of reasons. So let me ask you this. You're familiar with Charlie Munger.
Sure.
Those that don't know, Charlie Munger, of course, the partner of Warren Buffett for more than 5 decades, and somebody that's generally given credit for taking Buffett and turning him from this old school cigar butt style, trying to buy dollars for 50 cents investor, and churning through the portfolio, buy that dollar for 50 cents, sell it for 75 cents if you can't get $1, then go find the next one, helping him become the investor that we know now that can probably be best summed up with the idea of pay reasonable prices for great businesses instead of great prices for mediocre businesses, right? That's the transition that we've seen. So the inversion principle, again, it's the idea of basically taking something and turning it upside down to try to think about approaching it from a different angle to try to arrive at the truth. Do you see a question, Jeremy, in our queue so far that you think would be a good one to apply this to? Or if you don't, maybe if there's a question you want to answer, I will Mungerize your answer.
Okay. All right. I like that. And yeah, what you were just saying too reminds me of that classic Buffett quote. I think it's far better to pay a wonderful price for a good company. No, it's far better to pay a good price for a wonderful company than a wonderful price for a fair company or something like that.
Yeah.
Right?
Yep.
Um,
Fair price for a great company than a
fair
great price
great,
for a
yeah.
fair company. That's it.
Yeah,
That's it.
Those are the
Eventually we'll get
adjectives
to it.
Yeah.
There we go. There we go.
I see this question here. Yeah, maybe I'll give my answer and we can try to invert it. Question from No Noise about an hour ago. He says thoughts on DoorDash and its partnership with Klarna. So DoorDash looks like they just announced this news. We kind of went through this in Klarna as another buy now pay later platform. For those of you who aren't familiar with it, I feel like we went through this wave of all these companies partnering with the BNPLs a couple of years ago. I guess it's in some ways it's good to see DoorDash making that kind of move, though. I do wonder. I mean, I think DoorDash is making pretty small sales. I don't know. Maybe you're making a big catering order through it or something.
How long's it been since you ordered takeout? It gets pretty expensive nowadays.
Yeah, that's true. Yeah, I mean, I think of it's funny. Like a firm kind of got their start working with Peloton, which makes sense. As
right,
hey,
right, it's got a comment in the price. It's you might want to spread that out over a few payments.
Right. So, I mean, I DoorDash. I mean, maybe you're ordering out of $40-$50 to take out. I don't know. It could be a little more than that. But and they are partnering with DoorDash has spread beyond restaurants as well. They signed a deal with the Home Depot earlier this year, and getting more into retail. So I mean, I think something like the partnership with Klarna, it could be marginally beneficial, but I don't know if that's I don't know if it's, I would call it a game changer for them. But I do think DoorDash has really evolved from there was a scrum a few years ago with all these food delivery businesses, and even with Uber and even Lyft as well, and ride sharing. They're sort of interrelated there. And DoorDash, I think, has really emerged as the winner in food delivery. I mean, Uber Eats is doing well also, but they're profitable now on a GAAP basis, and I mean, I think this is a one of those businesses with a long growth runway ahead of it. I mean, there's no shortage of demand for convenience. I think Jeff Bezos had some thoughts about that a while ago. I think people always want faster delivery and an easier way to order. So I think DoorDash is certainly providing that and branching out to new merchants, going beyond restaurants, finding new payment platforms or new ways to pay. I think that's all positive for the company.
Yeah. So I think I'm going to build on that before I invert it. So I think it is amazing. And this is kind of to the Bezos point, but there's nothing like the power of unlocking consumers' ability to make bad decisions here, right? So that's the one question that I have here is like, well, I can afford the meal, but they've just offered to stop by 7-Eleven on the way and pick up some other stuff. Maybe I'll do that buy now, pay later thing. I can stretch it out over a couple months now instead of paying it all at once, right? So,
yeah.
So it's interesting, but so the inversion to me is because it feels so. I think maybe there is a little bit of upside here for DoorDash because it could increase average spend modestly, right?
Mm-hmm.
And the way that it makes money, right? So that could be there. But the inversion here to me is who is threatened or at risk by this transaction. And I think about the flip side, like Stripe. I believe Stripe does DoorDash's payments processing. Maybe PayPal. I think it's Stripe though. I don't think it's PayPal's private label payments processing. But when I look at these deals like this that just don't feel very meaningful for necessarily either party, I often do look at like the other counterparties that are involved and say who could be potentially negatively impacted by this. And I would say, well, the payment processors that DoorDash is using that may see their piece of the pie shrink a little bit. So there you go. There's that.
Yeah.
Yeah.
Credit card companies as well.
Yeah. That's it. That's exactly right. But I would say probably Stripe before the credit card companies because they're so large.
Mm-hmm.
And Stripe probably counts. DoorDash is a larger percentage of its revenue than MasterCard does, right?
Sure.
So, again, moving up
DoorDash.
Go ahead.
Oh, guys. Oh, no. Yeah. I mean, DoorDash, when you think of all that, I mean, they're collecting that money that's going to the restaurant. So yeah, huge payment platform. I mean, if most of that is going through Stripe, yeah, I imagine they are a pretty valuable customer.
Yeah. Okay. What's next here? What's another good one that we could do? I think Dilf actually had a good question from Danny and I in the prior hour. That I do think is an interesting one to invert. So we were talking about Intel and its new CEO, who basically turned Cadence Design around back in the late 2000s, the late aughts, and led it to be massively successful. And the question was, are Synopsys and Cadence Design losing the shift towards NVIDIA and AI vision, i.e. less chip designer seats, huge productivity leap for programming and design? What about other software? So that's a really interesting question when you think about the automated design software leaders for semiconductor manufacturing and semiconductor design, Synopsys and Cadence, and I can't remember, it's around the tip of my brain right now, and I can't remember, one of the large multinational industrial conglomerates has a pretty sizable software business, but Synopsys and Cadence each have around a third of the market. And I just can't remember what the other company is. It has like 15 or 18%, somewhere around there. So about half the size of its two larger competitors. And maybe over the long term, there could be some impacts, but I think what we're seeing is that the shift towards AI and the transition over the past couple of decades really to contract manufacturing, foundries for semiconductor manufacturing, means more companies are going to be willing to invest in the resources to design internally for specialty applications or for proprietary things that they want to be able to do specific to their business or their needs. So I don't necessarily know that the potential losses of increased efficiency and productivity are going to make the market smaller for seats for design. I don't believe that is happening now. I think maybe at some point we could get to a point where the industry is more mature and that happens. But I think broadly, all of these things just increase they shorten the distance between the resources that you would need to be able to design your own silicon versus it being completely not a possibility and you're going to have to go work with somebody that's their business. So I don't necessarily know that that's the case. But the thing I like about this, as an investor, you're doing the thing that Munger has probably pushed into people's brains more than any other thing that he's done. And that's spend more time trying to disprove your thesis than trying to find the bull case. Because when we're wrong, it's because of something bad that we overlooked, right? Not because enough of the good things didn't go perfectly. So, Dilf, I love this specific thing. All right, what you got? What you got next here?
Yeah, maybe I'll just add a point there too.
Please do.
Is that I mean, I think with AI too, more broadly, we're at a stage too. I mean, basically what you said, that most companies are just thinking of this as a way to grow revenue, grow their business. And I think as far as job cuts or efficiencies, as you mentioned, we're more likely to see that as a second order effect or something. I mean, I don't think the market's really demanding that. What we've heard from those big tech CEOs is, basically the cost of losing this race is a lot more expensive than winning, or the price to pay for winning it is what am I saying here? It's much more important to lose money trying to win it than to lose it.
To play it safe and be left in the
to
dirt.
play it safe, exactly.
Yeah. No, I think that's exactly right. I think we have to share. I think we have to share long hold and prospers. Best inversion of the day. Jason's hairstyle of the past compared to today's look. So everybody, look at your screen.
Yeah.
Yeah. Yeah. Maybe worst inversion of the day. I think this could go either way. But we're making it about me, and that's all I care about. Make it about me. That I appreciate. All right, Jeremy, what's next here?
Well, I think this is a follow-up question, so maybe I'll get to this one first. But Ed says, I mean, I assume this was about DoorDash. Why are companies leaving one fintech platform and going with another? Seems the fintech area is very risky since the barriers to entry are non-existent. Well, I mean, we don't know the terms of the DoorDash deal as far as that goes with Klarna. So I think we can assume that something about it was more attractive than not working with a BNPL or versus an arrangement they had with Stripe. I think to take it one step further out. I mean, I think I agree with what you're saying about our fintech, or certainly the BNPL platforms in general. I'm not really convinced there's much of a barrier to entry here as well. I mean, these we've seen the firms and the peers sort of go through some cycles of sort of growth accelerating and slowing down. I think I'm maybe not fully convinced that the BNPL is going to be, sort of a long-term fixture in payments. But yeah, I mean, I think fintechs too are struggling with barriers to entry. Look at a company like PayPal too that once seemed very promising and has maybe just hit a maturity level faster than a lot of investors thought they would. So I'm thinking about inverting this and what if there's a winner here. I don't know.
Yeah, I think maybe the inversion here is thinking about Buffett's too hard pile. How do you differentiate across fintech platforms to find economic moats? I mean, maybe that's the question: is what moat does Klarna have? Maybe that's the way we think about this, that sets it up to be a lower risk, better reward investment than a firm. Maybe one way to think about it.
Yeah, maybe the best answer there might just be who their partnerships are with, and something like DoorDash would be, I imagine, would be helpful to them. But yeah, I think, yeah, it doesn't seem like it.
Do you get to a point where there's network effect here? I mean, here's the thing I know about Klarna. Klarna's been around for 20 years. This is not a new business. It's just they're Swedish and they do a lot of business in Europe, and so they're not necessarily super familiar for those of us that have got the U.S. bias and view the tech world through the lens of Silicon Valley, right? So maybe that's part of it. Is we're missing that they already have some network effects and they've proven to be good originators of debt. Like maybe that's really the key for the buy now pay later companies is they're good originators. They're good at measuring risk.
Yeah, well that's true, right? Yeah, that's the more hidden part of the business.
Right. No, it really, really is. So yeah, but I mean, here's the thing, right? If you're DoorDash, do you want to partner with the one that's going to be the best, like from a financial perspective, or the one that's just going to give credit to everybody that comes on your platform that wants to use it, right? Because if Klarna says, yeah, you know what, thanks, but no thanks. Who are they going to be mad? They're going to be mad at DoorDash, right?
Yeah.
I just spent 5 minutes trying, and now I can't, and now it's going to take 20 minutes more before I can get my food, and I got to use my credit card, So, you want your platform to be seamless and you don't want to create friction. So we'll see.
Yeah, that's a very good point.
Yeah. It's a hard one. This is a little hard one for me to totally invert. Maybe the question is where are the pain points that, and again, fintech is a big bucket because you've got a lot of companies that do a lot of different things, right? So, but where maybe the question is where are the pain points that fintech companies can find opportunity and create profit?
Yeah, I mean, I think at some level the competition is not too much different from how banks compete with each other, which is like you said, mostly managing risk, and then how you acquire and retain customers, which is often just you have a branch in the right place or something like that, or there's a lot of friction there with switching bank accounts. So yeah, I mean, if you signed up for PayPal or Venmo or whatever, you're probably it might be easier to just stick with them than join another fintech.
But Steve Mitchell's right here, right? Sezzle, I believe they're another one of the buy now pay later. I think that's their core. Is that their core business? I don't follow Sezzle, but I believe that's
something they do.
Yeah, there you go. All right, what's next here? I'll do this while you're looking. I'll take Newbie's question. We mentioned it in the prior hour, but I want to make sure Newbie might have put it in. We got a couple questions about the same time that were generally the same. And I want to, in case Newbie's still watching, I want to make sure that they got the answer. So Fortinet impact due to the Alphabet acquisition. So Alphabet's buying Wiz, the Wiz, right? Is that Wiz? I believe. The Wiz?
Yeah, I think I just saw a headline that Wiz might have called that off, and they're going to IPO instead.
No kidding. All right,
Let
let's
me
see
double
here.
check that.
What's the news? We got to read the news here for this because that's a big deal. So Google 2 days ago announced, $32 billion agreement to acquire Wiz. I'm not seeing. I'm gonna let you dig in a little bit more here. But the question,
Okay.
the question, I'll answer this question, and then you can circle back and if we have anything confirmed that the deal is off or not. The impact to Fortinet due to Alphabet's acquisition of Wiz. So that is one thing that I kind of inverted the question before we were talking in news or noise about, is this what's the upside for Alphabet here, bringing cybersecurity cloud-based cybersecurity in-house to be able to integrate it with Google Cloud and to sell to Google Cloud customers? What was the upside there? And I said, well, what about, let's think about the downside. And I talked about CrowdStrike, where there's a little bit of overlap. And then Fortinet came up, which of course they're more on the firewall side. So definitely more affected by a move like this. So there could be some Fortinet could definitely be impacted to some degree by this. But I think it's worth remembering too that there's a lot of cloud data out there across a lot of companies, and it's still going to be interesting to see if this deal happens, how Alphabet integrates it, and whether they're able to leverage what's compelling about Wiz and grow it and expand it, and use it to take more cloud share, right? Which is their biggest goal, right? They've been growing their cloud share for a few years now. Can they continue to do that? And will this help them unlock more cloud share growth? Or are they just going to sell security licenses and keep about the same amount of share, right? So that's what we don't know. If Wiz's share of the security market would grow coming out of this. So did you find anything new?
No, I think I was wrong about that. I'm sorry.
Okay.
I must have.
All right.
Maybe that was an old.
We're here.
headline.
We're creating new rumors every day here on Fool24. Just a reminder, anybody that's watching, if you've signed into the live stream on YouTube, or if you're a Motley Fool member and you've found it behind the paywall, and you've never asked a question here, people are asking questions. How to ask a question? Go to Slido.com. The event code is Fool24, all one word, Fool24, and ask us your questions. We'll answer questions as best as we can. Just remember, not individual or personalized investing advice for a lot of reasons. We're not telling anybody what to do here. We're happy to share our experience and expertise, but just remember, this is not personalized advice. Yeah. So Steve Mitchell did confirm Sezzle's buy now, pay later. Yep. So I guess they do their hook is it's four installments to pay off the good. I've never looked at Sezzle because the whole buy now, pay later space to me, I don't find it very compelling as an investor. So I haven't really opened up a lot of hoods to see what's under there for any of these companies.
Yeah, I think I'm similarly skeptical on that. I'll take this question from Besties. Let's see what we can do as far as an inversion. What do you think of Broadcom as a growing dividend play and top line growth in store? Yeah, I mean, I think Broadcom and even the semiconductor sector more broadly is kind of overlooked as a dividend, and certainly a area of dividend growth. I mean, a lot of these stocks have gone up a lot in the last couple of years, so the dividend yields aren't as attractive as they once were. But I mean, for dividend growth, I think Broadcom, looks like for close to the last decade, they've hiked their dividend at least 10% every year. I mean, yield is 1.2% right now, so pretty modest, but still.
Well, the thing that's and it's modest because as impressive as their dividend growth has been, consistent double-digit growth, the earnings and their cash flow is really, the earnings have actually been really lumpy, but for legitimate reasons, their free cash flow growth has been insane. Like, it's been exceptionally high. So the stock has gone up so fast, right? That's why the
Yeah.
yield has come down, because the stock has just skyrocketed.
Yeah, right. Yields come down for a good reason, right?
Bingo.
Yeah, I mean, I think it's a very, very well managed company. They have a history of making acquisitions and kind of trimming the fat. Their EBITDA margins are, over 60%, which, even in semiconductors is very good. Certainly, a great number in any industry. So I think they're well positioned in AI with their strength in networking chips, and I think more diversified than most of their peers in semiconductors. So I think they're kind of a good almost like a one size fits all chip stock that can work for a dividend investor. Certainly still has a lot of growth. I mean, I think they face some of the same risk as the other companies in that industry, but they do have more diversification. So I think maybe not as cyclically at risk, and I think their valuation is also still pretty reasonable.
I'd push back a little bit on reasonable. It's 44 times free cash flow.
Yeah.
So, but comparing it to some of the other,
Okay.
some of the
It
peers,
was more reasonable.
right? It's so that's the thing is that, and tell me if you agree with this or not. But I think, Jeremy, the challenge I have with Broadcom is because we are in this environment where the AI spend, capital spend to grow the infrastructure is enormous. And yeah, Broadcom is a diversified business, and they sell a lot of things: software, hardware, services, to things across the enterprise that have nothing to do with AI directly.
Yeah.
But management has been clear that the AI opportunity is a very big growth driver for the business right now. It is a substantial driver of its growth, right? And we don't know what the timeline looks like for that growth to continue before all of the capacity investments and growing the infrastructure switches over to maintenance. And we see the spin rates. How are they going to look, right? So, I mean, it's easier for me to say 10 years from now, Broadcom is still going to be a big, profitable, massively important part of the tech stack. And today's price is probably going to make you money. But it's a lot harder for me to say what it's going to be in 3 years because of the cyclical risk to the business of a change in spend in the technology industry. That's my concern at this valuation. If it traded for 25 times free cash flows, which would have been expensive 5 years ago for this company, it'd be a different conversation.
Yeah, well, yeah, I think that question about the growth in CapEx is what's keeping a lot of these chip stocks, when you look at their growth rate and the valuation, it sort of doesn't quite add up. But yeah, it seems like there's some skepticism about growth there. I mean, in the Jensen Huang, the NVIDIA CEO, in his keynote address the other day at the GTC conference, he shared some chart with CapEx spending, data center CapEx spending going up to like $1 trillion in 2028. So I mean, if you agree with him, I mean, I think these stocks will continue to do pretty well. But yeah, I mean, there's definitely risk there, and
Yeah.
it's a bit of a wild west with any new technology.
Free cash flow has doubled in 5 years for Broadcom. So it's if the growth rates continue, this price makes sense. It's less obvious that they're going to continue. So Jensen Huang saying Jensen Huang things and has been right, for a while now. But we'll see. We'll see. All right. Do you follow Globant? I don't follow Globant closely enough to weigh in.
Yeah, not really.
Okay. So there's a lot of really good consulting businesses out there, and Globant and tech consulting is good. I'm assuming you're saying that 2.5 to 3 times book value looks expensive. I'm going to do some research on that, and then I'll circle back, Jeremy. You see another one you want to grab?
Oh, I guess they were talking about they do some kind of got some questions about brackets and final eight. Maybe we could both do this one. For a dividend, Rose says a couple hours ago, for a dividend bucket, would you add 2 positions in the round of 18 final 4? Well, I think this is maybe asking for top 4 dividend stocks or so.
Okay, I like that. I'm always happy to play that sort of game. How about you go first and I'll weigh in?
Yeah, I think I'm going to go. I'll start off with Realty Income. Real estate investment trust. They do triple net leases. So they rent to they lease to mostly conservative recession-proof businesses like 7-Eleven, Walgreens. They're a monthly dividend payer. They have a track record of, I think, over 100 quarters now of raising their dividend every quarter. And I think like a lot of REITs, the prices, valuation's pretty good on the stock right now. And I'll double check this, but I'm pretty sure it was between 5 and 6% yield last time. Yeah, 5.7%. So yeah, I think if you're looking for a steady REIT, a steady dividend payer there, pretty good. Another stock that's kind of come up on my radar, I think is an sort of an interesting dividend opportunity right now is Target. Dividend yield above 4%. They are a dividend king, so they've raised their dividend every year for 50 years. The company struggled recently with the sort of broader consumer spending issues. They've had some problems with theft, that sort of thing. But management was kind of introduced a plan to reinvigorate the brand. And they expect to add $15 billion in sales over the next 5 years. I think they're still, I think they're one of those brands and retailers that I don't, I think the kind of headwinds they're seeing right now will prove to be temporary. So they're pretty differentiated in the space, and they're trading at something like 12 times earnings, which I think is a pretty good valuation for them. Move it back to utility, Dominion Energy. This is another, I think, fairly well valued, steady utility stock. Yield of about 5%. I think what's attractive about Dominion is that they're based in Virginia, and they're the data center capital of the world, or is Northern Virginia, Loudoun County. So they're seeing a lot of demand grow from new data centers coming up. They're kind of like something like an AI play in utilities. They don't have the same exposure that a company like Constellation Energy or I think Vistra is the other one, that are deregulated. But I think they're well positioned there, for a steady dividend payer. I think
you got a fourth in there.
More?
You do a fourth?
I don't know. You have any
ready?
A
retailer. You got a retailer you want to throw in there? Maybe a restaurant chain you like? See if I can get the juices flowing there for you.
You know what? I'll give another company that struggled recently, but I think long term they'll figure it out. I'll give Starbucks a nod here. I think historically they've been a good good profit, good source of profit growth, good dividend payer. I like Brian Nickel a lot. He did a great job at Chipotle. I think a lot of the moves he's made, he's only been running Starbucks for about 6 months, so it'll take some time to play off. But I think he's making some smart decisions there. Not a bad yield, 2.5% right now. So I think for that kind of sweet spot between dividend growth and dividends and growth, I think they're pretty good as well.
Yeah. So the National Collegiate Athletic Association has trademarked, copyrighted all of those awesome terms around that basketball thing that gets played in the month of March. So we can't use all those special terms around the words 8 and 4. But I will say, so we'll take your 4 and my 4. I would actually put Starbucks in there as well, because I think it's a safe dividend, interesting risk reward with the turnaround there with Brian Nickel, because I agree. He's an excellent operator. He's done turnarounds twice with very established brands and led them to new heights. And I expect that he's going to do the same thing for Starbucks. It's not because he's an innovator, it's just because he's an excellent, like, blocking and tackling operator, right? And gets right to the things that are holding businesses back and gets those things fixed, accelerated or out of the way, right? So I will do that. So we're going to call this our stupendous 7, okay? Because we each have one of our 4 that we're sharing. So my other 3 that are differentiated, you went with Realty Income. I love Realty Income. Great read. I'm going to go with EPR Properties. So it's also Real Estate Investment Trust. It's experiential properties. So hotels. Theaters are a big part of the business, but they've steadily brought that down. It's far less risky to the business than we would have thought a few years ago. Dividend yields 6.6%, and I think it's pretty safe. The payout right now is pretty safe. So the risk reward there to me is more compelling than Realty Income. And the one thing I'll ding Realty Income on is their dividend growth rate is really slow. It's growing far lower than inflation. So it's a high yield, but the growth rate is pretty slow. I think EPR can grow their dividend at a faster rate over the long term. I'm going to go sticking with that trend of housing. I've talked a ton about housing over the past really month or so. But I think Meritage Homes is an interesting dividend investment. It's a top 10 home builder, but it's one of the smaller of the top 10. Still has tremendous opportunity to continue expanding its operations. They're right in the sweet spot of where the demand is for housing, with entry-level housing and first move up. Exceptionally strong balance sheet. They use a lot of optionality with their capital, with acquiring land. They use some land options. They buy some land. So their flexibility allows them to get the land that they need in the markets they want when they're ready to develop it. Great economic results, profitable business. It's only been paying a dividend for a couple of years now. But I think that dividend, the yield right now is around 2%. You look at the valuation of the stock, you're buying what I think is a good price for the business over a multi-year time horizon. This could be a tough year for home builders, but I think, again, that theme of risk reward I think is interesting. And Meritage's dividend should prove pretty nice over the long term. And lastly, you mentioned Dominion Energy, talked about renewables, or talked about data centers. One of the things that we've seen from a lot of companies that are either relying heavily on data centers or building data centers is this appetite for low carbon energy to power them. And thinking about that trend, and also thinking about simply the need across the grid in North America, and then looking outside of North America to developing markets for the need to expand power capacity. Renewable energy is getting a lot of that because it's cost effective. In addition to the low carbon footprint, the reduced emissions, particularly as storage costs get lower and lower. And probably the best capital allocator in that space is Brookfield Renewable. You can buy Brookfield Renewable Corporation, BEPC, and get a 4.9% yield. And it's going to be a long-term dividend growth story. High single-digit percentage growth for that dividend over the long term. So best capital allocators in the space. Their optionality geographically is wonderful. And when your partner has $1 trillion in assets under management of OPM, other people's money, with the express directive to invest that money in these assets, you got a lot of tailwinds in your favor. So that's my 4 again: EPR Properties, Meritage Homes, Brookfield Renewable Corporation, and then Starbucks, where we overlap. So that's our stupendous 7 dividend stocks for our Mungerizing hour. Not bad, huh?
Yeah, that was a pretty good roundup. Yeah, EPR is an interesting one. You're right. Yeah, I looked at that not too long ago. They own a lot of ski resorts and some other. They are a lot more diversified than they once were with the mostly movie theater kind of business.
So I owe Sadaf an answer from an hour ago during the first hour that I was on. Sadaf, I hope you're still watching. I apologize if you're not. So Lennar Homes, again, sticking with the home builders theme. Sadaf asked, what are you watching for Lennar earnings today? So Lennar is going to report here in an hour and a half or so after the market closes today. Lennar is one of the largest home builders in the U.S. So a couple things. We largely know the results from the prior quarter. They give little updates on a monthly basis, and I think we have a pretty good idea that the results are probably solid, good results. Not mind-numbingly good, but good. What I really want to hear more from Lennar, because of their scale and size, is 2 things. One, just a little more information on kind of their macro view. Home builders, land, labor, and lumber. Those are the 3 big things, right? The land picture for most home builders right now is pretty good. We went through that period 2020 and 2021 where home builders just, man, the demand skyrocketed and they sold through inventory and they were running at 110% capacity, just building as quickly as they could. And then there was a little bit of a breathing period over the past couple of years as interest rates went up and just buildable land hadn't been fully developed, where things kind of slowed down a little bit. So I do want to get a little bit of an idea of where they're viewing kind of their land pipeline, particularly when it comes to Millrose, which is they did have an internal development business that would actually go and prep and develop the land. So putting in the infrastructure, finding the land, acquiring it, negotiating on it, and then building out the infrastructure that did most of their land. And they would work with other developers for land as well, but they spun Millrose out. And so now Millrose still develops some of their land, but they've spun that out. Now it's a completely separate business. So now they're paying Millrose to do the business. It's not internal operations. So I'm interested to see how that affects their results going forward, what management says about that. But I'm also interested to hear what they say about labor supply, because immigrant labor is it's a double-digit percentage of home construction. In a lot of markets, it's like 1 out of every 5 construction laborers is an immigrant, and a lot of it is undocumented labor. It's just the reality of that particular industry. So I want to hear more of their thoughts about concerns in their markets about labor supply and also lumber supply. We get a lot of lumber in the U.S. comes from Canada. So the impact of tariffs is potentially a few percentage points of margin for these companies. So I'll be curious to hear what Lennar says about their outlook for the next year, because it's always useful about helping get a little bit closer to having a better clarity on a cyclical industry like home building. What the management of these big companies, what are they seeing, and how are they thinking? That's basically it.
Yeah.
Hope the stock falls 15% so I can buy some more. I really don't, but I kind of do.
So I seem to have lost my video, but I think my camera's still on. So
yeah. Oh no, you look great. You look great.
Okay.
How do I look?
Well, I can't see you, but
there you go. Right.
So
it's better. It's better than it was 5 minutes ago. So. All right. So are you able to see the queue?
Yeah, I can see the queue.
Okay.
Here. We could take this question from Counselor Rob, I think. It just says, Jason and Jeremy, I'm wondering what are stocks that you've added to recently that you can talk about. Yeah, a couple big tech stocks. bought in the last couple weeks. And we were talking about Broadcom before, but on a similar level, I think a good mix of valuation and growth is that I bought is TSMC, Taiwan Semi, and NVIDIA as well. I mean, I think I do think there's always some risk, in any stock, and I mean, I think the AI market is, we don't know exactly where it's going, but I think the forward valuations on both of those stocks now are under 30, and both of them are still seeing very strong growth. I think they have great competitive, they're both respective leaders in what they do, and I don't really see much changing that. Frankly, I mean, I think that the closest competitor for each of them is not really very close. So I think they're very good as far as a mix of risk reward of growth and valuation. And one more stock I'll mention is Cava, fast casual Mediterranean restaurant chain that's come down pretty sharply from peak a few months ago. We were talking about Starbucks a little earlier. I mean, I think there are a lot of restaurant chains right now that are really, growing well, just seem to be doing a lot of things right. That their financial results really across the income statement, I think are pretty phenomenal. And they only have about 300 restaurants right now, so I think there's a lot of room for growth for that company.
Counselor Rob has played right into my hands. I'm going to invert this, and I'm going to share some stocks that I've actually chosen to sell recently.
There you go.
Don't worry, I'll talk about some that I bought too. Hang on just a second here. So I've made a little bit of a few decisions here. So I think this is going to be a useful conversation because I manage some investments for a family member who's not quite middle age, but is established in their career, but is actually looking to go back to school for a 3-year program, and is not going to be working when they do that, but they're going to be starting in a couple of years. So the conversation that we've had is you're going to be looking for income really starting in about 2.5 years, 3 years to replace your work income. You have stocks, not money. We need to start thinking about where you're going to get money and not worrying about the upside for stocks that you might miss, but avoiding the downside of volatility if we go through a downturn or something like that. So what this family and I have decided to do is start reducing a little bit of exposure to a few different companies. So one that was in the account that I managed was Boston Omaha. Now, so we sold Boston Omaha. I've held the Boston Omaha that I own in my own account, but they're going to be reporting here pretty soon. And there's a very good chance I will no longer be a shareholder after their report unless I see a clear signal that they've figured out operationally how to get it done with the businesses that they've acquired that they operate. So that's so Boston Omaha again. I sold and also sold Atlassian. This was an interesting, hard decision because Atlassian's actually started to figure some things out. They're starting to do better as a business. But it's one that the timing we made these investments in Atlassian was the second week of March of 2020, Jeremy. It's been a massive winner since then.
Yeah. Timing.
Yeah. So we're taking advantage of the fact that it was very good timing. It's been a big winner, and lowering the risk of volatility and the business has any further missteps and moving that to cash. So again, these were decisions partly around the quality of the business, like with Boston Omaha, some uncertainty, but also around leveraging big winners to do what you invested for, which is to pay something in the real world. So those were those decisions. I keep buying home builders. What's going on here? I bought some LGI Homes and Green Brick Partners recently. So ticker LGI Homes is LGIH. Green Brick is GRBK. You might ask, well, why not these other ones that you've talked about? And like Meritage that you just said was great. I own a lot of Meritage already. So I have a good bit of exposure, and I was increasing my exposure to green brick. And I sold LGI a couple of years ago because of some concerns that I had that they've largely answered. And I decided it's time to reopen a position there. I also chose to sell Zillow out of my personal portfolio. I sold and exited Zillow because of the concerns that I have with the existing family residential real estate market. Now, Zillow makes money in a lot of ways across residential real estate, but it's just kind of moved into the too hard pile for me right now, and I don't want to have a lot of exposure to companies that are a lot of their business is tied to existing family homes, existing inventory, because they require a lot on that for the business that they do with agents for advertising and that sort of thing. So I sold Zillow. It's still on my list of companies to follow, but until I see more clarity about the turnover of existing inventory, then it's just in the too hard pile for me.
Yeah, home builders, that definitely feels like a sector that it should come around one of these days. It's
Yeah.
a lot of tailwinds out there supporting that one.
Yep. Eventually, it's gonna come back. I also I bought in the past 6 weeks or so. I bought Transmedics for the first time. I know some executives for the headquarters is less than half an hour from my house. So I actually coach soccer with a few folks at Transmedics, and I know some people there. So having had a chance to get to know them a little bit, one of the things that it's helped me with is that these are people that are extremely purpose driven. And that says a lot about the corporate culture to me. I was already pretty bought into the idea of what they're trying to do and that their technology is better. And I get the idea of standing up their own fleet of aircraft to better leverage money they're going to spend anyway for transportation to improve patient outcomes and also potentially lower cost across the business, but really allowing them to scale up in a cost-effective way. And I think a lot of negative sentiment has been factored into the price of the business for a while. And I just decided, okay, it's time to open a starter position. And it's one that I can see if they continue to execute and deliver, then I'll add to it over the long term, because I was very mindful of the fact that I know people there, and that can cause you to over leverage to trust in the people that you know in a way that might cloud good decision making. So I've decided to start with a small position that if things don't go well, it's not going to make much of a difference at the end of the day, but it's has me invest and have skin in the game, and I'll pay closer attention and be willing to, hopefully I'm dollar cost averaging up, right? Because the price is going up, because the business is delivering, earnings are growing, and I'm paying more per share for the stock. That's like the ideal situation that unfolds with this business. And I buy it 10 more times over the next 5 years. So we'll see how it plays out though.
Yeah, Transmedics, they definitely their technology as far as the organ transportation seems pretty compelling.
Yeah. So we got a question. Mohsen Farzad asked about JEPQ, which is an ETF from, it's a JP Morgan ETF. JEPQ. I'm reading up on it right now. I'm pretty sure.
Yeah.
Is this a leveraged?
Yeah, it seems like they must be doing something with the, because what is the yield on, right, with?
Because the Q is, this was like a
9.9%
QQQ thing. So I'm trying to pull up their off on JP Morgan Asset Management. I'm trying to pull up their fact sheet to see what they actually say about this thing here. Okay, it's using options. Yeah, it's using options. So I think that's the first thing that I would say to anybody that's looking at any of these specialty ETFs is understanding how are they structured, what do they own, how do they make money, and how do they lose money, right? So just for grins here, I'm gonna share on the screen here the price chart for this. I think this is a new thing. I think it's only been around for a couple of years.
Yeah, it looks like that.
So this is the stock price movement of this going back to the summer of 2022 when it was first opened. This is what the NASDAQ 100 has actually done. All right. Now, here's the kicker. Total returns, it's done a little bit better because again, they're using options trades to generate return, and they're paying a portion of the premiums earned from those options as dividends back to investors in the ETF. Okay. So that's what it's done. My question is, what is the upside opportunity, and is it worth any additional risk that you're creating? So I'm going to have to just shorten this up to make it a little bit cleaner. So the purple is this is the QQQ, or not the QQ. This is that JEPQ. And then the yellow is the actual QQQ, the NASDAQ 100 itself. And the interesting thing here is that the volatility has been lower. So probably the biggest question that I would have is, they've shown how they can use options to make money on the way up. How do you do when you're not going through a roaring bull market for tech? How can you do across a volatile cycle through a downturn? That's what we're going to see. And there was part of that was a downturn, right? 2022. It's kind of looks like it was fired up kind of in the middle of the downturn. It was January of 2022 was the peak for the S&P. October was actually the peak for the NASDAQ 100, October 2021. So this was about 6 months into the sell-off when this was launched. So we don't really have a clear full picture of the return profile during a period of downside volatility. So just a thing to think about there. What are the fees?
Yeah.
Go ahead.
Well, yeah, it looks like red 0.35% expense ratio, so that's not too bad.
It's not terrible for these specialty kind of vehicles. That's not. I mean, that's 10 times more expensive than like a Vanguard or iShares fund that's more of a broad index.
Yeah.
But they're doing options trades, right? That costs more money, and a lot of people doing a lot of work and research to actually do the trading. So their fees are higher for a good reason. It's made investors a little more money than the QQQ, but again, we're talking 2.5 years here. We don't have a lot of track record, which we know with funds. There are very, very few that have an extended track record of generating alpha meaning long-term market outperformance. Jeremy, I talked us out of the hour, buddy.
Yeah. I was going to add it with this one too. They're selling out of the money options, so it's right. Like you're saying, it's more a risk on capping, your upside return, and then right. What I would be concerned about in a sell off is that maybe those call option premiums, go down a lot, so that might not be able to generate the same kind of yield.
Yeah. That's a really good point. All right, well, let's leave it at that. I'm going to go away, Jeremy, and Brian Orelli's in instead of me. So something tells me you guys are going to be talking healthcare.
I don't think Jeremy is supposed to be on with me. I think it's supposed to be Karl. Where's
MIA. Karl?
I don't know. He's MIA. I just texted him.
Oh, buddy. All right, Jeremy, do you want to hang out, or do you need to go?
I can hang out with Brian.
Okay. All right. Well, I'm going to leave you guys to it. And so playing the role of Karl is Jeremy Bowman.
All right. I'll try my best.
Ready to talk some healthcare in the healthcare power hour? No? Okay. I'll do all the heavy lifting then. Let's see. There was while we're waiting to get to questions, there was one a couple hours ago from Richard, who asked AbbVie or Eli Lilly as your two options. I mean, I think Eli Lilly's overpriced at this valuation. It's trading at some crazy like 17 times sales or something like that. I mean, they're expecting sales to grow by like 32%. So if they hit that number, maybe 17 price to sales ratio isn't too high. But I think that the question is, can it continue to hit 32% growth year over year, for multiple years in a row? And I think that's very unlikely. I think that they're getting competition from other, obesity drugs. Currently, Zepbound is the leader in the space, and so they're generating lots of sales, but eventually they're going to loop their sales, and then they're working off of a larger base, and to try to get to 32% growth in year 3 or 4, I don't think that's very likely. So I think that can it grow into its price to sales ratio and grow, still beat the market, but have a lower price to sales ratio in the coming years, based making its value okay if it's not growing at 32%? Yeah, probably. But I think you're taking on a lot of risk by buying Eli Lilly at this high valuation. I mean, obviously, in retrospect, buying it a year or two ago would have been an awesome idea. And I'm sorry I didn't recommend it then. But at this point, I'm not sure that it's the best investment right now, in terms of risk and reward. AbbVie, on the other hand, is probably trading at a more reasonable valuation. I've been definitely impressed by the company being able to deal with the fact that Humira went off patent, and they started having biosimilar competition, and they've obviously done quite well at switching the patients on autoimmune diseases to other treatments that are slightly better, but more importantly, have patent protection, and so therefore don't have competition from biosimilars. Now, of course, those drugs are also competing against the Humira biosimilars, because the drugs are treating the same sort of diseases, but Eli Lilly has done quite well at keeping them from having, keeping patients on their drugs, and therefore generating revenue for them. And so that has alleviated the patent issues that AbbVie was facing, and that's the reason why it's up substantially.
Yeah, the thing I wonder with the obesity drugs is what the true market potential, the true addressable market for them is. I don't know if you have a sense of that, but
yeah, I mean, people are saying that it could get to 100 million, which just seems like, 100 billion per year, which just seems like craziness to me. I mean, if you think that like the autoimmune diseases like altogether are like about 30 billion. So I think that hitting 100 billion seems a little crazy, but especially for disease that in theory you treat and then it goes away, right? Where autoimmune diseases, you can't stop them, right? Once you treat them, you start treating them, and then as soon as you stop treating them, the disease comes back, right? I mean, in theory, you can lose the weight and stop taking them, and as long as you can, keep your don't eat as much as you were before, in theory you can keep that weight off. Now, in reality, maybe that's not necessarily the case, but I think there's going to be a lot more patients going off of the obesity drugs than there are patients going off of, let's say, autoimmune disease drugs or statins, which were a a big sell. Those were probably $20 billion market when they were not generics. So
Yeah, that's a good point. So, I know, we had there. I know there was a moment maybe a year ago or so where it seemed like every company was, saying that the obesity drugs were going to change into the food market and that sort of thing. But yeah, maybe it's more of a temporary thing.
yeah. Mike E asks, yesterday, Professor Babson, who specializes in AI, claimed that AI is providing useful in drug discovery. Agree or disagree? It's definitely being useful in discovering drugs. Is it useful in discovering better drugs? I don't know. We don't have that data yet because it's been fairly recent that AI has been developing, discovering drugs. But if you look at the companies that are using AI, they're developing drugs at a much faster speed. They're discovering drugs at a much faster speed. The problem here is that the discovery part of the marathon that is developing drugs is quite long, right? So you've got the discovery, you've got preclinical, you've got phase 1, phase 2, phase 3, and those get longer and longer as you go along. And so the discovery part that AI is helping do is quite short. I mean, it can be as little as a year to go from I have a target to I've got the best drug that I think I can develop, and I'm going to take that into preclinical in levels. So I mean, sometimes it's 2, sometimes it's 3 years, depends on the target and how hard it is. But nowadays, with the ability to synthesize compounds fairly quickly, especially overseas, cheaply, companies can test a wide range of drugs fairly quickly. So yes, the AI can come up with those ideas faster than a human ever could, but it's not really, it's shaving off, 6 months, a year, maybe in the drug discovery process. So if it can make better drugs, now we're talking, that could be a huge increase in value to the chain, even if it doesn't speed it up that much. It in theory could potentially speed up the clinical trials, because if you've got a better drug, you can enroll less people and still show statistical significance between the drug and placebo. So in theory, if you have better drug, that the clinical trials will be shorter because you don't have to enroll patients. You don't have to enroll as many patients, so the enrollment period would be quicker. Depending on the drug, it depends. It determines whether the enrollment period is longer than the actual treatment period. A lot of times the enrollment period will be years, and the treatment period will be months to a year. And so if that's the case, then shortening it makes helps. If it's something where there's a lot of patients and they all want to get into a clinical trial, and the enrollment is only a few months, and it's a year to run the clinical trial, you have to read out is a year later, then that doesn't really help you in terms of your ability to speed up the clinical trial. You might go from 3 months to 2 months if you have to enroll less patients. So Ed asks about the talc powder lawsuits still going against Johnson & Johnson, and seems like the issue has held up the stock price. So I'm not sure if the talc powder lawsuits went with Kenvue when they spun out, because the talc powder would obviously have gone with Kenvue. So I'm not actually sure whether the lawsuits went with Kenvue. You would think that they would, and so that would be now a Kenvue problem versus a Johnson & Johnson problem, since Johnson & Johnson no longer sells the product. But I'm not 100% sure of that, and I don't own Johnson & Johnson, so I haven't looked that closely. But that's a good question. I would assume that it's not that it went with Kenvue, but I think you could easily find that out in the 10K and just go through Kenvue and Johnson & Johnson's 10K and figure out which one is it would be. And then Ed asks, are most major pharmaceutical firms utilizing AI in their formulation and approval process of new drugs? So definitely I mean, yeah, I don't know about, so when I think of formulation, I think of like, we've already got a molecule and we're trying to figure out, do we do it in pill form or in injection form or in that sort of thing, or do we adjust it so that it's a long acting version? That's a technical definition of formulation. I'm not sure if you're using that definition or you're really just talking about like drug discovery and trying to discover a molecule. So they're definitely using it in the discovery. In the formal definition of formulation, I don't think they're really using it. That I can't think of how it could be that useful to sort of figure out, maybe there's some like, helping with the inert ingredients in the pill to help it, stay stable or something like that. Maybe AI could be helpful there. That's sort of beyond that's more chemistry than biology. So I'm not actually sure. And then in the approval process, I think, I don't know. So I watched a panel. This was maybe I think it was just about a year ago. I watched a panel of people who were talking about AI and drug discovery and development. And one of the venture capitalists said one of the most exciting things that they were investing in was a company that so it was a private company. You and I can't invest in it, but it was approval for it was they were designing a AI that could fill out the forms that are required for the FDA to submit their new drug application or biological licensing application. So NDA or BLA, depending on whether it's a small molecule or a biologics. And so the thing is the amount of data that the FDA wants from a drug in an NDA or a BLA is like crazy. I mean, like back when they used to print them out, somebody posted a picture of the one copy of the, or maybe it was multiple copies, but like it was a boardroom table, and the entire table was stacked, like a foot high and that was what they were going to have to ship to the FDA. Now, of course, they just send a PDF. But back then they were, they had to print it out, and they would print out these, reams and reams of paper, because they literally want like data on individual patients, down to the individual patient level, and then, everything that the patient that they measured on the patient. So, weight and height and whatever, and any symptom, side effects and that sort of thing, down to the individual patient level. Of course, they look at like they get a summary of it as well. And that's what we see when we see press releases. But the FDA wants to see down to the individual patient level of this data, and so they have to send it to them, and they have to have it in the right format and whatever that the FDA wants. And so this venture capitalist was really excited about the fact that they could, I mean, that can take months, or it does take months. And so if you can shave off, a month or two off of that, so after you have an FDA, a company reads out their phase 3 clinical trials, the last one of the set, usually it takes 3 to as much as 6 months to actually file with the FDA. And during that time, the company's not just like sitting around twiddling their thumbs. They're working, as quickly as they can to get all this data into the right format. And they can do some of that. They can do the preclinical data and that sort of things, and from the earlier clinical processing the phase 3 data until they bind it to them, and they are able to do the readout. And so as soon as they hit that, they start off and running to try to get it into the proper format. So if they could scale back a month or 2 or 3 off of that, they'd have a huge advantage.
Yeah. Hey, Brian. I wanted to comment on the Johnson & Johnson question from before. Yeah, I mean, I believe they took a write down for that before. I mean, typically what we see with these large lawsuits is that you see the write down, and then they make a payment over a several year period. It looks like maybe litigation has reopened recently with the government over that the $10 billion talc lawsuit. But sorry, I had some technical issues before, so I just thought I'd add my 2 cents in that.
Yeah, I mean that would I sort of do recall that from some perspective, so I think that makes sense. Nathan asks, might it be time to give up on Novocure for now? It feels like it's the risk reward has just steadily eroded. With just a few bright spots left to keep me hanging on. Yeah, I don't know that the risk reward has really eroded. So that would mean either there's more risk or less reward. There's, I mean, it's certainly the stock has gone down, but the question is, we're measuring reward from the current level. And so I think it's, there's less risk now because there's not much expected out of the company. And so the chance that it goes down further is pretty low. And if they're able to do anything reasonable with the lung cancer, when in its current state of approval, they should have potential for quite a bit of upside. And so there's actually maybe more reward now and less risk now that it's gone down. Now that said, it's going to be a waiting game because if you assume that investors are right and that then not much happens with the lung cancer in its current state, then they've got to wait for the new clinical trial in lung cancer comparing it with and without the tumor treating fields with and without checkpoint inhibitors, immune checkpoint inhibitors, which is the current standard of care for lung cancer. But then they have pancreatic cancer, which just read out. That one was positive. So potential upside there, but you got to wait for the FDA approval. So and I don't know if they've even submitted that yet. Or maybe in that time frame that I was talking about with the paperwork, where they've got to get all the paperwork together before they can submit it, and then it could be another year. So we're probably talking about a 2027 event in terms of growing sales in pancreatic cancer. So right now it's really just glioblastoma. They certainly don't have all of the market in glioblastoma, but they really should, because it's first line and they have no direct competition. It's used in combination with chemotherapy, but there's no reason that a patient should be on just chemotherapy. They should be on chemotherapy plus tumor treating fields. It's clear that it works. So there's some sort of marketing issues there. Maybe there's some patients that just don't want to wear around a cap, and point out that they have pointing to the fact that they have a disease, in this case brain cancer, and then there's probably some so I think that's probably the main issue. So they probably just need to have a better marketing, and maybe the new management will be able to move that in the right direction and get some more sales there. Glioblastoma is a small market, so really lung cancer and pancreatic cancer are the ways to go, and we really just need to get that going, and pancreatic cancer is going to be a couple of years away, and so the question now is just, will lung cancer end up being positive? And so I'm not going to sell my shares, and I think maybe I might consider selling if the shares went up quite a bit and there wasn't any reason for it. If the lung cancer, they're not able to generate much sales from the lung cancer now, and the shares go up substantially, now the risk of it going back down is higher and the potential reward is lower. So then now I feel like the risk reward it has been eroded, and then I would potentially consider selling my shares. But because the stock is already down, I'm not sure that it makes very much sense to sell at this level, and I'd rather just hold on and see how pancreatic cancer turns out.
So a question here about what are your favorite small cap, profitable healthcare and biotech companies to own? company we were talking about, and you know, I know you and I did a deep dive on this one earlier, Brian. You know, Transmedics. It's, you know, seems like one of the more intriguing, you know, biotech, you know, growth companies out there. I know they've hit a few speed bumps lately, but you know, that's one that I opened a small position in, you know, shortly after that, and you know, the stock has pulled back a bit since then, but you know, it seems like a disruptive technology there with what they're doing in you know, organ transportation and that sort of thing.
Yeah, the ticker's TMDX, right? Yeah. Is it profitable? I was just looking because I'm not sure off the top of my head.
Yeah,
that was one of the prerequisites.
Yeah,
but yes, they are profitable, at
true.
least in the trailing 12 months. They earned $1 a share, and they're trading at $68, $1.07 a share. And they're trading at 68.29, so that puts their PE at 63.82. So quite a high PE for sure. But you know, I think I don't know. I'm not super excited about Transmedics, mostly because of their business model. They've decided to become a one-stop shop for procuring and transporting the organs, rather than just being a razor and blade model where they sell their machines that transport them and let somebody else do the logistics work. And so it's really become a logistics company. And I think that could work if they're good at it. You know, logistics is certainly a business, and you know, there are successful businesses that are logistics businesses, UPS, you know, that sort of thing. But I'm not, you know, I mean, I think it may be difficult to do on the scale that they're going to be doing it on. There's quite a bit, you know, quite a few organs that need to be moved around the country to get from the donor to the recipient. But I'm not sure, you know, if it's that number is high enough to make it so that they can do it, you know, at scale and profitable and that sort of thing. You know, that part of the business has low margins, and so, you know, flying organs around the country is not it's not technically difficult compared to figuring out the best way to keep an organ alive. And you know, for instance, the heart's actually like beating, and the liver, the one that transports livers, the liver is actually still producing bile. And so you know, they've definitely figured out a better way to transport organs compared to transporting them on ice, which was the standard of care. And I think that they're doing a great job at that. And I you know, commend them for it. I'm cheering for them, but I'm not going to buy the stock just because I don't like the logistics part of the business. And it doesn't seem like that's necessarily, you know, a high growth part of the business, especially since it's going to be low margin. So I don't know. That's just my opinion.
Yeah, definitely a change in the business there with the logistics side of it. But
it's funny to watch all the shareholders like tracking the airplane movements of their, you know, because that's all like public data, right? So there's all these like people on the internet that are like tracking the flights of their, you know, counting up the number of flights that the airplanes that they own are going on, and trying to, you know, figure out what the revenue might be based on those things. And, you know, I mean, if that's your thing, I commend you for it, because I mean, that's great, you know, but I don't know. It's just not something that I'm all that interested in dealing with.
All right. Well, looks like Karl's here to join you now, Brian. So I'll leave you
hopefully
to
with hopefully with my manageable technical problems now.
All right. Well, you're in good hands.
All right.
All right.
Can you hear me okay?
Yeah, you sound great.
Okay, good.
See you guys.
All right. See you. Thank you. So you've been holding down the fort. I appreciate it.
I have,
that,
yeah.
I'm just trying to look. There was a question up here about favorite profitable. Oh no, maybe that got answered because it looks.
Yeah,
like
we just answered it. But if you've got a favorite small cap, we talked about Transmedics. and that was I don't know, that was one Jeremy came up with. I'm not sure that all my favorites I don't think are profitable, so I'm not
Well,
sure that...
I mean, I know one that I think you like pretty well is that certainly has been pretty impressive is TG Therapeutics, right?
Yeah.
They've actually swung to a profit. I guess, was it specifically, did they have to be small cap? Was that part of the question?
Yeah, I mean, yes, which I guess, you can sort of define how you want to define. I mean, obviously if it's got a drug on the market, it's going to be, well over $1 billion valuation.
Right. I mean, TG Therapeutics is about 6.5 billion now. So,
Yeah.
I mean, that's not a large cap.
Right.
But they've been doing great just with Briumvi, right? For
Multiple sclerosis.
right, on the MS market. It's just one of these where, it's one of that really came alive after hitting the market, because I think that was regarded as being kind of a Me Too product against some of the leading MS drugs. And then it's got some modest advantages, but those, it's very slightly lower rate of complications and some slightly easier administration. And it's just one of those things where that difference is enough that people are starting to gravitate towards it. And I think that's been a slow move. So I think that the stock has been a really slow cooker.
Yeah. I hadn't realized it had gotten to profitability.
Yeah, they're doing good. All right. Well, it sounds like you already covered some of that, though. I mean, there's some other interesting ones there. Let's see. So we have one from Ed that was 22 minutes ago that says, from your perspective, what is the cheapest healthcare stock at today's prices? Pfizer, Moderna, or something else? I mean, I guess that's, part of that's your perspective on what's cheap, right? I mean, I guess that sort of implies something that's actually making a profit, maybe, as opposed to, I mean, there are lots of companies at this point that are trading under their cash value. So in other words, a company that has $400 million in the bank and a $200 million market cap, so negative enterprise value. I mean, those are, I guess, cheap, but they're also a risky area to play in, because usually they're priced that way because it's regarded as they have very little prospects of turning a profit and are likely to burn the cash that they have. So that's why they get valued for less than their cash. Some of those turn out to turn it around, but many of them, often don't. I do like Pfizer here as being a relatively cheap stock. It's got it certainly has some short-term challenges with patent expirations. And I think the other thing that I don't love about it is that I think some of the things that are baked in as kind of near-term drivers of growth are a little questionable. For instance, their obesity drug is it's a small molecule, kind of like what Lilly is working on, that has had kind of equivocal data so far, and I think there's a fair bit of value wrapped up in that. With all that said, I mean, great dividend, not in any danger of not continuing to pay that dividend, and probably will continue to increase it. And it's been priced pretty cheaply at this point. And they do have, I mean, I do think they paid a lot to acquire Seagen, but I mean, I do think that is a great platform for them to build off of. And then Moderna, I have to say, I've been really surprised. For the longest time, I always preferred, and I think I still do, but I always preferred BioNTech to Moderna, just because there was this valuation gap between the two of them. That I didn't think was justified by anything in particular, and that's kind of reversed itself. Moderna, I mean, both companies have gotten beaten up, but just as vaccine sales have come down. But now the gap is kind of reversed, and Moderna really has very sort of little enterprise value beyond its vaccine business. Just going to pull this up here real quick. I will say that, so they've got a $4 billion enterprise value, And so if you ask yourself, what is the remaining vaccine business worth? I don't think 4 billion is unreasonable. I can't remember what their latest revision was on, but I mean, they're still expecting well over $1 billion in sales.
It's 1.5 to 2.5 billion.
Yeah. Okay. So, I mean, so at the midpoint there, you're saying their enterprise value is like 2x sales. That's not a super rich valuation. And then you have, at the same time, they have a ton of cash that they're sinking into this pipeline. The downside of the pipeline, is, I guess, that they're all in on mRNA and a lot of concentration on vaccines. They have a really interesting and promising looking program in melanoma, but it doesn't read out until 2026. So, you have to wait a little bit on that. But I mean, at this point, I think they look pretty attractively priced. I think BioNTech still does too. Not maybe as much as Moderna, but it's got a much more diverse pipeline. I guess I should say a lot of antibody stuff that I think looks pretty good. And there you go. Anything you want to throw in there? I mean, those are just the two companies he already mentioned.
Yeah, on Pfizer, I think that dividend that's at 6% or something, 6 point something percent dividend yield. I think that should keep the stock at the current valuation. Like, it's not going to drop any further because that would just attract more and more dividend seekers to buy the stock. And so I think that provides a floor, hopefully, to the stock. It certainly got higher right before Lipitor went off of the market, but I feel like their patent cliff now is not as bad as their patent cliff was with Lipitor, because one, Lipitor was a huge product, and now they've got a couple smaller products that are coming off the patent, and then two, Lipitor was just such a large percentage of the overall sales back then, and now it's not, and so everyone was just assuming that they were going to cut the dividend back then, and it got up to, I don't know, 12% or something crazy. But it eventually did end up cutting it when they bought whoever that was, that other pharmaceutical company that they bought. So I think that.
Yeah. Okay. Sorry.
Yeah. Yeah. So I mean, I think that provides a floor, assuming that the dividend's not going to get up into the 12% range. Obviously, if it does that, then my hypothesis is completely wrong. But I think it's probably not. I think they're in a better state than they were right before Lipitor went off patent and they bought Wyeth, which was the company I couldn't remember.
Okay. Sorry, I wasn't sure what time frame you were looking at. I mean, I'll put in a plug for another. Just briefly, I'll put in a plug for another company that is profitable, that I think is relatively cheap at this point, which is Genmab, which has just had a horrible run. It's down at it's at a 5-year low right now, but it is quite a profitable company. It's trading now at a PE of about a trailing PE of about 11. They sell they make most of their money selling Darzalex, which is a huge, massive blockbuster for J&J. They just get a royalty on it, but it's such a huge product that royalty amounts to quite a bit of money, and so that should be steady with them still for a number of years to come. I can't remember exactly when the patent expiration is, but they've managed to diversify it out quite a bit, and they're another company that just has a pretty big pipeline. So I think that's a relatively cheap company that, while the chart looks terrible, I think they've been reasonably de-risked. All right.
Yeah.
Is there? Ed asks. Sorry. Go ahead if you were going to do something.
No, go ahead. You can, if you got one.
Yeah. Okay. So Ed asks, are there times when the FDA does not require extensive clinical data trying to get a particular drug approved? Well, I mean, so the basic rules are obviously with a generic drug, right? So a drug goes off patent and you're trying to get a generic, you're basically saying I'm making the same active chemical as was already approved. Those are mostly what you just have to do is to prove that you are indeed making the same chemical. And if you are, then it is presumed to work because the originator company did the clinical trials to get it on. Then there's the kind of in-between one, which is if you're trying to make a biosimilar. A biosimilar you can't just say I'm making the exact same molecule, because the molecules are so large and complex that they won't be necessarily the same. They'll be similar, but there's going to be various changes to the surface sugars and all this kind of stuff that you can never say they're exactly equivalent. So you do have to do clinical work there, but the clinical work tends to be faster and truncated. But if you're talking about a truly, novel drug, then FDA is always going to have a very, very high bar to get that drug approved.
But the bar sort of changes a little bit if it's a unmet need versus versus something that has multiple drugs on the market already. So if it's an unmet need and there's no other options, oftentimes you can get approval on a single phase 2 clinical trial, and then you get a accelerated approval, and then you have to go back and run a phase 3 clinical trial that's oftentimes on a like if it's a late stage cancer treatment, you'll run a clinical trial on an early stage patients and then show that it worked in those patients as well, and then you can get your full approval. In rare drugs, it becomes a little bit harder because rare diseases, because there's no other option except, so oftentimes you just have to follow, they just require them to follow the patients to gain the full approval. But you can definitely get, the number of patients that are required varies greatly depending on the disease. So you can go from approval with 100 patients to approval with 10,000 patients, depending on whether it's, a rare disease or whether it's diabetes or Alzheimer's disease. Then you need thousands of patients, where you only need hundreds of patients for rare diseases, generally speaking.
Yeah. And likewise, the tolerability for how safe a drug is also changes with the indication. So, obviously, if you're doing something that's treating a deadly cancer, they're going to put up with a lot more side effects and deleterious health effects than they would for, something that's supposed to maintain, your heart health for decades.
Right.
So
if the drug caused your hair to fall out, they weren't, that's fine for a cancer drug, but not going to be fine for a heart health drug. So,
yeah.
As an example.
Okay. And do you have one?
No, go ahead.
Oh, okay. Right.
Yeah, I guess we could talk about. So SB asks about thoughts on Evolus. The ticker there is EOLS. What do you think it could be a market beater from here? So this is an aesthetics company. They have a competitor to AbbVie's Botox, basically almost the same molecule. It's a neurotoxin that it gets injected into wrinkles and causes the wrinkles to get, the muscle to no longer be tightened, and therefore the wrinkle doesn't occur. And they've recently gotten fillers that have gotten approved. The one thing, the sales of the neurotoxins seem to be slowing down if you read between the lines of their latest fourth quarter their fourth quarter results, which had 2025 guidance. So the revenue is trying to pull it up here. But the revenue, they gave guidance for the overall revenue, and then they gave guidance for what they expect the fillers to add into the sales. So the sales in the fourth quarter were up 30% and 32% year over year for the entire year of 2020 of 2024, 2024 compared to 2025 was up 32%. And then guidance for 2025 is that revenue will be in the 30 to 33% range. So basically bracketing that 32% growth that they saw in 2020 2024 compared to 2023. And so but they also say that their fillers are going to contribute 8 to 10% to total revenue growth, total revenue of 2025. So about $30 million. But that means that the neurotoxin drug that goes by two different names depending on whether it's in the US or not in the US, I think that means that it's going to go down year over year. It's going to have slower growth year over year. So if it was producing 32% growth last year and now they're going to have 32% growth, but they've got these fillers, that means that the neurotoxin growth can't be 32% by simple math. So I think that that's a concern right now, and maybe the reason why the stock is trading at the valuation that it's trading at right now.
Yeah, and I guess there's it's interesting. There's no exact generic of Botox, but these are different botulism A. There's another one from Revance.
Yeah, I think they're second. Evolus says that they're second in brand recognition, and they've done a lot of it's almost a direct to consumer business. They obviously need doctors to be selling it, but they've really tried to go out and try to get patients directly, and they even have like a program that gives rebates or whatever, points or whatever as you get more injections, and so they're really taking a consumer brand to this because it's a cash business rather than the way a typical drug would be marketed, which would be to doctors, obviously, for the most part.
Yeah. And it's I guess, and my understanding, I mean, these all work the same way, but my understanding is that the Revance product, Daxxify, is supposed to be slightly longer acting than Botox. So that's kind of their secret sauce. Whereas I believe Evolus is just competing more on price, right? I mean, that they're going up. I mean, that's the tough part of the market, is that you're going up against very, very strong brand recognition and, a lot of relationships with the doctors who are giving it. So,
yeah.
It's going to be.
Yeah, I think the other thing is that you have to sort of maybe worry about if we hit a recession at some point in the future. Is this going to be one of the things that people cut? It's sort of hard. It's hard to tell because maybe the people who are in the position to be using Evolus's products are less likely to be hit hard by a recession, and so maybe they're still have the cash to go out and make themselves look beautiful, but maybe not. So that could be a potential. They could end up having a potential issue with that.
So I have a couple of new questions that came in, and I want to answer them both. I guess let's do the one from Sadaf first, since we were just talking about it. It says BioNTech is trading almost at its book value. What is the catch? Any thoughts on BioNTech? I mean, no, I think it's very, very cheap right now, given, I mean, you can look at it. Yeah, you look at its book value. You could look at its enterprise value, which is $5.8 billion. Again, that's $5.8 billion is the, essentially the value that's put on the vaccine business and on the pipeline, which, again, what is the catch? I guess the catch is that that we still haven't seen a bottom in vaccine sales, right? So I think people continue to just be very, very cautious because they don't know how much, they don't know where vaccine sales are going. And I do think it's unlikely that vaccine sales, I mean, it was a year or so ago, Pfizer was saying like I think they thought 2024 was going to be a low point, and then they would see growth from there. I'm not so sure that that's true anymore. I mean, I think, at least for now, COVID is shaping up to be much more like a flu, where it's like, well, do you get the flu vaccine that season or don't you? It comes just kind of a personal preference almost. I think if there was, I think if people had more confidence in those numbers, there would be a little more stability under it. But nevertheless, I think BioNTech is really pretty attractively priced, and I do like their pipeline a lot. They've got similar to Moderna that I said was working on a melanoma vaccine, which is a neoantigen vaccine, which is a personalized cancer vaccine essentially. BioNTech is doing something very similar, and they've had really impressive data in pancreatic cancer. And again, they're cooking along with that, which I think could be, at least based on the early data, looked really impressive in a cancer that just is horrible. It's just got really, really poor prognosis, and there's just not a lot of great options for it. But I mean, beyond that, they've got a bunch of stuff in late stage trials. So I think the company is attractively priced, but it's also you're definitely fighting the tape essentially on most biotech stocks at this point still, until we get into a more favorable environment. And when you do, I think it's pretty safe here, and I think it should eventually return to much stronger growth. It's much stronger returns on the stock price, especially once they get some clinical data out that shows that there's something people can really focus on other than the COVID vaccines.
Yeah, so the sales in 2024 were 2.8 billion euros, and they're expecting 2025 to fall in the 1.7 billion to 2.2 billion euros. And
and euros not terribly different than dollars, so that gives you
1.84 at the 1.7 euros is $1.84. So slightly better sales than Moderna is expecting at their 1.5 to 5 to 2.5. So
right, and again, just based on that alone, that's a pretty low multiple of their enterprise value, and then there's the whole pipeline on top of that. But you need the market to start reacting. So let's see. Then there was a question about Intuitive Surgical. So Andy asked a few minutes ago, in your opinion, what is a fair valuation for Intuitive Surgical ISRG right now? Is this pullback a good area to potentially start a position? Yeah, I've been pretty cautious about Intuitive Surgical. I was certainly cautious about them when they were up over $600 a share, just because it was, just because when I would try to run any kind of valuation model on them and say like, well, what the stock price is implying a lot of growth. Like, what kind of growth is it implying? And the growth it was implying was just higher than seemed, reasonable to assume would happen. And so, but by the same token, they're a really high quality company, really amazing at executing. They basically almost never disappoint investors. They tend to softball their guidance and then do better in terms of procedures during the year. So there's really, it's a great company. There's a lot to like about them, but they're just very, very expensive. And so I would say they've pulled back from like a peak of 616, it looks like was the recent peak, to their 494 today. So that's, what is that, like a 20% pullback? Not quite. That looks better to me. Is that like could it go down further? Yeah, absolutely. It could go down further just based on how people start regarding it as a, if they're really going to be strict on valuation as opposed to just continuing to watch how this management executes quarter after quarter and does really well. I would say if you wanted a position in Intuitive Surgical, I just wouldn't do it all at once. It's nice that they've had this pullback. This would make me feel more comfortable in taking a bite and starting to build a position. And then if it goes, it is a company that I feel pretty good about adding to as it went down, because there's no hiccups that I've seen in the business that should really concern anybody. And they do have, I think, a few nice growth levers going on, one of which is that the Da Vinci 5, their latest robot, launched relatively quickly. Again, I think they just, even though competition has always been, just around the corner for them for the last decade. It's, just around the corner. I think they just keep putting themselves ahead so that, you really have, Medtronic and J&J, if they hope to compete, it seems more and more they're just going to have to try to do it on price, because the Da Vinci 5 adds a lot of new data gathering capabilities around how the surgeon is working and the force feedback, and then they can use that, I think, to continue to improve techniques and the machines themselves. I think that the Ion has been a really, really big success. That's the catheter-based robot that goes into the lungs, based on these very small diameter flexible catheters. I think they can use that platform to do some other stuff in the future. So, they've got some more growth levers to pull. Stock was expensive at a level that was a little hard to justify. Now it looks more justifiable. That is not a promise about where it goes in the short term, but I would just say build slowly.
Yeah, I mean, I think it's still overpriced based on the valuation. I'm trying to pull up this chart here, and StreamYard is in my computer not playing well together. But here we go. Okay, if we can get Natasha to bring that up as soon as it is available to her.
I'm sorry. What are you looking for?
I'm trying to bring up trying to share my screen to show the
I got
valuation, and it StreamYard. There we go. Now Natasha should be able to bring it up. There it is. Okay, so this is a PE. You can see the pullback. The PE has come down because, of course, the price went down and the earnings are the same as they were because it's measuring off the trailing 12 months. So and the price of sales has also come down. But you can see, like, as late as most recently as July of 2022, it was it was trading in the 50 range as for price to earnings, and now it's still at 77.15 right now, even with the pullback. So I mean, I think there's potential that it could pull back further from here. Whether it does or not, I don't know. But obviously, it was very overvalued here, but it's always looked overvalued. If we go out 5 years, like, it's always been like kind of crazy. I never bought it until I bought it on like this dip, probably this dip right here, when during COVID they were having problems because a whole bunch of elective surgeries were getting canceled, and so the sales went way down, and the stock went way down, and that was I was like, wow, that's really cheap, and so I bought it right then in 2020, I believe, and so the valuation here, it was obviously really cheap, and the valuations up here were really expensive. But I think that if you can get it in this range, that would be more ideal than buying it at 77, personally, in my opinion. But I'm not selling my shares either. But I'm certainly not. I don't think I would add to it at this position, for me personally.
Yeah. And I don't disagree with anything you're saying. I mean, it was crazy expensive before. It's still expensive, but I mean,
Yeah.
it just always looks expensive. So
yeah,
I mean,
if I had ignored, valuation 10 years ago and bought it then, I wouldn't be, I mean, I would have done much better than when I did. So, ultimately my return, is, sometimes you just have to hold your nose on valuation. So, and I liked your idea of, if you're going to buy it, maybe consider buying it in thirds. And that way you can buy now, and then if it goes down, you feel better about not buying, only buying a third. And if it goes up, you feel good because your 1/3 has already, made you some money. So
yeah. And to that, I would just also add, be patient, right? Don't do it for the next 6 months. Okay, so it looks like we have a couple of questions kind of related to GLPs. I'll get to this one from Roberto. It says, what about Viking Therapeutics and CRISPR Therapeutics, which seem to be rather stuck in search or waiting? I don't know which catalysts for each do you expect and when. For Viking Therapeutics, they one catalyst that was kind of necessary for them was that they needed some sort of manufacturing agreement in order to be able to make the materials that they needed for clinical trials, but also the materials that they would need to commercialize. And what they're looking at is, obviously, if you're trying to at all be a contender in this space, you need to be able to produce a lot of an injectable drug, which is, it's not it's a peptide. It's not super easy to make. So you've got to be able to build out that manufacturing, and then presumably some sort of auto injector. And then they also have an oral drug, which is, again, I think a somewhat complicated manufacturing process to make an oral peptide. So they really had to line that up. They did. The market initially hated it because they were, every time anything happens that implies that Viking isn't about to be acquired, everybody gets upset, because that's really what investors want. They just want Viking to get acquired by somebody. And so when a big pharma makes a deal with anybody who isn't Viking, they get upset. When they did this manufacturing deal, which looks like more of a, we're going to go it on our own plan, they get upset. But then the next day, the stock actually came back really strong, because it's actually a pretty good deal. It certainly establishes. It certainly looks like they signed on with a capable partner, I should say. And so it looks like they should be in relatively good shape for the clinical trials and for eventual commercial launch. It does imply that the company is certainly not super eagerly seeking to be acquired. Not ruling it out, but at some point, investors have to stop being disappointed that the company isn't going to get acquired. So your next catalysts after that for Viking are going to be just them actually launching the trial, the phase 3 trial, which hopefully will be coming relatively soon, and you get to see exactly the design of that study. And there's some important things to look for there about how they're going to ramp dosing and some other factors. And then obviously, you're looking for the data itself. And I think we're getting more oral data later in the year, although I might be getting that right. Wrong.
Yeah, I think
yeah, and then did you want to add anything on Viking before I move over to CRISPR?
No, just that it's a GLP-1. If that wasn't clear to the people who were.
And yes,
and the ticker's VKTX.
Yes, thank you. And then and we're almost out of time here. I guess this is what happens when I come on 20 minutes late. Whoops. CRISPR Therapeutics. I just think they're in the catalyst I'm a little worried about that I'm looking for is actually a negative one, which is, do they what kind of inroads do they make with Medicaid programs, and then does Medicaid get major cuts in an upcoming budget? Will that really happen or not? I don't know if that will really happen, but doing major cuts to Medicaid makes it harder to justify an expensive new program in Medicaid like sickle cell treatment. And it's just that a high percentage of people with sickle cell and with beta thalassemia and with a number of other very expensive to treat genetic diseases end up in the Medicaid program. So that's a bit of a negative. It just worries me. It's been a slow launch already. And it's been a tough market to sell these one-time cures. So I've been just a little cautious about it. And you've seen them hold up relatively well, but generally speaking, the gene editing space has just suffered.
Yeah.
All right. Let's see. We have gone over a little bit, so I guess we should wrap it up. Let's see. We should be back on, I think, Monday to get to questions that we didn't get to today. Is that right, Brian?
Yeah, I think we're on Monday. We have a power hour on Monday, healthcare power hour on Monday. So,
okay. All right.
I'm on it. I'm on at 7 on the prediction show, and we talked about 2 of the stocks that are on my predictions. Pfizer's Dividend. I have a prediction on that one, and then I have a prediction on CRISPR versus Intelia at their stock price. So tune in for that at 7 o'clock.
I was going to say I kind of want you to spoil it for us, but I guess I won't ask you to.
Gonna have to wait.
All right. Let's see. Looks like we have Rachel and Neil coming on.
Hey guys.
Hey there.
Thanks so much.
Hello.
All right.
We will leave it in your capable hands, and we will see you all on Monday. Thanks very much.
Awesome. Thank you. Hi, Neil. How are you?
Hello, Rachel. Good. How about you? It's been a while.
It's been a whole day.
Yeah.
Good to see you. Welcome, Fools, back to another hour of Fool24. We're going to be doing our regularly scheduled valuation hour for this next hour. We will also try to work through some of the questions in the queue that either Neil or myself are able to answer. But if you have any valuation related questions that you want to get to us, go ahead and drop those in the Slido, whether it's a particular metric related question or if you have questions about the valuations of certain businesses you're following. We will do our best to answer those. I know that both Neil and myself brought a few companies that we are watching, particularly as it regards valuation. Maybe to start off, I'll share a couple thoughts of my own, and then I'll kick it over to you, Neil, in terms of what we're talking about and what we're thinking about when we're looking at valuation. And there's a lot of different types of valuation metrics that can tell us different things about companies that we own or follow. Now, obviously, price to earnings is one of the most essential metrics that we talk about a lot in the context of companies here at the Fool. And essentially, this measures a company's share price relative to its earnings per share. And that can indicate that investors expect strong future earnings growth for a business and are willing to pay a premium for that potential if you see a business with a high price to earnings ratio. Sometimes it can suggest a stock might be overvalued. And something that we also talk about a lot here on the show is that sometimes whether or not a stock is overvalued is somewhat in the eye of the beholder. I personally, as an investor, and I've shared this many times, I have often seen businesses that seemed from a metric perspective, from a price to earnings perspective, to be overvalued, but that hasn't necessarily stopped me from buying shares of the stock. So price to earnings, again, you divide a company's share price by its earnings per share. That shows you the PE ratio, and it also really tells you what investors are willing to pay for each dollar of earnings at that given point in time. And a high price to earnings ratio can sometimes suggest that investors anticipate a company's earnings are going to grow significantly in the future, and that can lead to a willingness to pay a higher price for the stock today. So sometimes a high PE could be a sign of overvaluation, but then it can also reflect really strong growth expectations as well. Now, what about when you see a low price to earnings ratio? Well, that can suggest that a stock is undervalued, that maybe it presents an opportunity relative to its industry and peers that suggests an undervalued business in relation to how the company's actually doing. But sometimes you're going to see a low PE ratio that indicates that investors are skeptical about the company's future growth prospects. And sometimes that might be for a good reason. So I think this underscores the fact that these metrics are very, very important, but there is a lot to look at behind those metrics to really understand, whether or not a company is, the right choice for one's portfolio. In addition to PE ratio, we look at metrics like price to book ratio. That compares a company's market value to its book value, which is essentially assets minus liabilities as reported on their balance sheet. Price to sales ratio can also be a useful metric where you're comparing a company's market cap to its revenue. And that can be useful as well for companies that are not profitable yet, but they are generating significant revenue so far. And a lot of times you'll see this being a valuable metric for businesses that are earlier in their growth story. Maybe they're investing heavily in the growth of the business and profitability is not yet on the horizon. But in addition to these types of metrics, factors like free cash flow, which represents the cash flow that's available to the company after all expenses and investments, that is a key indicator of a company's financial health. That can be a key metric to watch as you're evaluating, what an actual numeric valuation is for the business. So these are some of the things that are worth noting and that are top of mind, I think, for a lot of us, but for me, when I'm approaching, my portfolio, it's also important to understand, how that relates to share prices and the value of a stock. I mean, we know that stock prices are fundamentally driven by the forces of supply and demand, just like any other commodity. And when more investors want to buy a stock, the price tends to rise. And sometimes that can also lead to an inflated valuation. So sometimes determining, whether that stock is underpinned by a really good business, it requires a lot of research and fundamental understanding of the business. But I'd love to hear your thoughts, Neil, as we kick off this valuation hour.
I agree. I think it's one of the tools that an investor has at their disposal to look at companies and see whether or not it's an interesting investment for them or not. Again, it's one of the tools. It's definitely not a tool that tells you what the business does or maybe even how healthy it is. Yes, sometimes you can see on a chart fluctuations in valuation, in pricing metrics, and that might tell you part of the story. But if you really want to know what's going on, you have to look at the business financials, listen to what management is telling you. We've talked about that a little bit yesterday, for example, with Nike. Nike's forward PE a year ago was lower than where it is right now. So a year ago, you might say, oh, low forward PE, but turns out that was not truly the case, because if you dig a little bit deeper, you saw the business was struggling, and now we're looking at a forward PE that is much higher than where we are today. Another example is an Amazon, for example. An Amazon a year ago, the forward PE was twice as high as where we're at today, yet the stock is higher today than a year ago. So here we have the complete opposite, where the business has just improved its profitability so much faster than the stocks increase that you got these results. Then, like you said, there are some companies where you might say, oh, high forward PE, high PE, or high any other metric. That does not necessarily mean that it's a bad company to have. It could mean that, one, it's a company that maybe just started to turn a profit, so automatically that PE ratio or whatever ratio you're using is starting up high. Or it's one of those companies, and I want to touch on one of those companies later in this stream, one of those companies where it's always going to be expensive because it's such a good company. The market will always put a premium on that name, and so you're always going to pay a little bit more to have it. Just like with an expensive car, for example, a Ferrari. You're in Italy, so we have to talk a little bit about Ferrari. You are paying a premium because you're getting a premium car. Same with stocks. Now, okay, sometimes the premium just becomes super inflated, and then it doesn't make any sense. But eventually, all stocks do come down to normal levels eventually. So, that's a bit of a good introduction, I think, to this live stream. And then, of course, if you've got more questions, do let us know in Slido.
And I know, Neil, there were a couple companies that you were thinking about specifically with regards to this next hour. If you want to jump into those, and then I'll talk about a couple as well on my radar.
Yeah, sure. So I'll continue here on the Amazon story. So Amazon, I'm looking at right now a forward PE that sits around 30.7 times. And if I look at the 5-year mean, that sits at 64.4 times. Now, of course, in the last 5 years, Amazon, the stock, has done, I'll tell you exactly what it has done. It's, in the last 5 years, it's up 106.6%, yet the forward PE is basically cut in half. Now, on Amazon 5 years ago, you might say, okay, look at the forward PE, doesn't make much sense. It's not really profitable. How can you buy such a business? But it was by design. If we listen to what Amazon's management have been telling us for a long, long time, even if you go and you watch a video from Jeff Bezos when they launched AWS, and that business was burning millions and millions, maybe even billions of dollars at the start, they were always asking the same question: is it worth it? Is it worth it? And he has always had the same answer: we have the luxury that we're thinking about the long term. And today, AWS is a money-making machine. It's currently at an annual revenue run rate of over $100 billion, with I think operating margin for last quarter was 37%, which I mean is just amazing. So an Amazon might have been seen as a super expensive stock because, well, they were just focused on making sure that they're growing the whole Amazon business, while also making sure that whenever they want, because with an Amazon, as they've shown us, especially in the last, I would say, year and a half too, if they want, they can flip a switch and suddenly you see how profitable this business really is. You can look at operating cash flow, then you can look at free cash flow, and you can see how profitable a business like that is. So currently, like I said, forward PE 30.7 times, much lower than their 5-year mean. Even the others, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth, all lower than the 5-year mean, because this is a company where right now they are growing, but they are showing us that, look, we can grow, but look at how profitable our core businesses are. And that's reflected in the stock right now, which in my opinion, again, looks still cheap to me, even at $2 trillion in market cap, 30.7 times forward PE. Even at that size, they are continuing to grow quite rapidly. Their fastest growing segments are also the segments that have higher margins than the online store, for example, than the physical stores. So it's a great business. Valuation wise, I like it very much. Now we're under $200 per share. For those that don't know, Amazon, ticker symbol AMZN. It's one of the best names out there. Me personally, I'm biased. I've been an Amazon shareholder since 2018. Last time we had trade wars, tariffs, and all of that. We also had a short-term pain, what was a pretty good opportunity. So yeah, that's the first name I wanted to talk about. That's Amazon. If you have anything you want to add, the floor is yours.
That's a company as well I've been a long-term shareholder of. I really like Amazon, and it's been one of those businesses that, despite the ups and downs of the last several years, I mean, I first invested in it about 5 years ago, so it's obviously been a volatile time in the markets. But this is a business that I think just continues to really refine and upgrade its business model in all types of environments to meet the demands of the age and industries in which it's operating. And I think that that's something that has been really unique to this business, and something that has made me want to be a long-term shareholder in it. I mean, you know, it's a household name. Most people know and are familiar with Amazon, but it is one of those stocks that I think, I've said this before, when I first invested in it, I remember thinking, I wonder if this is a business that has, you know, reached its growth potential. Am I investing too late? And I think already in, you know, roughly 5 years of being a shareholder, I've answered that question of no, this is a business that has still a lot of room to run and has continued to demonstrate that even in a relatively short period of time. And, you know, obviously a lot of people are paying attention to what they're doing with AI and how that is incorporated into AWS and other elements of their business right now. And I do think that's an important piece of the puzzle, but I do think there's so much more as well to this business, and just their flagship e-commerce platform continues to be just an absolute powerhouse for the business. So yeah, this is definitely one that I think is probably one that a lot of investors will inevitably pay a higher valuation for. I mean, I definitely did when I bought in, but it's been well worth it.
Yeah, no, I agree. I mean, if you look at their business, I've seen something yesterday where maybe they're going to announce that you can buy cars straight from Amazon.com, which basically means that they're going to compete with a Carvana, for example. And I was like,
wow, I didn't see that actually. I have to look into that.
I mean, it's crazy. You start off as a bookseller, and now 25 years later, you're selling cars online. But yeah, it's
well, and something as well I was talking about, for example, I think earlier in the month was, you know, they're as they expanded to AI, this new agentic AI group that they were forming, and how they see these tools as being, you know, invaluable to help organizations improve their efficiency over the long term, and how they're establishing this entirely new unit that's going to build software for working with AI agents. That's fascinating to me. And when you see sort of the interplay between these AI agents and then, you know, large language models, and the opportunity that has for Amazon internally, as well as, you know, some of its largest clients, this is something that I find really fascinating as well. And I think it kind of underscores that point of, this is a business that continues to innovate with each year, with each decade. And I think they've proven their ability to do that through time.
Yeah, no, I agree. There was one question here before we jump into your pick. One question from Dizzy Fool. So he asks, isn't it really fair to say valuation doesn't include an understanding of the business? Does it include growth rate projections based on business lines? So yeah, maybe that's something I forgot to say as well. When you look at a forward PE, for example, the E, which is the earnings, that can change, right? Because if we look at forward PE for this year, or even a year after that, or even 2 years, it is based also on analyst expectations. So if those expectations go up or down, that PE metric will of course change, and so the stock can become cheaper or more expensive based on the expectations of that E, which is the which is the earnings. So yeah, I would agree.
I'll talk really quick about a company that I've been looking at for a long time, and I've been watching it, from afar over the last several years through the ups and downs of the market. And I think it's getting to a point at which I'm much more interested in buying, and that's Airbnb. This is obviously a company that has seen their, valuation come down significantly in the last few years. And that really has not been something that has accompanied any issues with the business itself. Far from it. This is a business that has continued to improve in terms of profitability, in growing free cash flow, and generating positive, consistent top line growth. But just to kind of give some numbers to this. So the company currently has a market cap of about 76 billion. And their market cap has decreased by about 20% over the last year. Their market cap peaked back in 2021 at over 100 billion. And in 2020, when they held their IPO, they were valued at about 47 billion. So there's been a lot of ups and downs since that time. Currently, Airbnb trades for a trailing price to earnings of 30.66, forward price to earnings of about 28, price to sales of about 7. And a price to book ratio of about 9. Now, this is one that, again, I've talked about a lot on shows over the months and years, a long time ago in the earlier iteration of Fool24 when it was Fool Live. And this is one of those companies that I just think has been unfairly treated by the market at large, which obviously could present, an opportunity. And I do think it's fair to say that, especially early on in its journey as a publicly traded company, I think the valuation was too high. At that time when the company was newly public, and this is something I've said before, I don't generally invest in new IPO stocks. And so that was one where I was watching. I've seen that valuation come down a lot over the last few years. And now I find myself a bit more intrigued with the business as someone considering taking an actual position, as I've seen that draw down in shares. But if you look at the actual business, I mean, in 2024, revenue was about 11 billion. That was a 12% year-over-year increase. They delivered net income of about 2.6 billion in 2024. Free cash flow of about 4.5 billion in the 12-month period. Nights and experiences booked were about 492 million. That was a 10% year-over-year increase. Their gross booking value in the year was 82 billion. That was a 12% year-over-year increase. And they have a very fundamentally asset-light, capital-light business because they do not own or operate the listings on their platform. And that's something that has been really, really key. Now, another thing that has made me even more interested in this business is the fact that they have been really working to refine their platform of offerings. As they've said before, and we've said before on this show a lot, this is fundamentally a tech business. This is a tech business at its core. And this is something where management has really been working to refine the offerings that it presents to both hosts and guests. They've been really aggressively removing what they deem to be low quality listings from the platform over the last few years and especially over the last 12 to 18 months. And that's been something that, while in the short term could impact some of the listing numbers you see in terms of what they report, that's something that over the long term is fundamentally good for the business, because that means that they're focusing fully on providing the most quality types of stays. That also creates a situation where great hosts that are listing their homes on the platform are going to have even more of an opportunity. At the same time, they've also been working to expand into markets where they have, been heavily underpenetrated in these regions, or in some cases did not have a presence at all. One great example is in Japan. This is a market where Airbnb had a very nascent presence, and they built an entirely localized marketing campaign, had a very, very local approach to expanding there. And that was something that was an immense success for them that they highlighted in their recent report. They said Japan is one of the largest global travel markets, but many locals did not feel that Airbnb was relevant to them. And so they said, we worked to localize the product, highlighting specific amenities preferred by locals, along with reviews from fellow Japanese travelers. They said we featured homes and points of interest that are perfect for domestic weekend travel, one of the most popular types of travel in Japan, and having more accurate search options with popular landmarks. They also said that we reintroduced the Airbnb brand to Japan with an integrated campaign featuring the line, all types of accommodations, all flavors of Japan, and that it talked to the breadth of Airbnb homes in unique parts of the country where travelers can stay for a weekend. And even though it's early days, in this one example of a market that was a huge opportunity for them, but where they had a very minimal presence, it's already been an immense success. You know, they've got a very, very concentrated presence in North America, but they are growing fastest outside of that region because that's where there is all of this opportunity for them. And some of that might be from US travelers, but Europe, the Middle East, Africa, Latin America, these are all areas that are robust growth opportunities for Airbnb, where they're seeing some of their fastest growth rates and where they're also noting some of the lower penetration compared to North America. So I think this is a really intriguing business. The valuation is looking a lot more palatable for me than I did a few years ago. And if I take a vacation at some point soon, so I'm not talking about the business every day on the show, I might actually buy some shares.
Airbnb, I own it as well. It's a very good business, very, very good business, very profitable as well. It's true that the stock has been struggling. I mean, the last 5 years, I think the stock is basically down, but the business has become bigger. So you're paying today a better price than you did 5 years ago, of course. One thing I'd say with Airbnb is that there is, I mean, the experiences, for example, that has been something that they've talked about before, but didn't really live up to the expectations. And I think they know it. They know it as well. They said that this year there are already some big changes that are going to happen. Brian did say that they're going to launch 1 or 2 businesses yearly, I believe, that could generate and should generate the company $1 billion each. So that could be a big, big change as well in the future. I've always said that Airbnb should become a one-stop shop if you want to book a holiday vacation, no matter what, like from your house up until you get to the hotel and maybe even back. Like, especially now with AI, generative AI, you can have a chatbot, an Airbnb chatbot, or they can come up with a nice, funny name where you say exactly how many people you are, how long you want to go, what are the dates that you're free. You're looking for hot, cold, what type of vacation. This is the budget. Find me something. And I think that's where we're going. A type of concierge service. He's also talked a little bit about potential future partnerships that they could announce with other companies, which would make sense. Right? Imagine you go with your family somewhere, you book the whole house, and you have already all the groceries inside the house, right? You partner up with Uber Eats or a DoorDash, no matter what. You already order everything you need, and everything is already at that place. It's an added service. It's a concierge service, and I think Airbnb might be going that way. I'm still mind blown that there is no rewards on the platform. Like on bookings, you have the genius ones, and on Airbnb there are no rewards. So just by adding rewards, you incentivize people. Okay, well, you booked with Airbnb. Here are a couple of points. You might redeem them in the next time, and it gets 5% cheaper or whatnot. I don't know why this doesn't exist just yet.
I think that's a good point, and I've actually never thought about that with regards to Airbnb, which, as both a consumer and then someone who follows and reports a lot on both Airbnb and Booking Holdings, it's interesting to think about. There was a very relevant question from Besties that came in. Airbnb unfairly treated. Why do you think that is? Why has the stock not moved for many years after its IPO? What are the negatives that would make this? And this is obviously something we've been talking about a bit the last few minutes. I think it's a range of factors. I think that we saw a real impact across the market in the period following the time in which Airbnb went public, where a lot of these growth-oriented businesses saw a significant downward trajectory in share prices. And I do think in the early, months and year plus following the company's IPO, that was a huge element of what we were seeing from the broader market. At that point, this is obviously a company that was working towards consistent profitability, growth-oriented business. That was a whole category of stocks that, broadly speaking, somewhat fell out of favor with investors. Now, in the last couple of years, as the market has rebounded and Airbnb has had some good days, but overall is still, down and has gone down significantly. I can prognosticate a little bit. I think that there's been ongoing concern about spending patterns of the average consumer. We know that a lot of travelers on Airbnb are, from all over the world, but they are very much also driven by U.S. travelers who are spending money to go to, whether it's in North America or to Europe or other international locations. And there's, I think, been a lot of concern about the general appetite of the consumer to spend. Now, despite that being the case, we have seen a lot of favorable metrics from the travel industry. We've seen a reality where people are still spending money on travel. And I think we are far past the point where that is, pent up demand from the pandemic, where people had, savings set aside that they put to use later. I think part of it is also that people are prioritizing on experiences rather than things. And that has, I think, very much flowed into Airbnb's financial performance, but it really has not impacted the stock at all. And this is, I think, something that's puzzled quite a few investors. I think for me personally, I think that there's still just overall fear in the markets about what the trajectory of this industry will be. And I think that that concern has trickled down to the stock performance. Now, more recently, there's obviously been some quarters where management has, talked about maybe having weaker than expected sales, or maybe warnings about moderating growth in some of their categories like nights and experiences, but they're still having really robust results. I think that this is one of those companies that eventually shares are going to catch up to where the stock is. But I think as long as there continues to be shifts in broader consumer spending, which we've been seeing come down across a lot of categories, and concerns about, economic unrest, I think this is a stock that's going to struggle. And I don't know, when that dynamic changes. We have seen across so many industries, great companies, eventually that does feed into share price performance. With Airbnb, I think the broader market sentiment and overall concerns about the long-term state of travel in the macro landscape of the last few years have been the biggest issues.
Yeah, I mean, the topic of this stream is valuation. So I guess valuation matters, right? 5 years ago, it was probably too expensive. And that's why when we see the 5-year track record, it's still down because maybe it was just too high back then. But it's still, if we look at a competitor, which I think is a big competitor, is Bookings, right? Bookings Holdings, ticker symbol BKNG. The last 5 years, that stock is up 118%, whereas Airbnb is down close to 20%. So it really depends how much you're paying at a certain price for a certain stock. Because Airbnb, if we look at, for example, when was it? I believe there was a time where it was trading closer to $80 or something like that. So the end of 2022, it was at $85 or so. So that's still up close to 50% since then. So again, it really depends the price that you're paying. That's why we're talking here about valuations. Great business, wrong price, you get a bad performance in the short run, I'd say.
Yeah. And Matt, I see your question. I think that's an outdated listing on the disclosure page, because as I understand, as contributors, we are no longer required to publicly put out, even though we have internal disclosure requirements, publicly put out our stock holdings. So I do think that the listing you're seeing is a bit outdated. I haven't quite worked up to my long-term goal of 25 to 30 stocks, as I'm a more recent investor over the last several years. So I've started out early on investing a more significant amount of money in some very specific larger businesses. But I think that was an outdated page you were looking at. So hopefully that answers your question. Let me talk really quick about another company I'm looking at in terms of valuation. And then Neil, if you had another one you wanted to talk about, and we can also get through maybe a couple of the questions that are here. But another business I talk about a lot is Vertex Pharmaceuticals. This is a company that is the leader in the cystic fibrosis therapeutic space. For a long time, and up until recently, that was essentially what their entire business revolved around, particularly their flagship drug, Trikafta, which when it was approved by the U.S. Food and Drug Administration back in 2019, that approval covered about 90% of the cystic fibrosis patient population in the U.S. alone. And they have been having some significant developments for the business that I think are really robust tailwinds, over the coming years. And I'll talk about those in a minute. But in terms of, valuation, this is a business that trades at a trailing price to earnings of about 32, a forward price to earnings of about 30, price to sales of about 12, which is in my humble opinion, a pretty good price for this company. Again, they're a biopharmaceutical company. They focus on developing and commercializing therapies that target rare, underserved diseases. And one of the biggest things that has been, I think, something that I've been really excited about for this business looking over the long term is some of the drugs they've had in their pipeline, which are now most recently being approved or are hopefully about to be approved. They just garnered approval for their new triple combination cystic fibrosis therapy. This is a therapy that sort of combines some of the best elements of their existing cystic fibrosis therapies into one new super therapy. And this is one that is expected to not only impact existing patients that take Vertex's cystic fibrosis drugs, but is also expected to benefit patients who have never taken a therapy before, or maybe were taking one of their therapies and had to stop for one reason or another. This is widely expected to be a blockbuster drug, following up or even outpacing the success of their longtime blockbuster, Trikafta. But outside of cystic fibrosis, this is a company that's been working on many different drugs that are designed to serve as functional cures for very rare or underserved diseases. They made history last year, or I think it was last year or the end of the prior year, when they garnered approval for their gene editing therapy, Cascavy, that they developed with CRISPR Therapeutics. This is a one-time functional cure for both sickle cell disease and beta thalassemia, transfusion-dependent beta thalassemia. And this is also one that, unlike more traditional drugs and therapies, the impact of this on its balance sheet is going to take significant time to show up, because the process of administering a gene editing therapy is a very protracted process. But this was a huge, huge deal that this company, along with CRISPR Therapeutics, garnered approval for this drug. The other one that I'm watching, and again, just was approved at the end of January, is Journavax. This is a first-in-class non-opioid pain medication. This was approved by the FDA, I believe, about January 25th, somewhere around there. And it's specifically approved for treating moderate to severe acute pain in adults. It is the first of a new class of pain medication that has been approved in over 20 years. It blocks pain signals in the peripheral nervous system before they reach the brain. It is a huge addressable opportunity for the business. There are roughly 80 to 90 million people in the US alone with moderate to severe acute pain. And that, of course, is only one of their long-term core target markets. So fascinating business, historically very, very profitable, has a long track record of producing positive free cash flow and GAAP profits, and growing their revenue in the low to mid double digits. And this is a business that I think over the long term has really only barely begun to realize its long-term growth opportunity.
This is a business and an industry I do not follow at all.
It's all good.
Yeah, no, for sure. I'm sure there are a lot of interesting companies in that industry. Before I jump into my name, I just wanted to answer Bestie's question here from, I believe, 28 minutes ago. So what is the stock you are looking at now that is attractive? What is your portfolio's largest position, and what % does it occupy? How to pick your stock? So right now, it's still Tesla. I'll explain why. Because I bought Tesla in August 2019, which means that position that I opened back then has gone up by 15x. So organically, it became a super large position in the portfolio. At one point, it was actually 50% of the portfolio, but that has come down now closer to 20, and might get down a little bit more as I add more to some other stocks in the portfolio. So that's to answer the last couple of questions. How do I pick stocks? That's a long story. To keep it short, if I understand the business, if I like the business, if I think there is some growth potential, if I like management and I like the price that I'm paying, I'll probably pick that stock. Then again, I like a lot of companies, so I cannot buy all of them. It's not like a Pokemon game where you have to catch them all. I cannot catch them all, so I have to be selective. So in my portfolio currently, there are around, say, 15 names at the moment, and I'm quite comfortable with that. So what I'm looking at right now is probably the same names I own, just an Amazon, for example. Like I said, the next name is Alphabet, Google. I've talked about in the bold predictions stream yesterday about AMD and PayPal. So yeah, lots of names, lots of very interesting businesses that are looking quite attractive at today's prices because of the overreaction. Well, I think it's an overreaction in the market. So that's that. I would like to talk a little bit about the next company, which is Google Alphabet. So ticker symbol GOOGL. This is one where it's very interesting because it's one of the best businesses ever created, one of the most profitable businesses ever created. Has a market cap now of just under $2 trillion and a forward PE of 18.3 times. Now, when you hear this 18.3 times, of course, this sounds crazy. Like, how can this name be trading at such a low PE? But it's very important to know that a business like Alphabet has never really been that expensive. So I'm looking here at the 5-year mean for the forward PE, and the 5-year mean sits at 24 times. If I look at the 10-year mean, that's at 23.7 times. So yes, it is cheaper today than the 5-year mean, but it has never been at around 30x or so on average. Far from it, actually. So that's one thing. It's cheap, but it has never really been that expensive compared to, for example, an Apple. Apple barely grows or barely grew that much in the last 2-3 years or so. Yet its forward PE has been around 30 for quite a long time. Amazing business, super profitable, lots of cash. But yeah, there's definitely a difference here, or the market definitely thinks that there is a difference between the premium that you're getting from buying an Apple, and the one that you're getting from an Alphabet. Now, I would like to say that maybe because it's more predictable, Apple is a more predictable business, you could say, from a free cash flow perspective, then that's why you're getting a higher premium on that name. And then Alphabet right now, with everything that's going on with chatbot, ChatGPTs, Grok, Perplexity, even their own Google Gemini, maybe that might hurt their cash cow, which is search advertising. That's where they make the majority of their money right now. Could that be under threat? And that's why the market feels like, okay, we don't want to pay that much for that business. Could be, but in my eyes, even if that's the case, I still don't think that 18.3 times should be the number that I'm seeing when I'm looking at a business like Alphabet, because despite all of the new players in the last couple of years since ChatGPT came out, they're still dominating search. Their business is still growing, still becoming more and more profitable. Yes, free cash flow wise, that has fluctuated a little bit as they increase capex. Now, more recently, we've seen them acquire a cybersecurity business called Wiz for $32 billion. That's $9 billion more than 7 months ago, by the way. So not bad. If you wait 9 months, you get $9 extra billion for your business. But it is an amazing business. You now also, of course, have Google Cloud, which is the third largest cloud provider, and that's growing quite quickly, becoming more and more profitable as well. So even if let's say they take a small hit from their search business, they have YouTube, which is the second most popular search engine on the planet. So they have that super popular platform that is also growing. They've got the cloud platform also growing quite quickly, becoming more profitable. Then if you want to really think longer term, you also have Waymo, which I would say is a bet. Is a bet that Waymo becomes a huge autonomous company, autonomous player, and that could generate them tens of billions of dollars in the future, maybe even more. Although I think, and maybe that's another prediction for the bold prediction show, I think by 2032, 33 or so, I think they're going to spin off Waymo into an independent company. That's just my prediction. So you're getting all of that right now for the business that is still doing very, very well from a growth perspective, from a cash generating perspective. Yes, there are some uncertainties, but the data at the moment does not tell me anything that would change my mind that this is not worth more than a 18.3 times forward PE, or even 1.1 if you look at price earnings to growth ratio. So yeah, I want to talk about that because yes, it does look cheap, but it has never really been expensive, and that's fine. It's just two big companies I just talked about, two $2 trillion companies, Amazon and Google. Could have talked about smaller companies as well, but even the big ones sometimes are worth it, are worth looking at despite their size, because bigger can become bigger, and they are becoming much bigger, more profitable, and sometimes they even grow faster than smaller players.
Yeah, those are both businesses that I own right now. We have a bunch of questions in the queue. There was one that came in about an hour ago that I wanted to answer. As a fallout of GLP-1, which subsectors could benefit? Medical aesthetics comes to mind. Well, that is a good guess, SB. There's some others. What about CGM? Anything else? So there's a few ways in which you could see this trickle down to other industries as well. Obviously, we've seen the rise of GLP-1 drugs over the last few years. You've got Novo Nordisk's Ozempic and Wegovy. You've got Eli Lilly's Zepbound and Mounjaro. And this is obviously impacting companies across a range of industries, both in and outside of healthcare. Now, of course, within the healthcare space, pharmaceutical companies like these ones that I've just mentioned, and which are currently primary players in this space, are obviously benefiting the most, at least in the short term. Now, the initial shortage of GLP-1 drugs also led to a surge in demand for compounded versions, which nearly doubled the market share of compounding pharmacies. We've talked a lot on the show about how Hims & Hers Health, which had more recently acquired their own compounding pharmacy operations, responded to this demand. Now, in the U.S., compounding pharmacies can only make compounded versions of a drug so long as that drug is in shortage. So while no longer Novo Nordisk's Ozempic and Wegovy is in shortage, if that were to reverse again, these are companies that could be very well primed to respond. And of course, there are a lot of other drugs which can benefit from compounding. But looking outside of pharmaceutical companies, telehealth businesses, right? You think about how users want to speak with a healthcare professional, maybe like a Hims & Hers Health, to have recommendations, prescriptions, maybe to access different forms of care. You could see how telehealth businesses can indirectly benefit from the growth of patients taking these types of medications. Companies that administer health plans, employer plans, insurance companies. This is another area where there could be a benefit. More health plans are covering GLP-1 medications for both diabetes and obesity. So this is leading to increased demand and utilization. I think it's interesting, the question about CGMs, or continuous glucose monitoring devices, because we've definitely seen this sort of trend afflicting some CGM stocks like Dexcom, which is one I own and talk about a lot, that as weight loss and some of these other goals are achieved through GLP-1s, is there still a need for medical devices like CGMs? And there absolutely is. I mean, GLP-1 receptor antagonists, or GLP-1s, these are obviously medications that help lower blood sugar and they aid in weight loss, but continuous glucose monitoring devices provide real-time glucose data. They offer insights into glucose trends and food triggers, and that can help personalize diabetes management. So depending on the reason why a patient is taking this particular drug, there is very much a use case for both a CGM and a GLP-1. These go hand in hand. They are not mutually exclusive. One does not replace the need for the other. So I do think this is an area that over the long run has a robust growth trajectory. Now, specifically as it regards the medical aesthetic space, I think this is an interesting question, and I do think this is a subsector that could benefit as well. We know that GLP-1 drugs have been, revolutionizing the weight loss and diabetes landscape. But there's also the reality that sometimes patients who take these drugs and they achieve rapid weight loss, they can be dealing with other effects like skin laxity and facial volume loss, and that can drive demand for aesthetic treatments. But it could also potentially reduce the demand for certain fat reduction procedures. So it's interesting to think about how companies like that could benefit. You think of businesses like AbbVie, which owns Botox Cosmetic and Botox Therapeutic. You are already seeing increased demand for aesthetic treatments from patients that are on these drugs, especially because GLP-1 drugs can cause a loss of subcutaneous fat in areas like the midface and temples. And so there's been a real demand for dermal fillers and other biostimulatory agents. So I do think you can see kind of trickle-down effects on the medical device industry, obviously the pharmaceutical industry, the CGM space. If anything, I think there has been mixed sentiment there as investors worry about the long-term demand for these types of devices in the context of GLP-1 disrupting the diabetes care space. But again, one doesn't replace the need for the other. And then there's opportunities for really diverse aesthetic practices, I think, as the uptick in GLP-1 continues. So I think these are all spaces that could be poised to benefit over the long run, indirectly from the growth of the space. There's a lot of companies as well that are obviously developing what could be very revolutionary GLP-1 products. I think a lot of people are following Viking Therapeutics' ongoing trials for their new GLP-1 therapy. There's many others. It's an exciting space to look at. For me, I don't find myself interested in a particular company just because of its exposure to GLP-1, but I do think that this is an interesting and very investable space right now. And there's a lot of ways to invest in it, no matter really what type or style of investment approach that you take to your portfolio.
Yeah, no, I agree. This is a space that I do follow a little bit. So Novo Nordisk, Hims and Hers, although Hims and Hers, I always say that the focus should not be on whether or not GLP-1 becomes a huge part of the business, but whether or not you believe the Hims platform makes sense. And if that platform can continue to grow in the future, of course, GLP-1, their solution is the compounded one. Whether or not that can continue in the future remains to be seen. And a Vikings, that's on my speculative names list, because at first, if you look at Vikings, it was more of okay, we buy that name because we think someone will acquire it for a premium, and then we'll just sell the pump, basically. But right now, especially with the recent announcement, I think the previous two hosts talked a little bit about that. It does seem like Vikings thinks that they can succeed by going their own way, alone, without being acquired, partnering up with other manufacturers. So it's going to be interesting to see. It's definitely a space that is growing quite quickly, with Novo Nordisk and Eli Lilly being huge players in that segment. But yeah, interesting industry. I have zero exposure to it at the moment, but it's definitely something that I'm looking at. I do want to ask you, this is a semi question from Besties here. If you're looking at a particular stock at the moment, a particular company at the moment, and why you're looking at that.
Oh goodness. I mean, there's so many companies. Some of them I've talked about today. One I'm probably looking at a little more closely is Duolingo. And we actually had a question, I think, that came in regarding the valuation of that business. Roberto was asking earlier about Honeywell, which I don't know that business very well, but also about Duolingo. That's a business that I find really fascinating right now, because so much of the growth that they have experienced, something they've noted is that they attract a lot of users to their platform organically. So even though they pay for advertising, organic growth has been, well over 80% of the growth input they've seen to their business. And they've done just this really exceptional job of monetizing the users they have, even though paying versus free users is still, a relatively small part of the platform, which I actually think just gives them tremendous opportunity over the long run. Now, from a valuation perspective, the stock has a pretty robust one. I think trailing PE is something like 161, if I'm remembering right. Now I want to look this up to make sure I'm not getting this wrong. Yeah, okay, about 161, 163 on a different chart that I saw. Price to sales is about 19. Price to book is about 17. But this is also a company that has seen a tremendous run up in terms of profitability. The last couple of years, they've been growing their profits at an exceptional rate. Revenue is growing in the mid double digits. They're free cash flow positive and continuing to accelerate on that metric. And they provide a really valuable proposition to the end consumer on their platform. And with providing so much flexibility of ways to learn a language, and having that core, advertising revenue that drives their business, as well as the growth of their, premium paid subscription channel, which I think is a real key area of focus for the business in 2025. That's something that can also really drive their growth over the long term. And this is one of the few examples I've seen in this space of a really, really profitable tech company that's also growing at a really fast, above average rate. Often we will see companies that are, tech-based, sacrificing profits in order to achieve growth. And that is very much not the case with this business. So its valuation is steep. That's something I've been pondering, but this is one I have been increasingly interested in recently.
Yeah, no, I agree. I think we talked about Duolingo yesterday, because we also talked about about Chegg and the other company. It's an interesting name for sure. One that I'm looking at right now, in no particular order. I think I've been talking a little bit too much about Alphabet for the last couple of weeks because, it's just a very, very good company. And Alphabet and AMD, I think those are the companies that I've been looking at more closely. Nebius as well. Nebius is that company that NVDA and some other companies did invest in it late 2024. They basically build out AI infrastructure, and we can it's slightly similar to a hyperscaler, but at a smaller scale, and that's how they compete. Plus, they have some other businesses inside their own business. For example, AV Ride, autonomous vehicles, autonomous robots. These little robots that you can see right now on the Ohio State University campus. Basically, they can deliver you food, so small robots. They then have Toloka and 1010. One is basically data tagging, when now it's more automated one. And the other one is more on the education side, reskilling workers so they get used to this AI revolution. They're not really stuck in the past, which I think the CEO said last week that according to Fortune magazine, they were the best IT bootcamp of the year. So that's quite good. So that's one of the names that I'm looking at right now.
Okay, let me look through here and see if there's any other questions I can answer. Bart was saying, what is your favorite medical device stock? There's a few. This was a question that came in a couple hours ago. One I talk about it a lot is one I own, which is a company called Dexcom. They're a leader in the diabetes care space as a maker of continuous glucose monitoring devices. They have faced a lot of competition in this space in recent years, but they really continue to lead the market despite that. They also recently garnered approval for a new device called the Stelo, which was the first ever continuous glucose monitoring device that is available over the counter that was approved by the FDA. So that was a major win for the business. They're also constantly upgrading, their flagship CGM. The current generation of that is called the G7. And I believe they're seeking approval for a new version of that CGM, which would have a 10-day wear time, I believe, a 14-day wear time compared to the current one, which is just around 10 days. It's a really interesting business. It's one that the market has not been particularly kind to recently, but this has been also a very historically profitable business. They dealt with some kind of short-term issues last year. They had some restructuring of their sales team, and that impacted some of their sales growth. They also were dealing with higher than expected rebates for their flagship G7 devices, and that again had an impact on sales and margins. But those are, broadly speaking, shorter term factors. And I think this is still a business that's really, set to win over the long term. But there's a whole host of interesting businesses that feature, medical device segments, or maybe not entirely focused on them. I mean, another one that I love is Intuitive Surgical, right? They're the, leading surgical assisted robot maker in the world. They're also have benefited for over 20 years from being sort of first to market in this space. Their Da Vinci flagship platforms are used in a wide range of minimally invasive surgeries by healthcare providers around the world. And one of the things I love about that business as well is the fact that it is really revolves around a recurring revenue model. So even though they sell these, very costly platforms that can cost up to $2.5 million for a single Da Vinci surgical robotic system, they make even more of their revenue and profits from the replacement tools, instruments, and accessories that go with those systems. Well over 80% of their revenue is recurring revenue, and it's also been a really profitable business. So those are a couple: Intuitive Surgical, Dexcom. I also like Abbott Laboratories, although I've chosen to invest in AbbVie, which was their spinoff. Johnson & Johnson also has a medical device segment that they've really been bolstering the last few years with the acquisition of Abiomed, which makes the Impella pump, which is the world's smallest heart pump. And they also, I think, just closed the acquisition of Shockwave Medical. So those are a few.
I mean, the only one I know much better than the rest is definitely Intuitive Surgical. I mean, that company is just an amazing company, and that Da Vinci machine is wow. Like the first time I saw it, I was like, oh, what kind of horror movie machine is this? But it's an amazing machine, and right now I'm looking at the installed base. We're closing in at the 10,000 mark. And like you said, the bigger the install base, the better it will be for the business, because those are recurring revenue. So the bigger the install base, the better. It's a bit similar to ASML, not the same field, but ASML in the semiconductor industry. The bigger their install base, the larger that recurring revenue comes from basically management of those equipment. So yeah, wonderful business. It's also one that has always, since we're still talking about valuation, it's also one that has always traded at a premium, because again, best in class. You will have to pay a premium, although more recently the stock did take a small hit, but not by much. But yeah, great businesses will, in my opinion, always trade at a premium, because it's worth paying a little bit more.
Absolutely. I think we have about close up to time. I know we're waiting for Danny to get ushered into the room here.
Mm-hmm.
I don't know if there's one more question we have time to hit before he gets in here. Looking through. I don't know if you have any closing thoughts as it regards valuation, Neil, as we come to the end of this hour. I think we've talked about a lot of different interesting companies that represent very different valuation metrics.
Yeah, no, maybe a quick question for you. Like, what was the most expensive stock you bought? If you remember.
Gosh. I'm doing this off the top of my head, but I think it might have been Shopify when I bought it several years ago. Before it had before the stock had a significant come down, and then has been having a lovely steady upward trajectory. So ironically, it's now has been one of the highest portfolio performers since that time. I mean, that's been already a multi-bagger for me. But I think at the time I bought it, and I remember thinking at the time, is this a business that still has room to run? But I really believe in it over the long term. And it was pretty expensive at the time from a valuation basis, but no regrets.
Okay, no, very good name. Very good name. All right, I think if Danny is ready to come on, he could appear, and here he is.
Hello.
Here I am.
All right, I will
Thanks,
leave you
Neil.
to it. Yeah, see you. Have fun.
Well, fools, I am here to break it up a little bit, but you still get all Rachel all the time. Welcome to the next hour of Fool24. We are here to take your questions. We're here to talk about one of our favorite topics, which is earnings. And there are a few companies that are going to be reporting today, a few that have already reported. The one that I am keeping a close eye on is Micron, ticker MU. They are supposed to be dropping their earnings, just any time here in the next little bit. So I'm going to be keeping an eye on their website and on the SEC website to see what we can find out. And we're going to be bringing it to you live here. Or I don't know, right? Are you feeling live there, Rachel?
I am alive. Yes. Well, no. For anyone
good.
that's been watching, I have had a horrible flu for the last few days, so I still have the cough, which is why occasionally I'm coughing with my camera muted, because no one wants to hear me choke. I mean, that's not it.
Well, and as just so you don't feel alone, I have a chronic winter cough. So anybody who tunes in here regularly will see me mute myself more often than not, so I can keep my cough to myself. Mostly because that you would think that in San Diego the air would be moister than what it is, but in the wintertime, man, it is just dry as a bone out here. So yeah, dry cough. However, we're going to muddle through, and we're going to bring you some of the best entertainment that foolish money can buy.
Yeah, we're gonna have dueling mute buttons.
There you go.
I know you're waiting for Micron to come in. I can quickly talk about Accenture. They reported this morning.
Oh, good.
I don't know how many fools follow this business, but it's one I want to talk about a little bit. For anyone who's not familiar, Accenture, they are a global professional services company that it helps organizations improve their performance and create value by offering services in strategy, consulting, digital technology, and other operations. So they specialize in helping businesses with their digital transformation, cloud adoption, cybersecurity, data, and artificial intelligence, as well as other emerging technologies. So they offer this wide range of services, including consulting, providing expert guidance and advice to help companies improve their operations and processes. Accenture has a global presence that spans over 120 countries. They have a very large workforce of more than 774,000 individuals globally. So they make money in a few different ways. Again, professional services is a huge part of their revenue model. So consulting services, tech services in areas like cloud systems integration, application management, AI and automation. They also offer outsourcing services, helping clients manage their operations and IT infrastructure. They've been seeing a lot of potential for their business over the long run as they provide consulting and strategy services to businesses seeking digital transformations for their businesses as it pertains to cloud computing and artificial intelligence, to give a couple examples. Their revenue comes from a variety of regions, but North America and Europe are two of their biggest markets. I was curious to see how the stock actually responded. It looks like shares are down about 7% today. Just to give some context, this is a massive business. They have a market cap of about $203 billion, currently trading at a price to earnings ratio of about 25. Shares are down about 20% over the last year. And then, as I mentioned, shares dropped about 7% today after they reported their earnings. Now, I'm going to dive into their earnings a bit, but it is worth noting that management said that tighter federal spending efforts are starting to weigh on their financial results. There is a quote from the CEO of Accenture, Julie Sweet. She said, as you know, the new administration has a clear goal to run the federal government more efficiently. And during this process, many new procurement actions have slowed, which is negatively impacting our sales and revenue. So they were saying that their federal services business has lost quite a few contracts with the US government after recent efficiency reviews. They noted that the federal government has represented about 8% of their global revenue in the past and 16% of their Americas revenue. And this was in full year 2024. So that is a fairly notable impact for their business. And that is something where you are seeing already an impact on revenue. And I would expect that to continue to be the case over the long run. The CEO had noted that Accenture's federal services business was also affected by guidance from the U.S. General Services Administration to all federal agencies to review their contracts with the top 10 highest paid consulting firms contracting with the U.S. government and to end contracts that are not considered mission critical. So again, 8% of their global revenue, 16% of their Americas revenue in full year 2024 was traced back to the federal government. So that's something to be aware of with this business and how they operate. And that's something to be aware of as I go into these numbers here. Now, this was their results for their fiscal 2025 second quarter. So this is not a full year of earnings. And so I think that we will also have an even clearer picture of the impact of some of these factors I've mentioned as we progress throughout the year. Now, it's worth noting that management said our Q2 results demonstrate that we continue to deliver on our strategy to lead reinvention for our clients and return to strong growth in full year 2025. They also said that the trust and confidence in our unique strengths and capabilities is reflected in 32 clients with quarterly bookings greater than 100 million for their business. They said we are also very pleased to have another milestone quarter in generative AI with 1.4 billion in new bookings. And then they also said in Q2, they had total new bookings of 20.9 billion. That was a 3% year-over-year decrease. Generative AI new bookings, however, was 1.4 billion, and that was a milestone quarter for that particular segment. Now, total revenue was 16.7 billion. That was a 5% year-over-year increase, despite the fact, again, that new bookings decreased slightly, and some of that, again, due to the changes you're seeing in terms of federal funding and contracts. Revenue, if you factor out currency fluctuations, was actually up 8.5% year-over-year. The company also reported an operating margin of 13.5%. That was an increase of 50 basis points. And then they reported diluted earnings per share of $2.82. That was a 7% year-over-year increase. Finally, free cash flow was about 2.68 billion for the 3-month period. This is also a long-standing dividend payer. They declared a quarterly cash dividend of $1.48 a share. That was a 15% increase. Now, they did narrow their full-year revenue growth guidance, which again is being reflected in the response you're seeing to the stock today. They are projecting 5 to 7% year-over-year growth in local currency. So again, expect that figure to come in slower in US dollars. They are expecting a foreign exchange impact rate of about 0.5%, negative 0.5%. And they are updating their operating margin expectations to 15.6% to 15.7% for the year, which is an expansion of 10 to 20 basis points over their adjusted operating margin. So highlights for this: new bookings were down slightly year over year. Revenue grew by single digits. Free cash flow position was solid. They did see growth in earnings per share as well as their operating margin. Their generative AI business continues to be a really robust area of growth, but they are already and will continue to likely see an impact from the decrease in federal contracts that they noted. Again, that was in their last fiscal year, about 7% of global revenues and about 16% of their North America business came from federal contracts, many of which have been slashed in the last couple months. So That plus their adjusted guidance, some of which was lower compared to what they had previously entered, are broadly what we're seeing in terms of the response to the stock. I still think this is an interesting business. This is not one, that I currently own. There's a lot of companies we talk about in these earnings hours that may not all be in our respective portfolios, but it's a leading strategy and consulting business. Again, they have been very reliant in the past on federal contracts. So at least in the short term, that is a headwind to be aware of. But given all of those factors, it was still a pretty solid quarter for the business. But I think the sentiment related to some of these other elements I mentioned is what we're seeing in the stock today.
And it looks like Micron has reported. It's going to take me just a minute to get my slides up here. Just because the system, it takes a little bit of time to get them added. So in the meantime, we'll talk a little bit about what it is that Micron does. And so Micron is a company that you may have heard of. They have been doing particularly well in the area of high bandwidth memory, which is kind of a recent area for them, but they're doing really well. This is also a company that, give me 1 second here. I'm going to pull these slides in so that they can be loading while I'm chatting here. Now, the other thing that investors may know Micron for is they are well known for their memory and storage products that are used in data centers. They are partners with NVDA. So if you are using one of NVIDIA's high-end AI chips, it probably has Micron technology embedded inside, whether it be for random access memory or high bandwidth memory, HBM. And so this is a company that has really benefited from the accelerating trend of artificial intelligence. So let's see if we can get the slides pulled up here. So this is Micron's fiscal second quarter for 2025. The revenue grew to 8.05 billion. That's an increase of 38% year over year. Now notice that was comfortably above analyst consensus estimates of 7.9 billion. They had GAAP net income that was up 100%, which is fairly impressive. I mean, they were growing well, but triple digits is next level. And they had adjusted earnings per share of, of $1.56, which was up 271%. You'll note that analyst consensus estimates was for $1.42. So the first thing that I'm noticing is that the market seems to like the fact that they were comfortably past analyst consensus estimates. The stock is up just under 6% in after hours trading. So let's dig in just a little bit more here. They had gross margins of just under 37%, 36.8%. That was up from 18.5% year over year. Now, a lot of this has to do with the fact that their growth has been skyrocketing over the past year or so since AI has really been taking hold. And Micron's processors and storage have been in great demand, particularly among the most advanced graphics processing units used in data centers. So there's been a lot of demand there. Their operating cash flow followed their revenue and their earnings per share higher. Operating cash flow grew to almost $4 billion, up about 220%. and their high bandwidth memory, which is what has been used in NVIDIA's AI chips. And interestingly, since they introduced this product, I believe it was a little more than a year ago, they have been selling out as soon as they get a product run done. So, last year they were in the first quarter of producing this, and they said they were already sold out for that year, and they were sold out or almost sold out for the following fiscal year. So this is a product that is doing remarkably well, and they are carving themselves out a position in an industry that typically they had not been involved in, this high bandwidth memory. Finally, Wall Street liked the forecast. They are forecasting third quarter revenue of about 8.8 billion at the midpoint of their guidance. Consensus was calling for 8.48 billion. So again, comfortably above Wall Street expectations. Their gross margin, they are forecasting about 35.5%, and they're forecasting adjusted earnings per share of about $1.57. Wall Street was expecting about $1.52. One of the things that I saw in the earnings release that they wanted to headline was the fact that this was the first quarter ever that they surpassed more than $1 billion in their HBM, or high bandwidth memory, revenue. So that might not sound like that much, but when they had just over $8 billion in revenue, and $1 billion of it is from a product that they hadn't even introduced a couple of years ago, that is pretty impressive growth. And the fact that they were able to pivot and create this, and not only did they get the product to market, but also this product, there are other producers of high bandwidth memory out there, and they were able to benefit from this, even though there were a lot of entrenched players out there already. A couple of the ones, let's see, I'm trying to see who else their high bandwidth memory competitors were. It's HBM3E is what they recently introduced. I'll get back to you on that in a minute, but suffice it to say that this is an area that it has a great deal of growth for them, and is expanding from their existing market. So a very impressive showing from Micron.
Yeah, that was a pretty impressive report. I want to talk about Nike. I know that's another one, as Sadaf was saying, if possible, please cover Lennar and Nike. So I want to talk a bit about Nike's results as I was pulling them up while you were talking about Micron. Just shares of Nike down about 2% today, largely in anticipation of the company's earnings, although it's worth reporting that Nike is actually trading up about 3% in after-hours trading. Nike, this was their results for their third quarter of their fiscal 2025, right? So again, not a full year of growth. And there's a couple of things I want to note, before I get into the actual numbers, right? We know that Nike is a business that has been facing a lot of challenges recently. They have been dealing with revenue declines. That's obviously heavily impacted investor sentiment about the stock, which has come down significantly in the last year. North America, which is Nike's biggest market, has experienced a really sharp decline in sales, with notable drops in footwear sales. Some of that could be due to changes in discretionary spending that we're seeing. But some of it has also come down to slowing growth in some of Nike's legacy brands. They've also been dealing with a reality where they've had excess inventories that they have been working to slowly shave down. That has also really impacted growth and margins. And they also had previously brought down their outlook for fiscal 2025, forecasting a mid-single digit decline in sales, which again has brought shares down. there's been a few issues that have contributed, I think, to some of the declines the business has been seeing. There's obviously been reduced demand globally for some of their core products, even their popular lines like Air Force One, Air Jordan, and Dunk. That has contributed to some of the declines the business has been facing. And then there's also things that came down to real operational mishaps. They were cutting some ties with some of their long-term wholesale partners and instead relying on sales of popular styles rather than innovating their core product. And that has caused the company to lose market share. And then obviously this is also a business that's very much impacted by global economic conditions. And as consumers have slowed down overall spend, that's something that has, ultimately trickled down to the business. Now, the new CEO, Elliott Hill, has been working on a variety of initiatives to turn the business around. They plan to invest in new marketing and product innovation and focus on rebuilding partnerships with wholesalers. And those are just a few of the things that Elliott Hill has outlined. There's also been this strategy that the company has announced they call Return to Sport, which is emphasizing going back to their core sporting roots, focusing on categories like running, basketball, training, football, and sportswear. The company plans to invest in, as they've said, bold creative marketing that really leverages athletes and sports moments. And they also want to elevate their direct-to-consumer experience, making it more of a premium destination in the sports industry. They've also been implementing a roughly $2 billion cost savings plan to drive growth and profitability over the long term. And that's something that I think is worth noting as we head, into these numbers. Now, looking at the top numbers here for, again, this is Q3 of their fiscal 2025. Third quarter revenues were $11.3 billion. That was down 9% on a reported basis compared to the prior year. That was also down 7% on a currency neutral basis. So Q3 revenue, $11.3 billion, down 9% year over year on a currency neutral basis, down 7% year over year. Direct revenues were $4.7 billion. That was down 12% on a reported basis and down 10% on a currency neutral basis. Now, wholesale revenues for Nike were $6.2 billion. That was down 7% on a reported basis. Their gross margin decreased 330 basis points to 41.5%. They also reported diluted earnings per share of 54 cents. Now, I think that the market is responding the way it is to Nike's results after hours, because as somewhat abysmal as they were, I think that they are better than what the market had been projecting. Now, CEO Elliott Hill said the progress we made against the Win Now strategic priorities we committed to 90 days ago reinforces my confidence that we are on the right path. They also said our outlook for the second half of fiscal 2025 is driven by these actions. They said the operating environment is dynamic. What matters most for Nike is serving athletes with new product innovation and reigniting brand momentum through sport. So again, this is obviously a business that is consumer-centric, but they have been really shifting their brand focus back to focusing on athlete shoppers and athlete consumers, and having that also be the essential, image for the brand, while also as they're working to reestablish these relationships with wholesalers, cut back on costs. This is obviously a business that has a long way to go to get back to where they were a number of years ago. I mean, overall revenues were down single digit percentage. Direct revenues were down double digits. Revenues for Converse were down 18% on a reported basis. They did report net income of $0.8 billion or $800 million. That was down 32% year over year. They finished out the quarter with about $7.5 billion in inventories. And again, they've been working to slash their inventories. That inventory total of $7.5 billion was down about 2% year over year. Part of that was a mix in their product shift, but also that was partially offset by an increase in overall units. So they're still dealing with inventory issues. They finished out the quarter with cash and investments of about $10.4 billion on their balance sheet. That was down from a year ago, but still fairly solid. Now, they did return about $1.1 billion to shareholders in their Q3. It's worth noting that they are in their 23rd consecutive year of increasing their dividend payout. They reported dividends of about 594 million that they paid in this most recent quarter alone. That was a 6% year-over-year increase. They also enacted 499 million of share repurchases. And that reflected 6.5 million shares that were retired as part of their 4-year, $18 billion program that was approved back in 2022. So a mixed quarter of results for them. Still profitable, but profitability is waning. They're still dealing with tremendous inventories. I've said before, I still think this is a business over the long run that can affect a strategic turnaround, which is what they're in the midst of doing. But I think that there is a long road ahead for this business. I think anyone who owns the stock is going to have to be very, very patient. I think that Elliott Hill is headed in the right direction. I think that there is a lot of promise for this business under his leadership. But I think it's reasonable to expect, given the headwinds that the company has been facing that have been reflected in its recent financial results, and the reality that consumer spending continues to be a very fluctuating dynamic in the current macro environment, I think this is a business that is probably going to be having some rough financial reports ahead.
So we had a question from KJ Mutha about 36 minutes ago. Any thoughts on Cognix? That's ticker CGNX. For investors who may not be familiar with the company, Cognix is a company that provides industrial machine vision technologies. So what that means in reality is if you own an e-commerce business and you need to track packages as they fly down the conveyor belt, and when they are loaded onto a delivery truck, as an example, Cognix has the cameras with the high-speed capability that can capture the barcodes on those boxes as they fly by. That's one example. But they're also used, they provide machine visions systems, software, sensors. They have a strong presence in the semiconductor and electronics industries, particularly in cell phones, as another example. Cell phone manufacturing. So this is a company that, I own Cognix, so I understand where the question comes from. When AI started kicking off a couple of years ago, Cognix was one of the companies that has long used AI in their software and to guide their machine vision cameras. And they got kind of caught up in that excitement, I guess, about what was going on in AI, and there was an expectation, perhaps, that the stock would do really well, and it turns out that the applications for this are still primarily in the same areas where they have always been. And so there wasn't as much uptake of their technology as some investors had hoped. Now, the stock's price to earnings ratio skyrocketed late last year, and they were selling for somewhere in the neighborhood of 150, a multiple of 150 times earnings, which was pretty pricey. Now, that has since come down, and they are currently selling for about 30 times earnings, which is much more reasonable, although still a little bit pricey for a company that is growing moderately well. Now, I went back and looked at their fourth quarter results, which came out in early February. Their revenue grew about 17% year over year. Operating income was impressive. It was up 142%. They had strong results. They had in the logistics and the semiconductor markets, but they also serve automotive as an example. And we all know that, automotive has seen a slowdown because of inflation. So they took a little bit of a hit there. So this is a company that it seems like it's feast or famine with them. Automotive is weak. Factory automation did well. They talked about how the powerful AI models were kind of enhancing their advanced camera and software technology. But again, if you look at their earnings growth, I think investors were thinking more along the lines of Broadcom level growth or NVIDIA level growth. And this is not, that type of business. There's a lot of demand for these cameras. It's solid demand. It's recurring demand. They need them in all the areas that I have talked about. And they are widely regarded as, the cutting edge. They are the leading supplier of industrial machine vision and barcoding technology. They've shipped over 4.5 million image-based products since the company was founded in 1981. So this is a company that it has not served me very well as an investor. I've held it for more than a decade, and the stock has done, okay during that 10-year period. Let's see, I want to go back and take a look here. So it looks like over 10 years, the stock is up 274%. So over the long term, it has done really well. But as you look closer, they're up 189% over 5 years. Also impressive. You get down to 3 years, and it's only up about 32%. You look at the past year, and the stock is only up about 12%. So moving, kind of sideways. I think this company will continue to be the leader in its field. And if you're looking for a company that is more reasonably priced than it has been in the past, Cognex certainly meets that requirement. They're not dirt cheap, but they're not very expensive either. But that said, this is a company that suffers from a lot of cyclicality. So if this is one that you own or want to own, I think be prepared for the fact that there will be boom and bust cycles for them. Rachel?
Thanks for that, Danny. One other thing I wanted to add when I was talking about Nike's earnings, their So Win strategy that they referenced in their game day ad, but also as part of their broader Win Now strategy that they talked about a lot in their earnings report for anyone that follows that. This is all about a huge part of their plan for their turnaround story, which is returning to their roots, centering the brand around sports by creating authentic connections with consumers through compelling storytelling and sports moments. It's really emphasizing athlete collaborations, shifting from sponsorships to co-created product lines, which is obviously something that Nike has done for many, many years, which goes way back to its roots, as well as long-term storytelling. So they're really trying to reconnect with athletes and sports enthusiasts by doubling down on some of their iconic products, as well as introducing fresh designs for the business. So they're working on investing in their legacy sports partnerships. So long-term deals with the NBA, WNBA, and NFL, to give a few examples. We'll see how that works over the long run. But that's what I wanted to add regarding that. One other company I wanted to hit as we're talking about earnings, and maybe I'll hit on it again a little bit in the next hour when I'm on with Will talking about consumer goods, is Darden Restaurants. So they also just reported today. This is a Fortune 500 company. You might not be familiar with the name Darden Restaurants, but you're probably familiar with some of the companies that it owns. These include the likes of Olive Garden, Longhorn Steakhouse, and Ruth Chris Steakhouse. And Darden operates these names through both company-owned and franchise locations. Some of its other brands include Seasons 52, Yard House, Capital Grill is another one. And they offer franchise
Yard House is one of DL's favorites.
There you go. It's really good. They offer franchise opportunities in international markets as well as at non-traditional sites like airports, campuses, and military bases. Their primary revenue comes from food and beverage sales, both company-owned and franchised. It was a fairly solid quarter, but mixed results compared to what Wall Street was expecting. So in terms of earnings, they beat what Wall Street was expecting, but revenue fell short of estimates. And this was partly because Olive Garden and Longhorn Steakhouse, which, while being two of many brands that it owns, are the two restaurant chains that represent the largest groups of restaurants in its portfolio. Both Olive Garden and Longhorn Steakhouse reported weaker than expected same-store sales growth. Despite that, I think Darden shares were up single digits today. I'm actually curious to see after hours. So it's not showing me what the stock's doing after hours, but shares were up about 7% today during trading. So that's interesting. I always like to check that. I always think it's kind of interesting to see how a stock responds. There were a few elements that management mentioned when they were talking about the company's numbers for this particular financial reporting period, which I'll get into in a minute. But they were saying that winter weather and snowstorms were a major factor in the disappointing elements of the quarter that they just reported. And they actually said that when you exclude weather-related factors, same-store sales across all four of Darden's segments grew during the quarter, and only consumers making less than $50,000 a year were spending less at its casual dining restaurants. So the CEO, Rick Cardenas, said, even if consumers say they're feeling less optimistic, we haven't seen a huge correlation between that and dining out. And he said this on the conference call today. He also said, I think as long as incomes are going up and outpacing inflation, I think they're likely going to keep spending. So again, Olive Garden and Longhorn are usually the two standouts of Darden's portfolio, and they reported pretty underwhelming same-store sales growth. But as management noted, if you strip out those weather-related factors, they saw positive growth across all four of their segments. I would need to see probably a few additional quarters after this recent winter one to fully buy that. But I do think that that's a fair thing to say. I mean, so much of the U.S. Over the last couple months, and I also experienced this anecdotally when I was visiting my family in the Midwest, had record-breaking winter storms. And in a lot of the regions and parts of the U.S. where Darden's restaurants are located. So that is very possibly a reasonable explanation. In terms of looking at the actual numbers, again, this was for their Q3 of fiscal 2025. Total sales increased 6.2% to $3.2 billion. They also noted that Olive Garden, again, this is where you're seeing kind of tepid growth. Sales in their Olive Garden segment rose just 0.6% year over year. Consolidated sales rose just 0.7% year over year. Longhorn Steakhouse sales rose 2.6% year over year. And then they saw very slight declines in their fine dining segment and their other business segment, which they report. But again, management said if you strip out the weather-related elements, all four of these would have reported positive growth. So take that what you will. They reported diluted net earnings per share from continuing operations of $2.74. The company also repurchased about $53 million of its outstanding common stock in the quarter. CEO said, we had a solid quarter. I'm proud of how our teams managed their business and controlled what they could control. They said all of our segments grew total sales and segment profit margin. Several brands set sales records during the holidays and on Valentine's Day. Looking again at profitability versus sales. So in Q3 of their fiscal 2025, $1.3 billion in net sales for the Olive Garden segment, and about $307 million in profits for that segment. $768 million in net sales for the Longhorn Steakhouse segment, and about $149 in profits for that segment, $149 million. So this is a business where single-digit sales growth is fairly common. I do think that it is reasonable that because so much of this quarter fell during a period where inclement winter weather occurred across various regions of the U.S. where its restaurant locations are highly concentrated. I do think it's reasonable that that could have impacted their growth. Management is saying they're not seeing slowdown from the consumer, but I'll be very curious to see what their Q4 and full year sales reflect, which we should see out in a few months.
So we had some other questions here. One was from Matt about 5 hours ago, and it's about a company that I cover. And though it wasn't directed at me, it's one that I feel qualified to answer. And is Coupang beginning to look like it was an overpriced IPO? And what's interesting to me about that is, that's something that I remember discussing with a colleague when, Coupang first went public. The company came out, I think it was in 2019. Let's see, Coupang IPO. 2021, early 2021. Now, for those who don't know, Coupang is Asia's largest e-commerce company. It began trading on the New York Stock Exchange in March of 2021. So Coupang was originally supposed to debut at about $30 a share. Then it went from $30 to $32 a share. Then they decided its target range was going to be between $32 and $34 a share. And by the day that it actually debuted, the company had decided on $35 a share. Even with all of that increase, the stock began trading at $63.50 each, and ended up gaining about 40% on the day. It closed at about $49. When I look at the stock chart, the thing that I see is that Coupang stock peaked almost on the day that it debuted, it seems like. And then since then, the stock and timing couldn't have been worse. If you recall, in late 2021 was when all of the tech stocks began to fall in unison by, I'd say, mid-November. So you have a stock that was very highly hyped. There was a lot of great expectations for the company. There was a lot for it to live up to. It didn't even really have a chance to live up to those expectations, and the stock began to fall. We had the economic downturn, and over the course of less than a year, the stock had lost probably 80% of its value, which is that's really a difficult for shareholders who got in soon after the IPO. That would have been a tough to take. Now, I will say that I think the company is doing okay. In fact, anybody who's bought anywhere since, I don't know, probably mid 2022, let's say, is probably has a profitable investment on their hands. I'm going to just pull a chart here real quick. So since June of 2022, the stock is actually going upwards. Right now it's up about 80%. So the stock is currently trading at about $23 a share, which is not terrible. But again, I think the evidence is clear. And I think our viewer was exactly right. This was not only was it an overpriced IPO, but then even as soon as it went public, investors bid it up on the excitement, and the stock, from there, it really had nowhere to go but down. Now I bought several months after that, but my investment in Coupang is still underwater. And I would say, this is clear evidence of why, generally speaking, I don't invest in IPOs immediately. I generally wait for a quarter or two. And even then, you can see from the charts that, this is a stock that continued to fall. It did finally bottom out. It looks like it's growing nicely since then. But yes, Matt, I think this was definitely, this is almost the definition of an overpriced IPO.
We had a question from Vihan. What's the ticker for the restaurant you're talking about? Darden Restaurants, ticker symbol DRI. Yes, that is ticker symbol DRI for Darden Restaurants. That's correct. There's actually a question that came in quite a while ago that I wanted to answer from No Noise. Any thoughts on Farmer Mac, ticker AGM? This is kind of an interesting one. For anyone that's not familiar with this business, Farmer Mac is the name commonly used for the publicly traded entity, the Federal Agricultural Mortgage Corporation. So this is a stockholder-owned, federally chartered corporation that serves as a secondary market for agricultural and rural infrastructure loans. So it essentially provides liquidity and facilitates access to financing for the agricultural sector. So they, Farmer Mac, as they are called by most, they purchase loans from originating lenders, and they provide other risk management tools to facilitate the agricultural lending market. They offer a range of financial solutions, including flexible, low-cost financing and risk management tools to help lenders and investors in the agricultural sector. And because they securitize assets, this means that they repackage loans into marketable securities, which are then sold to investors. And by facilitating access to capital by providing a secondary market, this increases the availability and affordability of credit for American agriculture and rural communities. They work closely with the U.S. Department of Agriculture to support its programs and initiatives. And again, they provide financial solutions to a broad spectrum of customers, including agricultural lenders, agribusinesses, and other institutions. And then they offer a wide range of products and solutions to meet the different needs of its customers. This includes farm and ranch loan purchases, USDA guarantees, rural utilities financing, and even institutional credit. They also provide other risk management tools that help lenders to reduce regulatory risk weighting, mitigate, things like portfolio concentration. Farmer Mac is what's known as a GSE, or a government-sponsored enterprise, created by Congress to improve the availability of long-term credit for farmers, ranchers, rural homeowners, businesses, and communities in the U.S. Farmer Mac was established in 1988, and again, with the goal of enhancing the availability and affordability of credit for rural communities within the agriculture space, as well as, broadly speaking, the American agriculture space. Now, there are three, different categories of stock. AGM is the Class C shares. This is Class C non-voting common stock. So there has no ownership restrictions. It's listed on the New York Stock Exchange under the symbol AGM. That is what we as, individual retail investors can buy shares of. Farmer Mac also has Class A voting common stock, but that's restricted to banks, insurance companies, and other financial institutions that are not part of what's known as the farm credit system. And then there's Class B voting common stock, which is, again, just restricted to institutions within the farm credit system. So Class C stock is what you're looking at if you're someone that's interested, in this business. Because Farmer Mac is an institution of the farm credit system, but they're not liable for any debt or obligation of any other institution there. And they combine private capital and public sponsorship to serve their long-term mission. And again, the thing that's kind of cool about this business is they support agricultural producers by creating a secondary market for agricultural loans, which increases liquidity and lending capacity for lenders, but it also ultimately makes it much easier for farmers and ranchers to access sources of financing. In terms of one of the things that is kind of interesting about this business is because they have enacted pretty conservative underwriting measures and they've seen very low defaults through the years. This is a business that historically has generated significant cash. And again, it has a government mandate. So that means it cannot go to other lending areas outside of its focus of agricultural lending without an act of Congress. And so it returns a significant part of its earnings to investors through dividend payments. It has substantially grown its dividend payout over the last decade. And even its current yield is well above the S&P 500 average. That current yield is about 3.1% right now. To give you an idea, they reported their results for their fiscal 2024 in February. They announced that they were increasing their dividend by about 7%. They had outstanding business volume of about 30 billion. Their net interest income in 2024 grew 8% year over year to 354 million. Their net income was about 180 million compared to about 173 million a year ago. And then they had core earnings of about 172 million, or $15.64 per diluted common share. And they said as of December 31st, 2024, they had 264 days of liquidity. And then again, as I noted, this has been a historically cash-rich, earnings-rich business. They passed that back to shareholders. They raised their quarterly common stock dividend by 7% to $1.50 a share. And this was also the 14th consecutive annual increase. So definitely some things to like about this business. This is a very unique one in terms of the types of companies we talk about within the Fool universe. Again, established by a mandate of Congress, has a very, very unique capacity in which it functions. That also gives it, I think, some resilience, particularly because its entire design is to provide sources of liquidity and financing to the U.S. agriculture sector. And I think that that's something that we've seen through all administrations has been a key focus and desire for funding to continue. So interesting business, certainly a dividend, a substantial dividend stock, dividend player. And those are some things probably to consider, if you're looking at this business for a longer term investment.
So we have a question in the queue from Ed from about 4 or 5 hours ago. Piper Sandler has an overweight rating on Tesla with a price target of $450. Is it time to slowly start to add? I'm not going to address the main part of this question, which is whether or not it's time to add Tesla. I have concerns about Tesla's business, and most of those have to do with the fact that sales in its 3 major markets are all falling. And I have concerns with Elon Musk spending the majority of his time in Washington, D.C., which I have talked about at length at various times. However, I want to talk a bit about the fact that we have an analyst who thinks that Tesla is underpriced and has a price target of $450 over the next year. So I wanted to counter that. UBS analyst Joseph Spack reiterated his 12-month sell rating on Tesla shares on Monday, saying that he has concerns about the near-term demand outlook for both the Model 3 and the Model Y. He slashed his price target on Tesla to $225, down from $259. The other thing that I'd mention is when I go to Yahoo Finance and I look under, type in Tesla and look under analysis, what I find is there are 48 analysts listed that cover Tesla stock. Of those, there are 23 who recommend the stock as a buy or a strong buy. There are 14 who say that the stock is a hold, and there are 11 that say it's either an underperform or a sell. Now, the reason I bring that up is because Wall Street is notorious for having varying opinions. So I never make the decision to buy or sell a stock based on what one Wall Street analyst has to say. I might cite something that a Wall Street analyst has to say, if it's supports a position that I am arguing. But generally speaking, what I also do, and if you read my articles, you've probably seen this, is I will say, okay, this is what Wall Street says. This many analysts say it's a buy. This many analysts say it's a sell. This many analysts say it's a hold. The stock has an average price target of a certain amount of money, so that you have a broader amount of information in which to inform your own decision. And so I wanted to bring that up because I think making a decision to buy or sell a stock based on the rating of one Wall Street analyst is a recipe for failure. And honestly, I think you deserve better. So, maybe get a more broad scope of opinions about what the stock is doing, and make sure that you know what the bear argument is too. When I look at it, I'm concerned about the fact that sales are falling. Yes, I think there is the potential for robo-taxi to be, a big winner down the road. But I also am concerned that right now, their main business, their main cash cow business of selling Tesla automobiles is basically falling down the toilet. So that's just my opinion.
I know we only have a couple of minutes left here. There was a question I wanted to hit that came in earlier from Ed. Do you think we'll get a flurry of IPO activity later this year? If we do, will Goldman Sachs and Morgan Stanley benefit? I think inevitably, if these are companies that are, invested in these pre-IPO businesses, that's very much the case. I have one example that obviously comes to mind immediately is Klarna, that recently announced that they are, getting ready to go public. They had filed for their US IPO, I believe, at the end of last Friday. They filed their IPO prospectus. They plan to go public on the New York Stock Exchange. That's obviously just, one example of a business I believe that they have been working on preparing for their IPO alongside Goldman Sachs. That's one example. And I think that's one that, a lot of people that follow the buy now, pay later space are interested in. This is also a business that has seen its valuation fluctuate significantly. It was valued at about $46 billion several years ago, and then its valuation plummeted in 2022 to about $7 billion. And now analysts think the company is valued at roughly the $15 billion range. So there's a lot to follow there. In terms of the broader IPO market, we've seen some estimates from analysts. For example, Deloitte has said they think that the 2025 IPO market will be slightly above average, with capital raised in the 45 billion to 50 billion range, that they could see up to 160 debuts, particularly in the life sciences sector. Obviously, that doesn't mean that those are all debuts that we would want to invest in as individual shareholders. I do think that one of the things that will really impact this environment is just the trajectory of the macro landscape moving forward. I think that if conditions continue to be more volatile and that volatility is reflected within the markets, I think that you are going to see companies that are more hesitant to enter the public markets at this time. And I think that's a dynamic that would be reasonable to expect moving forward. So we've had some positive estimates, for 2025. Obviously, we've had really subdued IPO activity the last few years. There were quite a few more IPOs in 2024 than in the prior few years, as well as some good aftermarket results, but it's still a pretty subdued environment to pre-pandemic. So I would expect that trend to continue, at least for the near term.
Yeah, I wanted to mention, I was looking at some commentary from PricewaterhouseCoopers, aka PwC. They are one of the largest accounting firms in the world, one of the big three. And they noted that there are about 700 unicorns in the private market. A unicorn is a company that is privately valued at $1 billion or more. And, companies are beginning to strengthen their finances. They're starting to, bulk up their balance sheets, improve their income statements, on the potential that there could be a resurgence of IPOs in 2025. Now, one of the major factors that could play into that is whether or not there's going to be interest rate cuts. And we have been watching. The Fed recently said they were not going to raise rates right now because inflation is a bit stickier. And as long as inflation is high and interest rates remain high, I think that's going to negatively impact the IPO market. The other thing that I would say is that there are a lot of investment banks out there that serve the IPO market. And so while, yes, I think there could be some benefit to investment banks like Goldman Sachs, ticker GS, or Morgan Stanley, ticker MS, I think there would have to be a lot of IPO activity because these companies, these startups tend to spread it around a little bit. Some, of course, will go with the more well-known names because it gives their IPO a level of credibility. But also one of the things that you will see is that they're also going to shop around a little bit because when you go to a bank and say, I want you to run my IPO, they'll come back and tell you how much it's going to cost you. And those figures are not necessarily cheap. And so normally a company will do what they call a roadshow, and they will go out to the investing public, and they will do the same thing with banks. The investment banks, they will go out and they will tell them, this is what we think our company is worth. Here's, what our financial results are. And they will wait to see who will give them the best deal for running their IPO. That's why sometimes you'll see, rather than one investment bank, there might be two or three, so that they can kind of spread the wealth a little bit. So again, yeah, I think it might benefit Goldman Sachs and Morgan Stanley, but they are not the only ones. And I think that it would have to be a really large IPO market for it to move the needle for them.
With that, I think we're actually a little over time, aren't we?
Oh, we are.
Well, I'm
I
sticking
didn't
around
even
one more
notice.
hour. I know Will's here. Well, it was a good time, Danny. It's always fun.
Indeed.
I'll
Well, I'll
make
be
it
back.
can't-
I'll be back in an hour, Will.
Yes, I will see you then.
Fool on, guys.
Fool on.
Hey, Will, how's it going?
Good. How are you, Rachel? Well, welcome to another hour of Fool24. I'll be with you for the next hour. I'm Will Healy. I'm joined in this hour too by Rachel Warren. And how are you doing, Rachel?
Doing pretty good. Doing good. Excited to talk about consumer goods companies that have or are about to report earnings.
Yes, and there's still are a lot of them. This one earnings season seems to go on and on and on. I think a lot of companies will take more time to get their earnings out because they're reporting Q4 and full year in at least most cases. So we still have a few more to talk about. One of them is it's going to be OLLI, as you see, which is Ollie's Bargain Outlet. Excuse me, Ollie's Bargain Outlet. I'm also going to go a little bit into Academy Sports and Outdoors. So this will be a good hour, and I think Rachel has some stocks she wants to talk about as well. So
yeah, I definitely want to talk a bit about Academy Sports and Outdoors because I was looking into their numbers a bit before the show. But if you want to start off with OLLI's, we can kind of go from there.
Yes. So I thought you may or may not be familiar with Ollie's Bargain Outlet. They're in about 31 states now. Mostly the eastern half of the country, I would say. They're not really so much in the west, but if you're east of the Rockies, you've probably seen one or maybe even been into an Ollie's. Oh, excuse me. They reported earnings yesterday before the market opened. So that they actually met on revenue. They slightly missed on earnings, as you can see. Up 3% on revenue. down 10% for earnings. They had some executive compensation, some one-time charges. That's the main reason they're down. But of course, it has kind of been a sluggish economy too. So you don't really see all that much growth this year. Despite that, the street still liked the numbers, and the stock was up significantly yesterday. I don't think it did too much today, but they have an outlook of 14% revenue growth for 2025. So things are set to improve a bit. And also, you look at the full year numbers; they were a little bit better than the Q4. Up 8% in revenue full year, and then there was an increase of 10% still for net income. So it was a fairly good year. Sorry, I misspoke. It was a little rough quarter, but it was a good year. So again, it was skewed by the fact that there were 53 weeks in fiscal 2023. So that might have thrown the numbers off a bit. But there were comparable sales increase of almost 3% for the quarter, about 5.7, almost 6% in 2023. So that it did come down a little bit, but they still managed to open up 50 new stores. And now they have 559 stores in 31 states. For those of you who don't know what OLLI's really sells, the short answer is they sell a lot of things. It's a very interesting business because what they do is they buy excess inventory from either manufacturers or retailers. Inventory they can't sell for whatever reason. Then they usually buy it at very low prices. And they mark it up slightly and sell it to consumers. So everybody benefits in a way because the manufacturers, the retailers of the world get rid of some excess inventory, which I know has been a big problem for a lot of retailers. And it always obviously makes money off of the transaction, but consumers get these products at a discount. So it's one business that really benefits everybody in a way. But with that, they got their gross margins about 70 basis points higher because they improved their supply chain. I did mention that executive compensation. They do plan to expand a little bit faster in fiscal 2025, adding 75 stores. This is because as you might know, Big Lots, which is kind of a competitor of theirs, kind of did the same thing. They went out of business. OLLI's acquired 40 former Big Lots locations, so that's going to probably juice their expansion a little bit. So, things are. The quarter was a bit rough, but I think things were. Things are moving along for the stock. As you can see, it has outperformed the overall market over the last year. So I think it is gaining some traction finally. So I think that pattern will probably continue as time goes on.
Yeah, this is kind of an interesting one. I looked at this company a little bit yesterday, and I think the model that they operate under, which you mentioned briefly, is really what makes the stock kind of interesting right now in particular. I mean, I also was surprised that shares were up that much, given the volatility we've seen in the markets, that shares are up around 40% over the trailing 12-month period. But what you mentioned, they purchase and sell closeout merchandise and excess inventory from manufacturers and other retailers at discounted prices. And it creates something of a treasure hunt shopping experience to attract consumers. So it's all about, purchasing merchandise that retailers or manufacturers maybe no longer want, like overstocks, overruns, package changes is another area where they get inventory, and then even manufacture refurbished goods. And what's interesting is that they will actively seek out closeouts from these kinds of sources, not just manufacturers, but also retailers like Walmart, Target, Kroger. Like, they have bought inventory from these major brands that we're familiar with, and then they sell them in their stores, and then they're able to discount that merchandise anywhere from 20 to 70% below regular retail prices, which even the regular retail prices were usually quite accessible anyway. And another thing that I think is notable about this business and I noted this yesterday, there's a little bit of a way in which it reminds me of something like a TJX Companies, even though TJX Companies focuses more on somewhat maybe higher end merchandise. But they've specialized again in this brand name merchandise from these different types of stores, close out excess inventory, And then Ollie's does not have an e-commerce business. So unlike TJX, which has a limited e-commerce business, you can buy from some of its brands online. Some of it you can't buy at all, like Home Goods is 100%. You have to shop in store. But Ollie's doesn't have an e-commerce business at all. So they focus completely on that in-store treasure hunt shopping experience, which it's interesting to see how that clearly seems to resonate consumers in what we're seeing translating to Ollie's growth numbers. But also you can see a paradigm where the manufacturers and stores that they are sourcing their products from, these are already much more, maybe accessible inventory from a price point perspective, than discounting that further 20 to 70%. This seems like a store that could really benefit if recessionary headwinds, took further hold. So it's interesting to think about for sure.
Yeah, and looking at the PE ratio, the PE ratio is about 31, which might seem kind of high. The average over the last 5 years, though, is 29. So the PE ratio fell into it looks like it fell into the teens in 2022 when we had that huge bear market. It went up to almost 45 that same year. So it does fluctuate quite a bit. So I guess we're basically in the middle on valuation, but it looks like it's fairly valued here. So if there's a pullback, this one might definitely might be worth looking at accumulating some shares.
Yeah, for sure. I'll talk a little bit about Academy Sports and Outdoors, and then I know you have a slide to share in terms of their numbers, but just maybe to give a bit of an intro to the business. They're a major sporting goods outdoor recreation retailer in the US. They offer a wide range of products like hunting, fishing, and camping gear. Also, they sell different sports and leisure items, apparel, and footwear. Sporting goods is a huge part of the business. So they have a lot of equipment and apparel for various sports and activities. Then they have items targeted towards outdoor recreation. So hunting, fishing, camping gear. They stock a variety of athletic and casual apparel and footwear from other brands as well. But then they also sell items like grills, smokers, outdoor cooking equipment. They have roughly, I believe, 300 stores across 21 states. This is a business that's been around since the 1930s. They started as a family business in Texas. Now, the last few years, they have been, and especially recent quarters, they have been dealing with some struggles. And this has been a combination of factors. Obviously, and we talk about this with a lot of these types of companies, you've got a tough economic environment, right? You're seeing a shift in consumer spending towards necessities. That's one. But they've also had some other issues as well. Academy Sports, their primary customer base is primarily middle income families, many of whom are feeling financial pressures from inflation and other macro factors. And that has obviously led to reductions in discretionary spending. But they also have faced some issues during Q2, for example. They were converting their Georgia distribution center to a new warehouse system, and that caused some operational issues, including out of stock merchandise. They lost some sales that way. So they had some short-term, but impactful operational challenges related to that. At the time, the CFO of the company said that Q2 results were hurt by a temporary distribution center backlog related to going live with a new warehouse management system. And based on their performance in the first half of the year, they had revised their full year outlook. They expected a lower range in terms of revenue, as well as a decline in same-store sales. They make money, obviously, in a variety of ways, selling directly to customers through their physical stores. They also have their online channels, so a typical, omni-channel business there. It looks like, just from looking at a few of these numbers, I don't know if you want to pull up the slides you have, Will. It was they beat what Wall Street was expecting, but it's still, there's still some weaknesses there in terms of growth.
Yeah, so like always, it had that 53rd week in 23, so the numbers are going to be a bit skewed. But even when you consider that seems a little disappointing, frankly. I think Academy is kind of the victim of the sluggish economy. You can see the Q4 revenue down 7%, and that hurt net income down 21%. But as you can see from the fiscal 24 numbers, this is not really new. Revenue is still down 4% for the year, and then 19% for net income. So even if you factor in that extra week, it's still a slight downturn for the year. Comparable sales down 3% in the quarter. 5% on the year. It's still, believe it or not, despite these numbers, it's still adding stores. It added 16 in 2024. I think they're in about 21 states now. So, and they are based in Texas. So they're kind of expanding out from there. But they do plan 20 to 25 additional stores in 2025. They've also been aggressively repurchasing shares. So it's kind of interesting that even with all the stock repurchases, the stock really isn't getting any traction. They spent $368 million in 24, and then $204 million last year. That's taking the outstanding shares down by 25%. So it is kind of amazing that the market's not really responding to that. They are becoming a little bit more of a dividend stock, though. The dividend's up 18% from last year, 52% on an annual basis. It yields about 1.1%, which is slightly below the S&P 500 average. But it is a dividend they can easily afford. They're only spending $31 million a year to finance this dividend. So, and they brought in about $342 million in free cash flow. And despite the fact that its PE ratio is below 8, it's actually slightly above average. So, it's hard for me to get excited about the stock. In a sense, they are buying back shares and expanding, but the financials are, not wonderful to say the least. Maybe as the economy improves, they could improve. But for now, even despite the low valuation, I'm not too bullish on this name, quite frankly.
Yeah, I think that's right. One company I want to talk about that also reported earnings today is FedEx. So this was one I had done some earnings previews about, and it was definitely a mixed quarter of results for the business. They cut their forecast for the full year based on a few factors, including uncertainty and softness in the U.S. industrial economy. The CEO said they're navigating a very challenging operating environment, including a compressed peak season and severe weather events that have impacted the business. Shares were down about 4% in after-hours trading. Now, FedEx, as well as its rival, United Parcel Service, have both been working to reduce costs as they've been dealing with weakening demand from delivery customers. That is a trend that has been in effect the last few years, particularly as inflation and other macro weaknesses have really impacted the wallets of consumers. Consumers are turning towards more affordable and even longer shipment times to save money in terms of delivery options, slowing down shipments overall to save money. There's also the reality that, tariffs can have an impact on package volumes as well that could further depress their growth. The company is now expecting that it's going to have flat to slightly declining revenue growth in this upcoming year compared to 1 year ago. And they also changed their adjusted profit from what was previously an outlook of $19 to $20 a share to $18 to $18.60 a share. Now, I'm going to look into their earnings here in a minute, but there's a few factors that FedEx has been dealing with despite or in addition to some of these macro weaknesses, right? Obviously, slowing demand, volatile macro conditions, a weaker industrial economy. This has all impacted the business. It's impacted e-commerce. It's impacted business-to-business shipping. It's impacted the behaviors of the average consumer. We've seen customers shifting away from premium, higher cost shipping options, and that's really impacted the FedEx Express division. There's also been weaknesses in international shipping demand that has contributed to the decline in revenue. And again, as the potential and long-term impact of tariffs go into effect, that's something that one would also expect to continue. But there's also been a reality where the rise of lower-priced competitors, the growth of e-commerce platforms with their own logistics processes has really intensified competition in the package delivery market. A big thing that has happened with the business recently is the end of their contract with USPS, which is expected to result in a $500 million hit to the company. So FedEx's contract for providing air cargo services to the United States Postal Service expired on September 29th, 2024. UPS, their rival, won the new contract, and so they replaced FedEx as the primary air cargo provider for USPS. FedEx and USPS had previously enjoyed a long-standing relationship. FedEx had been the primary air cargo provider for USPS for over 20 years. FedEx and USPS were, as they put it, unable to reach mutually agreeable terms to extend the contract, hence it ended. Switching air cargo carriers for USPS's part is part of an overall initiative of theirs to cut costs. The agency's trying to save billions in the next few years. The loss of that contract, which brought in about $2 billion in annual revenue for FedEx, is going to require FedEx to make adjustments to its network. And that is also something where we are already starting to see the impact of those changes. They generate revenue through a broad portfolio of transportation, e-commerce, and business services. Looking at their results that they just reported, this was for their third quarter. And again, as I mentioned, they lowered their revenue and adjusted EPS guidance for the full year, which we should see those Q4 and full year results come out in the early part of the summer. So their Q3 results, revenue was $22.2 billion. That was just up slightly from 1 year ago when they reported $21.7 billion in Q3 GAAP revenue. They reported operating income under GAAP of $1.29 billion in the third quarter of their fiscal 2025. That was compared to $1.24 billion a year ago. They also reported net income of about $910 million compared to about $880 million a year ago. Diluted earnings per share were $3.76 compared to $3.51 a year ago. The CEO noted that the FedEx team delivered improved profitability while navigating a very challenging operating environment, including a compressed peak season and severe weather events. They're obviously working on a range of cost reduction initiatives right now. That is starting to be reflected in their operating results, which we saw. The FedEx Express segment operating results improved during the quarter. That was driven by some of their cost reduction benefits as well as increased U.S. and international export volume. Then they saw their FedEx Freight segment struggle and saw operating results decrease slightly during the quarter due to lower fuel surcharges, reduced weight per shipment, and fewer shipments, although that was partially offset by a higher base yield. They had cash on hand of about $5 billion. That's as of the end of February. And they also said that they had about $2.6 billion remaining available for repurchases under the company's 2024 stock repurchase authorization. So, revenue grew slightly. Operating income was up slightly. Net income was almost flat year over year. Single-digit growth is pretty common for this business at best, but some of the headwinds they're facing, a lot of which are well outside of their control, regarding the just operating environment they're in, and then there's also again the impact of that loss of that USPS contract over the next several years. I expect that is going to continue to impact the business, at least in the near term. Now they are in the process of spinning off their LTL unit, FedEx Freight. They're planning to spin off that into a separate publicly traded company within the next 18 months. So that is ongoing for the business as well. They're progressing in their spin-off preparation, which is what they said in their earnings. I have not had a chance to listen to the full earnings call. Management thinks that separating off this business is going to allow them to focus on the current FedEx, and the new FedEx Freight company will be able to also focus on its strengths and pursue growth strategies more effectively. So a lot going on for this business. Some of the key challenges they're facing are not necessarily within their control. This is obviously a sort of mainstay business within their industry. Shares are down about 5% over the last year, about 10% year to date. The company does pay a very consistent dividend. They currently yield, the stock yields about 2.3% based on current share prices. They've increased their dividend every year for almost 20 years at this point. This isn't a stock that I hold right now. This isn't one that I'm super enthusiastic about right now, but I do think the business is interesting. I'm curious to see what their growth trajectory will look like after they spin off that LTL business, but I think it was one worth covering as we're looking as well at the broader consumer space.
Yeah, I don't follow it that closely, but it's one that actually it tends to beat the market most of the time. However, over the last year. It is down 4% compared to about 11% for the S&P 500. So, yeah, a bit of an underperformance. Let's see where valuation. Valuation is it's about a 16 PE, which looks like it's a little bit above average for the year. So, but yeah, it's coming. It was kind of highly valued at one point, but I guess they improved their profitability. So, yeah, over the last 3 years, it's like I said, about 16 PE, and that's actually, at least over the last 3 years, that's actually a little bit expensive for the stock. So, yeah, it's kind of hard for me to get excited about it, although obviously serves a valuable purpose in the marketplace. I wouldn't necessarily sell it, but I'm not. I wouldn't be in a rush to buy it either, quite frankly. And moving on to upcoming earnings, what I'm going to be watching tomorrow is Carnival Cruise Lines. Carnival's been very interesting over the last 5 years. As you might remember, they were forced to shut down completely for about 15 months during the pandemic, and they've spent the next few years ramping up their business again. I think they're about there. Analysts are looking for 6% revenue growth to about 5.74 billion. It had been double digits in recent years, so I think this is the sign that they're finally back. They're back more or less in normal operations. The last few quarters, their capacity has been above 100%. As of late last year, they had booked most of their 2025 cabin space. So. And by the way, 100% capacity in this industry means they have 2 people in every cabin. So in a few cases, they have 3 or maybe even more in the cabin. But they're pretty much operating at full capacity. They're adding ships again. Profit wise, analysts are looking for a quarterly profit of 2 cents a share. But this is becoming a slower growth company. So it trades what looks like about 15 times earnings. For a slower growth company, kind of hard to say whether that's undervalued or overvalued, to be honest. Plus the cruise industry has been fairly resilient too. So that's why they've been filling their ships and adding more. I kind of wonder if and when the economy is going to hit the company and take the stock down. So I'm a little worried there, but I will say. As I mentioned before, they ran out massive, debts during the pandemic. As of the previous quarter, which ended November 30, they were still 28 billion in debt. But over the last few quarters, they've been actually paying off debts as they mature. So they're not having to reissue so much debt. So I think that's a good sign there. But nevertheless, 28 billion is a lot of debt for a company that. See if I don't have the shareholders' equity in front of me, but I think it is substantially lower than that. Let's see if I can find that quickly.
Yeah, that's an interesting one. I'm curious to see. We've been talking a lot about cruise businesses like Viking Holdings recently, which is obviously so different. But Carnival's one that I find kind of fascinating within the cruise space. This hasn't been a space I've traditionally invested in very much, but it's one that I follow with a lot of interest.
Yeah, and I think they were just over 40% of all cruises were a Carnival-owned cruise. So they're the dominant company in the business, along with Royal Caribbean's about second, and then you have Norwegian third. With all I think Royal has a little bit over a quarter of the business, and then a little bit under 10% for Norwegian, and then MSC, which I think is a Swiss company. If I don't know that it trades on the market, but that's maybe a little bit less in capacity than what Norwegian offers. And that stockholders' equity figure is 9.3 billion. So 28 billion is a lot of debt when you only have 9.3 billion in equity. But nonetheless, they are building back. Like I said, they seem to be paying off these debts as they come. So I think their balance sheet is steadily improving, even though it's obviously very strained from those huge debt levels. But like Rachel, I don't really invest in this business myself, but I always have a soft spot for travel, I guess. So I do follow it closely, especially Carnival. So I'll be looking forward to hearing what they come up with tomorrow.
One I wanted to talk about, which is kind of adjacent to the consumer space, their earnings came out in February, but I don't think I ever hit them, and I'm not sure if anyone else did, is Fubo TV. I don't know if you follow this one. Shares are about $3 each. The $1 billion market cap. The stock is actually up about 120% from the beginning of this year, which is interesting. But for anyone that doesn't follow this business, this is a live TV streaming business. They offer a variety of channels, including sports, entertainment, news. They serve as an alternative to traditional cable TV. They have plans available in the US, Canada, and Spain as well, I believe. So sports, entertainment, news, local channels allows users to stream TV content over the internet without needing a cable. They've really expanded their offerings as well. Sports streaming is really where their roots are. They have a strong focus on soccer, other major sports leagues like the NFL, NBA, MLB, and NHL. Their channel lineup includes a lot of the popular networks like ABC, CBS, and NBC. And then in addition to live TV, they offer on-demand access to a variety of shows and movies. They also include unlimited cloud DVR storage with all plans, which allows users to record and watch their favorite shows. And they allow users to stream content on multiple devices simultaneously, both at home and on the go. They primarily generate revenue through subscription fees and advertising. Their core model really revolves around offering a sports-first live TV streaming service with revenue streams, again, for both subscriptions and advertising on the platform. Subscription revenue is the main source of income that comes from subscribers who pay monthly fees to access their live TV channels and content. And then Fubo also generates revenue by displaying advertisements to its subscribers. And the amount of that revenue is really tied to subscriber numbers and viewership habits. They use average revenue per user, if you're looking at this business and their financial reports, as a really key metric to evaluate their core operating performance and their subscriber monetization. They also analyze their business performance by breaking down average revenue per user into North America and rest of the world, or ROW. And again, that model of theirs has been, effective through the years. I feel like if I remember right, Disney in January of 2025, Disney announced the merger of its Hulu live TV business with Fubo, becoming the majority owner of the resulting company, which still operates under the Fubo name and ticker. This is what I thought. So they acquired a majority stake in Fubo TV in January. Disney acquired a 70% stake, again, combining Hulu and live TV with Fubo's existing platform. But again, the combined company is still publicly traded under the Fubo name. That is why you're seeing the stock soar the way it has since the beginning of this year. Fubo's management team, which is led by CEO David Gandler, will continue to run the business. This also was a deal that helped resolve litigation between Fubo, Disney, Fox, and Warner Brothers Discovery over the Venue sports streaming service. And then under the terms of the agreement, Disney, Fox, Warner Brothers Discovery will make an aggregate cash payment of about $220 million to Fubo. And then Fubo was going to then drop its litigation against Venue Sports, which is a joint venture of Disney, Fox, and Warner Brothers Discovery. So kind of interesting. Again, Fubo TV publicly listed, but now held mostly controlled by Disney, which has a 70% controlling share in the business. With 6.2 million customers, expected annual income of about $6 billion. This makes the new merged business a major participant in the online pay TV industry, ranks second in North America. Looking at their recent results, which they just released in, the end of February, they closed the full year 2024 in North America with record total revenue and paid subscribers. It was their first quarter of positive free cash flow. They improved key profitability metrics by over $100 million on an annual basis for the second consecutive year. They delivered full year 2024 results in North America of $1.6 billion in revenue. That was a 19% year-over-year increase. They also delivered a 1.7 billion subscriber count. That was up 4% year over year. Again, those were both record-breaking metrics for the company. They closed Q4 with about $434 million in total revenue. That was up 8% year over year in North America. And average revenue per user in the Q4 was $87.90 in North America. That was an all-time high for the company, up 1.4% year over year. In their rest of the world, or ROW segment, the company delivered $9.4 million in total revenue. That's a much smaller part of their business. That was growth of 12.1% year over year. They also had about 360,000 paid subscribers outside of North America. That was actually down 11% year over year. So North America is the biggest market for the company at this point. In the full year, they did improve their net loss, but they are still operating, I believe, at a GAAP net loss. They did deliver adjusted EBITDA of $115 million. Net cash from operations of $97 million, and free cash flow of $104 million in the 12-month period. Interesting business. Obviously, since Disney owns a majority stake of this business, if I was interested in investing in this company, I would just buy shares of Disney. But because this is still its own publicly traded entity, and because it has been a high-flying stock recently on the news of the merger with Hulu, I thought it was an interesting one to cover.
Yes. So just want as a reminder, if you're just joining us and maybe this is your first time on Fool24, you are free to ask us questions. If you want to do so, just go to Slido. That's slido.com or sli.do with the code of Fool24. And so speaking of questions, I saw one from Alan Benton about 5 years ago that I wanted to address. That's like an interesting question. Is there an auto parts ETF out there? Something with O'Reilly auto parts, ORLY, AutoZone, AZO, and Genuine Parts, GPC. The short answer is no. But most of the stocks that cover that are just pure automotive stocks. I was looking at those three stocks though, just just for fun. Of those three stocks. Both AutoZone and O'Reilly slightly outperformed the S&P 500 over the last year. Genuine Parts did not. It actually dropped about 22% versus about 11% gain for the S&P. Genuine Parts, however, has paid a significant dividend, and they've increased it for 69 straight years. So they're very very much a dividend king. That dividend currently returns 3.3%. So, the stock performance isn't that great right now, but that's one you might want to keep in mind if you're a dividend investor, put it on your watch list. But I mean, if you want to be in those stocks, but maybe you should just consider buying AutoZone or O'Reilly Auto Parts, since they tend to beat the market. Now, looking further out, the increase is even more significant if you're looking at a 3-year or a 5-year. 5 years, the S&P was up 154%. AutoZone was up 331% and 362% for O'Reilly over 5 years. So, these stocks are pretty good performers, even though they don't get a lot of coverage. But those are two I would look at. I would, if your comfort level allows, I would probably recommend just maybe putting a little bit into AutoZone and O'Reilly and seeing what happens.
There was a question that had come in earlier from AD. I've had ticker VGHAX, which is the ticker for the Vanguard Healthcare Fund Admiral Shares ETF. The AD was saying, I've had shares in this ETF for over 10 years. I'm down about 20% with lots of fluctuation over time, anywhere from 0 to 20%. What is your thought on the forward view of healthcare stocks? So this is an interesting fund to mention as well, because it holds some of the biggest companies across many different sectors of the healthcare space. Now, it's worth noting the fund is concentrated about 20% in biotech businesses, about 13% in healthcare equipment businesses, about 11% in managed healthcare businesses, and 44% in pharma businesses. So those are some of the top sectors in which it's concentrated. And then businesses within this fund are ones like Eli Lilly, United Health, AstraZeneca, Merck, Novo Nordisk, Vertex Pharmaceuticals, Edwards Life Sciences, Novartis, Boston Scientific, and Danaher Corp. Those are the top holdings of the fund. So it's a real, solid selection of businesses across the healthcare space. I think looking at healthcare broadly, there are so many different sectors and ways to invest. There are obviously ways like, investing in a fund to get exposure to a whole basket of businesses across the space. But looking at healthcare over the long run, and obviously this is a space that I follow and report on a lot, I think there is so much opportunity within this space, whether it's pharmaceutical companies, medical device companies, GLP-1 stocks, companies focused on diabetes care, companies in the biopharma or biotech space, companies focused on rare drugs, drugs that target rare or underserved genetic diseases. There are a lot of different ways to play the healthcare space. And I think it's obviously, very personal to one's personal interests and risk tolerances. But we know that healthcare spending is one of the highest areas of capital concentration globally across the world. And that remains the case, moving forward. And I don't think that is going to change. We know that we are dealing with a global population that is aging. That also trickles down to the performance of healthcare businesses and everywhere from, pharmaceutical companies making prescription drugs, vaccines, therapies. That also trickles down to insurance businesses. There are other areas like, again, medical device companies, biotech companies. I think it really, depends. But over the long term, all of these different sectors, these are areas I'm still really bullish on. Now, as is true with any investment, I think the performance of any of our respective portfolios are really going to depend on what investments we make within what sector. I have healthcare companies in my portfolio that have done, really well. I have others that I've bought and held that have not been the investments I hoped. One example of a company that I own shares in is AbbVie. That is a stock that's up about 200% over the last 5 years. And most of that period of time, I've been a shareholder of this company. Another one that I now have a very small position in, but bought years ago on hype around the business was Teladoc. That's a healthcare stock that has absolutely been an abysmal performer in my portfolio, and for which I only have a very small position in now, partly just because I wanted to have a little bit of skin in the game in case the company ever turns around, which I'm growing less and less optimistic that it will. But that's to give an example of, two different healthcare companies in my portfolio, two wildly opposite performances in terms of share price appreciation. So it really does come down to the individual investments we make, which is obviously very personalized. We can't give investment advice on the show, but there are so many different sectors in healthcare that are investable, whether that's buying individual stocks or whether that's buying in a basket of stocks is through a fund. I think over the long term, all of these different sectors of healthcare that I mentioned are really poised to benefit from, an aging population. As well as other factors. Healthcare is a resilient space, broadly speaking. These types of companies make, devices, medicines, deliver products and services that are broadly needed by the consumer populace globally, no matter what is happening in the world or in the economy. We are also seeing the prevalence of and growth of chronic diseases like diabetes, heart disease, cancer. That creates significant opportunity and growth over the long run for businesses that are developing the therapies and drugs to meet these needs. There's also major innovations in the pharmaceutical space, in medical devices, in diagnostics that's driving growth in the healthcare sector. We're seeing the rise of digital health technologies, telemedicine, wearable devices. All of this is transforming healthcare delivery, and also I think creates new opportunities for investors. So those are some of the things I think about when I'm looking at this space.
Yeah. So Besties a couple of days ago had a question for Lou, but I'll go take it. Besties asked, you follow Garmin, symbol GRMN. What do you like or dislike about it? Your expectations? Garmin's been a very interesting one because back in the mid 2000s, they led the market for GPS devices, and that market got almost completely wiped out when the smartphone came along, and GPS was just one app of many apps on the smartphone. So with smartphones, you really didn't need a GPS anymore, and Garmin stock got hammered. However, Garmin was very smart, and they pivoted into specific areas that a smartphone wouldn't go, or at least most of them mostly wouldn't go anyway. They did fitness, outdoor, aviation, marine, and auto OEM. So auto OEM is kind of like the connected sort of, a very connected autonomous experience. So that so they're still in the auto market in a way, but I like this stock overall. It's in terms of performance, it was up about 42% last year compared to, like I said, 11% for the S&P 500. It trades at about 29 times earnings, which that's been actually higher than it used to be. But it did grow revenue at a fairly rapid clip. Over the in the last fiscal year, revenue was up 23%. So that's it is on the comeback trail. Like I said, I think it's almost, well, it was at record highs earlier in the year. It has pulled back a little bit, but I think I haven't followed this too much in the last few years. I owned it back in the day when I was interested in the GPS market. But yeah, it's just off record high. So I think at 29 times earnings, it looks like it's finally finding its footing after all these years, and maybe worth taking a deeper look at.
I'm just looking through here at some of the questions. I lost the question that I had found that I wanted to answer. So one moment while I look through and find that. Well, this was an interesting question from Ed. Maybe both of us can share our thoughts on this one. At today's prices, can you name a stock or two where you should not be timid? Obviously we can't give personalized investing advice here on the show, so we can't tell you what stocks to buy or sell or any specific movements to make with your portfolio. But I think companies that, we're interested in right now in the current market as long-term investors, I'm sure there's a lot that both, Will and myself are watching right now. One I talked about in the prior couple hours ago with Neil. Vertex Pharmaceuticals is a business I talk about a lot. Major biopharmaceutical company, a leader in the cystic fibrosis therapy space, is working on a range of therapies targeting rare, underserved diseases, for which there are essentially no or very limited treatment options. This includes treatments and therapies for disorders like APOL1 mediated kidney disease, Duchenne muscular dystrophy. They're also in the process of rolling out their gene editing therapy that is a one-time functional cure for sickle cell disease and transfusion-dependent beta thalassemia. And then they also just had their a major approval for the first in a new class of pain medications that's been approved in 20 years, called Journavax. It's a
Oh, it looks like we might have lost Rachel. Maybe it looks like she's having some technical difficulties. Yeah, as for stocks that I would look at today's prices, that's a good question. I have actually made some purchases recently. A couple of weeks ago, I doubled down on AMD. I don't know if for those of you who don't follow AMD, it's a semiconductor company. It's in several different segments of the semiconductor industry. Its biggest segment right now is data centers, which they handle the AI accelerators. Also, they're big into the gaming, embedded chips, and of course PC chips. Where they played little brother to Intel for decades. Now Intel's fallen behind. AMD stepped up their game here, and AMD is really now strong in the client segment. The stock is down more than 50% from its high. I think it's because the gaming segment has been struggling. However, they make the gaming chips for the Sony PlayStation and the Microsoft Xbox. Both of those consoles have not come up with updates in a few years now. So I think that's why that segment is suffering. It's only around 10% of the company at this point, give or take. Whereas the data center segment and the client / PC segment, which are prospering, those are 80% of the market. So that's taken the forward PE ratio into the low 20s. I really think this one, I think this is a great buy at this price. I don't think it's going to. It's already come up a bit from its low. It briefly fell below 100. I think I haven't checked it today, but it was like in the 105 range yesterday. So I think that one is starting to make a comeback. That's probably the number one that stock that looks good to me right now. And Rachel is back.
I am back. Yeah, the system kicked me out for whatever reason. I'm not sure at what point it cut off, but Vertex was the one I was talking about, and then another one is Intuitive Surgical, leading maker of surgical robotics globally, known for their Da Vinci system. And this is a business that has a significant global footprint and market share within global surgical robotic platforms. Their platforms are used in a range of minimally invasive surgeries, delivering a lot of benefits both for surgeons as well as for patients. For patients, there's the ability to have often shorter recovery times, minimized risk of complications and bleeding, and other adverse events. And it's a great recurring revenue business because so much of their revenue and profits, well over 80%, is derived from recurring sources, like selling replacement instruments and tools that go with their system. So those are a couple, Vertex and Intuitive Surgical as well.
Yeah, so Bessie's had another question about 5 hours ago that caught my eye. What are your views of data center REITs and tower REITs? To be perfectly honest, I haven't really looked at data center REITs lately, so I don't think I want to comment on that. As for tower REITs, I actually started my career in a related business, really decades ago now. So I worked with companies like American Tower, Crown Castle, SBA. At that time, there were a lot more companies in the market. But I was noticing the cream of the crop were American, Crown Castle, SBC, and a couple of others that no longer exist. And I hear that investing lesson. Invest in what you know. And I really should have invested in some of these companies because they fell to rock bottom prices during the .com bust. At the time, they were not real estate investment trusts. They marketed themselves as tech companies, and it's one of those things. If I bought near the bottom, I'd probably be making my money back in dividends every single quarter at this point. So, it is always good to take the industries and see if there's an investment case. Now, this doesn't work every time. I realize there's products that are well established that probably aren't going to be great returners, but in an emerging industry like tower REITs were at that time, it's definitely can lead a huge return. So good opportunities now. American Tower, do they have much income from data centers? So I was looking up their data center income. As you might, if you follow American Tower, they're the biggest company in this space of vertical real estate. Selling positions on towers, and at least in the U.S., their main clients, not surprisingly, are AT&T, Verizon, and T-Mobile because those are the three major operators. They are international though, so they're in Latin America, Asia Pacific, Africa, and Europe. So they do have some other clients besides those three, unlike Crown Castle, which only operates in the U.S. But in terms of data centers, I don't have really updated data, unfortunately. The way they set up their pages, it's kind of hard to find things on the fly. They're making a little bit of profit on this. I would say it's a very, very small percentage of their revenue and of their operating profits. I personally, I would just play American Tower for the towers. If I wanted to invest in data center REITs, I would just go directly into those REITs. In terms of which company in the tower space I like best, I would say I like American Tower. I think that has the biggest market, and they in terms of dividends that they pay about in the middle. SBA Communications is also solid. However, their dividend is much lower. I don't think they quite perform quite as well. The one that's struggling relative to the others is Crown Castle. Crown Castle pays a huge dividend yield, but I kind of wonder how sustainable that dividend is, because I haven't looked it up lately. Let me see if I can find that, because it's it was extremely high when I looked last time. So in terms of dividend yield, Crown Castle pays about 6% right now. So it was kind of, last time I looked at their financials, it was questionable as to whether that dividend was sustainable. Whereas you have American Tower, they're paying a 3% dividend right now, which is still pretty good, considering that the S&P pays about 1.3% right now. So that's more than double the averages. I think there you get a more stable company. I'm not really sure how they're doing on data centers. We'll see if they stick with that. I admit, though, it was a natural pivot, as they have a lot of the equipment at these towers anyway. So it may not seem like a big change to add a data center on the ground near some of these towers. But yeah, that still hasn't become a big part of its business. So, but this is a very interesting business, and I think one that has good long-term prospects. Like I said, unfortunately, I have not looked at data center REITs lately, so I prefer not to comment on those for that reason.
Okay. There's a question I wanted to hit from Ed that came in a couple days ago. Do you think BX, which is the ticker for Blackstone, is a good investment at today's prices? Well, I'll offer my thoughts on this. Obviously, can't give personal advice about whether or not to buy this one, but I'm happy to kind of share my thoughts and maybe some things to consider if you are looking at this company. I know the stock has been hit recently. Blackstone, for anyone that's not familiar, they are the world's largest alternative asset manager. They have more than $1 trillion in assets under management, and they serve both individual and institutional investors. They were founded back in 1985 as a mergers and acquisition firm by two gentlemen who had previously worked at the Lehman Brothers long before that infamous firm went down. Blackstone generates revenue primarily through management fees and performance fees, also known as carried interest, charged for managing portfolios and generating returns for their investors. So Blackstone earns a regular fee, typically a percentage of the total assets under management, for managing funds and providing investment expertise. They also receive a share of the profits that are generated by the investments, contingent on the success of the portfolio. That's known as carried interest. And they operate through several business segments, and this includes private equity, real estate, hedge funds, and credit. Their private equity business invests in companies, often through leveraged buyouts, with the goal of improving the companies and eventually selling them for profits. Their real estate business acquires and manages commercial real estate assets globally. Their credit platform provides financing solutions to both businesses as well as governments worldwide. And then their hedge fund platform offers investors access to a diverse range of hedge fund strategies. Now, this is a business that, from a financial perspective, is still doing very well. But there has been, obviously some challenges that they are up against in the current environment, namely rising interest rates, a cooling commercial real estate market, which, as I mentioned, is a huge part of their real estate portfolio. The Federal Reserve's interest rate hikes have made borrowing more expensive. That's impacted commercial real estate investments. And obviously, because they're a major commercial real estate owner, they have faced challenges with declining property values and lower rents. They've also faced challenges with refinancing, as rising values, may not be enough to counter high leverage and pass missteps in the market. They've also had some challenges in selling private credit to some of their wealthier customers in Europe. They've seen slowdowns in the growth of their private credit fund, which works to tap into the roughly 50 trillion cash pile held by the most affluent in Europe. Now, their real estate business has grown to nearly 300 billion, which accounts for about half of their earnings. And again, because, as I mentioned, their commercial real estate business has faced headwinds due to the environment, not the business itself, they have been facing some headwinds in that area. Just a couple notes as well. I mean, looking at their 2024 results, they did report, total revenue of about 7.1 billion. That was compared to about 6.7 billion in full year 2023. GAAP net income was about 2.8 billion for the full year. That was compared to 1.4 billion a year ago. As I mentioned, they're seeing kind of a myriad of issues in these different segments of theirs, but this is still a fundamentally very, strong business. Their fee-related earnings were about 1.8 billion, distributable earnings of 2.2 billion, and their net accrued performance revenues were about 6.3 billion. And again, they had about 1.1 trillion in assets under management as of the end of the year and quarter. They are a pretty faithful dividend payer. They distributed about 6 billion in dividends last year alone. I think it's an interesting business. I think it's just important to be aware of the impact of their commercial real estate business, which again is about half of the overall business as a driver of growth over the long run. But this is still a fundamentally strong company. And I think the weaknesses in the commercial real estate business are part of what you're seeing drive stock performance down right now.
Okay. Well, thanks, Rachel. It looks like we're at the top of the hour right now, so I'm going to let you go. Give you a break finally after 2 hours, and bring Danny back on where we can talk tech dividend stocks.
Sounds good.
Yes.
Thanks so much.
There he is. Thank you, Rachel. Fool on. Danny, how are you doing?
Here I am.
It's like I just saw you.
It's deja vu all over again, to quote Yogi Berra.
Exactly. So, welcome to another hour of Fool24 Fools. Again, I'm your host, Will Healy. I'm joined today for this next hour by Danny Vena. It looks like he's doing pretty well.
I am doing pretty well. I have nothing to complain about.
Okay, so as the title says, we're going to discuss tech dividends today. And then when it comes to tech dividends, when it comes to dividends, I should say, you don't really think of tech. Usually, you think of mature companies like maybe like consumer staples, like utilities, like real estate investment trusts. A lot of those, I mean, at least a few now, more so nowadays, but especially in the past, those were not really tech stocks. But now that tech has been around for a few decades, you have a lot of tech companies that are maturing. And as they mature, they've gotten out of that growth stage and started to pay dividends. So there are a lot of interesting names out there. Unfortunately, I don't think we're going to be able to touch on all of them in the next hour. But I think there are a couple that we, or I should say a few that we want to touch on. So I'm going to start off with IBM, which IBM is arguably the original tech company. It's been around since 1911. So, and it's it's had it's done a lot of things over more than 110 years. They had the punch cards at one time. They led the way. They led the way in PCs back in the day. Their latest push, though, has been more cloud and AI. And the stock was struggling in the 2010s. It really, during that decade, at least from the 2013 timeframe, it actually lost value until Arvind Krishna, who was the head of its cloud division, came in 2020. He's really worked to redefine IBM as a cloud company and later as an AI company. And the shares have been on the rise again. And he's been able to keep IBM's dividend streak going. IBM has been increased its dividend. Excuse me. It's increased its dividend for 29 straight years. It's been paying a dividend for several decades. I think it had to reduce its dividend sometime in the 90s, but it got through that. Ever since then, even through its troubles in the 2010s, it's been able to keep hiking its dividend. So. As you can see here, it pays $1.67 every quarter. At least it does for this last year, or $6.68 per share annually. That's a yield of about 2.75%, which is still double the S&P 500 average. Now, when the stock was struggling, in the earlier part of the decade, the dividend yield was often in the 5% range, or sometimes higher than that. So it has come down a bit just as the stock has improved, but it's still a pretty strong dividend stock. As I said, it's increased its dividend every year for 29 years. I don't see that changing. I mean, however, the dividends have been more modest as it struggles. So last year it only increased its dividend by a penny per share every quarter. I'm kind of wondering now that it's doing a little bit better if it's going to increase that. We're going to find out probably next month. They announced their last increase in April of 2024. So I imagine we'll hear sometime next month what they do with their dividend. But when you have 29 straight years, you get a certain classification that I'm not allowed to say here, but not quite highly as ranked as Dividend King, which I can say, but very noble nonetheless. So it probably wants to keep that status. So it'll almost certainly increase its dividend and make it 30 years this year, I think. But it's one they can easily pay. That free cash flow last year, $12.7 billion. It paid $6.15 billion in dividends last year. So it's generating the cash to pay the dividend and do other things like spend on capital expenditures. By the way, capital expenditures is subtracted out, so free cash flow does not include that. Although if you spend more on capex, it's going to reduce the free cash flow. But either way, though, it can still afford to keep that dividend going. It's told that it's a little bit high compared to shareholders' equity. Shareholders' equity, which is the book value of the business, $27.3 billion. It's told that it's about $55 billion. That was much lower in the last decade, but Arvind Krishna gambled heavily when he borrowed a lot of money to buy out Red Hat to make IBM more of a cloud company. IBM would probably be in dire straits if that gamble had failed. Fortunately, it looks like it has succeeded. However, it still has a debt overhang. But despite that, I think it can keep paying its dividend, and I think it will keep paying that. Is that one you follow? Oh,
I followed IBM for a while, and after about 3 years of following them or being a shareholder, I grew impatient, and I sold off my IBM stock. And this is one of those cases where shortly after I decided to do that, within a couple of years, they turned things around, and now the stock has been up. I was looking at this a moment ago. I think the stock is up like, let's see. Yeah, I don't want to lie about something as important as how much the stock is up. So it looks like over the past 5 years, IBM stock is actually up 153%. And of that, it's up about 26% over the past year and about 89% over the past 3 years. But yeah, there was a period of 3 to 5 years there where IBM stock was just a dog. And again, I grew impatient.
The same exact thing happened to me. I first bought it for that. What was at the time just a massive dividend. But I saw the performance. I got impatient. I'm not anywhere near retirement, so I just let it go after that. But and like with Danny's experience, seeing after I let it go, it started taking off, and it has beaten the market since Arvind Krishna became CEO in April of 2020. So it's not really the most exciting stock to follow. The revenue growth is still in the low to mid single digit. So it's not. I would not call it a growth stock, despite the considerable gain over the last few years. But it is one to follow. And if you are an income investor, I think it's one that at least needs to be on your watch list, if not in your portfolio.
So one of the tech dividend stocks that I want to talk about may not be considered a dividend stock in the traditional sense, but it's one of my favorites, and that is Apple. I don't think Apple gets enough credit for the fact that they have been paying a growing dividend for more than a decade now. I'm going to go ahead and share my screen here for just a moment so that we can take a look at the charts that come with Apple. And the first chart here basically just shows how much Apple's dividend has increased since it reinstituted the dividend in early 2012. And what I like to see is these little stair steps here where it goes up and up and up and up and up. And that's what you get from a consistent dividend payout and in consistent increases in the dividend. I also like to see this one big, climb right there in the middle where it was a little bit higher than what folks expected. What's interesting about Apple is, you look at that dividend and that is, fairly impressive in its own right. Now, what I'm going to do is I'm going to overlay the stock price here as well. And you'll notice that during that same period, the stock price has increased by 864%. So, you're getting a pretty solid overall total return when you get nearly a 10 bagger from the stock over a dozen-year period, and you get 164% increase in your dividends. Now, I'm going to take that price off there. The other thing that I wanted to talk about here is Apple's payout ratio, which when you look at this chart, you'll notice that was really high at first, and then it trails off. And what that shows that even as Apple is increasing its dividend, it's increasing its earnings by more, which is why that line is sloping down and to the right. So currently, Apple is only using less than 16% of its income to fund that dividend, which means that, increases can continue for the foreseeable future without any fears of a dividend cut. Now, the other thing here is I want to pull up the dividend yield. You'll notice that the dividend yield down here at the bottom is half of 1%. And you think, well, that's not a very good dividend stock if they're only paying 1/2 of 1%. But that is a function of the fact that the stock price has gone up so much. Even over the past year or so, if you look, I'm going to change the date range here to a year so that you can see, Apple's stock price has, not done that well. Normalized percent change here, and you can see that Apple stock price is only up about 21% over the past year. But still, when you're looking at the ability to consistently pay a dividend and the ability to fund that dividend, increase the dividend, and you also get a boatload of capital appreciation at the same time. So I'm a big fan of Apple, and I suspect that in the coming decades, we will be talking about Apple as some form of dividend royalty.
Yeah, you got to think that they're like 3.5 trillion market cap now. They look like they're maturing, so you'd think they would be leaning into their dividend a little bit more. Although 0.5% is pretty low, so they're going to have to pass some pretty substantial increases to be seen as a dividend stock. Although that with the amount of liquidity they have, it's hard to find a company that has more liquidity than Apple. You'd think they could afford it.
And again, if you look at that percentage, Apple with those consistent dividend increases, if not for the consistent increase in the company's earnings, that would be pretty paltry. But if you look at the capital gains from the stock, that more than makes up for the fact that, perhaps that yield is not as high as some dividend investors might like to have.
Yeah. So I also want to bring up something. You brought up the dividend payout ratio. For those of you who don't know what that is, it's basically dividends divided by net income. Danny and I might have a bit of a philosophical difference here. I'm not a fan of the dividend payout ratio precisely because it uses net income. And the problem with using net income, you probably have to know some accounting to understand this, but net income subtracts out a lot of non-cash expenses like depreciation and amortization, stock-based compensation, etc. So I don't feel it gives investors a good, a good read on how much cash a company's generating and how much they can afford to pay a dividend. So I personally use free cash flow, but a lot of people do like the dividend payout ratio. So if you get heavily into dividend stocks, you might see both kinds of measurements there. For my analyses, I did use free cash flow rather than net income. So
since you brought that up, Will, this was an idea that I was toying with before I came on the air. And what I wanted to do is I wanted to share actually a financial report from a company just to illustrate exactly what you were just talking about. And if you go back into the third quarter of 2024, the company that I want to talk about is Broadcom. If you look at Broadcom's payout ratio, it says that it's more than 100% of their earnings. Unfortunately, that's not an accurate depiction of the company's ability to pay that dividend, where it works in most cases. But Broadcom in the third quarter had a GAAP net loss, generally accepted accounting principles, of $1.9 billion. And part of that was the fact that they had a $4.5 billion non-cash tax provision because they brought some of their intellectual property back to the United States. And so they were looking at having to, accrue some additional taxes as a result of that. So, this is, again, like you said, it's a non-cash provision. But that $4.5 billion hit to the company's net income made it look like they were losing money, $1.9 billion. But if you back out that $1.9 billion or back off the $4.5 billion of the non-cash provision, then you have a $3.3 billion net income. So I just wanted to illustrate that, there's actually a real world example that backs up what Will's talking about, and Broadcom is it.
Yeah. If you look at enough dividend stocks, you'll see that not too uncommonly. So it is always something to watch out for if you're interested in this topic. But despite the fact that I bring up tech dividends, there's not. I don't really like it every tech dividend stock. Not because it's like Apple and only pays 0.5%, but there's some out there I kind of question whether they can pay their dividend, and you always need to watch out for that. So with that, I'm going to bring up Verizon as one. Again, some fools will disagree with me on this one, but because I see a lot of articles on the Fool website, touting Verizon as a great dividend stock. In many ways, it is, but I think it does have some problems. Sorry, bear with me. It's a little slow in coming up with the slide. Hopefully that will show up, but I'll go on anyway. So right now it pays a quarterly dividend of 67.75 cents per share. That amounts to $2.71 per share annually. Its dividend yield now is 6.2%. So yeah, we're talking at that point almost 5 times as much as the S&P 500 average, maybe a little bit under, but you see dividend yields that high. It's especially important to do your due diligence to see if the company can actually pay that dividend. I don't think that Verizon ever planned for its share price to fall where it did. It has increased its share price for 18 straight years. However, the last increase was only 1.25 cents per share quarterly. So that was only about 2%. So, maybe the modest level of that increase may indicate that it's noticing some issues here. But yeah, in terms of affordability, I'm going back to free cash flow, a little bit under $20 billion in free cash flow, and that's despite capex, capital expenditures of $17.1 billion. As you know, Verizon is a nationwide 5G provider, and they also provide fiber services. And between those two businesses and the licensed spectrum they have to buy, which is basically the right to use a premium frequency in a given market area, all those things cost the company billions annually. So last year it spent $17.1 billion in capital expenditures, but still, considering that they have that expense, $20 billion is a lot of free cash flow. The dividend right now is costing them $11.2 billion. On the surface, that wouldn't be so worrisome because it leaves them, I guess $8.6 billion that they could free up for other purposes. Unfortunately, it's burdened by heavy debts. I think they spent a little, I want to say $53 billion a couple of years ago to buy some licensed spectrum in given markets. Now, that does give them a competitive advantage because they are able to, get some of the highest quality spectrum in some key markets. So that's going to mean they can provide very high quality service. But it did take their debt to a very high level, $144 billion. Their stockholders' equity, which is the book value, is just over $100 billion. So this is a heavily strained balance sheet. So the debt has only come down very slowly. I kind of fear that they're either going to have to either cut back the dividend or eliminate it completely to get this debt to a more manageable level. Because if they'd spent that $11 billion to pay off debt, their balance sheet would be in a much stronger position right now. In my opinion, this is a company that should suspend its dividend and just get its debt at least to a level where the balance sheet is in a strong position again. But so far, at least from what I'm hearing, they are committed to the dividend. They want to keep adding years to this streak of increases. However, you do have to worry because until a couple of years ago, AT&T, its biggest competitor, had a 35 straight years of dividend increases, and they finally had to cut that back. Now, I think their dividend yield is around where Verizon's is now, despite that cut in the dividend. So that kind of tells you how much the stock price took a hit because of that dividend cut. And I think Verizon fears its stock is going to suffer in a similar way if they cut the dividend. But so that for that reason, they probably won't do it. Excuse me. They probably won't do it unless they absolutely have to. But in my opinion, anyway, given their financial situation, I think they either have to more or less have to soon. Well, they're more or less going to have to at some point, in my opinion. So I'd be leery of investing in the stock for the dividend for that reason.
Yeah, whenever I see a company that at some point has to go to the well to get cash to help pay for its dividend, that's concerning to me. To artificially prop it up. Now, I realize these were extraordinary circumstances, but still, you would think that a company that plans to pay a dividend over the long term, generally speaking, they say that a company that pays between 15 and 25% of their dividend or their income to fund the dividend is in good shape, but between 25 and 50% is still okay. You start getting higher than that, and then it becomes concerning because then you're only, maybe one downturn away from either having to slash the dividend or fund the dividend through borrowing, and either one of those is not, optimal in terms of dividend paying history.
So it's very, very important to look at these financials, in my opinion, and do your due diligence before buying some of these stocks. Make sure they're bringing in a sustainable amount of money, and they don't have burdens like that massive debt that's going to maybe prevent them in the long run from sustaining the dividend.
So another tech dividend company that I wanted to talk about is relatively new to the dividend paying world, and that is Meta Platforms. Meta Platforms announced back in February of last year that they were going to start paying a dividend. And it was a somewhat meager 50 cents. Now, they went through the first year, they paid out their quarterly dividends, paid about $2 worth of dividends over the past year. They bumped that up when they announced their results last month. And they now pay a quarterly dividend of 52.5 cents, which comes out to a dividend of about $2.10 per year. Now, when you look at their yield, this is similar to Apple in that it is only 0.36 so 3/6 of 1%. That's not very much of a dividend. It's actually kind of paltry when you think of, you were talking about how much of a dividend that Verizon pays. But this is something that, is new. Meta has only joined the dividend game in the past year. I'll go ahead and share my screen and give you some of the particulars here. Pull up my chart creator. So right now, Meta has a payout ratio of about 8%. It's only using 8% of its net income to fund its dividend. The dividend yield, and this says it's 0.35%. And again, this is very relatively new. But when you layer on top of this what the price has done in recent years, over the past year, Meta Platforms, even after the recent decline, the stock is up about 18% over a year. You look at 3 years, the stock is up 170%. Over 5 years, the stock is up 282%. So, if you are like I am, a growth investor, and you're looking for a company that has been fairly consistent in its capital gains, you could do worse than Meta Platforms. Now, of course, you want to see this dip right here that happened around the time of the economic downturn, and of course, Meta Platforms, their primary way of earning money is through digital advertising. And of course, if you have a company that is primarily in the ad business, you will know that that anytime there's an economic downturn, the very first thing the companies do is they try to cut their expenses so they can shore up their financial position. And one of the first expenses to get cut is so this is well known among people who follow advertising stocks. So there was a lot of fear and loathing surrounding Meta stock for about a year while the stock plunged. However, students of history will note that this is normal. And I took that as an opportunity to add to my position in Meta. I didn't catch the bottom by any means, but I did get a really good price, particularly when you look at, I got the price in here, and now the stock is trading up here. So, that's a pretty good indicator. So when you see slumps in Meta's stock price, like you're seeing right now, actually, I just want to take a quick clear. Meta Platforms right now has fallen about 20% off its high, not nearly as much as it fell in 2022 and 2023, but I expect this to be more of a short-lived downturn than a long-term one, and so this is an opportunity, I think, to get shares of Meta Platforms at a discount, and also to get in on the early stages of a company that has only just begun to pay a dividend. If you look at Meta Platforms results, You can see the company generates a huge amount of cash flow and revenue every year. For the fiscal year of 2024, Meta generated $164 billion in revenue. And for their cash flow, they had free cash flow of $52 billion for the full year. That's more than enough to cover their dividend, with a lot more left over. And this is a case where this is a company, again, very early in its dividend paying days. The company is also was in the midst of a $50 billion share buyback. So, with all that cash, they're putting it to good use. They have a lot of shareholder friendly policies. They're buying back shares. They're boosting their dividend. And I think this is an opportunity for investors to get into a good growth company that also pays a dividend.
Yeah, and just as a reminder, free cash flow is the cash flow left over after they spend on capital expenditures. So you've heard that they're spending tens of billions of dollars this year on CapEx. So this is the cash left over after they spend on that. So yeah, I agree. They have a lot of cash to pay a decent dividend. It looks like I'm guessing they probably will keep bumping that up in the future. And also as a reminder too, a company, with the exception of a real estate investment trust, like some of these data center REITs, they can take away their dividend at any time. So a lot of companies like IBM and Verizon will increase their dividend every year to give investors confidence that they can keep paying a dividend. Like I said, I'm not sure that's going to work long term in Verizon's case, but such strategies tend to boost investor confidence in a dividend. So that's kind of a workaround they have. Again, the data center REITs or real estate investment trust, they have to pay a minimum of 90% of their net income in dividends in order to avoid paying taxes on their operational profits. So those will probably keep paying dividends even if they have to cut them back for whatever reason. But other companies, that they can go away at any time, so you always have to be aware of that. And we are getting some questions related to dividends. Besties asked 13 minutes ago, is Broadcom, symbol AVGO, a dividend play or an AI and growth stock? The stock has run up lately and the dividend yield has come down. Can top of the line still grow while growing dividend? The short answer is I think so. And Broadcom has actually been a stellar dividend stock. I think they paid their first dividend in 2010. And if you've owned the stock since the beginning, you're making more in dividends every year than your original investment. So just looking at their track record of dividend increases. Now, keep in mind they had their 10-for-1 stock split last year, so factor that in. But they this last year they raised it from 53 to 59 cents, so a little bit more than 10%. And then the splits happened, and so at that time the quarterly dividend was $5.25. The year before it was $4.60. So they have a very long track record of dividend increases exceeding 10%. So with those increases, they've been able to really return cash to shareholders over the long term. Looking at them right now, the dividend yield is 1.2%, which yes is actually below average. However, I think that probably increases the chances that there's going to be a significant dividend increase this next time. So that's something to watch out for. Judging by the record, they usually increase their dividends sometime in the fall every year. At least they've kept that pace for the last year or so. I don't see why that would change. But yes, it will be interesting to see how much Broadcom increases its dividend when that time comes.
I wanted to share my screen here for just a minute because I think it helps to illustrate the point that Will was making. If you look at this chart, it shows you, Broadcom's dividend payments, and just going back to 2010, Broadcom has increased its dividend by 8,330%. Which is an impressive increase there. Not only that, but I'm going to pull up their dividend yield and their payout ratio. Let's change this back. And you can see that, right now their dividend is about 59 cents. Like Will said, the dividend yield is about 1.14 that Will talked about. And we talked about that payout ratio a minute ago. The fact that, it looks like it's 100%, but that's actually a function of, those non-cash items, the tax provisions that they made for bringing that intellectual property back to the United States. But, this is a pretty fair dividend pair, but I also want to look at the price here because, Bestie, I think you're absolutely right. If you look at the change in the stock price, it's up 12,000% since 2009. But even if you look much more recently, the stock has gapped up over the past 5 years by almost 900%. And the biggest chunk of that, which is this part, since early 2023, is because it is an AI play. And because, that it has a lot of the semiconductors that are used in AI and in data centers. And so I think the answer to that question is yes, it is a dividend play. And yes, it is an AI and growth stock. Yeah, the dividend yield has come down. But for investors who have held this stock already, their yield based on the price that they paid for the stock is going to be much more impressive because what you paid for the stock doesn't change. Meanwhile, the dividend continues to go up. So I think that's a great question. And in my opinion, I think you can make a strong case that yes, it's a growth stock and yes, it's a dividend play as well.
And I have nothing to add to that. That's the perfect explanation. Yes, it started. Yeah, it would have been hard to invest in it early though, because I think it was based in Singapore when it first IPO'd. It IPO'd under a different name, Avago Technologies. It bought the old Broadcom in 2016 and then adopted that name as its own. But as you can see, never changed its stock symbol. But it hasn't. It really wasn't on the investors' radar, I think, until they moved the headquarters to Silicon Valley a few years ago, or maybe a little bit before that. So that's kind of unfortunate, but that's how it goes with a lot of these.
Yeah, Besties looks like Besties is doing their best to keep our queue funded with questions. So Besties ask, I'm going to change tack here for just a little bit. Is now an opportunity to add Toast, ticker TOST, or is it not a good time considering the sentiment? When I am enthusiastic about a stock, I generally buy the stock. I keep it in my portfolio. There can be times when the stock price goes down because of investor sentiment, because of geopolitical factors, because of macroeconomic factors. There's lots of reasons that the stock market goes down, and there's lots of reasons that stocks go down. But generally speaking, I think Toast has a very good opportunity in its space. If you think about the restaurant as an industry, the restaurant industry, there are a lot of restaurants in the United States. I'm going to take a look here because they have a really good presentation on their website that lays out some of the metrics that I think are really compelling. Let's see, go to their investor relations website. I'm going to pull up their presentation here.
Yeah, this has been one of the more interesting fintech plays, at least in the U.S. Danny and I yesterday talked about international fintech, as a lot of the fintech opportunities in the U.S. have dried up. And I think Toast is one of the few exceptions, because they've created this niche in the restaurant industry that makes them competitive over say a Block that does more generalized fintech for businesses.
Yeah, so I think what I'm going to do is I'm going to go ahead and share this while I look through, the items in this investor presentation. Here we go. I'm going to share this. So they talk a lot about, being obsessed with customer success. Their origin story, they started off with mobile order and pay. They've got social experiences. They handle wait lists. One of the things that I see is that, they were actually built to handle the needs of a restaurant. They're referred to as the restaurant operating system. So they not only handle, things like, being inventory ordering. They handle, delivery services, the hostess duties at the front, helps, keep the menu current. They handle payments for the servers. So there's so many things that this company does. I'm going to change that a little bit so we can see it a little bit better. And they have consistent increases. But here's the slide that I was looking for. So the U.S. restaurant sales have increased by 5x over the past 30 years, which kind of gives you an idea of the market that they're serving. And the annual sales of restaurants are expected to be about $1 trillion. And 1 in 3 Americans have worked in a restaurant. I can't speak for anybody else, but I have actually worked in a restaurant. This slide shows that the total addressable market, there are 875,000 restaurant locations in the United States. And right now, Toast is only serving about 13% of those locations. So that kind of gives you an idea of, just how much of an opportunity that Toast has. Now, whether or not now is a good time is really an individual question for investors. As you know, we cannot give personalized investing advice. What I will say is that Toast has done remarkably well at gradually expanding, its locations, gradually increasing. It has what's called a land and expand strategy. So, for instance, they will go into a restaurant and they will use their point of sale devices so that customers can check out at the restaurant. And then once the restaurant finds out how well that works, and the salespeople come back and they, sell them on how well their system is at scheduling employees, how well the system does at managing inventory, how well the system does at helping reservations, how well the system does at helping with these deliveries. And so I think this is an important thing to remember, is that the company is gradually but consistently moving further and further into the space. Now I'm trying to pull up a chart here. Now the company, let's see. So their price to sales ratio right now.
Yeah, I just pulled that up, actually. That is 4.4 right now, which over the last, say, 3 years, a little bit higher than average.
And yet on a forward basis, their price to sales ratio is down closer to 3. Now, dirt cheap territory is when you get down to where your price to sales is between 1 and 2. So it's certainly not there yet. But one of the things that, an opportunity, I'm going to take a look here just really quickly and see on a trailing 12-month basis, their average price to sales ratio is about 4.5, and it's about 4.3 right now. So that kind of gives you an idea that, that it's well down off its high of about 24, which is what it was going into 2022. So it's much more reasonably priced than it has been. So I think this is a case where this is, in my opinion, this is definitely one to watch. Whether or not now is the time to buy depends on, how much risk of volatility you're comfortable with, whether or not, how that fits into the overall construction of your portfolio. But I have certainly been looking at adding to my position in Toast here probably in the near future.
Yeah, it's a very interesting one. I was worried about this initially because the restaurant industry has so much turnover. It's true that if there's a recession, I mean, they're probably not going to stop using Toast services. But if the restaurant closes altogether, that obviously does hurt the company. That this is a very high turnover business. I do think the growth right now and probably for the foreseeable future is fast enough that this will be less of a worry. But it might be something to keep in mind as this company matures. So yeah, we are getting some good questions. Well, actually, we had one from Bessie's about Toast, which I'll hit quickly. Why do you go to price of sales as a metric? Why not forward PE or other metric for valuation? I mean, I think it just recently became profitable because there was no PE at all. The forward PE was like 40, which actually, I mean, Danny probably could have used that too, because that I think that's a metric you can work with, and that kind of maybe indicates a fair or maybe even arguably a slightly low valuation considering its growth. But if you have a forward PE that you can use, it certainly is another metric you can go with. It really kind of just depends on where a company is in terms of profitability as which metric you might use. And so I think that's why Danny chose price to sales.
That is indeed why I chose price to sales. If you go into Y charts and look for a P ratio for a company that is not yet profitable or only recently turned profitable, you're not really getting all the information. What you need is at least one full year worth of profitability before those numbers will mean anything. And so in this case, Toast only went public. Let's see, when was Toast's IPO? It hasn't been very long ago. September of 2021. And if you think about what's been going on since late 2021, you had an economic downturn, you've had a lot of inflation, and you've had, restaurants struggling to keep their same-store sales numbers up, to keep their revenue growth up. And consumers who have been having to make decisions about where to spend their money. How much am I going to spend at the gas pump and how much am I going to spend at the grocery store and what's left over to go to a restaurant? So nobody could have known, of course, that, 2 months or 3 months after Toast went public, we were going to have an economic downturn, which is one of the biggest reasons why the company has not been profitable up till now. But recently turning profitable is something that I was certainly watching and something that I will continue to watch. And I think that, as we watch that growth trajectory going forward, that's going to be a much better indicator of the company's potential as we look ahead.
Yeah, so it looks like Danny and I gravitated to the same question from Karen Wyatt. So I'll say it and let Danny answer first. A very newbie question. What's the incentive for a company to pay a dividend versus using that cash for acquisitions, et cetera? And that's a great question, actually. So since I'll let Danny start off, and I might have things to add when he answers.
Sure. So, when you think about in terms of acquisitions, not every company is looking to go out and buy another company. They might like the trajectory that their business is going. They may not feel the need to, bolt on another business. There may not be any attractive opportunities out there. There are certainly companies out there that are very acquisitive, and they go out and they buy company after company after company. And there are others that, they can go their entire existence without ever buying another company or acquiring another company. Now, in terms of a dividend or really any type of, capital return to shareholders, generally speaking, businesses tend to focus on their growth story first. So, for instance, we were talking about Meta a little bit ago. Meta, since the company went public, has been focusing on its growth. Let's see. Meta went public in 2012. So it's been public for about, going on 13 years now. And the company continues to grow its revenue. It continues to grow its earnings, and it perhaps has gotten to the point where it is earning more than it can turn around and invest back in the business. And when a business gets to that point, then they may not continue to, some companies will say, okay, well, we're going to buy back shares, and we'll do that as a way of returning capital to shareholders. And once they get to a point where they can consistently and reliably forecast what their earnings are going to be, what their cash flow is going to be, and they just have no other growth venues or not sufficient growth venues where they can spend all of the capital that they are raising, all the cash that they are generating, then they will generally turn to paying a dividend. Will?
Yeah, and also, the dividend is a signal to the market. For example, if you want to show that you're a strong company, you might pay a dividend to show you have a lot of confidence in your financials. You might also pay a dividend as sort of a stabilizer. If you know you have that dividend, you're not going to take some of these chances that a growth company might take. So it does serve a purpose there. Or as Danny said, I mean, there's just not a lot of other great options for what to do with their cash hoard. So they return some to shareholders. All of the above can be great reasons to pay a dividend. But back way in the late 19th century, early 20th century, before there was a Securities and Exchange Commission, companies did not publish their financials to the public. So often they would pay dividends to show the public that this is a strong company. Of course, that could be a fraud long term because you could always pull back a dividend. But that was a strategy they used to exhibit confidence. And I think that's still used today to an extent, even though we have a lot more visibility on the financials today.
So we have another question from Besties. This was about from 31 minutes ago. Do you invest in tech because of tech dividends or because of dividend growth? What tech can grow its dividend over the long term? And a comment that Verizon is not really tech. Okay, tech, telecom, we kind of group them together here. From my perspective, when you look at my portfolio, I primarily buy technology companies because I see the potential for long-term capital gains in those companies. And if you go back and look, one of the things that you might see is that many of the companies that I bought before they were dividend payers. Apple's a great example. I owned Apple stock before they decided to reinstitute their dividend in 2012. I've been holding Meta Platform stock for probably a decade, and that was well before they decided to start paying a dividend. Alphabet's another one. I have owned Alphabet stock for a long time, and they only recently decided to pay a dividend. NVIDIA is a company that you don't really think of as a dividend stock, and they're not really focused on their dividend. But they instituted that dividend a while back, and they increased their dividend. I think they raised it by a significant amount. I think they doubled it when they had the stock split last year. And so that's another company. I have a lot of dividend payers that didn't start out that way. Now, when I, bought stocks and I thought, okay, well, here is a company that I think has the potential for capital gains and also pays a dividend. So Starbucks is one of those. Disney is another one. Hasbro is another one. I bought those stocks years ago. Hasbro, the capital gains on the stock has been next to nothing. And so what I've gotten out of the deal is the dividend. And actually, once upon a time, Mercado Libre owned or paid a dividend. And it did that for a short time. And then they realized that they wanted to have all of their funds available in order to grow that business. They saw many growth opportunities that remained untapped, and they decided to stop paying that dividend. So, yeah, generally speaking, I buy tech stocks because I think they have the potential to go up and to the right significantly. And the fact that sometimes they decide to pay a dividend later on is a delightful bonus to me.
Yeah, and I pretty much take that same strategy that Danny does. And I to be honest, I suggested this topic to Danny despite that, because when you look at tech historically has been mostly growth stocks. So other than maybe IBM or Texas Instruments or AT&T and Verizon, there really wasn't much in the way of tech dividend stocks, or at least not any tech dividend stocks that paid a significant dividend. But as some of these companies matured now, so you look at NVIDIA, Alphabet, Microsoft, those are Amazon. Those are companies that have pretty much matured now. Now Amazon doesn't pay a dividend still, but as a company matures, that's the time they tend to add dividends. So I think you're going to see more and more tech dividends in the future. Like Danny, I'm still investing in tech primarily for growth, but I think as the years go by, you're going to see more investors turning to tech for dividends. So it's something that investors should watch out for.
So we have another question from Besties, and I bet Will has perhaps a different answer than I do. So what current tech growth stocks not paying a dividend and could potentially pay one in the short and medium term? For me, I look at the FANG stocks and the Magnificent Seven stocks to kind of inform that. And of those, as Will said, Microsoft is already paying a dividend. Apple is already paying a dividend. Alphabet is already paying a dividend. Meta is already paying a dividend. And that only leaves a few. And so I think the one that will probably pay a dividend over the short to medium term, there's actually two. The first, I think, is Amazon. Amazon has not said anything publicly about paying a dividend. But I think this is a company that as their cloud growth increases, they generate a lot of cash flow. They have some really consistent businesses. I mean, once people sign up for Amazon Prime, they tend to stay there. I think the retention rate, I read somewhere that Amazon was somewhere in the neighborhood of, or Prime customers retention was somewhere in the neighborhood of like 85 or 87%, which is phenomenal. I think they have the means. I think they have the opportunity. I think Amazon is probably waiting to see how AI plays out before they decide whether or not they're going to do that. The other company that I could see potentially paying a dividend before terribly long is Netflix, ticker NFLX. Netflix turned from being a cash burning business several years ago to a cash gushing business now. Now the company continues to spend, I want to say somewhere in the neighborhood of $9 billion a year on content, but they're generating a lot of cash flow. And I think that they will get to the point, particularly now that they have moved into an ad-supported tier, that they will continue to generate a lot of cash flow, and they will make the decision, probably not over the next year or so, but I think they will eventually pay a dividend. Will?
Yeah, I'm actually mostly in agreement with you. I pulled up the largest tech stocks, and you look at them, and most of them pay a dividend. As we both say, the obvious exception is Amazon and maybe Tesla and Netflix. So, but yeah, just if you look at the top 20, at least the ones that aren't based in China, I think all the others are pretty much paying a dividend. Also, there was Cisco, which I used to own Cisco back when it was a hot stock. They were, diametrically opposed to dividends, but now they're actually a decent dividend payer. They got new management at some point. They changed their philosophy on dividends, and that's actually been a decent dividend stock that now pays 2.7%, which is double the S&P. So that looking at these stocks, I mean, well, Palantir, but that's a fairly new company. Qualcomm, maybe AMD. But yeah, you have to really start going down the list to really find ones that aren't paying dividends. So some of these companies are like I said, they're starting to pay dividends. The sector typically isn't as good as other sectors like say energy or utilities or something like that for dividends. But as I said, I think that will change in the future. And so with that, we are at time now. We're at the top of the hour. So we have next is Brian Orelli and Bernd Schmid making their bold predictions. And here they are.
Here
we are. Good evening.
We're ready to break the rules here. So
I'm curious to hear what your bold predictions are there, guys.
Yeah, we've got
full on.
All right.
Full on.
Hey, Burns, how's it going? You're on mute. There you go.
I'm on mute.
You're good.
You're good. How are you doing?
Good. So you want to start us off with your first bold prediction?
Well, happy to do so. Maybe a quick pre-frame. I think you probably don't have as much clue about what I'm talking about, and I don't have as much clue as you about what you're going to talk about. It's going to be really interesting. I'm looking forward to these questions, and also if viewers have some questions, I'm looking forward to this. My first prediction is a bold one. I think it is that Beyond's market cap is going to at least quadruple in the next 2 years, and right now the market cap is about $250 billion. So we are looking at $1 billion. And why I think that's going to happen? I think the market has been just extremely negative over the last year. The business is not doing super, but it's doing fine. There's actually more than $3 of cash on the balance sheet. It's a $5 stock if you buy it, so you get 60% of that already in cash. Gross margins are improving, so the core business is actually doing better than the market thinks. But the actual thing is, on top of that, Beyond owns quite significant stakes in blockchain businesses, and they are doing really, really well. But it's not publicly visible because they're not being reported very well. However, I don't think the market will be able to ignore these for much, much longer. Especially one business, a grain chain, for example, Beyond owns 30% of that company, according to the latest filing. And this company is growing, basically doubling its revenue every year. This year, one in core investors predicting about $100 million in revenue. So 30% of that attributed to Beyond would be 30 million. It's already 10% of the market cap. And remember, this company has doubled its revenue in the past couple of years. And I don't think this is going to change that soon. It might slow down, but there's very strong revenue growth. And the market won't be able to ignore that much longer. And also, actually, what I like most, the new CEO came on board 1.5 years ago, Marcus Lemonis. He's compensated with nada. He doesn't own any base salary, but he's going to be rewarded if the stock hits $40. $40 is 8 times from where it is today. I think it's a realistic goal. Maybe not in the next 2 years, but I think the next 2 years, 4x is very possible with this CEO, with this excellent operator on board, a business that is improving, and blockchain businesses behind them that are going to be have a chances to be so big to even overtake Overstocks. Oh, I'm talking about Overstocks. Beyond it used to be Overstock. They changed the name 2 years ago. Forgive me for saying Overstock. When I say Overstock, I mean Beyond. But these blockchain businesses, some of them might be even bigger than what Beyond is right now.
So what do you think is the best metric for looking at Beyond stock? Is it price to sales? Is it price to earnings? Is it, some other metric for valuation?
Yes, for value, I would look at the book value, but the book value is grossly undervalued right now because all these blockchain businesses, they're basically valued at cost or even lower. So you don't see the grain chain business growing. You don't see in a balance sheet. So in fact, you can actually not really see these numbers in the balance sheet of Beyond. And I think that's one reason why the stock right now is so low. But at some point, it will have to be valued upwards.
And so where do you see that the valuation can change? Is it that the valuation metric will increase or decrease, I guess, so that the valuation actually increases? Nothing has to change, but the valuation metric goes lower, or are you expecting the valuation metrics to increase?
It will absolutely increase, in my point of view. The book value itself will increase in a very, very delayed way, right? Because if you invest into a company as a public company, as Beyond has done, into all these blockchain businesses, you have the value of this company basically in your balance sheet is only basically the price that you paid for that company. But these companies were bought years and years ago when they were super small. And so you don't see this right now reflected in the balance sheet. It will have to be in the future. Once the market sees the value of these companies, the market will recognize that the current value that they pay for the company might reflect the value of the core business, the retail business, the home business, right? They're supplying home furnishings, etc. But the value of all these other businesses that are behind it and that you own a share of is reflected with zero. And I don't think this will stay that way.
Yeah. So how do you see the overall valuation changing? So let's say, assuming your prediction is correct and that they 4x in 24 months. So what would you see as what if we're looking 24 months in advance, what do you think that has happened at that 24-month time frame that has resulted in the capitalization changing, market capitalization changing going up 4x?
Perfect question. Yes, thank you for that, Brian. What will change is that the market will start to recognize. So it's basically investors seeing the value of these companies. Marcus Lemonis, the CEO of Beyond, held a Twitter Spaces on the 1st of January, where he said, we made one mistake. And even the previous management made one mistake. They didn't understand how to integrate the technology business, all these blockchain businesses, together with the core business, because they're basically not related. However, they can be used with tokenization. That's one thing that they do I didn't even mention. But also in a way that they will help these blockchain businesses with their technology know-how to accelerate the growth. I don't know, doubling the revenue every year is already good enough. But this won't be, as I mentioned, not reflected in the financials directly, but once the market hears Beyond talking about these businesses in a more direct way. I also mentioned that in the previous earnings call, if you listen to them, these businesses were not really mentioned. They were kind of ignored. And that's why the market doesn't know about them, ignores them. But this will change. They cannot be ignored. They're so big right now. Some of them might be bigger than Beyond in just a year or two. And so they will be talked about in the earnings calls. And I think valuations will be given to them by analysts.
All right. So our polls are open. If you're in the Slido, the code is Fool24, so you can vote there. You can also ask questions if you have other questions for Burns before we close out this prediction. And so we're doing well. We got another minute or so, and so if you have questions, get those in right now. And then maybe my final question is let's say, so your predicting that the market's going to change their like sentiment, basically, right? So if that doesn't happen, you think that, I mean, that seems to be your main argument here, right? So how much of it is sentiment, and how much of it is potentially the company is going to change their outcome, and then that's going to change the sentiment. It's
It's 100% sentiment right now where the stock is right now. Actually, a year ago it was still trading at $20, which would be the 4x from where it is today. So the stock would only need to go back to where it was a year ago. Right now the sentiment is so bad. I'm actually not sure what the market is actually thinking. Is it thinking that Overstock is Beyond is going to go bankrupt? So it's absolutely the sentiment is the key driver behind all of it. Once people will see, and that they're actually, I'm not the only one, right? It sounds like I know something that others don't. Much of the information is public. Some of it is a bit difficult to find. For example, the revenue numbers of Grain Chain, they are not in the earnings calls, but they're out there. And I believe once the markets, especially CEO Limones is starting to communicate more directly in its earnings calls with analysts about the development of these blockchain businesses, how big they are going to get, that will change, in my view, the sentiment of the investors.
all right. And then Besties asks, Limones, was he the CEO of Camping World? Is that the same company?
That's right.
Same
That
person?
Yes, he still is.
And
I think
any
chairman and
thoughts
CEO.
on his experience with Camping World, and how you think that's gonna help him in beyond?
That's a great question. So what I saw in Limones already before, he's just an excellent operator. He knows which metrics to tweak, what to look at, how to optimize marketing, deriving strategies, and really putting a business on very, very solid footing. And I haven't seen that for Beyond in the previous management. I actually was quite convinced, but the reason for the name change is that they did acquire assets from the Bed Bath & Beyond bankruptcy for a very low price. I think that was a big bargain. But the integration of that, and also how they changed the marketing, it was a big mess that they created, in my point of view. And that is also actually one reason why outside investors pulled Limones in and said, hey, look, here's a company. It has such a solid foundation. It has all these other assets, but we need somebody to really operate that in a very efficient way. And you're the right guy. I'm glad he accepted. And I do think he's going to show that with Beyond.
All right. And then one last question from the audience, and I will then make my prediction, and might make my, whether I think my prediction agrees with you, and we'll read out the poll. So anybody who's looking to vote, please vote in the Slido app. The ticker, the thing that you want to enter after you get into Slido is Fool24. And so then Dizzy Fool says on Beyond is the thinking that there's been an overcorrection and the stock has been a crash from here.
Yeah, that is not totally just because the market changed sentiment just out of nothing. It is really when Limones came on board 1.5-ish years ago, he made very, very bold forecasts. He was extremely confident, and I think overconfident. He didn't manage to change as much as he anticipated to change. If you look at the stock price from the time on when he joined Beyond, the stock actually almost doubled, I believe, from 20 to 40, roughly. And then suddenly the market, and I also had to realize I was also one of these, okay, now it's going to change, but it was not the time. It actually got worse. They also had to divest. That is part of basically cleaning the business. They're making it now very clear. I think the strategy is clear, but that had to result in selling assets or at least, shutting down certain business segments. And this disappointed the market. And so I understand that the stock has gone down a lot since, but yes, I do think as the market is, it overreacted by way too much.
All right. So let's move on. I'm going to vote against you. And I'm going to say that the Beyond's market capitalization won't 4x within the next 24 months, mostly because I feel like the main issue here is market sentiment. and I'm not 100% convinced that market sentiment is going to change. And then if we're looking at the poll in Slido, it looks like they agree with me that they disagree that the market capitalization will increase 24 months, will increase 4x in the next 24 months. So we'll move on to my next prediction, or my first prediction, which is, pull mine up. So my first prediction is that Pfizer's, the ticker there is PFE, won't cut its dividend in the next 3 years. So the dividend yield is currently at 6.56% as of the close today. The company in 2024 issued $9.51 billion in dividends, and they had an operating cash flow of $12.74 billion. So that's a $3 billion difference between the dividends that they paid out and the operating cash flow that they brought in. I mean, obviously there's some in addition to the operating cash flow and the dividends, there's obviously some CapEx that is is in that prediction. And if you want to be like a total bear, you could argue that the dividend got up to 12% in the early 1990s, and before the company Pfizer cut its dividend, and after it acquired Wyeth. So the difference there that I think that obviously history says that if it gets high enough and there's not enough money to pay the dividend, obviously they're going to cut the dividend. So they've since they cut the dividend, they've obviously, it's grown back in the past, and most recently they've only been increasing it by a cent per quarter per year. So every year they've been increasing it by about 4 cents. So not much increase, but I think that they will continue to at least keep it level and probably increase it over the next 3 years. And they don't seem to have much like downside. There doesn't seem enough downside compared to how they were when they cut the dividend previously, where Lipitor was a major. I mean, Lipitor faced generic competition, and Lipitor was a major contributor to the top line growth and the top line sales. Where now they are facing some patent issues like they had in Lipitor, but they're smaller drugs, and there's a couple of them. So, a couple of them combined is, somewhat close to the sales of Lipitor, but the sales of Lipitor back then were much higher than the sales of the drugs going off a patent right now. So I think that overall, I think the dividend feels very safe.
When was it that they cut the dividend the last time?
Let me look. I don't know off the top of my head, but I think it was it was in 1990s. So it was in conjunction with the Pfizer acquisition of Wyeth. So let me see what that was.
Oh, so it's a really long time ago. When I'm trying to, while you're looking up, I'm you got it?
I don't have it, but go ahead.
During this, call it 20 years or 25 years since they haven't cut the dividend, did they have stronger periods where so it sounds like they're paying out almost 70 to 80% of the operating cash flow that they have as a dividend. I'm wondering if in the past, has it been the case that they continued maintaining that dividend despite operating cash flow or other such metrics decreasing substantially?
Yeah,
And
so
let me also add to how I also mean the question is, say operating cash flow went below 9 billion next year. Would this lead them to cut the dividend, or would they say, no, we want to keep our dividend history, we take this 1 year, swallow it, and we'll pay out the dividend?
Yeah, so the Pfizer acquired Wyeth in 2009, and that's when they cut the dividend. And it was, I mean, everybody thought that the dividend was going to get cut because they had Lipitor that was coming off patent, and they knew that the earnings from Lipitor, the cash flow from sales of Lipitor were going to be decreased because they were going to have generic competition, and so they were expecting that the dividend was going to decrease, and that's the reason why the dividend went up to 12%. Everybody, I mean, the dividend yield is only defined by the past, right? I mean, it's not defined by the future because we don't know what the dividend is going to be in the future. So the dividend yield in the past was 12%, and compared to what it is right now, which is 6%. But in the past, I think everybody was accepting the fact that the dividend was probably going to get cut, and so that's the reason why the dividend yield went up, which was caused by the price going down, right? So the price went down because the past dividend, is what it is, right? That's a fact, right? So the dividend yield is based on the fact of the past plus the current price, and the current price is determined by what do we think the dividend will be in the future. So in this case, the dividend, everybody thought the dividend was going to get cut, so everybody was factoring in the dividend cut in the future, and then if you look at the dividend yield, that's based on the dividend in the past. And so you can say the dividend, the dividend yield was 12%, but that was only based on the fact that investors were expecting a smaller dividend in the future. And then that turned out to be the case as they acquired Wyeth in January of 2009. And then that resulted in them cutting the dividend. And I think that's the last time they've cut the dividend. Since then, so I think they cut it in half there, and then they've raised it since then. Sometimes only by a penny per month per quarter, so 4 pennies per year. But so I think that they've made the at least inclination that they will continue to raise the dividend in the future.
Okay, and if the company were to struggle in the next 1 to 3 years, call it operating cash flow suddenly being cut in half, do you think they will maintain the dividend if this were to happen?
I mean, yes, but I don't think that their operational, revenue is going to get cut in half, because it's a pharmaceutical company that has pretty much fairly steady revenue. So I don't really see that happening. But yes, if the revenue got cut in half 100%, they'd probably cut their dividend. But I don't really see that as being a likely occurrence.
Okay. So as I understand, your prediction is basically this is a very stable business. It will continue to throw off cash, and because of that, they will be able to continue to maintain their dividend.
Yeah, exactly.
Is there, what are the biggest risks for the business? I think Pfizer probably, I don't know their financials really, but I imagine they got a big boost through the 2020 to 2022 years, the COVID years, maybe with the vaccine.
Yeah, they had a COVID-19 vaccine, and they had a COVID-19 treatment. So both of those definitely generated additional sales. And so that increased the valuation slightly, but also didn't increase the valuation as much as the revenue, right? So if you look at a price to sales ratio, it went down over that time frame, even though the revenue was going up, right? The sales was going up, and that's because everybody assumed that those sales were going to happen forever, and so they were expecting those sales to come back down. So I don't think the valuation has really been horrible compared to the overall the valuation on a price to sales ratio or a price to earnings ratio hasn't come up as much as the valuation would have if you incorporate all of those sales. If you assumed all those sales were going to continue forever, which I think investors haven't, and I think that's the right idea.
Got it. Do I should make a correct assumption if I think that Pfizer is not really, Pfizer's financials call it revenue, cash flow is not really dependent on one drug or on a small subset
Yeah,
of drugs?
no.
So
I mean,
that
they
if-
have, I know they have 20, 30 drugs over the, and so, it's a large pharmaceutical company, so they have a lot of drugs, and the sales, the sales are going to be determined by the, obviously the, sum of the total, and they have some drugs that are going off patent, not this year, but maybe in the next 2 or 3 years. So that's sort of driving the valuation, so that people are, if you look at a price to sales ratio, the valuation has come down, and that has driven up the yield, the dividend yield, because the dividend has stayed the same and the price has come down, right? So if the dividend's the same and the price is lower, then the dividend yield is higher, right? So the question is, will the price continue to stay that high? And then will the dividend yield continue to stay that high, right? So if both of those stay the same, then the dividend yield will stay about the same, and my prediction will come true.
Last question. So these call it expiring patents over the next 3 years, do you have a rough idea of what percentage of revenue would be affected? So all these drugs that are
I don't have it off the top of my head, but it's a smaller percentage than when Lipitor went off patent, right? So when Lipitor went off patent, it was, I don't know, maybe pushing 20% or something of the revenue, but it's about the same amount that Lipitor was, so in the $10 billion range over the next couple of years. But one, it's over the next couple of years. Two, Pfizer's sales have increased since 2007, when Lipitor was going off patent. So therefore, the 10,000-ish dollars is a smaller percentage of the overall. And then so I think that the issue is not as big of a deal as it was when the last time they cut their dividend.
Got it. I think, it's such a well-diversified business, generating strong cash flows and probably relatively consistent. So with all your assessment, I would agree. I think it's too strong, even a business, for it to cut its dividend in the next 3 years. I'm really curious to see how that plays out. I'm looking, I didn't see any questions. If you could help me, maybe I oversaw something.
Yeah,
But
looks like
with
the poll says 70% says that I agree with the pharma giant. So agree that Pfizer's dividend won't get cut, and there's 20% that say that the dividend might get cut, and 10% that say they need more information. So everybody, most of the people agree with you that 70%. 70% of the people think that Pfizer's dividend won't get cut. All right, so let's move on to your second.
Sounds like we have. Yes.
Let's move on to your second prediction, which is that Bitcoin won't cross $150,000 per year this year. So what are your thoughts on why you think that that's the case?
I think that was a communication mistake. My prediction was the opposite. I think it will hit 150,000 and probably surpass 150,000 even this year.
I think that's what I'm sorry. I thought that's what I said. Yeah.
Okay.
Yeah. Bitcoin will cross 150,000 this year. So what's your what is your thought there?
It's the major thing is macro, that I think right now the economy in the US is struggling quite a bit, especially due to Doge savings, all these things. If you look at airlines, they have to cut their forecast strongly, even though in January they said we will have a great business in 2025. So there will be a strong struggle I don't know how strong, but there will be struggle in the US economy. And what I think this will lead to, it will to be a lowering of interest rates, potentially money printing again. We just had 2 days ago, or was it even yesterday, I believe, the Fed even tapering its QT from 20 billion a month or day. I don't look at this very often, to 5 billion. I think that was a strong move. So they're still withdrawing money from or adding to its own balance sheet, but I think this will reverse. And if you look at correlations of the past, whenever financial conditions loosened, Bitcoin went into its parabolic state. And I think this is where we're going to go at the second half of this year, maybe even earlier. The second reason is suddenly in November, there was such a magnificent shift from we don't like Bitcoin. Actually, we think crypto is dangerous. I'm a bit over-exaggerating here in the US, especially the biggest economy in the world, to an administration that's very pro crypto and even saying we're going to have a strategic reserve of Bitcoin and other cryptos. And I believe other countries are going to follow. I also believe this opened the gate for institutions that were hesitant, thinking, should I do that? Should I not do that? Like most people still didn't follow Michael Saylor. I think more and more people will follow this, since even the US government is going to do that. And this will lead to a flood of more buying, driving the price higher in the medium term. And I think, these drivers will be strong enough to catapult Bitcoin over 150,000 by year end.
All right. So what's the current price of Bitcoin, and where do you how much is that going to? So it looks like the current price is 84,000. So we're looking at almost a double. I mean, not quite a double, but pretty close. You know, if 75 would be a double. So, you know, that seems like a substantial increase. And what do you think is going to drive that? I mean, so if let's just say the government, you know, puts Bitcoin as the currency that, you know, is the cryptocurrency that is the main cryptocurrency. I mean, I think everybody would assume that 150,000 is probably is reasonable, right? So assuming that doesn't happen, what else could possibly drive the price up to 150,000?
Actually, I do think I should also preface, I'm not really a big fan of Bitcoin. I don't own very much of it myself. And I don't think it's a necessary condition that the government, US government, or even other governments are going to start buying heavily Bitcoin. I think just the announcement and the more positive, news, the next government announcing we're also going to make a strategic reserve, or the next sovereign wealth fund, or another pension fund, which are starting to add Bitcoin. I think just this announcement, there doesn't need to be really the buying, but there will be this shift in liquidity coming at a later point of time that the market is going to anticipate. The market is not going to wait until the US government and all these others are going to throw all their billions and more into Bitcoin, but they're going to buy that earlier. And what will be the major shift in this year, that's why I'm having this year, is really the change in the economy. The outlook has been relatively positive, and I'm not even sure if we're going to have a recession. And I'm not sure if analysts agree. I'm not the best